something has to come up, whether it is that the Iran firing power get decimated, where they surrender, or there are some off-ramps to aggressive diplomatic measures where some sort of things, some sort of in-between way is found where a part of the war continues, but some of the oil supplies gets regularized. And clearing of the Strait of Hormuz will be the option in that. But the second option may be that IEA holds substantial amount of oil as a stock reserve, and the purpose of that to take care of such shocks. So there may be, they hold around 90 days of oil stock generally as their mandate. And in the past, I think 4 or 5 times the oil stocks were released in the market to control the situation. So that can be one of the option. Then the third will be, of course, the 2 pipelines which the Middle East has got, one going to Yanbu and one going from Fujairah for UAE and Saudi Aramco. They can handle around, let's say, 7 million barrels of oil per day supply. But of course, Yanbu port has got some restrictions. So I think some of the measures have to work out on all these things. It cannot happen that you continue like that. Then it will be the world is at the tenterhook. And therefore, I still believe, of course, it is wrong in today's time to believe and hope so, but I still feel that some solution has to come, and it will come. Otherwise, the world will have difficulty.
Mr. Surana, thank you very much for joining us, sir. We hope to continue to speak with you as this situation develops and get your expertise. Because there is so much here, right? I mean, we are, of course, talking about oil, maybe refined products, but oil basically is everywhere. We will, of course, be getting more reactions from other industries as well. Fertilizer, for example, is one important area where a lot of the feedstock goes into. Well, Brent, 26%. We don't see that often, right? 26.5% in a single day. $117 is where we're at. Let's just quickly run you through the interactions which are coming up on the show, and we'll, of course, focus on the big story. We'll connect with Rohit Srivastava of India Charts and Strike Money, and we'll sort of, get you a day-to-day kind of perspective, maybe even a slightly longer-term perspective with Rohit. Rohit, of course, has been very cautious for a while, way before the Iran war started. We'll, at 8:35, connect with Prabal Sen of ICICI Securities as oil prices surge. I mean, the stocks and where they land this morning. 9 o'clock, we'll have Praveen Sahai of PL Capital to decode the impact of gas supply disruption on chip supply from Taiwan. 9:20, Sandeep Chand of Quant Mutual Fund. He's, again, someone who looks at the macro indicators very, very closely and has got a strong view. 9:35, Apollo Hospitals on the impact of West Asia war and medical, patients coming here. And it's about 8 to 10% of revenues for most hospital companies. Following that, management of Suprajit Engineering at 9:45 on their outlook for 27. And Lata speaks with the former SBI chairman Arundhati Bhattacharya in a Women's Day special. Okay, we'll take a break. We are back. Our list of top stocks to watch on the other side.
ये हैं कोटक नियो के तेज ट्रेडर।
निकी इंडेक्स डिप्स एंड स्नैप्स बैक।
ये ट्रिगर गिरावट का है। कस्टम कैंडलस्टिक्स की।
बेचो और बचो।
ये करते हैं शोर को इग्नोर, और ये हौसला जानकारी और तैयारी से मिलता है। स्टे तेज विद कोटक नियो। इन्वेस्टमेंट्स इन सिक्योरिटीज मार्केट्स आर सब्जेक्ट टू मार्केट रिस्क्स। रीड ऑल रिलेटेड डॉक्यूमेंट्स केयरफुली बिफोर इन्वेस्टिंग।
This is Network 18, and you're watching CNBC TV 18.
CNBC TV 18 tracks the pulse of markets and business in real time, bringing you the stories that shape the economy.
From breaking news to sharp analysis, we deliver insights that help you navigate businesses, markets, and investment opportunities.
Nuvama presents CNBC TV 18 Market Central.
providing sharp market intelligence for wealth creation with a commitment to doing it right.
This is Network 18, and you're watching CNBC TV 18.
Welcome back. You're watching Bazaar Morning Call. It's time now to talk stocks. Our research team is standing by with CNBC TV 18's list of top stocks for the day. And the big story is the surge in crude prices. So let's find out how it will impact individual stocks. Sonal now joins in. Sonal, hi, good morning.
Good morning, Reema. Crude oil price hike, of course, that is the big story that we are tracking. 20% higher overnight, and it has crossed that $115 per barrel mark. And if you look at the numbers, it is up 40% in the past week and 60% in the past month, because around 20% of global crude oil is transported through Strait of Hormuz. A lot of major Middle East producers have cut their output due to the West Asian war. Now, it will, of course, impact a whole host of sectors, oil marketing companies, of course, but cracks there have gone higher in the refining segment, but it could impact their marketing margins. We do have the paint companies for which crude is a major raw material, aviation stocks, city gas distribution companies, because gas prices is a function of crude oil prices, and of course some of the commodity chemical companies which have raw material as crude oil prices, all of them will be hit by this increase in crude oil prices.
Thank you very much for that. Let's talk about auto companies and EMS companies. Sudarshan now joins in. Sudarshan?
So all the auto and EMS companies will be in the focus for the next few days, considering the shortage of gas supply that we have been seeing, and that might result in the increased chip price, and also it might reduce the chip shortage. And now you know that amongst all the auto companies there is a demand for the high end of bike, high end of car, and that's the reason there is an increased use of chips. So if there is a reduction in the supply, that might impact, and that will also bring the production down. And if you talk about the EMS company, they are already facing the headwind related to increased price of the chip. So that will also be a problem for EMS companies. And if you talk about Taiwan's, its energy-intensive chip industry is heavily dependent on imported natural gas, and 37% of the total natural gas is support from Qatar. And Qatar has already announced if not the complete stoppage of the production, but they have reduced significantly, and that will impact. And on Friday, and because of this news, Taiwan chip, the TSMC, was sharply lower, and even Taiwanese index was down. So we'll have to see how these auto and EMS companies behave over the next few days, but they will be under pressure because of this news.
Thank you very much for that. Over to Vinny now for more stocks in the news, like Quality Walls.
Hi, good morning. So Quality Walls, they've actually reported their Q3 numbers. Do not forget they demerged from HUL as well. So this is the first time they're reporting numbers individually. Now, net loss they have reported this time is of around 178 crores. We're comparing on a quarter-on-quarter basis. Last quarter was at 100 crore number that came in as a net loss. Now, there's an exceptional expense that is there of around 94 crores. But even if you adjust that, there is still a net loss. So we're expecting red coming in for the stock today. Revenue is down by around 30.5% on a quarter-on-quarter basis. Apart from that, the organic sales that the company has highlighted in the press release, that's at 6.5% decline YOY, while the volume growth is just at 1.2%. So let's keep an eye out on how things pan out for the company. Obviously, summer season will be important for them, but key to watch out for in terms of numbers going forward. As of now, red expected on the screen today.
All right. Thanks very much for that. Well, we've got fertilizer and ceramic companies, as I said, right? I mean, so many areas that oil and oil derivatives and oil feedstock goes into, and this is one. Upasana is here with what she's able to make out in terms of the impact on these sectors. Upasana, take it away.
Well, good morning. Certainly. Now, the LNG supply shortage can impact the overall output for these companies. Now, mind you that the LNG is the primary feedstock for producing ammonia and urea. Now, GNFC has also said that the company's supplier is a supplier of our LNG and has received a force majeure notice from its upstream supplier, which is Petronet LNG. Now, it has also indicated that due to supply constraints, the allocation of our LNG quantities to GNFC under the supply agreement has been restricted to 60% of the daily contracted quantity with effect from 6th of March 2026. This will impact the overall production of the company of neem urea. And for some more context, the Qatar is one of the largest LNG supplier with nearly 40% of India's LNG imports. And the further supply shortage of LNG and higher prices may lead to reduced operating rates and even temporary shutdowns, is what the companies have also indicated. So all in all, we'll be keeping an eye out on all these stocks in today's trading session.
Thank you very much for that. That's the view on fertilizer stocks. Let's do a quick recap then of the top stocks. We're looking at oil marketing companies, paint companies, aviation companies, companies which get impacted by the surge in crude prices, commodity chemicals, city gas distribution companies, fertilizers, ceramics, auto, EMS companies, Quality Walls India. These are stocks which could open in the red. Well, when the GIFT Nifty is down close to about 800 points, even if there is good news, perhaps it's not going to be very resilient today. But let's now go across to Manisha for more details on what's happening in the world of commodities. Manisha.
Well, thank you so much for that. I'm going to stick to the crude oil prices because 100 was a scenario that most market experts believe that will come in dire circumstances. So this clearly is that. All of last week was a 20% gain in case of crude oil prices. And today, a single day open has been at 20%. So the markets are looking at $115 a barrel. Remember, we started this year with almost $60 a barrel. So it has been a strong run-up that we are looking at in case of crude oil prices there. On one side, it is about the U.S.-Israel-Iran conflict entering day 10 and the kind of airstrikes that we have seen, one on oil facilities. But the major scenario clearly emerges out of Strait of Hormuz remaining shut due to the Iran war and the concerns of storage due to supply disruptions, and most of the Middle East producers now curtailing production because of that. So a sharp increase in prices, with markets believing that this could lead to recessionary fears. This could also lead to fiscal strain, especially for India, and this perhaps could have long-lasting impact because this is not a one-day or a two-day like we've seen in crude prices earlier when it went into a negative or a huge positive as well. This is sustaining for almost a week now and could have lasting impact. What we also have seen in the market is, of course, gold and silver prices slipping between 2 to 3%. You have copper down by 2%. Zinc, aluminum, nickel, which were trending higher previous week, also have seen very sharp decline. The strength in US dollar index trading at a 3-month high, and the fact that the safe haven seems to be flowing into dollar seems to be weighing in across metals as a sector.
Thank you very much for that. No place to hide, perhaps, except the dollar index. That's the only asset class which is inched up. Get into a break. On the other side, we'll connect with Rohit Srivastava of India Charts to decode the impact of the West Asia war on Dalal Street.
Welcome back. 30 minutes to go for the pre-open session. Rohit Srivastava, founder India Charts and Strike Money, are with us. Is with us. Rohit, good morning. Good to have you with us here. Thank you for joining us. Just a quick word. I mean, it's a sharp 800 point a cut on the GIFT Nifty. I mean, any way around it? Any way to trade this?
Well, we've had to really fine-tune it down to hourly charts because we did not get much of a bounce last week through Holi, and after that, the market did make one attempt to get back above 25,000. But once we broke 24,600 on Friday, it is setting us up for what we call is a free fall in markets, because it's a larger head and shoulders pattern that we technically call. And therefore, daily charts did not give us any signals. Now it's just we're going to be, tracking hourly momentum cycles and trying to see how many legs down we can build on this. In fact, our market at 700 points still, I think, at the start at least, looks better poised. We should be aware that, some of the other Asian markets, US markets are all opening down with significant gaps. I think US futures more than 2% and Japan more than 6%. Really puts you in a tough spot. And the main reason for this is not just that, that there's a war, but that it would become a prolonged affair. I think that is the risk that markets are trying to price in now.
So Rohit, the advice is don't aggressively sell into the panic open?
Oh, well, see, it depends on what your situation is. I mean, there are traders, there are investors. For most investors, I have told them to hedge. If you're still able to get the 24,000 December puts, that may be a good hedge, to still try. I think through Jan and Feb, we said that, just take on the December 2026 25,000 puts and hang on to them, because we don't know what kind of risk will show up. Definitely war was not in mind, but that's ended up being the case. So that's the hedging part. Now, if you don't have hedges, the only way is you can create some. Second is, if you're a trader, I think there may still be short opportunities, because what is happening is not everything was really falling last week. In fact, till Friday, banking stocks were actually holding up much better in this market. And only on Friday, we saw selling accelerate in banking stocks. So we've seen weakness mostly in IT, real estate. These were the weakest sectors before. Now we are seeing it spread to other sectors. So there will be opportunities in other stocks to trade the short side for people who are, near-term traders with a 1 to 2 or 3 week kind of perspective. You may not feel comfortable with the index since it's already fallen a lot. So that will have to be the approach. Selling stocks from your portfolio is going to be difficult here, especially stocks that are already down. We are trying to, nibble into some defensive areas. So if you're really looking at, deploying cash, then consider either defense stocks, pharmaceuticals, or something in the agro space. Like I like sugar, for example, which can be a proxy to oil, especially given that ethanol would be seen as an alternate, at least for the time being. So these could be contra bets in a falling market, but I wouldn't go significantly bullish just because the market's opening lower.
Rohit, your view was negative, and this thing, of course, this Iran thing happened in the middle of it. So it was not the reason behind your bearish view. But the last time we spoke, I remember I was in Delhi, and you said makes sense to hedge your portfolio because it's very difficult. I mean, we can say sell stocks and sell cash stocks in your portfolio, but that rarely happens, right? Especially if you're sitting for a long time because of hopefully short-term things like this. But you said hedge, and hedge, you said buy the 20, at that point you had said buy the 24,000 or 24,000 December put.
Yeah, 25,000 December puts is what that time I was saying. Now you're well below 25,000. So the only alternative is for people to look at 24,000 if you open close to that.
And have you looked at it? Is it still worth, or is it too expensive now?
No, the 24,000 would not be too expensive. The 25,000 would have, because earlier it cost only around 2% of your portfolio. Now the 25,000 would have become more than 1,000 rupees. So it sort of becomes 4% of your portfolio. So the cost goes up. 24,000 may be a better bet. I know IVs will also spike a little bit, but still, if you get it within 500, 600 rupees, it's still just over 2% of your portfolio if you use the 24,000 puts as a hedge. And you're right, as you mentioned, that, what we don't know is that it's a war which can, easily end on any day if something happens. We don't know what that is. Would US back off from spending too much money? Would they? Looks doubtful they can get a deal through. But anything that gives hope is what we were thinking at least last week. Now it's not clear what is. So that is why you can't panic sell into these things. But at the same time, you have to be hedged because you don't know how long it's going to go on. And as long as it's going on and you don't know who the victor is, our markets would remain in turmoil.
Rohit,
just let me get in Prabal Sen as well. He's energy analyst at ICICI Securities. Prabal, good morning. Good to have you with us here. Thanks for joining in. And Rohit, of course, is still with us. So Rohit, just coming back to you. But Prabal, as an analyst, right, it's a red letter day in more ways than one. So just first top-down thoughts on this shock, and this is the definition of an oil shock.
I think we had pretty much highlighted the same thing in a note that we had published last week, where we were looking at the possibility of crude continuing to sort of remain constrained in terms of supplies, and therefore that reflecting in pricing. I don't want to say that, we predicted price would go to this level because it was impossible at that time. We were still working on the prices that were prevailing last week at around $85 to $90. But the fact is that 20% of global supply of oil as well as LNG getting out of the market is all, and the fact that now it does seem that the shutdown of the strait is going to be longer and more difficult than what people estimated. And I think that is what is basically now coming and reflecting in the markets at this point of time. This is slightly different than what happened during the Russia-Ukraine conflict. I think there I think the alarm was probably raised earlier. Crude rose much faster, much quicker. Here it has been a slow sort of burn in many ways. But now I think the market is starting to price in that this conflict is not going away anytime soon. And I think that is what is the major worry at this point of time.
For oil companies, in your list, in your coverage universe, Prabal, how do numbers change?
I think, basically, if you look at it, all the OMCs, obviously, a base case assumption would be that this kind of an increase will not really be passed on seamlessly to the customers, whether it is in petrol or diesel prices, and end product prices in ATF and other products might still change. But as far as retail margins is concerned, if this kind of a hit cannot be passed on, then basically what you're looking at is losses similar to what happened in FY23. If you remember again, post the Russia-Ukraine conflict from April 22 onwards, there were literally no price changes in petrol and diesel. And that led to very, very large losses, and I think that is the kind of level, where losses for HPCL, for example, on a net profit level could be, as high as 90 rupees or so. As per our scenario analysis, it could be higher or lower depending on which way GRMs go, because that is the other part of the equation.
Sorry, 90 rupees, Prabal, what is that number?
So if you look at, prices remaining this high, even, at GRMs of around $11, $12 that we were building in, maybe it could be slightly higher. But if retail margins continue to be at these negative levels, you can actually have, a negative EPS of somewhere around 80 to 90 as an absolute worst case scenario. This is, of course, annualized. We are talking about basically extrapolating what could be maybe a month or two of these declines to an annualized number, but that is the worst case that we are.
This is at a company level, you're saying they may lose 90 rupees per share. That's what you're saying?
Yeah.
Wow.
Which company?
That's HPCL.
HPCL.
That's and this is assuming the retail margins stay at these levels, right?
The major assumption here is that OMCs will not be able to pass on any of these price increases.
Yeah.
Because
but
obviously,
that's a reasonable assumption. That's a reasonable assumption, right, Prabal? I mean, to make at this point, because I think the government also will be waiting and watching to see if this is short-lived, and as you said, but this is also annualizing things, and yes. It's no one's case that this will last that long, but who knows? Now, you also mentioned one important thing, which is GRMs, refining margins. I believe refining margins, diesel cracks, etc., have also gone through the roof. How does that work?
So which is the other part, which is what we have not considered when we talk about these numbers. That's what I'm saying, that, these numbers only factored in when we were looking at the numbers last week. We're looking at basically, $3 to $4 higher margins than our base case. What is obviously playing out right now, if you were to look at the way FO spreads, FO spreads are at $20 positive spreads. They've never really traded at anything above a discount to Brent. Jet Kero spreads are at $180 in some markets. So these are numbers that we have not seen in our lifetime. I have certainly not seen in my career. So very, very difficult to model for it. And therefore, the numbers that I'm giving out are all, speculative and scenarios, unfortunately. There's very little one can do to sort of really calculate any definitive earnings, at least in my space at this point of time.
So the standard, if these refined product cracks stay here, because of oil marketing companies, because there is the retail side as well, where they lose money. But the standalone refiners, it does it because they only do refining. Does it benefit the CPCLs and the MRPLs? Are they outsized gainers for a while?
Absolutely. Absolutely. Till the time these margins are allowed to be earned and, the government doesn't step in with any sort of special excise duties or any other taxes the way they did last time around. Again, going back to the Russia-Ukraine conflict, till then, obviously, there could be outsized one-time gains, both on the inventory front, at least for this quarter, as well as for, as well as the margins itself that will come through.
Got it. Prabal, we'll leave it there. Thank you very much for joining us. That's a quick, punchy view, and hope you'll come back as we continue to discuss this. Rohit is still with us, and we'll go back to him. Rohit, thanks for waiting. Sudarshan is joining us on the big wall. Just to highlight, the news flow. We've spoken about the impact, but the news itself, of course, is developing. And so is here with the big developments over the last 2 days, the weekend, of course, and this morning as well. So take it away.
So it's the second week of West Asia tensions that started on February 28. And so far, there is no indication of easing those tensions. And over the last 48 to 72 hours, we've heard several statements from US President Donald Trump to Israeli Prime Minister Netanyahu to all the other international leaders, including Prime Minister Modi and French President. So I'll start with some of the statements that have been made by US President Donald Trump. He demands unconditional surrender from Iran. He says he has ruled out any deal with Iran, calling for their unconditional surrender, and he says US and its allies will bring back Iran from the brink of destruction. Talking about the coordination on the war duration, he says that all the steps will be taken along with Israeli Prime Minister Netanyahu, but the final call will be taken by the US and the President Donald Trump. Second, knocked out capability. He says US and Israeli strikes have destroyed most of the Iran's air defenses, missile launches, navy and air forces. And also he has talked about the casualties. US military has confirmed that the number of American troops killed in the action so far has reached to the number 7. Now coming to some of the statements have been made by Israeli Prime Minister Benjamin Netanyahu. He says Israel will continue its war with Iran with all its force, and Israel, alongside with the US, has achieved almost total control of the Iranian skies. Now coming to the statements that have been made by Iranian, both military as well as the government. Iran has vowed that the unarmed ship attacked with the US will not go with impunity and threatened the destruction of military and economic infrastructure in the region, especially those infrastructure which belong to the US. He says if main centers are hit, it will target all the economic centers in the region, focusing on the presence of the US. And following attacks on their oil infrastructure, Iranian guards claim they have targeted Israel's Haifa refinery. And also talking about the new supreme leader, Iran's Revolutionary Guards have said they will obey all the guidance that will come from the new supreme leader, that is Mojtaba Khamenei. And some of the international leaders, including Prime Minister Modi, has made certain comments. He has expressed grave concern over the escalation and focusing on the safety of Indian nationals and calling for the urgent dialogue and diplomacy. Talking about the France president, he said he has warned that the conflict would have severe consequences for international peace and the diplomacy, and also he has urged Iran to halt nuclear and ballistic program. Coming to the Russian Foreign Ministry has called for an immediate stop to the US and Israeli attacks on Iran and urges a return to a political and diplomatic settlement. Also, some of the comments have been made by even United Nations organization.
Yeah. Thank you very much. Very, very comprehensive wrap out. And we'll keep doing this through the course of the day because there is the news cycle, which, of course, is also developing very, very fast. Rohit, just last word with you. I mean, any other thoughts? You know, US markets are incredibly resilient so far. But as we were discussing earlier, US is a net energy exporter. So they can kind of sort of, it's not as painful for them as it is for Asia, Europe, etc., which are large importers. And so it's not shown up in the macro complex in the US, global markets in that way, right? Rohit?
Yeah, but if you see today, you are seeing US futures down almost 2%. The problem here is not just that oil impacts many other parts of the world, but eventually when you have diverted all your investment towards the war, it results in an economic slowdown, potential recession scenario. We were already very, very late in the cycle as far as the previous business cycle is concerned. Having it punctured by war is just the worst thing that you could have expected for. You see, worldwide, what happens is you have a shortage of oil, which is going to result in various cuts in production. If there are capex plans, in various countries, they would probably put it off. So there is a sense that the global economy slows, and then that has an indirect effect on what is on the US economy more than a direct effect. So that's, I think, the pain point, and markets start discounting it. The reason they were not discounting it so far, I think, is just because we thought maybe we can conclude this first over a weekend, then maybe over 1 week. Now that we are talking 3 to 4 weeks is what markets are really starting to, price in and panic about.
Rohit, thanks very much. Appreciate it. Good speaking with you, and we'll do this, on a regular basis because, I mean, developments are fast changing, but that's some quick view coming in. Dharmesh Kant is with us as well. We'll go across to him, but take a quick commercial break, and Dharmesh on the other side. Stay with us.
Welcome back. Last week, the Indian markets were down 2.9%, and this morning, the GIFT Nifty is lower by 800 points. Dow futures has stumbled 1,100 points, and this is on the back of a sharp slide even last week for Wall Street, where Dow was down close to about 450 points on Friday, and for the week, Dow Jones was also down nearly about 3% Dharmesh Kant, head of research at Chola Securities, is now joining in on the show. Dharmesh, we were just chatting with Probal Sen, and he said there is a possibility that oil marketing companies could report losses if the situation escalates or stays where it is for a prolonged period of time. UBS today has downgraded oil marketing companies, so IOC, BPCL now neutral, HPCL a sell. At Chola, what is the analysis?
Yeah, good morning, Nima. Thanks for having me for the show. See, the analysis that what we have always had is avoid oil marketing companies, and these are more commodity cyclical plays. And at times, it becomes trade. Otherwise, as far as long-term structural, building of wealth creation is concerned, I think those days are over for oil marketing companies. Anyways, renewable energy is taking much of the larger share. I have also heard HPCL and we're talking about it as a percentage of GDP, the consumption of oil is going down. So as a trade, as of now, I mean, sell may be going on, but we largely avoid this space altogether. In fact, even the upstreams for that matter.
Are you recommending any buys to your clients with the fall that we're seeing at an index level and individual stocks?
Yeah, definitely, yes. In such kind of a market scenario for investors, there's always a cherry picking time. And today, fall if 800 point materializes, then I mean, there will be some EPS adjustment, but as of now, it will be trading around 17 times Surya forward, that is FY27 EPS. And there, I think the clear play is defense sector, which is largely unaffected by whatever is happening. So if you are getting a good cut in, say, BEL or HL, it's a good time to acclimate it. The other sector from trading perspective, which we have been seeing and liking now is the air conditioner makers like LG Electronics or Blue Star, because the summers have picked up quite well, and last year was a washout for them. So if the valuation comfort is already there, I think as a trade, if this continuity of summer carries on, they become a good, discretionary spending from the consumer point of view, largely unaffected by whatever is going on, and valuations are comfortable. There, LG Electronics, we have been liking, and that's the topic out there.
The Maharashtra government has announced farm loan waivers. Have you all done the analysis? Who could it impact negatively? And do you think we're going to see more and more states announce this? Is that a big risk?
Don't know about the other states, but the Maharashtra government was clear that it applies to across the board. It's not for a specific, segment of the financial who have been providing farm loans. So whosoever in the PSL segment will be impacted by this, but eventually it's a temporary blip because loan waiver, government, reimburses the money to the financial institutions. So as of now, currently it may be some, liquidity concern, but I don't think that's big enough to move a needle. Other states don't see it coming immediately. So I think this is not a big, kind of a worry point at this juncture.
Did you all have any paint stocks that you all liked? Or maybe an Interglobe Aviation? These are stocks negatively impacted. Were there any in your coverage which you were bullish on and that view now changes? Dharmesh?
Interglobe Aviation, we have been, we were bullish on. We have been recommending that as, Interglobe Aviation, we have been recommending as a buy stock. And the stock price has corrected quite significantly. I think it will correct further from here on. But these corrections from a long-term investment point of view is definitely a good buying opportunity. Because again, there's a duopoly in the system. Tomorrow, maybe 1 month later or 2 months later, things will, neutralize and the natural business will resume thereafter. It also takes, the price correction also takes account the adjustment which will happen because of the restricted rule in the new DGCA norms under which they have to fly. So 10% cut we have taken out there on their projected number of flights and the routes they would be flying over for next 2 years. I think all has been there in the price. So today decline and maybe wait for more days, maybe around 3,200-3,500 becomes a good buying opportunity.
Dharmesh, more later. Thank you very much. Helpful conversation. Appreciate your time here on CNBC TV 18. We'll take a break. We are back with the pre-open rates. We'll connect with Sudarshan Sukhani and Mitesh Thakkar for some technical trading ideas. Stay tuned.
Yep.
Welcome back. I think the pre-open is with us, and we're down about 550 points on the Nifty right now. That's a 2% cut. This is certainly better than the 800-point cut that the GIFT Nifty indicated, but this is, of course, just the first inside of the first minute of the pre-open. We'll see where we finally are at. The rupees also opened, I think, about 25 paise weaker. So we're at about 92.20 compared to 91.75 at this point in time. So remember, we of course had the RBI coming in a very large way. This was Thursday, the pre-open in the pre-open time, and they pushed the rupee back decisively. I mean, in a very, very large way. But we are, of course, with this big oil jump that we have, prices starting to weaken once again. So 43 paise weak as compared to Friday's close as far as the dollar rupee equation is concerned. GIFT Nifty, we'll keep it on at the bottom of the screen so that you have a ready reference rate there as far as the market open is concerned. Well, let's get Sudarshan Sukhani with us and Mitesh Thakkar, who are both joining in. Sudarshan, Mitesh, good morning. Great to have both of you here. Thanks for your time. Sudarshan, so, 3% gone last week, 6.5% down for the year, and bracing for another lower start. Any way to trade this, Sudarshan?
Yeah, good morning. See, today is a black swan event. A 500, 600 point decline is not normal at all. And the way to trade it is to completely step aside. Do not buy a dip. Do not look to sell a rally or even the opening gap down. This is not a market where we can get any inkling of any kind of trade for the Nifty and for most of the stocks. But there's a good news part to it. The good news is that at some point this decline will stop. And when it does stop, then investors and traders will get a lifetime opportunity. So wait patiently for that. Today is not a day to trade.
Yeah. Mitesh, what about you? Echo the same view?
My belief is slightly different in the sense that one, the kind of fall which we have already had, and I'm not counting about today's cap down, has turned the weekly and the monthly charts on the negative side for the Nifty. Now, the same pattern is about to repeat for the Bank Nifty. In fact, on Friday, I did talk in detail about the Bank Nifty, saying that a weekly close below 58,200 will be damaging for the charts. And while you can have short-term levels from where the Bank Nifty could bounce back, it is kind of, reversing the bigger up move on the Bank Nifty. So if the Bank Nifty, to my understanding, starts declining below and starts closing below 57,400, which could happen today morning itself, but then we need a monthly closing for that. But then, that will damage the trend so much that the Bank Nifty on a longer term chart frame could decline to about 53,500 and lower. So in that sense, I think this is a slightly bigger shift for me. So I'm not in a rush to buy in any kind of market, in any kind of this thing. Yes, you can trade for pullbacks and all. But for me, I think the medium to longer term charts are slightly getting damaged. So this could be a market pain which could last for a few more months to come.
What about stocks, Mitesh? What are you recommending?
So, for the day, I have all sell calls, but I don't know, with the kind of gap down opening, which calls will fit into that risk reward equation. But a couple of banking names there. ICICI Bank is a sell with a stop at 1331 for target of 1270. Axis Bank, again, Axis Bank was a sell call on Friday as well. Sell with a stop at 1332 for targets of 1275. Ashok Leyland finally, after a long time, first signs of profit booking and correction here. So keep a stop at 198.5, look for a first target of 186. And Steel Authority sale is a negative call as well. Keep a stop at 157.25 for targets of around 149.
Got that. Sudarshan, what about you? What are your trades?
Well, it's a mix. BL is a buy with a stop under 460. Hindalco is a buy with a stop under 945. These stops are irrelevant. But the point is that the stocks are buying opportunities. You have to wait and look where you can buy them. I have two in shorts. Indian Bank is a short with a stop of 960. And Eternal is a short with a stop of 235. If at all somebody wants to trade, you should look for good quality stocks, the type I have named, and look to buy them.
Okay, thank you very much for that. We'll come back and connect with you. Let's invite Praveen Sahai, research analyst at PL Capital, on the show. Praveen, we'll get to the data center opportunity for many of the consumer names under your coverage. But just, if we could begin with the possibility of higher inflation eroding margins for the companies under your coverage. We've seen an increase, say, for instance, in aluminum prices. Last week, aluminum prices were at a 4-year high. Now, that's a base metal for coppers, wires, etc. So can you first detail out the impact on account of the war on, for the companies under your coverage?
Yeah, thank you for having me. So for a consumer durable, the copper is a major raw material in terms of the commodity. And not before, due to war, prior to war as well, we started seeing a lot of, up move in the copper. And that's basically impact the RM for the entire consumer durable space. And especially if I talk on the wire and cable, the large part of the raw material is a copper. Even the aluminum is there, but the contribution wise, it's a lower in the RM. So in the range of nearly around 80-20 ratio, if I just bifurcate between them. But this industry, wire and cable, is a pass-through with the lag. Definitely a couple of quarters of contraction in the gross margin we may see. But eventually it's good for the large players who do a large volume because for them, one, the supply, another is a pass-through, is a far suitable as compared of the smaller player. So definitely for a Q4, they are a hedge with. I can say they will continue in the good volume trajectory as well as the cable-based companies, and the margin would be better. Definitely in the entering to the next financial year, couple of quarters, we might see the contraction in the margin for them and then to reset. On the other side, that's the white goods space, definitely that's one of the big challenge from the third quarter onwards. We started seeing that the inflationary pressure, whether it's because of commodity prices or whether it's because of rupee devaluation, both are impacting the RM. And we had a scene in the RAC case that's a lot of inventory filling in the month of December happened. Same scenario to some extent where increased in the month of February. So that is because of one, the B-norm change and the inflationary pressure for them. Definitely this prices, if and with this war to continue at this level, we might see the contraction in the margin profile for the consumer durable space because that's the price hike is quite limited or restricted.
So there will be margins under pressure for wires and cables in the initial, at least for Q3, Q4, Q1, but that will eventually be passed through. But for the consumer durable companies, there will be some margin pressure. Is that correct? And what's the extent in Q4, say, in terms of EPS downgrades potential?
No, so Q4, as I said, that's quite a hedged wire and cable. I don't see there would be any impact of this pricing. Definitely Q1 and Q2, there would be a pressure. And just to give you a scenario of 2022, when the copper prices has surged significantly, the gross margin contracted by around 200 basis points for the players, except of a Polycab. The others, we had seen the contraction, and then after it's a reset. So such kind of an impact we might see because QOQ copper prices were 20% up, YOY it's a 45% up. So with the lag, I believe Q1, Q2, we will see the contraction in the margin for them. Similarly, for the durable space as well, because largely the RAC companies or even the electrical companies in the consumer space might see the contraction in the margin in the Q1 onwards with these inflationary pressures.
Voltas has significant exposure to Middle East. Can you quantify that?
So over the last 1 year, they had reduced after there is a lot of events related to certain projects happened. So if I look at a Voltas order book in their project business, they have a 70% of order of a domestic, 30% is outside, and in that 30% is a large portion is from the Middle East. They have exposure to.
And have you had a chat with the management of Voltas? Are they seeing any long-term implications on the Middle East business?
No. So related to the project, no, definitely we don't have any communication from the company. But on the consumer front, definitely they are taking a 5 to 15% of a price hike to mitigate the higher inflationary scenario of RM. And even we are also in anticipation that the summer is expected to be good in terms of the elongated advance as well as harshness. So the price hike is not a problem, especially in the RAC space, what I believe. And that's why the Voltas to somewhere mitigate this impact, at least for a Q4.
And exports of Havells and Blue Star to Middle East?
So not much. They don't have a much exposure to Middle East.
Okay. Now about the data center opportunity. Can you quickly run us through some of the big numbers?
Yes. So as you know, the data center currently of 500 megawatts is expected to reach to around 3.5 or 4.5 gigawatt by 2030. And that will bring some incremental opportunity for a wire and cable, especially because in the EPC side of a business, 10% of capex goes to the wire and cable. And in that also the cable heavy. So those who are having capacity of LT, ST and extra high voltage are the major beneficiary of that. And we believe that around 7 to 10% of opportunity in the next 4 years will arise from the data center for wire and cable companies. So I believe that's the Polycab, KEI kind of players are a big beneficiary out of that. So just to give you some numbers on the wire and cable, around 67,000 odd crore of incremental opportunity in the next 4 years. Out of that, nearly around 7 to 10% is coming from the data center. And that's on the assumptions of 3.5 to 4.5 gigawatt of opportunity coming by 2030. If that will improve from here, then definitely the opportunity size for the wire and cable will improve.
Thank you very much, Praveen, for joining in. Great chatting with you. Counting down to the open. Let's get in some 9-10 calls. Sudarshan, yours?
Well, it's BEL. Buy BEL. See, the initial stop was 460. You will have to adjust it based on how it opens.
BEL. Mitesh?
A sell on Ashok Leyland. I think after a long time, the stock is seeing first signs of correction.
Okay, all right. Gentlemen, thanks very much for that. I think we've settled now. Oil marketing, of course, we focused on with Prabal earlier, and they're all opening about 5-6% lower and 600 odd down at this point. Vivek is here with, just a spattering of stocks, apart from oil marketing companies impacted because of what we're seeing in Iran. Take it away.
Well, that's right. It's a 40% rise in oil prices in the last week, almost 60% in the last month or so. So clearly, like you mentioned, OMCs are all opening with significant pressure. Along with that, companies that use crude oil as well as natural gas as input, they too are opening sharply lower. Look at a name like Indigo, seeing a gap down open. Also look at some of the fertilizer stocks. Most of these names are under significant pressure. Remember, LNG supply shortage can impact output quite significantly, and also worries about the upcoming Kharif season. Along with that, you've tagged names like GNFC. Most of these stocks are under pressure. Not only that, remember, companies that have direct exposure as far as the Middle East or West Asia is concerned. So names like L&T, even a name like Adani Ports, there are unconfirmed reports indicating that there could be damage to some of their facilities as far as Israel is concerned. Also look at a name like Watek Wabag. Most of these stocks, expect them to remain under pressure today.
Yeah. Market open right on cue. Vivek, thank you very much for that. What do we have? 2.5% lower on the Nifty, 23,890. The Nifty Bank is starting about 3% down, almost 3% lower. And I think Dharmesh made that point, but Rohit made that point before that as well, that the banks were largely not, seeing this selling spree till last Thursday, but they did sell off strongly on Friday. So maybe, that's a stronger part of the market where there is more to lose in that sense if this continues. But so far they've been strong. Well, a small cap index is absolutely flat, about 0.25% lower. And I think the mid-cap index will come up on your screen as well. You just have three names on the Nifty which are higher: ONGC, Coal India, and BEL. And everything else basically is down at this point. So 2% on Trend, Bajaj Finance, Asian Paints, Power Grid, and so on and so forth. So it's a 550-odd point cut, about 2.25% lower to begin this trading session. That's the Nifty heat map coming up on your screen as well. Rima.
Well, it's below 23,900 now as the sell-off stands at 550 points. From the start of this year, the Nifty weakness stands at close to about 9-odd%. Mid-caps are down 2.25%. The advanced decline ratio stands at 1:10, so terrible. Misho is down 10%. Oil marketing companies like HPCL, BPCL, Oil IOC are down 6 to 7%. You've got quality walls on the back of the Q3 numbers. Weak, the losses have expanded, stock lower by 6%. Tejas Networks, PSU Banks. In fact, all banks are selling off. So PNB, Bank of Maharashtra, Ujjivan Small Finance Banks, IDFC First Bank, Bandhan, weakened trade. Ircon is down 4%, very large volumes here. Railways are not getting spared, and Ircon is under pressure. Samvardhan and Motherson, the street perhaps is now fearing weakness in global growth because of the supply shock, a rise in crude prices. GAIL is lower by 4-odd%. Eternal has corrected very sharply. Eternal from the start of the year is down nearly 20%. So it's been one of the biggest losers. IT, of course, has been weak, but Eternal outside of IT has been under pressure. Asian Paints is down 5% in the large cap space. Interglobe Aviation 5.5% lower. These are all stocks negatively impacted by the rise in crude prices. ONGC, Oil India, and Reliance Industries should come up for you on your screen. ONGC up 0.8%. Oil India flattish, negative buys, but down about 0.5%. And Reliance Industries too, not falling as much as the rest of the market. It's 23,800 now on the Nifty. A complete risk-off, severe rout visible across the indices and individual stocks. The Nifty Bank now down 2,200 points, Prashant.
Yeah, no, absolutely. More to lose there. I mean, did not correct with the rest of the market till recently, till a day ago. So in that sense, there is pressure. Just put up the refiners, right? I mean, Prabal was talking about the standalone refiners, Chennai Petro and MRPL in particular. So those are the oil marketing companies because, I mean, the retail side, if prices don't go up, they lose. MRPL is down 2.5%, and Chennai is down about 4.5% or so. But, we'll see how these go because cracks are super strong. Oil availability is not a problem. So this is an ideal environment for both Chennai and MRPL, at least till this war continues. So keep that in mind as we look ahead. Sandeep Tandon is with us, founder and CIO at Quant Mutual Fund. Sandeep, good morning. Great to have you with us here. Thank you very much for joining us. And what a day, right? Just these kind of big shocks. Sometimes I feel they're becoming more and more frequent since COVID, right? We've had many of these, but most of them have been short-lived, and that's what the market kind of sort of latches on to. That and historically, all these geopolitical oil shocks have been kind of short-lived, and they've been good buying opportunities, etc. But when you're in the midst of it, you're living through it. Who knows, Sandeep? What's your sense overall?
See, Prashant, if you recollect, beginning 2025, I talked about, this is the PE contraction year. And we see market correcting sharply, particularly on the developed market side. And the worry was we talked about on the technology front, NVIDIA or semiconductor. I think we have seen massive euphoria in some of these markets, whether you talk about Japan, Taiwan, Korea, US market, and so is the case with many other emerging market also. We have seen a euphoric move. If not, I'll not say a maniac phase, but definitely a euphoric phase. So obviously, risk appetite has peaked out in January 2026. The way it peaked out in July 2024 for India, something similar we are seeing for Taiwan, Korea, US market particularly. And that's a signs of worry. Now, if I have to look at now, obviously, beginning 2020, we said this is a decade of high geopolitical volatility, which will remain elevated till 32, 33. That's a timeline which we defined. Now, if I have to look at from a very immediate perspective, and crude has spiked significantly, though we were expecting, but not up to this extent. The implied walls gives you a fair good perspective whether up to what extent has been priced in or not. The implied walls are now have or crossed something similar what happened in 2022. Though price highs was around 129, 130 level, so we are closer to 120 mark now, which we hit today morning, which means up to large extent, if I have to go by from a behavior perspective, market is up to large extent, this thing has been priced in. So very high likelihood that crude will peak out closer to 129, 130 mark, employed was of 110, 112%. So we are in that phase where it can peak out, but can we say it's going to correct sharply? Answer is no. So it can remain elevated, but it has a potential for a peaking characteristic. Now, if I have to look at...
sorry, Sandeep, this implied wall on oil, right?
Yeah, on oil.
Yeah, the only thing is...
Oil quality index is 105 now.
Yeah, only a quick point. If you look at the implied wall on far-dated contracts on oil, they've not gone up. So my only point is the market pricing in a very short-lived kind of a disruption? So can we say, can we draw this conclusion on the fact that near-dated front-month contracts, walls are very high, as you said, that prices will peak? Just your thoughts.
Yes. So as you rightly said, the long term, it has not spiked up to that level, which means the long-term trend is still down on the crude. And that is something similar view we also have. We expect whatever the spikiness or the up move which you are seeing in the crude thing may not last beyond this quarter or so, maybe next 2 or 3 months. So if I have to say we may April sort of thing, it should peak out, on higher side. So that's the way we look at it, which means by end of the year, crude will be significantly lower than the current levels. And that's the reason it is not reflected in the out of money or the 5-month options in a big way.
Okay. So where does it leave markets here in India? Sandeep, what's the view?
So obviously these are challenging time, because anything happen in Middle East, we are affected a lot, okay, because our dependency on crude and gas is very high. But the way I look at it, it's not the first time we are seeing this sort of crisis or meltdown. It's a question how you handle this. Either you look this as opportunity or you look at this as a capitulative moment. So a lot of people who will get capitulated at this moment will not able to get re-entry chance in the market. So I will look at that worst is nearby. and best is yet to begin, which means this is the time. I'm saying, if I have to say, beginning in 2026, we talk about the first quarter will be challenging. So I expect maybe by March end, sort of thing will be a great buying opportunity for only for India market. I'm talking about, not for global market. It will be great opportunity because we have been underperforming the emerging market, developed market, as well as the world market also, which means we have potential to outperform. And I have said it in the beginning of the year also, this year, India will outperform if beginning April 2026. And that's a call we still maintain. So I will look for a buying opportunity. Yes, I understand from the price level, every levels have broken. So 23,800 is a very important level. If it breaks, then people are talking about significantly lower levels. I'm not ruling out, but nobody has bought exactly at the bottom. So as an institution, we are sitting on some amount of cash, which we have raised. I think will be looking for a buying opportunity rather than a selling opportunity in next 10 to 15 days.
Do you want to hazard a guess how low we go in the next 10, 15 days before it's all priced in?
No, we are not very good in quantifying the exact level, but we can quantify the inflection point. Like I said today, crude is giving you a sign where a lot of thing has priced in. Now, it's again question come whether you look at is breaking out or is peaking out. We think at around 130 levels, it should peak out rather than breaking out. And something similar, as and when it happens for India, we will be able to say with confidence. As of now, it's not happened.
What is the buying opportunity? If you have to now invest would you invest aggressively right now or wait till the end of the month? And what would you look to buy in terms of portfolio?
So I will look for a buying opportunity in staggered manner. So we think, given the global turmoil, pharma is a sector, energy power is a theme we should look at, telecom should be another theme which one should look at. So there are opportunity. PSU has been our biggest outperformer. So at lower levels, I will look for buying opportunity in some of the PSU names also. So this is a thesis which has been playing out, and they have relatively more strong in the market. And fundamentally also, we think pharma could be a great opportunity. Whether you talk about data center related things should be opportunity. So we are playing through power because there's no direct play available for the data center in that up to that extent. So it's a way we look at. I think energy power is a theme one should look at from a longer term perspective. And appropriate time, I will also look for a buying opportunity in metals also. But right now they have gone up sharply. Okay, so we have already booked profit up to large extent in gold and silver. And at appropriate time, we will be looking to rebuild exposure at lower levels.
You know, stuff like this, Sandeep, this dollar debasement is a slow burn process, right? Is nothing happens quickly. But what's happening going on once we're out of this? This is once again kind of negative, right? A positive for hard assets like gold and silver, isn't it, Sandeep?
Logically, yes, but we also have to look at, if you recollect in January, we talked about the biggest risk for 2026 will be rallying dollar. Okay. And that is the risk which we highlighted much earlier is playing out. So whole world has talking about de-dollarization thesis. We were very early to talk about that. We still believe that the long term is a trend, but from a next few quarter perspective or maybe few years perspective, dollar is the area which we have to look at very closely. If dollar spikes, let's say it goes back to 110 level, 112 levels or so, then gold and silver logically will correct. They have negative correlation, so it can correct sharply irrespective of the high geopolitical volatility. And we think both gold and silver have seen the high of 2026. And I think some if not very aggressively, but I think they have still more downside than the upside if I have to look at from even next 1 or 1.5 months perspective, irrespective of global volatility.
You have been calling for India's outperformance, but you need to be a bit patient. What is the call now on global markets? It's been a bit rocky now for the last couple of days. Money's been taken out of markets like Kospi, Taiwan, etc. Now, what is the call you're taking on global?
We are still quite skeptical about gold market, but we have to keep in mind it's not going to collapse one-sided. It can give you a pullback rally, but if I have to look at from January to December or November 2026 trend, I think trend is down for global markets.
Yeah, Sandeep, if you this is not just I know you think about these things, and so let me ask you this: is there any way to for the lack of a better word, game out this what's going on with regards to the conflict itself? How should we think about it? What do you think the the US, of course, Iran can stretch it out, and there's no total victory, and but of course, I mean, they're no match, right, for American military might. So, is the turning point in this going to come from US's side? Is that the way to think about this? In the sense that, retail fuel prices in the US are already up some 60% year to date. There are midterms coming. In all likelihood, they are set to lose the House. Perhaps Senate is also a coin toss. There is no real popular support in the US for what's going on. You think when we think about when this will end, the question, when is this going to end, it's going to come from pressures in the US rather than elsewhere?
So, Prashant, up to large extent, you may be right, because we also believe that we have seen complacency in US market. And some of the points we talked about, which when we talk about higher complacency means the vulnerability is also equally high. Okay. So US market and the current geopolitical development will have more negative impact on the US itself rather than as compared to other markets. So obviously from a vulnerability perspective, US will be more impacted than India. But if I have to look at from India point of view, from a longer term perspective, like in trade war also, we talked about that from a longer term perspective is very important that we are able to dilute the concentration risk on one country, and it will help us, and which played out reasonably well, and we have become more resilient. Similarly, I think Iran was a very hot spot, okay, which could lead to, it could keep geopolitical volatility remain elevated for many years, with Iran becoming weak, okay, by default, China becomes weak. And similarly, Russia also becomes weak, which is a re-emergence of US from next 2 or 3 year perspective. And that's the reason we also have to align our interests more towards US side of keeping in mind the friendship with the US, with the Russia also. So if you really look at I look at it as a very constructive move for India. It's a pre-expansion phase for India. When you're seeing a global turmoil, India is relatively safe. Yes, we do get impacted about the crude related thing, and maybe this problem by 2032 should be addressed when we are moved towards the green energy in a big way. So it's a temporary problem. Answer is yes, but I think if geopolitical volatility remains elevated, India will be beneficiary both from the stability perspective as the flow perspective. Now it's the question of how you manage this volatility. It's a maturity which we have talked about, and that I think we come with a lot of experience. People who have to be calm, people have to look for a buying opportunity rather than getting capitulated at these levels. So it's and then it's maybe time to rebalance your portfolio and get out of the most expensive high P multiple name stocks which have not corrected up, or the correction has rather just begun. You may see a significant down move in some of these names.
Sandeep, you would have spoken to a lot of companies. Companies which are a part of your portfolio. What has been the feedback from them after the start of the war? Up until now, what we're seeing is a supply shock. But are they talking about a demand risk also playing out?
Frankly speaking, we are more on the quant and data-driven guy. We don't interact much with the corporate because of things, so we don't talk much with them. And I think even whatever feedback we hear from the media, nobody has a 100% clarity what is unfolding in the and the uncertain one. If you expect the company people have more clarity, I think I have a doubt. A lot of the CEOs actually get capitulated at the bottom of the cycle when demand cycles completely collapses, and there could be reversal or the inflection point stage. At that stage, they give up. So I don't give too much weightage to the company's opinion because A, they are biased from their product perspective, and B, they lack that macro perspective. So I will look at, rather than looking at the company specific behavior, I will look at more from what is unfolding in the global market, because and if you work on a market implied analytics, that will give you far better outcome rather than looking at depending on the company's view.
Yeah. By the way, the rupees hit a new record low. We're down about 0.63. 92.32 is where we are at this point in time. So that's a sharp fall, 60 odd paisa. But I mean, Thursday was that big intervention. The RBI pushed back the rupee quite strongly. But when you have a 25% appreciation in oil prices, and we import 5 million barrels of it every day, that's straight away $200 million extra outflow from the exchequer. And that's showing up in the currency as we see. So, the big question, right? When is this going to cool down, end, and so that's the problem. Sandeep, just for a moment, if I can ask you, you're of course now running a mutual fund, but in a earlier lifetime, you were running a very large prop operation, and you were you're very active in markets, and you traded all kinds of things. I mean, for those who are watching, what's the broader advice? I mean, those who are inclined towards trading and not, sitting with their investments and, keeping the faith, and those who want to actively participate. I mean, any advice, Sandeep?
In our previous avatar, when we were the large prop trading firm, obviously we thrive these volatile moments. Because in mutual fund, we do have a lot of restriction in terms of playing in the market. Otherwise, we could have been gone long on the walls, because in the beginning of the year, we spotted what is coming. So we could have made a lot of money. Obviously, from a mutual fund perspective, the regulations are that we don't get all this sort of freedom. Now, if I have to talk about purely from a real retail investor perspective, and I think I always say any crisis is a very good opportunity to participate. However, people get carried away at the peak of the market. People think best is yet to come, and this is the early signs of beginning of a new bull run. All those theses get emerged. And I think those are the people who will struggle right now. But if somebody asked me in a very calm manner and a very composed effort, which you have to take right now, I think it's a selective opportunity to rebuild your portfolio. And I will also, if somebody says I'm fully invested, then what one should do, then one should rebalance your portfolio towards some of the sector which we highlighted has, wherever you see your stocks or sector has potential to fall, remove the emotion biases that, we have seen such high prices, or that was the levels we like to wait. That will not be a very effective strategy. Rather, book losses and move towards safety, move towards defensive name, move towards more value thesis, and what is going to work going forward. So every day you have to look at from here how market looks, and I will rebalance. That's the approach we follow in quant also. And there is something, we don't get upset or get carried away too much about this sort of volatility. Otherwise, it becomes very challenging for us to also manage money when you're talking about fiduciary responsibility. I think that mental piece is very important, and it's not valid for only for us. It's valid for every investor. This is a time you have to be calm and rebalance your portfolio. Don't panic. It's a time for rebalancing, irrespective of price. What do you sell? If you can rebalance, that would be a great opportunity.
I remember last time you said liquidity first, safety second, returns third. That's how you should rebalance your portfolio in a tougher environment. Sandeep, great chatting with you. Thank you very much for joining in. Sandeep Tandon of Quant Mutual Fund. Moving on now, a CLSA note suggests that medical tourists contributed 6 to 9% of revenues for large Indian hospital chains. 10% of medical tourism revenue. Of that, of the medical tourism, 10% came from West Asia, 15% from Africa. We have with us Sunita Reddy, Managing Director, Apollo Hospitals, now joining in. Ma'am, thank you very much for joining in. This is Reema here. For Apollo Hospitals, can you tell us the revenue that comes in from medical tourism and how much from Middle East?
So currently it's about 645 crores, about 6% of total revenue that we are seeing from medical tourism. A large portion of that revenue is, however, from Bangladesh. And this year we have seen a significant growth in revenue that comes from Bangladesh, and this will continue as the year goes forward. As you know, last year there was a significant hit, and I think now the market is opening up. With regard to the African countries, we do have about 45 crores from Tanzania and 30 crores from Kenya. So these are the two countries where they are alternate options, which do not go to the Middle East, where patients are still likely to come. In terms of the pure Middle East, I think there's only about 50 crores, and this should probably be a very short-term risk. This year we will close our budgets as planned. Next year, I think we will budget and make sure that we continue to grow international while looking at other markets, which we have currently seeded. So there is Indonesia, there's Mauritius, there's Sri Lanka. They are all those countries that would normally fly to Dubai and go to Turkey. So there is an opportunity to continue to grow the medical medical value travel, recognizing that the 25% structural cost arbitrage for these patients still exists.
Got that. And in terms of medical equipment supplies, is there any impact?
Currently, there is no impact. All our medical equipment is, I think we've calibrated price, we've calibrated rupee depreciation. So it is as per budgets. There is no impact on medical equipment at this time.
Okay. And the Middle East exposure is just about 50 crore. You said there is actually an opportunity now to expand medical tourism. Have you been able, what steps have you taken to do that? What are the numbers, the projections, and the budgets that you've made now?
So as we look at budgets, which we will close soon, we see a huge opportunity coming from Kazakhstan, Uzbekistan, all of the CIS countries which we had not, we have a huge opportunity to do work there. We are working with Indonesia. I think flight connectivity to these countries is very important, but there continues to be a huge opportunity, which and Africa, the flights have not stopped. We are seeing Air Tanzania bringing patients. I just want to close with this one comment, which is, healthcare is elective. All the patients that come to us are elective surgeries. And in the long term, these elective surgeries cannot get pushed out. So maybe there will be a short time where there will be a disruption, and the patients might have to bear the cost of a little bit more expensive ticket. But because of the cost arbitrage, I think we will continue to see patients coming to India for good clinical outcomes and good cost.
Yeah. Ma'am, hi, good morning. Thanks for joining in. I mean, I was in Bangalore for a relative's treatment, and I was at Apollo actually for the last few days, and I saw firsthand, not well run, and what can one say, right? But it is, but wouldn't want anyone, of course, and I don't think you'd want as well. But as you said, if it is needed, you need quality healthcare, and I guess that's where sort of hospitals like Apollo, etc., step in. Ma'am, in terms of bed addition, you've guided for 1,500 beds to be added in FY27?
Yes. We really have a strong focus on opening out these beds, and they will happen. Of the 1,500, 750 will become fully operational. The balance 750 will be fully operational next year.
Yeah, and I just had this question. Would you because the demand for quality healthcare is tremendous, right? But you also have so many other hospitals which are coming up. I guess to meet that demand exactly, and this comes from personal experience, because I mean, my interactions with hospitals and doctors, etc. A lot of a chain like, I mean, there's a chain in Bangalore called Sparsh. And they got 6 facilities now. It doesn't come up on the overall radar because they're not listed, etc. But a fair bit of build out is happening by first-time players in the healthcare space in that sense, ma'am. Will Apollo continue to add sort of greenfield? Will it be a mix of greenfield and brownfield? Will we see acquisitions? Because the demand is there. There is no doubt.
So yes, you were in Bangalore. You were right. I wish I could have helped you if you were in the hospital, but there are 2,500 new beds that are added in Bangalore. And our facility there, our main facility, is running at 80% occupancy. So clearly there is the structural demand for healthcare remains intact, and we will continue to expand. It is a combination of brownfield and greenfield. This has always been our objective. Greenfield, because we need to be in those key markets. Sajapur, Hennur, these are markets that we continue to, we've acquired land, we will build out, because there was no other facility to acquire. But clearly these markets are important to us. And I think that the payer mix is very.
Ma'am, I don't think it impacts you directly, but there has been a Supreme Court order and they've issued a contempt notice to 51 private hospitals in Delhi. Now, your name is not there, but they're basically saying that these hospitals had received government land at concessional rates and therefore they should provide concessional treatment to the economically weaker section. So 25% free treatment in OPD, 10% free treatment in inpatient department, IPD. And if the hospitals are found violating the rules, then there is a possibility of a cancellation or revoking their land leases or penalties. Do you want to just comment on the direction of this? The next hearing is on 24th of March.
Yes, so while I can comment on the Apollo in Delhi, clearly the use of free treatment is controlled by the government. An Apollo representative cannot be sitting there and choosing who gets free treatment. That control is with the government. And I'm happy to say that our institution has fully complied with all the patients sent by the government.
Yeah. Ma'am, if I can ask you two deal-related questions now.
Yes.
One is negotiations, and this has been reported last year as well, that you were in talks to sell the maternity arm, Apollo maternity arm. Any movement there, sir? This is Apollo Cradle and Children's Hospital.
Yes, I think our focus is on building out the network. So those assets that are needed to strengthen the network will continue to remain a priority for Apollo. This is a conversation that we're having, and I think I should be able to get back to you with more details next.
Fair enough. We'll wait for it. The other one, ma'am, was, and I asked you this last time you were on the program as well, the Indraprastha medical situation in Delhi.
Yes.
Any movement there? You told me last time that it is, and we will hear something very soon on that in terms of movement.
Yes, we will very soon. We're still in March. I think you asked me just a month ago, but I've explained the crux of the matter to you in the earlier one. Free patients are controlled by the government. Who gets to use a facility is controlled by the government. And I think that all of this is open for the public and the courts to see. So we will continue to work with the government to not only to make sure that we've secured a lease again, but to make sure that we expand the facility in Delhi.
Yeah.
How are the occupants?
Just to press on that point one more bit. Will we hear something? Is it an active negotiations, ma'am? And will we hear something? I'm sorry to press, but say in the next 6 months, will we hear something?
Yes, sure you will. That I can say. Yes, you will.
Okay. And just one last point on this. If you're able to increase your stake in the entity, the idea is to consolidate the financials within Apollo, not merge it, right? I'm assuming. Is that the right understanding?
I think you're crossing another bridge. So let's get back.
Okay. But we will hear something within the next 6 months is what you're saying on the Indraprastha medical.
Yeah. I think, yes. I think the free treatment, we are working with the government and we are very committed to making sure that we do the 10 to 25%. There's always been our intention. And post the court case, we will get back.
And occupancy, ma'am, so far in Q4, better than the Q3 level? Are you inching towards 70% for this quarter?
Yes. I think, there is a slight discrepancy between occupancy and in our Tier 1 cities are doing very, very well. And Tier 2 have really picked up. So we're on track with our budgets.
Thank you, Ms. Reddy, for joining in. We will get into a break. For the markets, by the way, the Nifty has now fallen 10% from its all-time high level, so entered into a technical corrective zone. On the other side, Manisha Gupta will once again focus on commodities. Stay tuned.
letting go, but.
Welcome back. As promised, Manisha is now joining in, tracking crude oil prices and the surge there.
Thank you so much for that. Well, yes, take a look at the crude oil prices. And when you look at Brent and WTI both, they seem to be trading at the same level of around $115 a barrel. It usually is a difference. WTI is slightly cheaper in discount to Brent, but that difference seems to have gone away at this point in time. So we are trading 24 to 25% on the higher side, 115 for both these varieties, which actually take part as 2/3 of the global oil therein. This is the highest level that we have seen for the crude prices since the Russia-Ukraine war began in 2022. The huge premium also comes in from the fact that you're looking at calls in sense of derivatives at record numbers there. It has been record volumes as well when you look at the previous week in sense of futures as well at ICE and in the WTI markets therein. The 20% gains that we saw in the crude oil prices has been the highest since April 2020. And when it comes to the WTI prices, well, this is the highest weekly rise that we've seen since 1983. So various records being created when it comes to crude oil prices in sense of weekly gains. Interestingly, last all of week was 20% higher. And today as a single day, we are looking at 25% of a jump coming for the crude oil prices therein. Well, the airstrikes have hit Iran's facilities in Al-Broz is what we understand, and that has taken the prices on the higher side. And then the major reason really has been Strait of Hormuz. This is the point that we have been talking about even as the war had just started to begin and many parties said that Strait of Hormuz would not be shut. This is where 20% of crude oil passes through and much of that is shut now. Today is a 10th straight day of this conflict therein and the Strait of Hormuz has been shut for 6 days therein. So West Asia producers are also curtailing their production and that has led to also increase in prices. Remember, there is just about enough storage for them to keep crude and if you can't ship it out, they are cutting production because of that as well. So I'll talk about various countries therein. You have Iraq, where the output of nearly 3 million barrels per day is what they have been doing, but 3 southern oil fields is where we have seen output there being shut. So 4.3 is before war, after war it stands at 1.3. 70% of a decline is what we've seen in sense of Iraq there. Take a look at UAE and there as well, they seem to be managing offshore production, addressing storage needs as well. From 3.5 million barrels per day of production in the month of January, UAE also has seen a decline of around 25 to 30% is what we understand. And then it is about Kuwait, which also has cut its oil production and refinery output. It produced 2.57 million barrels per day in the month of January. That seems to have declined quite sharply as well. Saudi also is known to be diverting some crude via Red Sea, but not too much. And that also is a longer route and delayed shipments, and that would lead to increase in prices as well. JP Morgan, in the meanwhile, says that the production cuts could exceed 4 million barrels per day if Strait of Hormuz continues to remain shut, and that's nearly 4 to 5% of the overall global consumption therein. Even as we speak, we're looking at newer highs there, $116 a barrel now for the crude oil prices there. This is what we've done in sense of prices then. Last 1 week has seen 40% gains. Last 1 month, 60% now. And for this year till time, we are up by nearly 80 to 90%, depending on what crude variety you're watching at. Let me also take you through prices on how we started this year really. 1st of January, the prices were at $60 a barrel. We did see gains up to 71. This is during the tariff conversation that we seem to be having. And then after that, immediately after that, we saw that conflict start. Crude prices jumped up by $6 to $7. So 71 to 81 came in within 2 days there. 5th of March, we were trading at around 85. On Friday, we were surging to $92 a barrel. That is where we closed. And today, we are trading at $116 a barrel. It has doubled from where we started on 1st of January. From $60 a barrel to $116 at this point in time has been a huge surge that the crude prices have seen. Now, when you look at it from the India's context, well, 85% of our oil requirement is imported. Not just crude oil, but various crude derivatives as well. So whether it is about LPG or LNG, we import nearly 85 to 80% of those as well. And the markets do believe that, not as of now, but you could be looking at higher prices and supply constraints coming in for India as well. Not just in sense of availability, but this has impacted the Indian rupee as well. Rising inflation is going to be another concern that perhaps not just India, but various other importing countries could be looking at. And finally, when you look at the kind of banks and brokerages report that seem to be coming in, $100 was supposed to be a level in dire consequences. Now that we are standing at 116, there are reports of $120, $140, $150 a barrel as well, depending on how longer this conflict is prolonged and how long you have Strait of Hormuz shut as well.
Yeah, absolutely. Manisha, right off that queue and the stats that you gave us, we have another important conversation on, with the management of MGL. Sandeep Kumar Gupta is chairman of Mahanagar Gas. He's also the former CMD of GAIL. So someone who's really knows the entire sector very, very well in terms of our dependencies on, imported gas and what the lack of that gas can do and can mean for both consumers here, households and industrial consumers as well. Sir, good morning. Great to have you with us here. Prashant this side.
Good morning, Prashant. One correction. I was chairman of Mahanagar Gas Limited till 28th of February last month, and I retired from GAIL India Limited as chairman and managing director. And this position was an ex officio position, so I have retired from MGL also.
So just we'll make that correction. So former MD, former chairman of Mahanagar Gas. So thank you for that correction, sir. So spot LNG prices, right? I think have doubled to about $24, $25 per MMBTU. Could you give us a sense? Now, I'm assuming since you're not running these companies and recently retired, I hope you can talk more freely in that sense. What is the situation, sir? With spot prices having doubled, what is the dependency on imported LNG? Are we already seeing cuts with regards to how much we are getting compared to how much we need?
Yeah. Prashant, as I mentioned a couple of days back also, in India, the total consumption of gas presently is around 190 million standard cubic meters per day. And out of that, about 50% is imported. But from Hormuz Strait, only about 60 million standard cubic meters per day is imported. And this 60 million standard cubic meters per day for the period when it is disrupted, I think India can manage very well by cutting the non-essential supplies to various industries, whether they are refineries or petrochemicals or ceramics or steel. This consumption can be cut, and we can sustain the supplies to the houses in the form of PNG, and also to the vehicles in the form of CNG, and also to the fertilizer plants, because the fertilizers, the urea fertilizer is dependent upon natural gas. So that also can be sustained irrespective of the period when this disruption continues. So the affected parties will largely be industries and to some extent the commercial establishments which use the piped natural gas.
So, since this started, I think this entire conflict started 27th, 28th, right? And you pretty much stepped away right at that point. Would you have any sense of what is the situation right now? I mean, actually, what is happening?
I believe certain cuts have been imposed for fertilizer plants also. I think there is no issue with domestic PNG or to the CGD supplies also. And the fertilizer cut, I believe, is largely in the wake that we are approaching year end, and normally all fertilizer plants would have completed their production quotas for this particular year. As such, this is a period when most of the fertilizer plants take shutdowns. So I believe that cut may be in that way, and I do not believe that
Yeah. Would you say that, and what you also said earlier, right, sir, that you think that industrial PNG will be broadly, I mean, that's the philosophy from the government as well. Industrial piped natural gas supply will be protected at the cost of industrial supply.
No, I'm saying that the industries, whether it is in the form of piped natural gas from the CGD entities or otherwise from the main lines by the GAIL or by other players, that may be affected, but that should not be a big cause of concern. What we need to protect is the consumers, the end consumers, the retail consumers, which are protected because domestic PNG will continue. And the CNG supply should also continue. There is no, this 60 million metric ton, 60 million standard cubic meters per day cut, which passes through Hormuz can be managed very well. And on the prices also, since these are the priority sectors as per government mandate also, so I think they are as such getting a large supply through APM. So domestic PNG will definitely be protected at those prices. There can be a small increase in the CNG prices, but that has to be seen if the war prolongs and if the cuts have, if the prices have to be imposed, some increase has to be imposed on CNG prices.
Yeah, you already but that's I just paraphrased what you said, sir. That residential PNG is usually at times of these spikes is usually protected. That is the first retail, as you said, is protected. On the industrial side, if necessary, there may be some minor cuts, right? That's the philosophy.
Yes.
Generally speaking, just those numbers, sir. How much do we? I think you gave the numbers, but just to repeat, how much of the gas imports that we get in comes through the Strait of Hormuz?
So I said India is consuming presently about 190 million standard cubic meters per day, out of which about 50% is imported. So about, say, 190, 85, 95 MMSCMD is imported. And from Strait of Hormuz, only 60 MMSCMD transits.
Okay, only 60 transits. So about one third of...
50% is domestic production, which is in any case there. And almost 30 to 35 MMSCMD of imported supplies are also there, which comes from USA, which comes from Australia, which can come from other parts of the country, other parts of the world through portfolio contracts.
Got it. So you're saying that it can be what comes from the Strait can be replaced from these other sources, is what you're saying?
Yeah, that can also be replaced. Now, definitely, everybody is scrambling for gas. So naturally, the prices for those spot supplies, as you have mentioned, have shot up to $24, $25. So naturally, it will have a cost if those supplies are to be sourced from other sources. So if industries want to bear that cost, additional cost, definitely the supplies would be available.
Will, in your long experience, will they do it, or will they? It makes more sense. I mean, it doesn't economically for most. It will not make sense at those levels.
It may not make sense, yes, at these prices, yeah.
Right. So then where is this disruption likely to show up in a big way, sir?
And in the case of natural gas, I do not see this showing up very drastically as far as domestic PNG or CNG is concerned. For industries, definitely there are other alternatives also, like there can be propane, there can be other liquid fuels also. The more problem is in the case of crude oil and in the case of LPG, because unlike natural gas, the crude oil has to be then processed and then the petrol or diesel or other products are to be produced. And in the case of LPG, the situation is little delicate because India imports about 65% of its LPG requirement. And out of that 65%, out of the total imports, about 90% comes from Middle East only. And of all the LPG which is consumed in India, about 87% is domestic PNG, is only 13% is industrial or commercial. So there the problem is little more, and we will have to see. Presently the Saudi CP prices for this month were comfortable, but going forward, the price rise will also be there besides the supply constraints.
Yeah. Thank you very much. Lots of numbers, lots of data, and I hope you'll join us again, sir, as we continue to track developments because they are fast evolving. Hopefully, they don't last. This current situation does not last for long, and prices come back. But thank you very much for joining us here on CNBC TV 18. Time for a quick commercial break here. We'll come back in just a bit. and we'll, of course, focus on the markets. Nagaraj Sethi of HDFC Securities on the other side.
अरे टेंशन किस बात की? सेंचुरी प्रोबूट का प्रीमियम प्लस है ना, लो एमिशन है, हाई डेंसिटी है, वाटर रेजिस्टेंट भी, टर्माइट एंड बोरो रेजिस्टेंट भी है। यानी ये है जहां नो टेंशन वहां।
प्रीमियम प्लस बाय सेंचुरी प्रोबूट।
मेरा रुतबा है मेरा सिग्नेचर, मेरा जज्बा है मेरा सिग्नेचर, बेबाक है मेरा सिग्नेचर। सिग्नेचर फाइनेस्ट सिल्वर इलायची, अ प्रीमियम प्रोडक्ट फ्रॉम दिलबाग ग्रुप।
अरे टेंशन किस बात की? सेंचुरी प्रोबूट का प्रीमियम प्लस है ना, लो एमिशन है, हाई डेंसिटी है, वाटर रेजिस्टेंट भी, टर्माइट एंड बोरो रेजिस्टेंट भी है। यानी ये है जहां नो टेंशन वहां।
प्रीमियम प्लस बाय सेंचुरी प्रोबूट।
ये हैं कोटक नियो के तेज ट्रेडर।
निकी इंडेक्स डिप्स एंड स्नैप्स बैक।
ये ट्रिगर गिरावट का है, कसम कैंडलस्टिक्स की।
बेचो और बचो।
ये करते हैं शोर को इग्नोर, और ये हौसला जानकारी और तैयारी से मिलता है। Stay तेज with कोटक नियो। Investments in securities markets are subject to market risks. Read all related documents carefully before investing.
मेरा रुतबा है मेरा सिग्नेचर, दुनिया की सोच से ऊपर, बेबाक है मेरा सिग्नेचर। सिग्नेचर फाइनेस्ट सिल्वर इलायची, अ प्रीमियम प्रोडक्ट फ्रॉम दिलबाग ग्रुप।
This is Network 18, and you're watching CNBC TV 18.
Welcome back. Still nearly 700 points lower on the Nifty. No recovery in the first 1 hour of trade. Sensex down 220 points. PSU banks are selling off. In fact, the Nifty Bank itself is down more than 4%. Top losers include Interglobe Aviation, that's 7.5% down. In financials, you've got SBI, Shriram Finance, Geo Financial, Axis Bank, ICICI Bank, HDFC Bank, all seeing losses between 3 to 6%. And Asian Paints, Maruti, L&T also taking a leg down. Nagaraj Sethi, Senior Technical Research Analyst at HDFC Securities, is now joining in. Nagaraj, after this open around 23,800 and lower, what are you doing?
Hi, good morning, Rima. Yes, the market is just echoing the global sentiment. This is a clear sell and sell on rise market. The opening downside gap, which are open on the daily and weekly chart, indicating the havoc in the market, which is happening right at a time. The support level are the just levels where market tend to penetrate in such during such times. And I wouldn't be surprised if 200, 300 points of bounce back from here on could met with severe selling pressure somewhere around 24,000 levels. So this is going to be a sell and sell on rise opportunity for the market. At the lower levels, I'm expecting around 23,200 to 23,000. There are some areas where we can see some base building, at least some bounce back at the lower levels.
So you expect bounce only to come in at 23,200, 23,300. So still about 500 points, 600 points lower from this level. Are there shorting opportunities in individual stocks?
Yes, of course, there are a lot of shorting opportunity. First one from PFC. Chartically, if you look at the chart of PFC, it has been in a distribution phase around 4828, 430 levels. It has broken below the important support of 200-day EMA. Kind of a fresh sell-off is happening in this counter, which is the best good opportunity technically for a shorting. Currently trading around 389, 390. One can look to short at this point of time. Immediate target would be around 368 to 370, and one can place a stop loss at 400. Second one is from a metal front. Steel Authority has been in a strong up move recently. We have seen some high tops and bottoms, encountered the hurdle around somewhere around 168, 169, declined sharply with a gap down opening. The overall chart pattern is looking weak for the sale. Currently trading around 147. One can look to short at this point of time. Immediate target would be around 138 to 140, and one can place a stop loss at 155.
Thank you very much for that. It's an all-down day. Out of the Nifty 50 stocks, only 2 of them are in the green. That's Coal India, Reliance. 48 out of the 50 stocks in the red. And in the Nifty 500, nearly 480 to 490 stocks currently in the red. As the West Asia war has disrupted oil production and key shipping routes, the problem is the surge in the oil price is now well past $110 per barrel. Sudarshan joins in with key data on crude and the impact in the Indian markets.
So today market is under pressure following the weak global cues and the sharp rise in the crude prices that we have seen in the last 48 to 72 hours. And one basket in the market which is impacted the most because of the increase in the crude price is all the crude sensitives. You talk about oil marketing companies of IOC, BPCL and HPCL, to all the paint companies, Asian Paints, Berger Paints, Kansai Nerolac, to all the other crude sensitive like even aviation companies, Indigo, SpiceJet, Asian Paints, all the stocks are trading with sharp cuts. So we have to understand at this point what had happened in the last or previous cycle when crude had seen a major increase. That was at the end of 2021 or in the beginning of 2022 when we were faced with the tensions between Russia and Ukraine. And that time in December of 2021, crude was around 68. Now in the next 3 months, that was of 31st January, first I'll talk about January, it had risen to 91, and in March it had risen to as high as $139 per barrel, and that was the level of Brent crude. What had happened to Nifty in the same period? In December 2021, Nifty was around 17,065. Over the next 3 months, we had seen a decline of almost 8%, and Nifty had gone to as low as 15,700. Now, how much time did it take for crude to come back to the levels between 68 to 70? So to $70 per barrel, it had gone in March 2023, it had come back, and Nifty was almost at the same level that it was at the beginning of 2022. And it took almost 3 years for Nifty to go to the level we had seen in December of 2021, that was 68. But in the same period, there was a sharp recovery in Nifty. From the level that we had seen in the early part of, or say, March 2022, Nifty was around 15,600. And from there, we had seen a sharp recovery. And in March 2025, Nifty had gone to as high as 22,300. So in a nutshell, it might take time for crude to go back to those levels or the lows that we have seen in the last month. But if there is a recovery, there might be a sharper recovery in the market if any kind of easing of tensions that we might see over the next few days.
Thank you. That's what we're all hoping for. For now, markets are tense, and even the India VIX today has surged about 22%. The level right now is 24.07. We will get into a break. On the other side is our special segment. Lata speaks to former SBI Chairman Arundhati Bhattacharya in a Women's Day special.
Red.
This is Network 18, and you're watching CNBC TV 18.
Welcome to It's the Economy. It's International Women's Day, and we cannot celebrate International Women's Day unless we have one of the most successful Indian women in the world of business in India Inc., Mrs. Arundhati Bhattacharya, former chairman of State Bank of India and now president and CEO of Salesforce South Asia. Mrs. Bhattacharya is also the only woman chairman of State Bank of India so far, and the only public sector banker, between men and women, the only public sector banker to be honored with the Padma Shri. Mrs. Bhattacharya, thank you very much for finding time for us.
You're welcome, and it's always a pleasure to, talk to you.
Okay, Mrs. Bhattacharya, first questions about Women's Day, and then I'll get to other boring questions as well. But, in your career, in your autobiography, you even point out that you had to be in what was then called the Badlands of UP. What were the most challenging things you found as a woman banker?
Well, it wasn't always external challenges, there were many internal challenges as well. And when I say internal challenges, I mean the fact that you are constantly having to prove yourself, especially when you're younger. People are never too sure as to where your priorities lie. So, time and again, you have to sort of make sure people understand that you know how to prioritize, that it's neither the office nor the family, but that priorities will shift and you will have the wisdom to determine which is the one that's more necessary, and you'll be able to act accordingly. That's one piece. The second piece also is that, you have to constantly be able to prove that you can add value to any team, to any situation, to any conversation. So you have to be literally on your toes all the time, trying and understanding the situation, trying and learning as much as you can, literally learning on your feet, because the bank has this system of transferring you very often. They transfer you not only from job to job, job family to job family, but also from place to place. So your ability to be agile, to be nimble, to be able to compromise on so many issues and still come up and deliver is something that you have to constantly work on. So there are a number of challenges that women face, whether it be from the family, though really speaking, my family has been very supportive. But even then, there were a number of times that I fell short of their expectations. And obviously, that's not very pleasant. And you do have these little tiffs and these little problems, and you need to get across all of that.
Now, let me come to the more important business issues. This whole concept of artificial intelligence, how are you seeing it from an India point of view? Are we going to stare at something negative like job losses, or is it going to be different? We're going to be pleasantly surprised with productivity gains.
We just finished the AI Impact Summit, right? And I had thought that in the AI Impact Summit, I would witness a lot of fear, a lot of apprehensions. And I was very pleasantly surprised that instead there seemed to be a lot of energy, a lot of, curiosity, and people actually were very enthusiastic about what they could do with AI. And this was very well brought out, in this little fireside chat that I had with Nandan Nilekani. And what Nandan said was that India is a country where a lot of people have benefited from technology. And when he talks about that, he talks about Aadhaar, he talks about the Prime Minister Jan Dhan Yojana, he talks about UPI, which has made lives easier for a lot of people. So, at the grassroots level, people have got the opportunity of getting included in the banking system, of, the ease of payments, which even we are experiencing the ease of payments.
Absolutely.
So with all of that, what has happened is people are not so negative about the march of technology. Unlike in the Western world, where actually speaking, they do have labor issues, they don't have that many youngsters, and they will benefit from AI. And yet, I see much more apprehension there than I see in India. In India, in fact, there is so much more of curiosity and energy and a positive, feeling about what AI can do for us.
Okay.
Now, if you ask me, what do I feel? I personally feel that India being so populous, there is no way that we can give our people what they deserve in the way of standard of living if we do not accept more and more of technology. Technology alone can empower us to actually deliver to the people what they deserve. Because there is no brick and mortar way of bringing this to the people. It's way too costly if you try the brick and mortar way. So the only way that we can really get our people to have the services that they need, whether it be in the area of education, it be in the area of financial inclusion, it be in the area of health, in any of the social areas, you need technology. Okay. Not only that, even in the area of creation of jobs, you have to use technology in order to take care of the pain points that people have. And as you go about doing that, jobs will get created. Now, having said that, there will be a very difficult time of transition. The older kinds of jobs will get phased out and the newer ones will still not have completely arrived, or people will not know how to get on with the newer ones. So there is going to be a full transition stage, which we will have to overcome. So I'm not saying that this is going to be entirely painless, but like every other industrial revolution that we have had in the past, there will be jobs that will be lost. There will be jobs that will be created. It's the transition that we have between the two, which if we can try and make it seamless, if we can be visionary enough to know what that transition is going to look like, what are the skills that you will need to have in order to, navigate the transition seamlessly, that is what is going to happen.
Fair point. Okay, now let me ask you to wear your banker's hat and answer similar questions, ma'am. Bankers today will face two problems. One will be what you have seen. The savings intermediation has gone away from banks. They have had to share it with mutual funds. How would you have tackled that? Or how will the system tackle it? And secondly, AI will also impinge over there. Do you see job losses, retraining? How do you see AI and banking?
So the way I see AI in banking is that a lot of this mindless servicing will be done by AI. Okay. Now, what will that do? That will release a lot of people back to actually connect with people. So, the sales teams will become bigger. The outreaches will become bigger. The advisories that the banks do will become bigger. So wherever you need human interaction, human empathy, that is the area where, the numbers will go up. And the areas where, you just had to do certain things in order to get servicing done, that can easily be automated and be done by AI agents. So, say, for instance, if you come to submit your life certificate or you are doing it even remotely. Now, what will happen? Actually speaking, the entire system of marking of your life certificate is something that can be totally automated. You don't really need to get there and do it. But then will it give the person a chance to actually have a conversation with the pensioner? Yes, it will. Because earlier that time was being taken up by doing certain, manual processes or semi-automated processes, which now can be done by the agentic enterprise. And you can have the time back in order to connect with the pensioner himself or herself and find out whether they need any further services, whether there is something more that you can do for them. So, those are the kinds of changes that are going to happen. So any place where human interaction is important or can be improved, that is the place where banks will need to concentrate on so as to move them into getting people to be more in connection with their customers and allowing the processes to run by themselves to be automated as long as the documents that come in are okay. And even the scanning of the documents and the triaging of the data to ensure that they are the right documents, all of that can be automated.
Okay.
So you can take the entire drudge out of banking work and get people to move to a people-to-people communication, which is, again, I think, both in the area of health and money, because money means security. I think it's very important and it's very necessary.
Fair point. But I must quickly get your view on the earlier question I asked you. the current State Bank of India chairman was with me a few days back. This fleety and expensive deposits because of changed intermediation. If you were here, his answer was more securitization. My liabilities are becoming speedier. Let my assets also be speedily done. But your views?
No, absolutely. You know, everybody is accepting asset-light models.
Okay.
What do you think a cloud is? A cloud is an asset-light model, right? Everything was supposed to be on-prem.
Yes.
Now you're Uberizing the use of the servers. Okay. So you are using an asset-light model. You are no longer paying for the infrastructure. So also the bank's balance sheets. The banks need to do that securitization to get their balance sheets lighter. Okay. That's on the asset side. But on the liability side also, you'll have to become a better player in the market in order to be able to raise those funds. You know, there was a accusation that was done sometime when I was chairman that our treasuries are lazy treasuries. Frankly speaking, there is no scope now for treasuries to be lazy because they actually need to be in the market in order to make the best of situations as to when they can raise funds. And if you look at all the Western banks, none of them are deposit dependent. Because as you evolve, as your economies evolve, the depositors will find better ways of investing their money that will give them better returns, and the risk appetite will go up. In our generation, because we were supporting a generation above us and below us, our risk appetites were very low. The current generation is supporting nobody other than itself, and therefore the risk appetites are higher. And they obviously will therefore not only want, you know, low returns and low risk. They're willing to take that risk. They will go in for risky kinds of assets and risky kind of instruments. So they will play in the market. And therefore you also need to be a player in the market.
Fair point. Point taken, ma'am. It's never occurred to me that I'm speaking to a woman chairperson of, or chairman of SBI. And it doesn't feel that we need to even celebrate Women's Day. People like you have arrived. Thank you very much for joining us on this very special occasion.
Thank you very much for having me.
Well, that's it on this special edition of Bazaar. After a break, Chartbusters.
Business tenfold in the coming years.
Bears grip tightens on the last trade. The Nifty slides into a technical correction below 24,000 levels. Now 10% of January highs. The breadth heavily in favor of declines. PSU banks and autos feeling the heat the most.
Brent crude marches towards $120 a barrel as geopolitical tensions showed no signs of respite. OMCs, paint companies, tires bleed in trade. Former HPCL chairman and MD M.K. Surana tells CNBC TV 18 that worries remain tilted towards supply more than pricing.
Geopolitical tensions choke LNG supplies, triggering risks of higher prices, reduced operating rates and temporary shutdowns for fertilizer makers. Stocks across the sector are under pressure.
A firm dollar puts a safe haven gold and silver under pressure as lofty energy costs fuel inflation fears and caps prospects for rate cuts. Hindustan Zinc and Muthoot Finance feel the heat.
And shares of Meesho crashed nearly 10% in early trade after the company received an income tax demand notice of nearly 1,500 crores. The company refutes claims, says they will contest the order.
Hello, good morning. You're tuned into Chart Busters, coming live from the CNBC TV 18 Motilal Oswal studios. I'm Vinny Motiwala. With me is my colleague Ekta Batra as well. And today, in terms of the markets, red across the screen coming in. Again, a gap down start. And obviously, there's no de-escalation that one has seen coming in from the US-Iran war that's been going on there. And that is why the market today is trading below 24,000, now 23,800. It's below that level as well. There's no respite, no recovery that is seen since the start of the day as well. 2.8% decline that we're seeing coming in for the Nifty in terms of the trading session. Apart from that, the broader end of the market also continues to be under pressure. And in terms of levels that we've seen today, actually is the lowest level that the Nifty is trading at in 2026, and markets are now into the technical correction level as well. That's 10% correction from record high. So Ekta, today again a sea of red coming in on the screens.
Hi Vinny, yes, absolutely. And you know what's concerning is that we are not seeing any kind of buying at lower levels which is coming through. In fact, at one point in time we had around 3 stocks which were trading in the green in the Nifty, and that slipped to around 0 stocks trading in the green in the Nifty, and now you can see just about 1 stock holding its head above the water. Separately, just watch out for what's taking place on the FII stable, because we did have another sell figure of around 6,000 odd crores coming in on Friday. So there has been continuous relentless selling which has taken place from the 26th of Feb in our Indian markets when it comes to the FIIs, continuously net selling. But nonetheless, it is definitely a very tough market on our hands, and we have Hormuz who's joining in to give us an overview on what's taking place. Hormuz, over to you.
15 lakh crore is what we lost at the lowest point of the day so far for our markets. But the bigger story, the bigger trigger for what's happening today is oil. And it's not just on the boil, it has overflown the vessel now in terms of the price movement. Brent is up 27% as we speak, nearing 120, as is the US crude prices. So both of them now nearing the same price point, $120 a barrel now for oil prices. And this rise in oil prices has had a cascading impact on the other asset classes as well. It's a record low for the currency in terms of the dollar, and the yields as well now at 6.76 as we speak. So rise in yields, a falling rupee and rising oil prices. It is a triple whammy for the Indian markets, and that is showing up now on the index. Both Nifty and the Nifty Bank have now entered a technical correction. 4% lower for the Nifty Bank, 2,500 points shaved off in a single session, 700 gone on the index. So it's a technical correction for both the Nifty and the Nifty Bank. You look at the extent of the sell-off. The Nifty, 49 stocks in the red. Every single stock on the Nifty mid-cap index is trading in the red currently. 95 stocks in the small cap index and 490 names on the Nifty 500, all of them trading with losses as we speak. The oil price shock has not boded well for the oil marketing companies. HPCL, BPCL, IOC, all of them down up to 6.5%. In fact, HPCL at one point was even down 8%. The others that get impacted because of this, aviation, look at Indigo, 7% lower. It has received an upgrade today and yet it's down 7%. JK Tyre, CLSA wrote a very damning note on the tire sectors on Friday, down 8% as we speak. GSPL 2 trading with losses of around 8%. The rise in bond yields has had an impact on the PSU banks. and on the NBFCs as well. Every single stock on the PSU Bank Index trading with losses. Bank of Maharashtra is down 7.5%. Bank of India is down 7%. India's largest lender, State Bank of India, was at record highs at the start of this month, is down 7% today. And of course, in the NBFC, Shriram Finance leading the losses, they're down 5% as well. The one sector that's bucking the trend today is sugar. It did so last week as well. It's doing so today. Balrampur Chini is up 1.5%. Praj Industries is up 3.5%. But the smaller names are the ones that are making the bigger noise. So Dwarkesh is up 6%. Dhampur Sugar is up 4%. Of course, they are not the most traded names, not the most liquid names. The one sector that's bucking the trend. Otherwise, everything you see is in the red.
All right, Hormuz, thanks very much for that. So a little bit of a sweetener, at least in terms of the sugar stocks, but nothing really at that point. Just want to also point out that all of the Bank Nifty constituents are currently in the red and trading with deep cuts. SBI, as you can see, is currently down sharply in today's trading session. The Nifty Bank itself is down around 4%, but the Nifty Bank constituents should come up for you. All of those stocks in the red. So sharp cuts which are coming in. State Bank of India, ICICI Bank, HDFC, Axis, all of them currently trading with deep cuts. But let's focus on one particular stock. We have K. Ajit Kumar Rai, who's the founder and chairman at Suprajit Engineering, who joins in now. We will be discussing the following talking points: the impact of geopolitics on financials, chip supply concerns at this point in time, electronics and control division outlook as well. Mr. Ajit, thank you very much for taking the time out and speaking with us. If you could just highlight and give our viewers a sense in terms of what the impact of the West Asia conflict is exactly on your business.
Good morning, and thank you for having me on your channel. In terms of the impact of what's happening in the Middle East, to us is pretty minimal. You know, our business is mostly in North America, Europe, and of course, India and China. We do have some business in Middle East, particularly relating to our Phoenix Lamps division, where we sell some of our branded products from Europe into Middle East, and thereby it gets distributed. I think that part of it has been suffering all through the year, not just because of this, even before that. I think that would continue as long as this is there, but it's actually not material for us. So the overall impact as of now on the business is very minimal. But what we are seeing because of the increase in price of oil, it will have issue on the downstream, products like engineering plastic prices are expected to go up. The gas prices, like propane and other things will also have an impact, which are all used by us in our industry. So I would say that as the prices go up, it will have a cost impact as an input for us in our manufacturing.
Right.
On that, in terms of the demand, we don't see any issues as of now.
Mm-hmm. Okay, so hi, Mr. Rai, this is Vinny joining in the conversation as well. Like you mentioned, right, input cost, if that sees an increase, that will impact. So what would that possible impact be? Because I believe your margins, even in Q3, were lower than the guidance that you've given. So does that mean for the full year, maybe you would have to lower your expectations given the geopolitical tensions that are going on?
I think the margin guidance that we have given for the year is between 12 to 14%. As the margin, excluding our SCS operations for the consolidated entity. I think we are very much there. I don't think there is a problem in meeting those margin guidelines. What I mean by some of these input cost price will is, again, minimal for our overall operations, but the guidance remains the same.
Okay. So just to drill down further, Mr. Rai, as of now, you're not seeing any kind of disruption in terms of input costs. Is that correct?
At the moment, no, but we do see that maybe our purchases from April onwards could have a price impact on, let's say, certain engineering plastics. And for example, we use propane gas in our Phoenix Lamps division.
Okay.
There will be some restrictions by government. So they're all small inputs for us. So I don't really see that being a big impact.
Sure. Just on your electronics division, we do understand that, you all deal with memory chips there, and there's a fear of shortages taking place. Is that something that you all have looked at? Is that a risk that you all are accounting for at this point in time? Just explain that to us.
The shortage of chips is, again, We feel it as a transitionary, not really a long term. We do have stocks for the time being, but I think the issue is of pricing of some of these chips. Some of them have increased their prices significantly. But there, I think we are working with our customers to make sure that the impact has been shared by the customer, not just by us.
Mm-hmm. And sir, what about your other divisions as well, or I beg your pardon, the acquisitions is what I want to talk about as well, the recent ones, SCS. What is the performance there? What is the expectation there now?
I think we have guided that, after the last 1 year of restructuring and completely revamping the operations, we will have an EBITDA break-even by end of this financial year, by March. As you have seen in the third quarter number, I think we have covered a significant distance in that direction. And we expect to meet that deadline that we have given earlier by end of March. So it's going as per the plan. All the restructuring is done. It is done well, and it's all been gone ahead at the same pace that we expected to do.
What are you targeting in terms of, incremental order wins at this point in time? If you could just highlight what it has been like in both of your main divisions. And you said that you're not seeing any kind of disruption in demand as of now.
At the demand, we have not seen any changes as of now because of the Middle East disruptions. So that is for sure. Overall, I think this year has been a year of lots of ups and downs with multiple challenges. So we are actually guided a double-digit growth for the group, excluding SCS. We'll just about meet it, maybe we're 8-9%. So to that extent, there may be a small gap. But I think considering the geopolitical conditions, I think that's a fair performance. But with the SCS, we would be comfortably in a significant double-digit growth for the year. And with the SCS turning around, we expect that next year would be an even better year for us.
Okay, Mr. Rai, thank you so much for joining it this morning, explaining us the outlook of the company going forward, and in terms of that minor impact, maybe not a major one, from the US-Iran war as of now is what is anticipated. But that was the management of Suprajit Engineering talking to us about the outlook of the company. On that note, we are actually going to slip into a very short break. We'll come back and we will be joined by Dev Garg, who's the Vice President of the Indian Rice Exporters Federation, talking to us about the impact of this West Asia war on exports as well. Stay tuned.
Warship in the same.
soon.
Welcome back to Chartbusters on CNBC TV 18. Now we have Dev Garg, who's the Vice President of Indian Rice Exporters Federation, joining us to discuss the impact of the war in West Asia, what it means for exporters as of now, and what's the issue that is going on. Mr. Garg, good morning. Thank you so much for joining us on the show. If you could just start by talking to us about the impact that's come in the last week, especially for exporters as well. What are we seeing for rice exports? Anything in terms of reduction in exports that you all have seen, or the ships that have been stopped as well?
So the biggest casualty of this war has been the marine fuel cost. Today, the bunker fuel cost, which is the main ingredient for all ocean voyages, because the rice is a very bulky item, it is transported by ocean. So any increase in ocean freight will have a major bearing on all our exports. So today, that marine fuel cost before start of this war was at $520. Today, it is at $800. And it is expected that this will go up further. So internationally, if you look at the freight prices, they have gone up by more than 20% in the past 1 week. Even container freights have gone up more than 40%. This has far-reaching implications for all our exports beyond the Middle East as well. Today, if we look at our major markets, which is the West African market and the North American market, so the freight rates have, in some cases, have gone up till 400%. So this is a very concerning situation because today, all our exports have been hit. Export to the Middle East, which is the biggest market for Indian basmati rice, it constitutes more than 50% of all our basmati rice exports, have come to a grinding halt. All our exports are there in three scenarios. Firstly, there are many shipments that are stuck at Indian ports. As per estimates received yesterday, about 3,000 containers are stuck at the Mundra and Kandla port, which is 60,000 metric tons of basmati rice. Moreover, about 100,000 metric tons of rice is in transit, which is being offloaded by various shipping lines at any ports. We have cases where the cargo was destined for Jebel Ali port in Dubai. However, it was offloaded in Oman, or it was offloaded at the Salalah port. So it is a very concerning situation for all the exporters, and in many cases, the exporters had to even call back the cargo to India, which is a significant loss because, calling a single grain of rice back to India after it has been exported is is almost 30% of the cost an exporter has to pay, which is a very significant cost in terms of rice because no exporter has such margins in their business. Moreover, today the insurance premiums have risen by almost 4 times. This is a very concerning situation because every rice consignment has to be covered by insurance. So beyond Middle East as well, all our exports today are at risk. Today, last year we exported around 117,000 crores worth of exports, out of which nearly 60,000 crores came from the Middle East. But this entire 117,000 crores worth, 117,000 crores worth of export today will be very, very badly hit. We have seen in the domestic market that the price in the wholesale market, which is for 1509 Sela, which is around 70 rupees per kg, has fallen by 6 to 7 rupees per kg in the past 1 week. And in 2012, when Iran had stopped buying from India, we had seen this price hovering around 28 rupees per kg. Okay. So the prices in the domestic market also may fall. Okay. We are today in a similar situation that we were about 10 years ago when we had a bumper crop and Iran had stopped buying. This issue or this concern today is on steroids. Okay. Because other than Iran as well, all our exports will be hit. All our exports to the Middle East. Let's look at the top 5 countries to which we export.
Sure. Mr. Garg, just on account of paucity of time, I just wanted some information with regards to the containers which are stuck at this point in time. If you could just reiterate the amount which is in fact stuck at the ports when it comes to basmati rice at this point, and what is the alternative that you all are thinking in order to remediate that?
Look, we have 3 situations in front of us. In the first scenario, the goods are stuck at the Indian ports. As per our estimate, that cargo is around 3,000 containers. That is roughly around 60,000 metric ton, which is lying at Indian ports. Majorly, this quantity is at Kandla and Mundra port in Gujarat, from where most of the exports to the Middle East happen. Next, if you look at the second scenario, then we have cargo which is in the ocean during transit. That quantity is estimated to be around 100,000 metric ton. And third are cargoes that have reached the destination. So those cargoes are also estimated to be in the range of about 150 to 200,000 metric ton. So in total, around 350 to 400,000 metric tons of basmati rice is today at risk. Our monthly exports to the Middle East are around 400,000. Now, every situation has a different solution to it. For cargoes that are lying at Indian ports, exporters are trying to arrange for alternative routes for their cargo to reach the destination, which is very difficult in this scenario because we have seen that the shipping companies have imposed war surcharge of about $2,000 per container. I'll give you an illustration. In the case of Saudi Arabia, the freight cost is $600. And today, if you impose a war surcharge of $2,000, the freight cost has become $2,600 from $600, which is a jump of more than 400%, which no exporter can bear. So in these scenarios, the exporters are invoking the force majeure clauses, and they are also canceling their containers. But the shipping lines and the port are levying huge charges on these exporters. So we have requested the government to to pass a direction to the shipping companies as well as the port authorities to waive all the penal charges in cases where, because of bona fide reasons, exports could not be made. In the second scenario, where the cargo is in transit, there are two options. First, one, the exporter can divert their cargo to any other destination where they might have the distribution network. In many cases, exporters have diverted their cargo to Europe and to the North America, where they can sell their cargo. Or in the alternative, they can call back their cargo. But this is not an ideal situation because even if you go for any option, it will entail more than 20 to 30% cost of your goods, which is a very substantial loss for any exporter. Thirdly, any goods that have reached the destination or are hit by this conflict, those exports will have to wait because the entire distribution network in those foreign countries have been disturbed. The payments have been delayed and there is no clarity what will happen.
Right.
So we have requested the government to even extend a 25% COVID-like ad hoc facilities to all these exporters so their short-term working capital cycle can be eased.
Okay. Mr. Garg, just the one-word answer. We have already seen a fall coming in the rice prices, right, on the domestic front. How much more can this lead to if this continues? What is the anticipation? Would it go back to those levels that you were mentioning a decade ago? When we had seen
So the recipe for disaster is in front of us because 10 years ago also we saw the same macroeconomic situation and today also we are staring at the same situation. So it's anybody guess, it would be in the realm of speculation that how much the prices would fall. But yes, a substantial fall is expected in the coming future.
Okay. All right, Mr. Garg, we're going to leave it on that note. Thanks very much for joining in and speaking with us. So that is a concerning situation at this point in time, around 300 to 400,000 metric tons of basmati rice, which is currently stuck in transit in terms of exports. We're going to take a short break, but a lot more on the other side. Stay tuned.
Any of
Welcome back. Well, a little bit of buying from the lows, as you can see. So the low point of the day today was 23,697, and currently for the Nifty we are at around 23,855. So there's a little bit of a respite which has taken place, and that's courtesy the Bank Nifty, which is seeing some amount of buying from the day's lows. So currently just about lower by around 3.5%. Compare this to an over 4% cut when we started the show just about 30 minutes ago. So let's see whether this sustains. On that note, we need to wrap up on the show, but trading hour will take all of the action on the markets and oil forward. Stay tuned.
ये हैं कोटक नियो के तेज ट्रेडर।
Nikki index dips and snaps back.
ये ट्रिगर गिरावट का है। कसम कैंडलस्टिक्स की।
बेचो और बचो।
ये करते हैं शोर को इग्नोर, और ये हौसला जानकारी और तैयारी से मिलता है। Stay तेज with कोटक नियो। Investments in securities markets are subject to market risks. Read all related documents carefully before investing.
अरे टेंशन किस बात की? सेंचुरी प्रोवुड का प्रीमियम प्लस है ना, लो एमिशन है, हाई डेंसिटी है, वाटर रेजिस्टेंट भी, टर्माइट एंड बोरो रेजिस्टेंट भी है। यानी ये है जहां नो टेंशन वहां।
प्रीमियम प्लस बाय सेंचुरी प्रोवुड। मेरा रुतबा है मेरा सिग्नेचर, मेरा जज्बा है मेरा सिग्नेचर, बेबाक है मेरा सिग्नेचर। सिग्नेचर फाइनेस्ट सिल्वर इलायची, अ प्रीमियम प्रोडक्ट फ्रॉम दिलबाग ग्रुप।
अरे टेंशन किस बात की? सेंचुरी प्रोवुड का प्रीमियम प्लस है ना, लो एमिशन है, हाई डेंसिटी है, वाटर रेजिस्टेंट भी, टर्माइट एंड बोरो रेजिस्टेंट भी है। यानी ये है जहां नो टेंशन वहां।
प्रीमियम प्लस बाय सेंचुरी प्रोवुड। मेरा रुतबा है मेरा सिग्नेचर, दुनिया की सोच से ऊपर, बेबाक है मेरा सिग्नेचर। सिग्नेचर फाइनेस्ट सिल्वर इलायची, अ प्रीमियम प्रोडक्ट फ्रॉम दिलबाग ग्रुप।
अगर शूज में फुल फ्लेक्सिबिलिटी चाहिए तो इन्वेस्टमेंट्स में क्यों नहीं? अब अपने इन्वेस्टमेंट्स को दो फुल फ्लेक्सिबिलिटी का एडवांटेज विद फ्लेक्सी कैप फंड्स। म्यूचुअल फंड निवेश बाजार जोखिमों के अधीन है। योजना संबंधी सभी दस्तावेज सावधानी पूर्वक पढ़ें।
This is Network 18 and you're watching CNBC TV 18.
Good morning. It's time for Trading Hour. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Hormuz Fatakia. Joining me from Bangalore, as always, Ritu Singh. Well, it's been a forgettable start to the trading day, but since we are clutching on to any positives that we can, there is a 150-point recovery from the lows of the day. The only question is whether that recovery sustains or not, because every intraday recovery that we saw either on Friday or whatever little that we have seen of today's session as well has been sold into. The bigger question is, of course, that whether that sustains or not. More importantly, whether the oil prices sustain or not. We'll get to that as the day goes by. But Ritu, it's not been a very pleasant start, and it's been selling across the board.
It is, in fact, a sea of red. Hormuz, the frontline index, the broader markets, Bank Nifty. You look at any sort of sectoral index as well, there's a sea of red pretty much everywhere. As we speak, the Nifty is down almost 600 points. That's where we're at, even though we've seen a bit of a recovery in the last few minutes of trade. The Sensex has lost almost 1,900 points. You have the Bank Nifty leading the fall. It had stayed resilient up until Thursday, but since Friday, we've seen that downturn. And today, again, it's extending those losses. The Bank Nifty losing more than 2,000 points in trade today. Leading the pack is the PSU stocks. Those are down significantly, almost 5% now as we speak, led by some of these names like Union Bank, Bank of India, Bank of Maharashtra. They're all down 4 to 5% in trade because of the impact that is being felt, the second order impact of what's going on in West Asia. The Auto Pack, Bank Nifty, Metal, Media, all of them are down, in fact, by 3 to 4% as we speak. Nifty IT, relatively better, still down about 0.5%. So that's where we stand in terms of pullers and draggers. Coal India, these are some of the names that are doing better. But of course, whether that is paints, aviation, they're all seeing the pain. But Hormuz, the Nifty has also entered a technical correction zone. Tell us exactly what that is and the significance of that.
How quickly do times change? At the start of the year, we were celebrating the Nifty hitting a new record high, crossing previous levels, and today, in just 2 months, we are entering a technical correction on the index. The record high for the Nifty, 26,373. Today's low, 23,697, and that is a 10% fall from record high levels on the index, and that is a technical correction for the index or for a stock. Of course, a 20% fall will mean a bear market, but we are still some distance away from those levels. For now, the Nifty has entered a technical correction. Now, what has transpired further, if you take a look at the index so far, now since the 5th of Jan until today, when you see in the index itself, there are 13 stocks that have delivered positive returns, 37 stocks that have delivered negative returns. And if we take a look at the market cap erosion for all BSE listed companies since the time the Nifty hit a record high, that figure is well over 40 lakh crore rupees. And that is the kind of erosion that we have seen on the index so far in terms of BSE listed companies since the 5th of January. Now, which have been the worst performers on the index when it comes to stocks? Well, if you would have thought about it, IT could have been the worst, but that's not the case. There are a few of them, yes. Wipro is, of course, the worst performer, down 26%. Asian Paints is down 23%. TCS is down 22%. There is Maruti in the list. There is Jio Financial in the list as well. 6 Nifty stocks are down 20% from the January 5 levels. Now, there are certain names that have bucked the trend as well. If you take a look, now of course oil sensitives being the one, ONGC leading the pack here is up 16% from the 5th of January. Defense as a pack has done well. SBI, of course, after this correction today, it could have been higher, but still up 7% from that period. The stock was until very recently at record high levels. Apollo Hospitals has also done well during this period. So as of now, the Nifty is looking to recover from those technical correction levels, but is still in the red, still down almost 10% from record high levels. The only question is, when does this stop and when do we see a recovery back to those levels?
Yes, in fact, when we see that recovery is what we're going to be waiting for. But, the markets are, of course, going to take their cue from what happens in West Asia. The war has now entered the second week and you're seeing pain across the board. Oil making big moves there and impacting a lot of sectors, individual movers that we'll get you details of. But that's where we're at. Quick check of what's happening in terms of the market breadth. You have more than 10 stocks that are declining. If you pull up that line for you, for every one stock that is advancing. So, very much in the green. We'll see how the day progresses from here. But as of now, things not looking very good. But we'll move on to the big story of the day. And that, without doubt, is oil prices that have been skyrocketing up 20-25%. What we're seeing in a matter of days is what we would have normally seen in a matter of weeks, months and years. Prices have now soared past $115. In fact, as we speak, at about $112 dollars a barrel mark. Now, let's go across to Sonal Bhutra, who's combined the impact that these high oil prices could have across various sectors and stocks. Sonal.
Thank you so much for that. Well, yes, the impact will be seen across sectors. Now, do remember, India receives around 2.5 to 2.7 million barrels per day of oil from the Strait of Hormuz and around 30% of LNG via the Strait as well. So these are inputs for a lot of segments, and that's how the impact will come by. Let's start with the oil and gas space itself, because ONGC and Oil India, of course, if crude oil prices rise, it will be positive for them because they are oil producers as well. However, do remember, they will benefit only if there is no windfall tax this time around, something that we saw 3 years back because of high crude oil prices. For oil marketing companies, remember diesel and gasoline prices or refining margins, they turn negative if crude is around that $75 to $82 per barrel mark, if retail prices are not increased. And if those prices are not increased, they will have negative margins in the marketing segment. The biggest impact will be on HPCL because they have the largest exposure to marketing segment, followed by IOCL. But BPCL could be resilient because of a balanced mix, while Reliance Industries will tend to benefit in their refining segment because remember, Singapore GRMs have surged to $30 a barrel from around $3.50 per barrel that we saw last week. So for every $1 per barrel increase in refinery margins, their EBITDA could increase by $500 million, which is around 2% of their EBITDA for FY27. But it all depends on how refining margins pan going ahead and if there are no windfall taxes on these margins. For airline companies, of course, it's a negative. Crude is a major raw material. For Interglobe Aviation, analysts suggest that earnings will contract by 13% for every $5 per barrel increase in Brent crude prices. Chemical sector, of course, that is impacted as well. A lot of them have crude-based derivatives, crude-based raw materials. Some of the companies, Coromandel International, GSFC, because of the gas prices hike, as it is also linked to crude oil prices. Deepak Nitrite, Atul Limited, Aarti Industries, that has benzene as a raw material, which is again crude-based. Paints company is again, crude is a big part of their raw material basket. So all these companies tend to be in focus on the back of this big surge that we're seeing in crude oil prices.
Sonal, thank you for summarizing that for us. Aviation, paints, tires, OMCs, all of them getting impacted because of the rise in oil prices, which are now at 110. There has been a slight cool off though from higher levels for Brent as we speak. So 21% higher now. At one point, both of them were up 27% each just a few minutes ago. And this is on the back of this Financial Times report, which is saying that the G7 nations are going to meet and discuss a joint release of emergency oil reserves. Of course, there is nothing concrete on this as of now, but the news itself has led to a bit of a cool off in crude oil prices, a subsequent recovery in Dow futures, and then a recovery on our own markets as well. To discuss the impact of all of this, we are being joined by Madhvi Arora, the Chief Economist of Emkay Global Financial Services. Madhvi, good morning. Thank you for joining in. For a net importer like India, seeing oil at $100 is never good news, but what do you see this as temporary as it may be, because you don't know how temporary is this going to be? How does this oil price rise impact the balance of payment situation for a net importer like India?
Hi, morning. So clearly, as you said, that oil impacts our economy in a direct fashion as well as indirect fashion. The terms of trade impact, no doubt, is going to be massively negative, right? Nobody expected that oil would actually, the war would sustain for this long and oil would actually cross 110 plus level. As we stand today, there is no sight of the war sort of getting over, which also implies that at least for a month or two, we could actually see this as the new normal. At this point in time, we're looking at, the base case for us and Brent still at 75 years. Assume that the moment the war adjusts or sort of season, we will see prices of oil sort of coming up naturally to a $70 per barrel kind of level. Assuming that it remains at say 100, I think we're looking at a current account deficit of as high as 2% plus of GDP. But more importantly, it will percolate down to the capital account, because clearly the impact will be also felt on the FPI flows. It will also be felt on other aspect, which is basically investment-led impact of our borrowings, and to be very, very sure, it will be also impacting the rupee dramatically. We already seeing that play out in the rupee market. Despite RBI intervening heavily in the last 5 trading days, rupee is crossed 92. And I think if oil continues to be at this level, we are pretty much seeing a 95 plus level. But generally, on a static basis, when you look at these numbers, every $10 per barrel increase in oil leads to a current account deficit increase of around 0.5% of GDP, again on a static basis. But unfortunately, things are never static. It's a dynamic world where other variables also tend to move as the terms of trade worsen.
Madhvi, you're still working with the base case of $70 a barrel crude. We're already seeing it in triple digits now. Last week, your note was talking about $90 to a barrel. The situation is moving very quickly. How long a sustain, will you wait for at these kind of levels before you have to revise your, CAD? You're already talking about a 2% kind of a level. The CPI for the year, the growth print, how does that get impacted? Let's say if this continues for another 3 to 4 weeks.
See, as I said, the numbers are based on the fact that things will normalize in a matter of 2 or 3 weeks. Honestly, we did not expect it to even escalate beyond last weekend. But that said, I think as of now, we're still sticking to the number because we believe that this is a pure supply side shock. At this point in time, assuming that things normalize, the demand supply balances are not as bad for the Brent market. But again, we do not know how long this could stretch. The reality is that we are in a situation where we probably would have to look at a much higher average Brent prices for the year. Before the war, we were looking at 65, increase it marginally to 70, 75. But I agree with you, if it escalates beyond another 1 month or so, we are looking at least Brent averaging a 280 plus levels. But as of now, I think we are making cases in our assessment, which I think is the right way to do things because we do not know where the end game lies in this war at this point in time.
Advi, the point being that now, as supply shock as it may be, but does this or will this have an impact on the inflation picture? As of now, inflation continues to remain under the RBI target range. How much of an impact do you see because of the rise in prices? There has been this not just the oil price issue, there is also a supply side problem with regards to the exports being stuck and so on and so forth. How will all of this impact the inflation picture and more importantly the trade deficit as well?
So, see, for the inflation bit, specifically retail inflation, it's a function of how much pain is actually passed on to pump prices. Unfortunately, pump prices are still frozen, which basically means that a large chunk of the oil-related pain is at this point absorbed by the OMCs. We're not expecting government to immediately bail them out, but again, we will have to see how fast and how long this war continues and how long do we see the oil prices sustain at these levels. If that happens, of course, we will see the government of India also intervening in terms of, bailing out the OMCs, and the balance sheet impact will be seen on 2 or 3 factors. One of those being how much of the pain the government bears, how much of that is actually passed on to consumers. As of now, from the retail inflation point of view, the impact is still insulated to some extent. But again, on a static basis, if you assume that the pass on is full, every $10 increase in Brent tends to increase CPI inflation to close to around 35-40 bips as per the new series. But again, I don't think the pass-through effect would be full because there will be absorption of the price pain both by OMCs as well as the government. As of now, it's the OMC which are bearing the brunt of it. For trade, again, as I said, the current account play is very clear. It's 0.5 for each $10 per barrel increase in Brent from our base case. The base case could actually move from a 70 to a 90 to 100. We do not know at this point in time. So the play is such that the more the longer the what plays out, the more the impact you will actually see in the capital account. Nobody will talk about the current account because we will still have some way or the other to sort of pull it through. But the capital account will become a big concern. So, at a 70, we're looking at a balance payment of around $15 to $20 billion negative. At a 90, 100, it would actually go to a 60 or 70 billion, which is a big deficit on our balance of payment. So the funding issue would be
Madhvi,
really,
let me just interrupt you.
concerning for me.
Madhvi, let me interrupt you since we're running out of time. I just quickly wanted to understand, do you think RBI can afford to look through rupee at 92 plus kind of levels, oil at $110, $115 a barrel kind of a level, when it meets in 3 to 4 weeks? And has your base case changed now, from the pause scenario that everybody had factored in?
Yeah, again, for the Reserve Bank, I think the problem is more to do with financial stability than to do with the inflation management. That becomes a very second-order problem for the Reserve Bank. I think we all are aware that the Reserve Bank is intervening in the forex market, both in the spot and the forward, and that will have implications for liquidity back home as well. So they are only facing the dilemma of managing the currency as well as the domestic liquidity, because the pain of the currency intervention is directly felt in the money market. As of now, we're not expecting the Reserve Bank to take any action, because large chunk of it is obviously externalities, and one doesn't know how long can it get dragged. We anyway understand that the RBI's conventional rate cutting cycle was over, but they were still ensuring that liquidity doesn't remain a constraint for the economy, and they were anyway ensuring that the balance sheet also increases to the extent that they are able to support growth. That will become a problem, because growth will be an issue. Fiscal will not have the leeway to intervene as beyond the point.
Running out of time, Madhvi. So thank you so much for sparing time and joining us today. Let's go across to the Rajya Sabha. External Affairs Minister S. Jaishankar is making a statement on the situation in West Asia.
Has been assessing the situation in West Asia continuously since the 12-day war in June 2020. We noted the indications of growing tension and cautioned the Indian community in Iran accordingly. On 5 January 2026, Indian nationals were advised by the Ministry of External Affairs to avoid non-essential travel to Iran. Those already resident there were urged to register with the embassy, exercise due caution, and monitor the embassy website and social media handles. A second advisory was issued on 14 January, reiterating this advice to avoid travel in even stronger terms. The Directorate General of Shipping, Mumbai, in parallel, issued its own advisory on 14 January for Indian seafarers, asking them to follow embassy advisories and avoid unnecessary movement ashore.
ये हैं कोटक नियो के तेज ट्रेडर।
Nikkei index dips and snaps back.
ये ट्रिगर गिरावट का है, कसम कैंडलस्टिक्स की।
बेचो और बचो।
ये करते हैं शोर को इग्नोर, और ये हौसला जानकारी और तैयारी से मिलता है। Stay तेज with कोटक नियो। Investments in securities markets are subject to market risks. Read all related documents carefully before investing.
मेरा रुतबा है मेरा सिग्नेचर, दुनिया की सोच से ऊपर बेबाक है मेरा सिग्नेचर। Signature finest silver elaichi, a premium product from Dilbar Group.
अगर हर जगह फुल फ्लेक्सिबिलिटी चाहिए तो इन्वेस्टमेंट्स में क्यों नहीं? अब अपने इन्वेस्टमेंट्स को दो फुल फ्लेक्सिबिलिटी का एडवांटेज विद फ्लेक्सी कैप फंड्स। म्यूचुअल फंड निवेश बाजार जोखिमों के अधीन है। योजना संबंधी सभी दस्तावेज सावधानी पूर्वक पढ़ें।
हाथ, ये जो हाथ है ना, सिर्फ लकड़ी ही नहीं, हमारा कल भी तराशते हैं। बंद हो या हो कोई स्ट्राइक, इनका शटर हमेशा खुल जाता है। इन हाथों का यही तो आपसे नाता है, और इन्हें हम आसानी से लोन देकर अपना फर्ज निभाते हैं। कैप्री लोन्स फर्ज निभाते हैं।
अरे टेंशन किस बात की? सेंचुरी प्रोवुड का प्रीमियम प्लस है ना, लो एमिशन है, हाई डेंसिटी है, वाटर रेजिस्टेंट भी, टर्माइट एंड बोरो रेजिस्टेंट भी है। यानी ये है जहां नो टेंशन वहां।
प्रीमियम प्लस बाय सेंचुरी प्रोवुड।
अगर हर जगह फुल फ्लेक्सिबिलिटी चाहिए तो इन्वेस्टमेंट्स में क्यों नहीं? अब अपने इन्वेस्टमेंट्स को दो फुल फ्लेक्सिबिलिटी का एडवांटेज विद फ्लेक्सी कैप फंड। म्यूचुअल फंड निवेश बाजार जोखिमों के अधीन है। योजना संबंधी सभी दस्तावेज सावधानी पूर्वक पढ़ें।
This is Network 18 and you're watching CNBC TV 18.
Welcome back. Let's get you some specific names to focus on. iFinance is one that has posted its third quarter numbers. The company that recently listed mid-February, we had it post nearly 90% jump in its profits this quarter. Credit costs have fallen. ROE has climbed to about 9.7. So the question is whether this, signals a longer term upward move, or is this just a good quarter? Let's invite Sanjay Sharma, the founder and MD of iFinance, who joins us to break down the company's third quarter performance. Thanks very much, Mr. Sanjay Sharma. As always, it's a pleasure to have you. Just looking at your numbers from what you told us last time, your net interest income has grown about 13.5%, while AUM growth is about 23.5%, and NIMs have also compressed to about 14.2% over the previous year. To begin with, is the margin compression structural, or do you see a floor from here? And also in terms of AUM guidance that you'd given us up to 33%, what are the segments that you believe will drive that kind of a growth?
Good morning and thank you, Ritu. We have seen a wonderful quarter three, and it is no surprise. I think we did expect it. And we have seen disbursements grow by 35%, AUM has grown by 23.5%. And seeing how the disbursements have been in January and February, we are confident that we will reach the guidance of 30% growth in AUM that we talked about. On the NIMs reducing marginally, it is actually partly structural because we are seeing an increase in the mix of mortgage-based loans compared to the hypothecation-based loans. So as the mortgage-based loans mix increases, it naturally reduces the NIM. But on the hypothecation loan, the NIM contraction isn't there. So it's only because of the mix.
Got it. Mr. Sharma, largely your top exposure, as we understand, is more in Uttar Pradesh, Bihar, Rajasthan, lesser in some of the regions here. But specifically, given what the Maharashtra budget has announced in terms of the loan waiver, could you give us a sense of what your exposure to the region is? And if you see any second-order impacts in terms of credit behavior, or worry that that's something that could play out?
Sure. It's an excellent question, Ritu. And the short answer is that we are not majorly impacted, but one has to be careful in lending. And we are monitoring it. To give you a sense, we are spread across 18 states and 3 union territories. So there is hardly any state which has a very large percentage of our portfolio. When I look at Maharashtra's our portfolio in Maharashtra is about 8% or below 8%. So I think that's one thing. The second is that we provide working capital finance to the micro scale businesses, which are into manufacturing, trading, or service. And this is very different from the agri-based lending, which might get impacted by the regulation that's just been proposed in Maharashtra. Also, you mentioned about Bihar, UP, and Rajasthan. Yes, we do have a larger part of our portfolio in these segments, still very distributed. And we continue to see very good good performance over these states in terms of collection efficiencies, etc. Primarily because it's not a consumption loan we're talking about; it's a business-related loan, and these are small businesses repaying based on their performance in business.
Mr. Sharma, you are planning on growing your AUMs by around 28 to 33%. Currently, you grew 24. A, by when does that happen? And B, when you do manage to reach that figure, is your portfolio construct going to remain the same, or there will be specific pockets that are going to aid that growth?
Sure. I think we will continue to focus on business-related lending. So a lot of our lending will be hypothecation loans, which are smaller working capital loans of 1 lakh to 2 lakh ticket size. And a smaller part will go for mortgage-based loans, which are larger loans, typically 5 lakhs to 10 lakh loans, which often are needed for expanding a business. But we want to stay away from consumption-based lending. So that's one place that we will focus on is on businesses. And this is a segment that has been excluded by most of the banks and NBFCs, and this generates 90% of the employment in the non-agri sector. So clearly an important segment. I think we have a long way to go. We have hardly touched 2% of the market gap. So long trajectory ahead. And we're quite confident that we will continue to address this market well. We have seen, we've gone through demonetization, we've gone through COVID pandemic, etc. And we've seen that this remains a very stable segment to lend to.
Okay. Mr. Sharma, quickly on your credit costs. Now, 38% of your book is unsecured hypothecation. Your credit cost has been coming down, as you told us, for the last 3 quarters, I believe, now at about 4% odd levels. Do you believe this can continue given the macro developments? What is happening, with the West Asia war, the concerns about that imported oil inflation shock feeding into, consumption demand at some point. So how are you building the stress scenario from here? Initially, have you seen in any pockets of concern, and how do you see the way ahead? Will you continue to see this improvement?
Yes, I think this asset class, on one side, it is not consumption. On the other side, it is also not highly linked to the organized industry supply chains. So when the organized industry sees a hit because of oil price increase or a tariff increase, this segment remains quite insulated. And in that way, this asset class is very contrarian to how the industry cycle goes. Having said that, we have seen, last time when I spoke, I said 3 quarters of reducing credit costs. Now with the 3rd quarter results coming in is the 4th quarter where we have seen a consistent fall in credit costs. And I think January, February data also show that that trend continues. People in the industry talk of green shoots. We've seen 4 quarters of reducing credit costs. So I would much rather say that we are not talking of green shoots. We're talking of a full bloom spring. And we believe the last quarter and the coming year is going to be even better and a more robust performance ahead.
Mr. Sharma, pleasure having you today. Thank you so much for sparing time and joining us. Wish you good luck for the rest of the new financial year as well. By the way, just before we take that break, the big story, oil prices off the highs of the day, significantly at that. Brent is now 107. The day's high was 119.5. So a significant cool-off after that Financial Times report of the G7 meeting to potentially discuss release of emergency reserves. NYMEX 2, the US crude, at one point, both of them were up around 27% each and have now cooled off to gains of just around 15% and trading with gains, trading at 107 for Brent and 104 for the US crude prices. And that, as a result, has had an impact on the market as well. The Nifty is now down 570 points. So that's an almost 200-point recovery from the lows of the day. 23,875 is where the index currently stands. So as of now, there is a recovery from the lows. It remains to be seen whether that sustains or not. The Dow futures too have seen a bit of a recovery from the lows of the day. At one point were down 1,200 points almost, now down only 800. Take a short break. Market technicals on the other side with Saumil Mehta of Mirae Asset Sharekhan. Almost at 23,900 now is the index. But just before we go to Saumil Mehta, look at the announcement made by PG Electroplast as the potential impact of the gas shortage situation cannot be quantified. And in its statement, it has mentioned that due to the supply restrictions imposed by the suppliers, the allocation of LPG quantities to the company under the said contract has been constrained from today onwards, which is the 9th of March. And the stock that was recovering from the lows of the day is now seeing some selling pressure at higher levels, now still down 5% as we speak. week is PG Electroplast. Of course, the stock has been in the news over the last couple of quarters with regards to the cut in its guidance, the rise in its working capital issues and so on and so forth. But we'll keep an eye out on these latest developments for PG Electroplast as well. Currently trading 5% lower. The markets though back at 23,900 for the Nifty, so 550 points lower. Technically at the highest point of the day as well now for the index. Good time to get in a chart check as well. Somil Mehta from Mirae Asset Share Khan is now joining in. Somil, good morning. Thank you for joining in. Now, would you use this recovery to trim down your long positions further, considering the fact that does the texture still remain a sell on rallies one? Your call on the index now and your stock recommendations as well for the morning.
Good morning to everyone. The bias definitely stays negative from here. We've seen some bounce back last week, but that was an selling opportunity. You're making low tops, low bottom on the higher degree time frame in the monthly charts, quarterly charts. That clearly says that we are in the downtrend now. The bounce right now, which we are witnessing, could go till 24,000, maybe 24,200, but that will again be a selling opportunity because I'm looking for a target of around 23,500, 23,200 levels in the short to medium term outlook. Yes, sell on rise should be the strategy. The weaker stock, which are already trading below 200 daily moving average, 20-40 daily moving average, already in the downtrend, should be shortened from here. Selling opportunities, there are a lot of selling opportunities in the weaker stocks, weaker sectors. So yes, view remains negative and sell on rise should be the strategy. The two calls which I have, one is PG Electroplast, which we were talking about just a minute ago. This stock has already making low tops, low bottom, medium term trend remains negative for the stock, trading below 200, 20, 40 daily moving averages. My targets on the downside would be 525 and stop loss would be 595. And the second stock is GMR Airports. GMR Airport has broken a small flag pattern on the daily charts, trading below short-term averages. I'll be expecting a target of around 86 with a stop loss of around 94.
All right, we've taken note of that, Somil, PG Electroplast and GMR Airports. Thanks very much, for joining in with those views. We have to slip into a short break, but don't go anywhere. When we're back, we'll discuss more on the market fundamentals with George Thomas, who's the fund manager of equity from Quantum AMC. Welcome back. A bit of a recovery in the markets in the last hour. About 0.2% up is where we're at. The Nifty still trading with cuts of about 550 points. Bank Nifty again leading the fall, about 1950 points lower still as we speak. But let's get in George Thomas, fund manager of equity from Quantum AMC, for more on the market fundamentals and his top picks at the moment. George, thanks very much for joining us here today. You know, from last week's crude oil levels, we're already at 110, 115. Now it's cooled off slightly on the back of some news flow from, the G7 countries to $106 a barrel. In this current scenario, given the sensitivity Indian macros have to oil prices, how do you as a fund manager approach the situation? What are the sectors where you see opportunities? What are the sectors you're going to rotate away from?
Hi, Radu. Thanks for having me on the show. So when we look at the current geopolitical tensions, so the base case assumption is this may not last for a very long duration. It could probably run into weeks or a month and may not prolong for a long time. But the base impact, if we were to assume, would be on inflation and the macro. So the globally, if you people had factored and the estimates were for benign crude, and that would have kept the global inflation to a moderate level, which may not be the case in the immediate term. But if things reverse, we could see a reversal in crude prices at a quite fast pace. But if we were to look at from our portfolio perspective and the potential movement over the medium term, we feel these are fairly attractive levels for one to consider fresh allocation, purely based on the earnings cycle where we are and the valuation levels at this point in time. So if we want to speak about our portfolio actions, we have been buyers in this market, and our recent allocations has been to a realty firm, and we have marginally increased weights in some of the existing allocations in private sector banks, IT services, and a cement player.
Okay, real estate, IT, private sector, and a cement player. But, actually, Nifty IT, you would have thought, start of the year, the kind of pummeling it had seen, it's today at least, it's the only one mildly in the green. Any views on that? And as well as the banking sector, with the second order effects now playing out, the treasury book getting impacted, because of higher borrowing, inflation, etc. is one thing. But, will this start to play out on, retail loan demands? Demand for retail loans as well. So how do you see, the banking sector getting impacted, and quick views on the IT pack as well?
Right. See, if we look at the economic momentum and the credit growth momentum, clearly credit growth is showing some signs of improvement. So when we were to look at the impact on economy, clearly near-term IT recruitments could be contained. We may not see the kind of fresher hiring we used to see a couple of years back, because there is some bit of productivity benefit which is invoked from the existing employees. So from that extent, from an economic perspective, there could be some bit of marginal impact. But if you look at IT as an overall provider of employment, it is only about 13-14%, but the quality of jobs are a lot higher. But our sense is the broader credit growth should be reasonably okay. But of course, there could be second order effect in terms of if the crude were to stay elevated for a longer duration, which is not our base case at this point. So our sense is, the credit environment could remain benign for in the medium term, and our economic earnings upcycle, which is ongoing, could continue. It may not be materially derailed, although it could be delayed by a few months here or there. From an IT sector standpoint, the major problem is the market or the buyers are kind of factoring that the tech evolution landscape would come to an end with the evolution of AI, which may not be true. Of course, there would be productivity benefits, and players with stronger balance sheets could see market share gains in this kind of environment, where you might have to do higher upfront investments to win larger deals and stuff like that. But our sense is Indian IT players have seen multiple cycles, and they have evolved with multiple tech evolution, and that scenario has not changed. And one of the important data point which is coming out in recent times is a lot of the Gen AI use cases have not migrated from pilot phases to enterprise adoption levels. And as and when that picks up, the Indian players should see better growth profile going forward. So we are kind of positive if we were to take a longer term view on the sector.
All right, positive on to the IT sector. Mr. Josh Thomas, thanks very much for being with us here today to share your views. On that note, we slip into a short break, but don't go anywhere. More on the markets when we return in this very short time.
Orgullosos que
TV18 and India Bonds present Bond Street.
Welcome back. Shifting focus back to the bond markets. Manisha Gupta is here with the latest. Manisha.
Well, it hasn't started as an easy day because we are looking at across asset classes a sharp decline come in, and same is the case with the Indian money markets as well. The Indian sovereign bonds have seen a decline. The yield spiked up by nearly 7 basis points on the opening market itself. Not completely unexpected because you're looking at the US-Israel conflict with Iran entering day 10. And the kind of repercussions that we are looking at across asset classes and within economies as well seems to be getting quite sharp there. Crude oil prices is a big one because we've seen 20% of gains on Friday and it opened 25% on the higher side today. So $116 a barrel and beyond is where the crude prices are trading right now. And as per various mathematics, every $1 increase in crude prices raises India's annual import bill by nearly $2 billion. Remember, India imports nearly 85% of its oil requirement, also imports nearly 80 to 85% of its LPG requirement as well. So that is where the concerns are coming in from. The Brent crude prices, the surge that is you have seen on that one, the prices are up 40% in the matter of last 6 or 7 trading sessions itself. So there are inflation concerns coming in for this one. You are looking at Indian rupee trading at record lows. The kind of sell-off that we've seen in equity markets also seems to be impacting the bond markets there. It really seems to be a chain reaction because higher crude prices increase inflation risk. Higher inflation is pushing bond yields higher, and rising yields are also putting pressure when it comes to the equity markets there. There are also various important events lined out in the international markets, and for the Indian markets, it really is going to be the Feb inflation data that comes in on Thursday.
All right, Manisha, thanks very much for getting us that quick wrap. We'll slip into a short break, but don't go anywhere. When we're back, we'll get you more on the markets.
CNBC TV 18 and India Bonds present Bond Street.
Welcome back. There is some recovery from the lows of the day, but there is some resistance at higher levels as well at 23,900 odd. Just before we take your leave, pull up PG Electroplast. That is now down 10% after the announcement that the company had made. The stock had over the cut in gas allocations. 10% lower now on PG Electroplast. Take your leave on this edition of Trading Hour from Ritu and me. Thank you for watching. Halftime report on the other side.
ये हैं कोटक नियो के तेज ट्रेडर।
Nikkei index dips and snaps back.
ये ट्रिगर गिरावट का है कसम कैंडलस्टिक्स की।
बेचो और बचो।
ये करते हैं शोर को इग्नोर और ये हौसला जानकारी और तैयारी से मिलता है। Stay तेज with कोटक नियो। Investments in securities markets are subject to market risks. Read all related documents carefully before investing.
ये हाथ केवल हल नहीं चलाते, मिट्टी से सोना उगाते हैं। ये हाथ केवल सिलाई नहीं करते, देश को नया रूप देते हैं। ये हाथ लोगों को उनकी मंजिल तक पहुंचाते हैं और इन्हें हम आसानी से लोन देकर अपना फर्ज निभाते हैं। कैप्री लोन्स फर्ज निभाते हैं।
मेरा रुतबा है मेरा सिग्नेचर, मेरा जज्बा है मेरा सिग्नेचर, बेबाक है मेरा सिग्नेचर। सिग्नेचर फाइनेस्ट सिल्वर इलायची, a premium product from Dilbar Group.
अगर शूज में फुल फ्लेक्सिबिलिटी चाहिए तो इन्वेस्टमेंट्स में क्यों नहीं? अब अपने इन्वेस्टमेंट्स को दो फुल फ्लेक्सिबिलिटी का एडवांटेज विद फ्लेक्सी कैप फंड्स। म्यूचुअल फंड निवेश बाजार जोखिमों के अधीन है। योजना संबंधी सभी दस्तावेज सावधानी पूर्वक पढ़ें।
अरे टेंशन किस बात की? सेंचुरी प्रोबुड का प्रीमियम प्लस है ना। लो एमिशन है, हाई डेंसिटी है, वाटर रेजिस्टेंट भी, टर्माइट एंड बोरो रेजिस्टेंट भी है। यानी ये है जहां नो टेंशन वहां।
प्रीमियम प्लस बाय सेंचुरी प्रोबुड। मेरा रुतबा है मेरा सिग्नेचर, मेरा जज्बा है मेरा सिग्नेचर, बेबाक है मेरा सिग्नेचर। सिग्नेचर फाइनेस्ट सिल्वर इलायची, a premium product from Dilbar Group.
अरे टेंशन किस बात की? सेंचुरी प्रोबुड का प्रीमियम प्लस है ना। लो एमिशन है, हाई डेंसिटी है, वाटर रेजिस्टेंट भी, टर्माइट एंड बोरो रेजिस्टेंट भी है। यानी ये है जहां नो टेंशन वहां।
प्रीमियम प्लस बाय सेंचुरी प्रोबुड।
This is Network 18 and you're watching CNBC TV 18.
Barely a fraction of stocks managed to gain as fears of prolonged conflict in West Asia sparks a brutal sell-off. Auto, financials, industrials and metals are the big losers even as the market comes off the day's low.
Brent crude tops $115 a barrel, the highest level since the breakout of the Russia-Ukraine war in 2022 as tensions in West Asia escalates and oil producers in the region curtail output. Prices see some relief when news reports that the G7 and IEA will discuss joint release of emergency oil reserves today.
Rupee dropped 60 paise from Friday's close to an all-time low below 92.30 against the greenback. The surge in oil prices and a big import for India weighs on the sentiment.
The government hikes LPG prices even as sources suggest an increase in petrol and diesel prices is unlikely. Experts tell CNBC TV 18 LPG supply remains key monitorable given that India gets 90% of its imports from the Gulf region. Hello and welcome to Halftime Report, live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always is Vinny Motiwala. Continues to be a down day, but there is some recovery which is underway from the lows of the day, courtesy the recovery that we have seen in crude oil prices and the IT index as well. So the Nifty is at the 23,880 mark. We continue to be below 24,000, but it's the IT index which has recovered around 500 points from the lows of the day, and that can be seen in the chart for Nifty as well. Crude oil prices, which topped $115 a barrel at the start of trade, is now at 108. So that definitely is some relief that we are seeing in the markets. But other than that, all the sectoral indices, they are in the red as we speak. Bank Nifty is down 5.5%, but it was down more than 6% at a point in time. So yes, a recovery which is underway, but we'll have to see whether we sustain this or not, or whether there's follow-on selling from the highs. Hey, Vinny.
Hi, good afternoon, Sonal. So slight that smidge of a recovery, at least some hope, but like you said, we'll have to see where this is headed and whether, we see a further recovery or whether we see a fall again. But yesterday, obviously, the Nifty has seen those lowest levels in 2026. And like we mentioned, 23,800, just above that mark is what the Nifty is trading at. What we'll also keep an eye out on is some of these IT names, where they look at a Wipro and HCL Tech. They are the two names that are actually only holding on to green in the Nifty 50. Apart from that, everything is trading in the red. At one point of time, Coal India, if you see the intraday chart, it was trading on the positive side, but seems like that's given up the gains because it's not making it to the list of the greens anymore. So now you have these IT names which are managing to hold on to gains. PSU Banks continues to be under pressure, and PSU Banks among that, obviously SBI. Look at that as well. That's also seeing a very, very sharp fall in the trading session. So surely we'll be watching out for that. But as the West Asia war disrupts oil production and key shipping routes also are getting impacted, oil prices have now surged at a 4-year high. So Darshan is joining us now with key data points on crude and the impact of that on the Indian market. Afternoon, Sudarshan, over to you.
Good afternoon, Vinny. So crude today not only crossed the level of $100 per barrel, but it hit the high of $119 per barrel. And that's the highest level that we have seen in the last 4 years. Now, in the last few minutes, we have seen that crude coming off ice after the reports related to the G7 countries are considering releasing the emergency oil reserves. And following that, there was a sharp downtick that came in the crude, and we hit the level of around $107 per barrel. But now, considering the up move that we have seen in crude over the last 48 to 72 hours, we have to see what exactly happened in the last cycle when there was a big move in the crude price. So India being the largest importer of the crude, we have to see the correlation between the crude move and the market. So December 1, 2021, when the Russia and Ukraine war had started, and that time crude from the level of 68 had moved to $139 per barrel, and that had happened on March 7, 2022. So within 3 months, crude had seen an uptick of almost 50 to 60%. And in the same period, if you see, on December 1, Nifty was around 17,065, and on March 7, 2022 also, Nifty was around 15,671. So Nifty had seen a fall of around 8 to 9%. Now, it took almost 3 years for crude to come back to the level of 68 to 70. So from 2022, if you come to March 25, 3 years, then crude has come back. Brent crude has come back to 68, and Nifty had seen an uptick of almost 40%, and in the same period, there was a fall of almost 51 to 52% in the crude. So there is a major correlation between the crude move and the market because India imports huge amount of crude. So in this cycle, we'll have to see if once the tensions ease and the similar kind of move we see both in the crude and the similar move we see in the market.
Okay. Thank you so much for that, Sudarshan. We'll surely keep an eye out on if we see the similar moves coming in for crude and market as well going forward. But in fact, we earlier caught up with the former HPCL CMD and former Mahanagar Gas chairman as well. Let's listen in to their views on the pricing as well as supply risk.
Not all the oil shock of the prices have been passed in the past to the consumers. So to that extent, it gives a comfort to the economy, it gives a comfort to the consumers, and over a period, then it is recovered over a period of time. So as of today, the more worry should be related to supplies rather than the pricing. But of course, it has got impact on the current account deficit, the foreign exchange, etc.
The more problem is in the case of crude oil and in the case of LPG, because unlike natural gas, the crude oil has to be then processed and then the petrol or diesel or other products are to be produced. And in the case of LPG, the situation is little delicate because India imports about 65% of its LPG requirement. And out of that 65%, out of the total imports, about 90% comes from Middle East only. And of all the LPG which is consumed in India, about 87% is domestic PNG, is only 13% is industrial or commercial.
Okay, just a stock that I want to mark right now is going to be PG Electroplast. There's an update that's coming from the company where they're saying that PGEL gas suppliers has communicated regarding shortage of gas and under its gas sale and purchase agreement. Now, this is mainly due to the issues of the Middle East region where there's an issue impacting the gas supply scenario and there's an availability issue and constraint coming in. So due to that, there may be some restrictions in overall supply of LPG as well that could come in. For the company, they're assessing the situation as of now, but some bit of an issue that comes in there. PG Electroplast has seen a fall and now down 10% in trade as well. But as this war between US and Iran is continuing and unabated in the region, chemical companies also are feeling the heat as most of the companies ship their products through the Strait of Hormuz and have also exposure to the US market. Sonal is standing by at the wall now to give us more updates on this one. Sonal, over to you.
Well, the West Asia crisis is not just impacting the oil sector, it could also ripple through India's chemical sector, which has heavy dependence on crude-based materials and will be impacted by supply chain disruption. Here is how some key chemical companies could be affected. Now, let's start with SRF first up. On raw material supply, SRF is relatively insulated in the refrigerant gas chain. But freight could be a factor because all three of its segments export heavily to the US and UK. So that is something that could be a worry for SRF. Another watch point is crude. Packaging films, they use crude derivatives as raw material. So these are some of the things which could impact SRF. Let's go to the next one, which is Coromandel International. This one has clear West Asia exposure. Phosphoric acid and sulfur, they are the key inputs. Iran is among the top global suppliers of sulfur. And most phosphoric acid and sulfur shipments pass through the Strait of Hormuz. So that is something which could be a problem for Coromandel International. Plus, some intermediates are crude-based. So that is something which could increase their raw material prices as well. Deepak Nitrite is a slightly different story. Its raw materials include propylene derivatives and ammonia, both of which could face supply disruptions. Exports are limited, so freight exposure is minimal. But propylene and benzene derivatives are directly linked to crude. Other Limited, that is the other company, has a very wide raw material basket. Several of those inputs have exposure to West Asia. The company also exports across segments to Europe and the US. That means both supply chains and freight rates could matter. Crude sensitivity is spread across its portfolio. Let's go to the next one, Aarti Industries. It sources benzene locally, which helps, but procuring aniline could become difficult if supply chains tighten. About 23% of its exports go to West Asia and about 4% to Europe. Benzene and other crude derivatives are key raw materials, so that is an important point. GSFC faces a different kind of risk. It relies on natural gas supply through GAIL and Petronet LNG, and GAIL has already cut allocation. The company also imports sulfur from Iran, and caprolactam feedstock is linked to crude. But not every chemical stock is exposed. Companies like Navin Fluorine, Tata Chemicals, Archean Chemicals, Rallis, and Anupam Rassayan currently have minimal or no direct impact from the West Asia disruption. So while oil grabs the headlines, the real story may unfold in supply chains, shipping routes, and raw material dependencies across the chemical sector.
Absolutely, Sonal. Thank you so much for highlighting the names that are getting impacted and the names that maybe don't see that much of an impact as well. So that is also something that you should keep an eye out on. But on that note, we're going to slip into a very short break. On the other side, we'll connect with Sunil Shah, president of the All India Plastic Manufacturers Association, as polymer prices are surging following that spike that we've seen in crude oil prices.
बिटिया की शादी है हमारी।
बधाई हो बधाई हो।
कुछ पैसे मिल जाते समय पे लौटा दूंगा। जिंदगी में जरूरत के वक्त हम अक्सर अकेले पड़ जाते हैं।
इसीलिए तो केपरी लोन्स आपको गोल्ड लोन देके अपना फर्ज निभाते हैं। केपरी लोन्स फर्ज निभाते हैं।
मेरा रुतबा है मेरा सिग्नेचर, दुनिया की सोच से ऊपर बेबाक है मेरा सिग्नेचर। सिग्नेचर फाइनेस्ट सिल्वर इलायची, अ प्रीमियम प्रोडक्ट फ्रॉम दिलबाग ग्रुप।
ये हैं कोटक नियो के तेज ट्रेडर।
Nikkei index dips and snaps back.
ये ट्रिगर गिरावट का है, कसम कैंडलस्टिक्स की।
बेचो और बचो।
ये करते हैं शोर को इग्नोर, और ये हौसला जानकारी और तैयारी से मिलता है। स्टे तेज विद कोटक नियो। इन्वेस्टमेंट्स इन सिक्योरिटीज मार्केट्स आर सब्जेक्ट टू मार्केट रिस्क्स। रीड ऑल रिलेटेड डॉक्यूमेंट्स केयरफुली बिफोर इन्वेस्टिंग।
अरे टेंशन किस बात की? सेंचुरी प्रोबूट का प्रीमियम प्लस है ना, लो एमिशन है, हाई डेंसिटी है, वाटर रेजिस्टेंट भी, टर्माइट एंड बोरो रेजिस्टेंट भी है। यानी ये है जहां नो टेंशन वहां।
प्रीमियम प्लस बाय सेंचुरी प्रोबूट। मेरा रुतबा है मेरा सिग्नेचर, दुनिया की सोच से ऊपर बेबाक है मेरा सिग्नेचर। सिग्नेचर फाइनेस्ट सिल्वर इलायची, अ प्रीमियम प्रोडक्ट फ्रॉम दिलबाग ग्रुप।
When the market moves, we don't just report, we decode.
From the boardroom to the trading floor, we track what's driving business and impacting investor sentiment.
With insight that empowers and guidance that builds wealth.
Nuvama presents CNBC TV 18 Market Central.
For your daily source of market intelligence and wealth creation, with a commitment to doing it right.
Welcome back to Halftime Report on CNBC TV 80. While the Nifty is at 23,850 above that mark as of now, the broader end of the market, the Nifty mid-cap at one point of time, it was down more than 3%. That has also seen a recovery as well. So Nifty mid-cap is now down 2.5%. So slight bit of a recovery that we've seen for the markets from the day's lowest point. But let's move on and talk more about the impacts that's happening in different sectors due to the West Asia war. We have Sunil Shah, who's the president at AIPMA, the All India Plastic Manufacturers Association. And the main reason is obviously crude prices have spiked up. With that, crude derivatives and all the products related to that have also seen a spike up. So whether you see polymer prices, that's also seen an increase. Now, Mr. Shah, good afternoon. Thank you so much for joining us on the show. Crude prices seems like, they've spiked up a lot, about that $100 per barrel mark. And obviously with that, polymer prices or any other crude derivative also has seen an increase. Could you just talk to us about the impact that you're seeing in terms of the polymer prices as well. What will it mean for plastic manufacturers, and what are you all currently assessing in terms of the situation here?
See, the problem of polymer price increase we face ever, but that is not a problem. This is the steepest price ever I have seen in this current for history. Another 10 years. This is the steepest price. So it is very difficult for a small scale industry to absorb this kind of prices, because probably in a week around 45 to 50% price increase in all the polymers, which is not conducible to the small scale industry. And everybody are aware of those 80 to 90% of the plastic industry is a MSME. So this MSME has no sustainability for long term. If they find it this kind of steep price, it will be very difficult for them to survive. Number one. Number two, to get the price for their customer, it takes its own time. You don't get it like that. It is not like you increase the price in the store and put today 10 rupees, tomorrow is 20 rupees. It's not possible. So now it is a tough time. And suppose if you increase today and the next day, tomorrow, another 10 rupees is increased. So, to survive in these circumstances. And madam, most important thing which I would like to highlight is this. There is a unification of price rise from all the polymer company. What you understand from that, or what your audience understands from that, it is their guess. Why it is, if 10 rupees is increased, 10 rupees increased by everybody, 10 rupees. Some is gas based, some is crude and naphtha based. So why the increase is so much?
Okay, we take that point, Mr. Shah. So can you give us a sense of what percentage of polymers are imported right now, and which are the industries in which we use the polymers? It could be some chip packets, it could be PET bottles, it could be some other industries as well, right? So can you give us an industry perspective? How much are the imports, and which are the industries which tend to get impacted in terms of final product?
No, almost all the products. Today, the PET is available in India, but PET is also imported. Today, the PP is available in India, PP is also imported. So the point is not that availability, import or no import. The point is that even the local prices, if all the PUCU and other private companies are making polymers, but they also increase the prices because their base, either oil or crude oil or gas, is imported. So dollar prices increase, so this is increased, so this is the impact. But our concern is very simple, that government should do something to neutralize this. I would give a suggestion, small suggestion, that if you have 18% GST today, you can reduce to 1 to 5%. So the little impact goes away. Second, the government should streamline that this price doesn't increase for at least 15 days. So one can survive a shock every morning. This is what our concern is, madam.
Absolutely. It's a big concern, right? Because every morning you can't come up with a price increase. What you're highlighting is right, sir. Could you also help us understand, are there any delays that you're facing in terms of raw material or imports that are coming in? Is there a delay on that front as well? And have manufacturers, because of this price increase, maybe taken a bit of a pause in terms of production as well?
Madam, I would not like to stress much on it, but the point is very clear. Suddenly the material is vanished. Suddenly. See, the people keep the feedstock 1 month, 2 months, the polymer people, because they're planned in very advanced, they are very advanced companies. Suddenly the polymer is vanished in the market. If you pay the prices, I'm sorry to say, if you pay today the prices is 145 rupees, if I'll pay 155 rupees per kg, I'll get it immediately tomorrow.
How big is the industry, Mr. Shah? How big is the unorganized sector which uses polymers?
This is, see, we have almost 50,000 units in India, out of which almost 45,000 is MSME.
Okay.
These people are using, and I'm telling you, the sustainability word I have used for that is very important. What happens is that they can use the material, the bigger people, like 20% of the people can keep the material forever, for 2 months, 3 months, they stock it. But the smaller people have no sustainability. They can keep it only for 15 days. And tomorrow the material is not available, the company will close down. And if they will produce by getting material at a higher price, they will not be able to sustain after 1 month. Very catch-22 situation. And the government should immediately give some kind of SOS injection. This is what my suggestion is.
We take that point, sir. Thank you so much for joining in and giving us your sense on what's happening with the market when it comes to polymer prices and the availability, most importantly, in the market for the final products. That's Mr. Shah, President of the All India Plastics Manufacturers Association. Thank you so much for tuning in with your thoughts. We'll slip into a short break. When we come back, we'll connect with the management of Lupin to discuss the impact of West Asian conflict on freight costs. Stay tuned for that. Welcome back. You're still tuned into Halftime Report. Well, high freight input costs could impact the pharma industry due to the ongoing war in West Asia. That's the word coming in from management of Lupin, who spoke to our colleague Ekta Batra. He also believes semaglutide drug prices will decline over time. Listen into a slice of that conversation.
So clearly, all of us are impacted by this. For starters, clearly there is an impact in terms of freight costs itself. Both air freighting, if it is available also, it's going to be extremely expensive. Clearly, the input costs will also go up. There is going to be an impact insofar as solvents are concerned, because oil prices are what they are, and solvents move in tandem with that. So clearly, all of this is going to be a negative for the industry. But hopefully, we would, this entire thing would come to an end very soon. We are all hopeful about that. So let's see.
Okay, but have freight costs already increased? Because reports indicate that, freight costs have already doubled to around $1,200 to $2,400 per container. Is that what you are seeing as well?
Yes, freight costs have certainly gone up. But more importantly, I'm also being told that container movement itself is kind of restricted. There are a number of containers, upward of hundreds, which are still stuck in ports and so on, given the fact that there's an imbroglio in moving it across the straits. It's indeed going to be an issue.
Okay. So how is that impacting business? For example, do we have enough inventories, in store for us to sort of protect ourselves from these higher freight costs, lower container movement? And if so, for how long?
So clearly, this is going to be an issue across the entire sector. So essentially, whilst we carry stocks, in America and other parts and so on, the fact of the matter is, the stocks, would they last out the entire distance is something that we need to gauge. Difficult to say at this stage. Clearly an issue, though.
But will API prices or API inventory be impacted according to you, since, West Asia is a port of transit as well, and we do have a lot of API imports coming in from China? Is that a threat, and are you seeing that on the ground already?
Yes, in terms of, it's a lot of intermediates and chemicals and all of that, and of course, excipients. Excipients, for example, we actually do it from Europe, and a lot of movement from Europe has also been impacted because of this. Clearly, as I said, every kind of material movement across the globe is certainly going to be impacted by this, by the war. And I would imagine it's not going to be unique to the pharmaceutical sector. It's going to be across sectors where there is international trade. Okay,
but are we working with a potential possible shortfall of APIs, or maybe a huge surge in terms of API prices? Are we anywhere close to maybe a crisis mode here?
It's difficult to answer at this stage, but because it really depends on how long this war lasts out. At this stage, things are looking about manageable, but I guess this could easily become a pretty bad situation overnight if things turn out to be pretty bad. But as I said, it's wait and watch at this stage.
You have indicated that your EBITDA margins would be around 26, 27% in FY26, and then you would probably go down to around 24 to 25%. At least in the near term, are you still working with that guidance, given the new information that we have, the dramatic dynamic changes taking place with regards to the conflict?
So clearly, when we actually last spoke, it was in the back of, in fact, the results that we saw in Q3. And at that point of time, tolvaptan was continuing to do well, and because there was no competition, and clearly that's the case even in the fourth quarter. We don't know when competition entered there. We had, of course, entered into a settlement for mirabegron, and given that we think that we are in a position to actually see that last out for the next foreseeable future, after September 27. And for those reasons, we believe that things are looking good for us. Of course, it calls for an amortization of the amount that you paid for in terms of the license fees for mirabegron, and of course there's a variable amount also, which will impact in some ways the overall profitability of the product. Those feel pretty good for us to be in the market. So there would be a tad lowering of overall, profitability and an impact on the results. But we are still upward of 24, 25%, in that range for the next year.
For the near term, at least, you're sticking to that 26-27% mark in terms of margins for FY26 and $1 billion in terms of sales for the US.
That is absolutely true. Okay. But as I said, these things could change rapidly given the fact that things are developing, especially freight rates and the like. Though, of course, we shall not derail the market per se in terms of, because the overall freight element itself is not, in the overall scheme of things, whilst it is extremely important, it is a smaller percentage of our total P&L structure.
All right. What is the plan for Lupin when it comes to the semaglutide launch in India? It's going off patent in around 2 odd weeks. The street is anticipating what could take place. It's expected to be a highly competitive market.
For sure, it's one of those things which which certainly is very exciting from our perspective as well. As you're aware, the diabetes market is well over 22,000 crores. And there has been a lot of visibility when it comes to GLP-1 products across, with a lot of holdings by Eli Lilly and others when it comes to airports and so on. So there is a lot of awareness of anti-obesity drugs in the market, I would imagine. So that's the reason why in the last 3 months, you see that the anti-diabetes market has grown by 15.7%. And if you were to knock out, in fact, the GLP-1s, the growth rate was 7.9%. The market itself, for GLP-1 drugs is close to about 1,600 odd crores. So, and given the fact that India is actually the diabetes capital of the world, with more than 100 million people who have been suffering from diabetes and a good 130 million who are pre-diabetic, I think it's a grand opportunity for pharmaceutical companies in India.
Okay. There are expectations that prices could fall as much as 50 to 60% initially. Is that what the market is expecting, industry veterans like you?
Well, the fact of the matter is there are going to be a number of competitors in this space. There are well over 30, 40, 50 who are anticipating to participate in this market. But clearly, there is going to be a decline in prices over time. And that would certainly be positive for the market because the market would expand also.
Okay, that's an interesting chat there with Lupin that Ekta had in terms of the diabetes drug as well as impact in terms of air freight costs because of the West Asia tensions. But we're going to sip into a short break. But as we sip into the break, here's a quick sneak peek into the stocks that we will be addressing on Your Stocks today. Don't forget to catch the fundamentals as well as the technical expert views in terms of the stocks at 2 p.m. today only on CNBC TV 18.
And
Welcome back. Joining us on the show now is Mukesh Sahadev. He's founder, CEO, Ads Analyst. Mukesh, hi, thank you so much for joining in. And it continues to be quite crazy when you look at the crude oil prices over the weekend. A lot of statements and stuff has happened in the Middle East that has taken a knee-jerk reaction to prices. We started 25% on the higher side. 15% up is where we are holding right now. That 10% off that the street is looking at is only because G7 says that they're looking to jointly release oil from reserves therein. One, how would you look at this G7 statement, and how would you look at the crude oil prices overall?
Thank you, Manisha. Good to be on the show. I know we talked about worst case scenarios in the past, and I was of the view that it may not go there, but it has gone there. I think one big assumption which has changed is the US ability to control the flows, which certainly was my assumption, which has not happened. Now, in this state, the reality is that even if the G7 countries, which is the 7 countries, they are holding about 1 billion barrels. China is holding about 1.3 billion barrels. From the 2022 to now, the G7 countries have actually declined their storages by 100 million barrels, whereas China has added in the same period by 300 million barrels. So the oil market is, in my view, looking for a safety valve. And I think the safety valve is probably China, which is holding tight and not giving the barrels because it is closest in the Asia-Pacific region where the refineries need the crude oil. Once the G7 countries release the oil, it will take some time for that oil to flow. And given the freight rates and insurance cost and everything, by the time the oil reaches, it might be too late. So if this was a case, I think this should have been prepared much in advance. Because this is a knee-jerk reaction, I don't think this can have some impact. But now I don't think this will have a big impact until China comes out to the market and does something. But for now, I'm saying China is holding tight.
Mukesh, just in sense of statements, really, when US said that they will ensure that no ship is harmed as they cross Strait of Hormuz, we saw a similar reaction in crude oil prices. It corrected quite a bit on the lower side. And now with the G7 statement as well, it has corrected. So what crude is basically doing is reacting to all of these statements where we do understand that the on-ground execution is going to be much difficult.
Correct, Manisha. I think the news comes, the market reacts, and then the market finds out, no, this won't work. And then we see another rally. So I probably can think of another rally. Now, the other angle to look at into, which is just my way of thinking, is that, yes, the Middle Eastern countries are announcing the cuts in production in quite a rush. But when you look at the data, the ships which are on the inner side of the Hormuz, even Iraq is filling the ships. They are filling the ships. So could there be a scenario where the Middle Eastern Gulf countries understand that all their calls for peace, for ceasefire on the US and Israel side are not being taken seriously? So they are announcing a lot of cuts to the market. It takes the oil price very high, very painful. And that might be the reason why the US may respond. So is there a strategy like that? I don't know, but I think is not unthinkable. And that's why, given these two sort of situations, I don't see an easy oil price respite coming until there is a big geopolitical announcement or a ceasefire or China comes to rescue the market.
I know we've been talking about various scenarios, Mukesh, but from where we stand right now, and with we are into a second week right now, with Street perhaps factoring in a third and a fourth and a fifth week as well, who knows? What are we looking at this right now? Because everybody seems to be making peace with the fact that, yes, crude prices have surged, may perhaps surge even higher, 120, 150 are the levels people are talking about, but it may not stay there too long. Is that what the Street is working with?
I think an excellent question, Manisha, and probably you're keeping very good tab of the market. The question tells me. You're right. The way the time spread, the structure in the crude market, which is not just the prompt market, but the deferred market is behaving, I think that is what the market is sort of thinking about. And my view is that there is supply cut in the Middle East. I doubt also some probability that it may not be real supply cut, it may be storages, but there is more announcement. That's number one. Number two, Russia exemptions for India. I'm seeing Algeria, I'm seeing many other countries across the world. Oil will be coming out of every place and everybody will be ramping up the crude oil production. And let's assume in a short time, this situation resolves. And on the other hand, refineries start going into maintenance, they prepone the shutdowns. We might run into a scenario where supply suddenly becomes available because of the geopolitical easing, but demand has said that now we are doing a turnaround. So in that scenario, there could be quite a correction, and that's something is getting reflected in the market. The bottom line is, Manisha, it all depends on the length of how long it continues.
Okay, all right. Thank you so much, Manisha, for taking us through this conversation. Thank you, sir, for joining in today, Mr. Sehdev, and talking about the outlook for crude oil prices as well. Time for a break now. Ajit Mishra of Religare Broking will join in with some trading strategies on the other side. Stay tuned. Decode.
Welcome back to Halftime Report on CNBC TV 18. Nifty as of now 23,850 levels. Around that mark is what the Nifty continues to trade at. Down around 600 points in the trading session, nonetheless, though recovered from the day's lowest point. But to take a further and closer look at the technical front, we have Ajit Mishra, who's the research at Renikere Broking, joining us right now to talk to us about that. Ajit, afternoon. Thank you so much for joining us on the show. If today the Nifty closes below the 23,800 levels, which it had touched at one point of time, then what is the downside that actually comes in for the Nifty, or the level that now we should keep an eye out on?
Yeah, good afternoon, Vinay. So, yes, 23,800 definitely is a critical zone, considering that we've opened below the 24,050 mark, which was the 100 days of weekly exponential moving average. And currently we are hovering around this 23,800, which is the next major support for the index. In case if we fail to hold, then 23,500 is where we are seeing a bit of a, put writing, and tomorrow being the expiry day also. Maybe around that area, we might see a bit of a breather considering the oversold position, because Nifty has declined roughly around 2,000 points in this recent days. So probably due to the expiry and other factors, it might find a support around that area. But having said that, the kind of carnage that we are seeing, the rate sensitive pack, probably the sideways negative tone might continue in the days to come also. So it's a sell on rise market largely, that until we decisively reclaim 24,200 market decisively, market may continue to trade lackluster, and any kind of rebound may continue to attract selling pressure.
Okay, so in that case, Ajit, what would your individual bets be?
So still, we are seeing that certain pockets like pharma, defense, wherein we are seeing strength. So Oro Pharma is almost like 7-8 months of consolidation, which is set to end. It's not only holding strong, but set for a breakout also. So we expect this outperformance to continue. 1310 is what we are eyeing as an immediate target. So with stop at 1178, one can go long in Oro Pharma at current levels. At the same time, one can look for shorting opportunity in Kalyan Jewellers. After this recent attempt of recovery or rebound, the stock failed to cross the strong hurdle around the short-term averages and formed a fresh shorting pivot. In near future, 362 is something that the stock might test. So with stop at 396, one can go short in Kalyan Jewellers.
Okay, thank you so much, Ajit, for joining us on the show right now and helping us understand the levels for the Nifty as well as individual names. But on that note, we're going to slip into a very short break. We'll get you more on the markets and stock-specific action on the other side. First to go. Welcome back to Halftime Report on CNBC TV 18. Just a short while ago, we did get that market technical check from Ajit as well. So 23,800 is surely going to be an important level, whether we sustain that and hold on to that or whether we fall below that will be key. But as of now, we are inching more towards the 23,900 mark as well in terms for the market. Advance decline ratio continues for the Nifty 50, only two stocks which are trading in the advance versus the decline there. HCL Tech is replaced by Cipla as of now. Apart from that, banks surely are under pressure as well. And advance decline ratio, the line, that gap is just there as we saw it in the morning as well. There's no change on that front. But with that, we're absolutely out of time on this edition of Halftime Report. Thank you so much for tuning in. Up next, your Business Lunch to take you through all the market action.
Barely a fraction of stocks managed gains as fears of a prolonged conflict in West Asia sparks a brutal sell-off. Autos, financials, industrials and metals are the big losers even as the market comes off the lows of the day. Brent crude tops $115 a barrel, the highest level seen since the breakout of the Russia-Ukraine war back in 2022 as tensions in West Asia escalate and oil producers in the region curtail output. Prices see some relief on news reports that the G7 and the IEA will discuss joint release of emergency oil reserves today. The currency dropped 60 paise from Friday's close to an all-time low below the 92.30 mark against the US dollar. The surge in oil prices, a big import for India, weighs on sentiment. The government hikes LPG prices even as sources suggest an increase in petrol and diesel prices is unlikely. The experts tell CNBC TV 18 that supply remains a key monitorable given that India gets 90% of its imports from the Gulf region. Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I am Hormuz Fatakia, and it's a down day to say the least. Of course, to clutch on to some bits of positivity, there is some recovery from the lows of the day. 23,697 was the low, so we are around about 200 points off the intraday low, and that is courtesy the big reason, which is oil. Oil was the reason why we are down this much to begin with. And it is the recovery in oil that has also sparked a recovery now. So oil at 106 as we speak. The intraday high was 119.5. And that is the reason why there has been a recovery in oil prices. The dollar index has also cooled off from the intraday highs. The Dow futures, well, they were down almost 1,200 points at one point of time. Now they are down 800. So there has been some recovery there as well from the lows. And that is, of course, because of the reports from the G7 and the IEA discussing the release of emergency reserves. That is, of course, a Financial Times report. And that is what has sparked the recovery from the oil prices from the highs, actually a fall from the highs. Now Brent at 107 and the US crude prices just above $100 a barrel. Now the war in West Asia has entered its second week with heavy firing from both sides continuing unabated. Let's go across to Dan Murphy for all the latest developments of the ongoing conflict.
Iran has named a new supreme leader as the region's conflict continues to escalate. Mojtaba Khamenei, the son of the late Ayatollah Ali Khamenei, has been selected by Iran's assembly of experts to lead the Islamic Republic following his father's death last month. The 56-year-old hardline cleric has long been seen as an influential figure behind the scenes with strong ties to the Islamic Revolutionary Guard Corps. But the appointment also signals continuity in Iran's hardline leadership, even as the war intensifies. Meanwhile, Israel has continued strikes on Iranian energy infrastructure, including major oil refineries and fuel facilities, dealing a blow to the country's energy network and adding further pressure to the global oil markets. The attacks come as crude prices surge amid fears of a broader supply shock across the Middle East, with Brent crude topping $115 a barrel earlier today. US President Donald Trump addressed the spike overnight, saying higher oil prices are, in his words, a very small price to pay if it means neutralizing Iran's nuclear capabilities. Trump has also previously dismissed Mojtaba Khamenei as a lightweight, warning that the new leader may struggle to hold power as the conflict continues. The surge in prices will have a direct impact on major energy importers like India and also has the potential to reshape the 2026 global growth and inflation story.
Dan Murphy, thank you for that update there. Now, speaking to reporters, US President Donald Trump has downplayed the need to tap into strategic petroleum reserves, saying that there is a lot of oil. Listen in.
We've got a lot of oil. Our country has a tremendous amount, and there's a lot of oil out there. That'll get healed very quickly.
Would you consider using the SPR or tapping into the SPR at some point?
Strategic reserve?
Yeah.
Well, I'm the one that built them up. Biden used them so that he could get some extra votes in the election. It turned out it wasn't even him that ran, it was Kamala. And she obviously didn't get any extra votes because we won in an absolute landslide. He shouldn't have used it for that. He used it to I filled it up, and he brought it down to the lowest level it's ever been. We will start at the appropriate time, which is basically a gut instinct. We will start filling up these strategic reserves.
Meanwhile, speaking to NBC News, Iran's Foreign Minister Abbas Araghchi has dismissed prospects of an immediate ceasefire. Take a look.
People have been killed, places have been destroyed, and now they want to ask for a ceasefire again? Well, this does doesn't work like this. So there should be a permanent end of the war. And unless we get to that, I think we need to, continue fighting for the sake of our people and our security.
We are going to get to the reports about some of the deaths in just a moment, but just to stay on this topic, would Iran ever agree to a ceasefire to get back to the negotiating table to end all of this military conflict?
Well, they have to explain why they started this aggression before we come to the point to even consider a ceasefire. Of course, nobody wants to continue this war. This is not our war. This is not the war of our choice. This is imposed on us by the United States, by Israelis.
Crude prices have now seen volatile moves and they were up 25% this morning, but they have come off now as the G7 is mulling the release of emergency reserves. Manisha is here with more on this.
Well, crude is absolutely on a boil after 20% gains on Friday. We've seen Monday opening at around 25% on the higher side. Crude seems to be making some sort of records across here. Interestingly, from those kind of highs, there's a bit of a profit taking that you have seen in the markets. This is after statements coming in from various reports that G7 is looking to discuss the joint release of emergency oil reserves. Now, the markets do believe that this is going to take time, but at least the intent itself is something that has led to some premium going off to prices. Let me remind you that the prices are trading at the highest since 2022. That is when the Russia-Ukraine war took over. The other thing also is that even as the US-Israel conflict with Iran enters into day 10, it really is about not so much about the damages on the energy infrastructure, but the kind of statements that we've heard coming in from various Gulf countries suggesting that they're looking to cut output. You have similar statements from Middle East producers like Iraq saying that output from 3 southern oil fields is facing a 70% decline. UAE says that they are managing offshore production to address storage needs. Kuwait has said that it is cutting oil production and refining as well. Saudi also seems to be diverting some crude to Red Sea. And then you have a JP Morgan statement saying that if the Strait of Hormuz remains shut more longer, then we are looking at 4 million barrels per day of a loss to the global markets therein. We have seen the prices gain up quite strongly. Well, let me remind you, 1st of January was $60 a barrel. March 27 was $70 a barrel. And we've seen 117 barrels day to day. So it has been really a 70% of a jump up that crude prices have seen in this year till time.
Manisha, thank you for that update there. In fact, earlier we caught up with former HPCL CMD and former Mahanagar Gas chairman, listening to their views on the pricing and the supply risk.
Not all the oil shock of the prices have been passed in the past to the consumers. So to that extent, it gives a comfort to the economy, it gives a comfort to the consumers, and over a period, then it is recovered over a period of time. So as of today, the more worry should be related to supplies rather than the pricing. But of course, it has got impact on the current account deficit, the foreign exchange, etc.
The more problem is in the case of crude oil and in the case of LPG, because unlike natural gas, the crude oil has to be then processed and then the petrol or diesel or other products are to be produced. And in the case of LPG, the situation is little delicate because India imports about 65% of its LPG requirement. And out of that 65%, out of the total imports, about 90% comes from Middle East only. And of all the LPG which is consumed in India, about 87% is domestic PNG, is only 13% is industrial or commercial.
We'll take a short break. More news and updates follow on the other side. Stay tuned.
Drops.
ये हैं कोटक नियो के तेज ट्रेडर।
Nikki index dips and snaps back.
ये ट्रिगर गिरावट का है। कसम कैंडलस्टिक्स की।
बेचो और बचो।
ये करते हैं शोर को इग्नोर और ये हौसला जानकारी और तैयारी से मिलता है। Stay तेज with कोटक नियो। Investments in securities markets are subject to market risks. Read all related documents carefully before investing.
मेरा रुतबा है मेरा सिग्नेचर, मेरा जज्बा है मेरा सिग्नेचर, बेबाक है मेरा सिग्नेचर, Signature Finest Silver Elaichi, a premium product from Dilbar Group.
अगर हर जगह फुल फ्लेक्सिबिलिटी चाहिए तो इन्वेस्टमेंट्स में क्यों नहीं? अब अपने इन्वेस्टमेंट्स को दो फुल फ्लेक्सिबिलिटी का एडवांटेज विद फ्लेक्सी कैप फंड्स। म्यूचुअल फंड निवेश बाजार जोखिमों के अधीन है। योजना संबंधी सभी दस्तावेज सावधानी पूर्वक पढ़ें।
अरे टेंशन किस बात की? सेंचुरी प्रोबूट का प्रीमियम प्लस है ना, लो एमिशन है, हाई डेंसिटी है, वाटर रेजिस्टेंट भी, टर्माइट एंड बोरो रेजिस्टेंट भी है। यानी ये है जहां नो टेंशन वहां।
प्रीमियम प्लस बाय सेंचुरी प्रोबूट। मेरा रुतबा है मेरा सिग्नेचर, मेरा जज्बा है मेरा सिग्नेचर, बेबाक है मेरा सिग्नेचर। सिग्नेचर फाइनेस्ट सिल्वर इलायची, a premium product from Dilbar Group.
अगर शूज में फुल फ्लेक्सिबिलिटी चाहिए तो इन्वेस्टमेंट्स में क्यों नहीं? अब अपने इन्वेस्टमेंट्स को दो फुल फ्लेक्सिबिलिटी का एडवांटेज विद फ्लेक्सी कैप फंड्स। म्यूचुअल फंड निवेश बाजार जोखिमों के अधीन है। योजना संबंधी सभी दस्तावेज सावधानी पूर्वक पढ़ें।
This is Network 18 and you're watching CNBC TV 18.
Well, there has been some recovery from the lows for the index, but at the day's low, the Nifty had entered a technical correction. Now, in normal terminologies, that is a 10% fall from the highs. Now, in just 2 months, it was on the 5th of January, the index had made a record high, which was 26,373, and today's low, 23,697, was indicating a 10% fall from the highs, which also signifies that the index has entered a technical correction. Of course, a bear market means a 20% correction, but we are still far off from those levels. The index, the Nifty Bank and the small cap index, all of them are currently in a technical correction mode. Now, if we take a look at the index from the 5th of January, only 1/3 or less than that, only 13 stocks have delivered positive returns, and the rest are down anywhere between 5% to as much as 25%. Now, if you take a look at the other stocks as well, 22 stocks are down more than 10%, 7 stocks are down 20% or even more, so anywhere between 20 to 30%. Let's break those stocks down. Now, the worst performing stock, but before we get to that, the overall market cap erosion so far for BSE listed companies from the highs of the 5th of January till date is around 43 lakh crore rupees, most of which has happened in just the recent last few days. Now, take a look at the worst performers on the index. Wipro, of course, IT finds a mention. Wipro is the worst performer, but paint companies, Asian Paints is down 23%. It had a forgettable year last year. It's having an equally forgettable start to this one as well. TCS, Maruti Suzuki, TCS, of course, being the worst performing stock in the Tata group as well. Now, the outperformers, of course, ONGC leads the pack because of the rise in oil prices, 16% higher on ONGC. Defense as a theme has done well with BEL. PSU banks have done well. SBI, barring today's fall, of course, had it not been for today's fall, SBI would have been in double digits as well in terms of gains, but still up 7%. Apollo Hospitals has done well, as has Power Grid. So there are themes that have done well. on the index. But overall, it has been a bit of a down move over the last couple of months ever since we hit that record high on the 5th of January, led mainly by IT and paint companies, of course, as well. But the other major talking point today has been the currency. And after the impact that you saw, the rise in oil prices and so on, the rupee hit a new record low today, crossing the previous highs of 92.30 and is still trading around those levels as well. Ritu is here with more details on this. Ritu.
Yes, Hormaz, on the back of what's happening in West Asia, the rupee is under fresh pressure today. It has, in fact, hit a new record low, that is 92.34 against the dollar. That's a fall of about 0.6% from the Friday close that we saw. And it puts rupee very much near the bottom of the Asian currency leaderboard today. Now, the driver, as I said, remains this escalating geopolitical tension, on the back of which crude oil prices have surged sharply on disruption fears. Of course, since the morning, we've seen some cooling down, but, they still remain above $100 a barrel mark. India imports more than 85% of our, energy needs, and therefore that has a direct impact and, a sharp spike in dollar demand from importers as well. All that is not helping the rupee. Now, traders do suggest that RBI stepped in to cap the damage in the pre-market session, and it has been selling dollars through state-run banks. So, because RBI was active in the spot markets today, that's why we haven't seen an even more disorderly move. But, heavy dollar buying across the board is why the rupee continues to be under pressure. Now, while it is one of the worst performing Asian currencies today, better perhaps only than the Taiwanese dollar and the Philippine peso, if we zoom out and look at the rupee's performance since the West Asia conflict escalated, we're somewhere in the middle of the pack, so we're not the worst off per se. Since the conflict started, the rupee's down about 0.84%, which is better than the Malaysian ringgit, the Taiwanese dollar, the Philippine peso, and so on. Now, RBI is very much present, and it is watching the market. In fact, last week, if you recall, RBI is believed to have deployed an estimated $12 billion to contain the fallout of this war and cushion the currency fall. But, this combination we have, very expensive oil, a strong dollar, and the risk of flows, all that is a tough one for the rupee.
Ritu, thank you for that update there on the currency. Still hovering around those record low levels of 92.34, currently at 92.26 is where the currency stands. Take a short break. More news and updates on the other side. Stay tuned.
Access to the most
Welcome back. Staying with the fallout of the Iran war, government sources say that around 88,000 Indians have been brought back from West Asia since the 28th of February. Madhya is now joining in with more updates on this. Madhya.
Well, several special flights are being operated by Indian and foreign airlines to bring back passengers stranded in West Asia since the 28th of February. Now, government sources say nearly 88,000 passengers have been brought back to India from the region so far. Of these, Indian Airlines carried over 49,000 passengers on 286 flights between 28th February and 8th March, while foreign airlines transported nearly 38,700 passengers on 166 flights during the same period. Among Indian carriers, Indigo brought back the highest number of passengers at over 20,900, followed by Air India Express with nearly 10,700 passengers. Among foreign airlines, Emirates carried the most passengers back to India at more than 18,200 passengers during the period. However, the disruption for airlines has been significant. Around 2,600 flights operated by Indian Airlines to West Asia have been cancelled since the 28th of February and the 8th of March, and of this, Indigo suffered the biggest hit at close to 1,100 flights since the 1st of March. Despite this, airlines are gradually restoring connectivity. Indian carriers are planning around 50 flights to West Asia today. Air India and Air India Express together will operate 24 scheduled flights to Jeddah and Muscat, and they are also planning 32 additional ad hoc flights to and from various cities in the UAE, subject to regulatory approvals and slot availability. Meanwhile, the Aviation Ministry says it is closely monitoring airfares to ensure that ticket prices remain reasonable and that there is no sudden surge in fares during this disruption.
Madhya, thank you for that update there. Now, India's External Affairs Minister S. Jaishankar debriefed the Indian Parliament today on the war in West Asia and diplomatic interactions surrounding the conflict. The EAM addressed how secure India's energy supply chain is in the wake of the conflict and the impact on consumers, as well as the three key guiding factors that India has adopted with respect to the situation. Listen in.
Government remains committed to ensuring that fully taking into account availability, costs and risks of the energy markets. For us, the interests of the Indian consumer has and will always be the overriding priority. Where required, Indian diplomacy has supported the endeavors of our energy enterprises in this volatile situation. Let me conclude by highlighting the three guiding factors of our approach. 1. India is in favor of peace and urges a return to dialogue and diplomacy. We advocate de-escalation, restraint, and ensuring the safety of civilians. 2. The well-being and security of the Indian community in the region is our priority. We will continue to work with the governments of the region towards that end. And 3. Our national interest, including energy security and trade flows, will always be paramount. I'm confident, sir, that the government has the full support of this august House on this matter. I thank you.
S. Jaishankar there on the developments in West Asia. Now, the Indian cricket team created history in the ICC Men's World T20, becoming the first ever team to win the title thrice, to win the title at home, and of course the first to defend its title after a commanding 96-run win over New Zealand in Ahmedabad last night. And India piled up over 255 after losing the toss and being put into bat, riding on half centuries from Sanju Samson, Abhishek Sharma and Ishan Kishan as well. And Sanju Samson, considering his stellar performance over the last 3 matches, was adjudged the player of the tournament. But New Zealand was never in the chase to begin with, and a top order collapse put an end to any hope whatsoever. And that was courtesy Jasprit Bumrah, who starred with the ball with 4 for 15 in his 4 overs. Akshar Patel also chipped in with 3 wickets as the Kiwis were bowled out for 159. Jasprit Bumrah was adjudged the man of the match. With that, we take a leave on this edition of Business Lunch. The Nifty is looking to attempt a recovery from the lows, but finding resistance at that 23,900 mark. The final 2 hours of the trading session begin on the other side with Midcap Radar.
Good afternoon. Welcome to Midcap Radar live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra and with me is Vivek Iyer. We continue to be below the 24,000 mark. There was some recovery, but some of it has been sold into. The Midcap index is down almost 2,000 points. A bigger cut coming in Bank Nifty, which is down around 6 points. Majority of it led by PSU banking names.
That's right. Good afternoon, Sonal. We came in with a very weak set of cues globally. Oil prices at a significant high. The only set of sectors that are managing to see a smidge of green are actually the defensives. Both the IT pack and pharma pack managing to ensure that there is some amount of green seen on the screen. But a lot lined up on the show, some important conversations. So let's start off with the top headlines. Barely a fraction of stocks managed gains as fears of a prolonged conflict in West Asia sparks a brutal sell-off. Auto, financial, industrials and metals are the big losers, even as the market comes off the day's low.
Crude oil prices jumped to hit a high of $119 per barrel. Oil marketing companies, Spain's aviation stocks bleed.
PG Electroplast falls more than 10% as the company received a communication from its gas supplier about a gas shortage and supply constraints linked to tensions in West Asia.
Maharashtra government announces a farm relief package in its 2026-2027 budget, a crop loan waiver of up to 2 lakh rupees for farmers with dues pending till September 2025. Bank of Maharashtra falls in trade. Okay, all right, those are the top headlines, but of course, markets are the top of our mind with the kind of cuts that we are seeing. It's a global decline, which is translated into the fall that we are seeing in Indian markets as well. As I said, there is some recovery which is underway, so we'll track whether that sustains through the course of the trading session or not. PSU banking index under pressure, mid caps are bleeding 3.5% over there. And look at the market breadth. For every one stock on the advancing side, there are 8 stocks which are declining. So across the board, it's a red-looking screen today.
That's right, Sonal. Across the board, it's a red-looking screen, like you mentioned. Well, a couple of stocks do stand out. Very high volumes have been seen in both commodity as well as equity trading segments. And MCX, especially one particular stock, amongst a few that is doing quite well. Very high volume seen in the month gone by. That's something that's aided a bit of the recovery. We spoke a little bit about the IT pack and the pharma pack. Also, hospitals have made a bit of a comeback. So names like Max Healthcare as well as Apollo Hospitals, both of them have rebounded quite sharply off the day's lowest points, and these names too are doing quite well. But this is our special segment, Mid-Cap Movers. Gaurav is standing by the wall to take us to the mid-caps that are moving around in the session. Gaurav, over to you.
Well, if you look at the markets, actually, market is under pressure. Over just 300 stocks are in green, and if you look at some of the stocks which are actually still going good in this day as well. So we've got companies like Jindal Poly Investment, R Systems, Cupid, Chemplast. If you look at the volumes are good, and at the same time, if you look at the stock performance, even if you look at Impure Pharma, all the stocks are up more than 7.5%, even in a day where Nifty is down almost by 2.5%. Apart from that, on the losing side, we have a whole bunch of stocks. We have got stocks like PG Electroplast, as Vivek mentioned just, that the LPG supply is something which is concerning the investors, and that is something which is dragging the stock down. Along with that, we've got companies like Meesho, Rain Industries, Suntech Realty. All these companies are not just down in trade, but we are also seeing some pressure from volumes. If you look at the sectoral indices, Nifty PSU is something, Nifty PSU Bank specifically is something that we have seen. Over the last few weeks, we saw this index was gaining in trade, but last week we saw the index itself was down more than 5%, and in today's trading session, it is down more than 5%. And we've got key draggers like Bank of Maharashtra, Bank of India, Union Bank. All of these stocks are down more than 5%. One of the reasons is that if you look at the Maharashtra government's bill, they have passed farm loan waiver, and that is also something which is sentimentally impacting these stocks. Other than that, in the pressured environment, we are also seeing Nifty Autos being one of the casualties, with the companies like Bharat Forge, Motherson and Uno Minda, all of these stocks down more than 5% in a trade today.
Okay, all right. I take that point. Thank you so much for joining us with that list, Gaurav. Let's now welcome Sneha Seth, who's the derivatives research analyst from Angel One, for a technical check. Sneha, good afternoon. Thank you so much for joining in. There's been some recovery from the lows. Do you think we could add on to that? Because we've been seeing resistance at the highs as well.
The kind of recovery we have seen, I think still now we are not out of the woods. We have seen a gap down opening, and I believe looking at the options activity, 24,000 call option is attracting fresh positions. So at this point in time, surpassing 24,000 would be a task. And on the lower side, I believe again we are seeing some writing happening. So at present, I believe one should be waiting, avoid being very aggressive, trade into individual counters, and that too being very selective, because looking at the IVs, looking at the overall setup, especially in the index, and despite what we have seen is the recovery is there, but again, the call writers are very active on the higher strike price. So at this point in time, 24,000 would be a challenge. And if we see an up move above 24,000, 24,200, then that would be a positive development. For now, be very selective in trade for now. That would be a strategy.
Okay, got that. Very selective in trades. Yeah, that's what you're saying. Amongst the chosen few, which are the ones you're recommending for our viewers today?
So one of the counter which I am liking is Dr. Reddy. If you see the chart structure, we have seen some consolidation recently, and after quite some time, we have seen this counter surpassing the falling trendline resistance, and now at this point in time, it has again come near those, that support zone. So I believe one can go ahead and long this counter at current levels, keep a stop around 1250, and go long for the target of at least we can expect 1340, 1350 levels in any time soon. So this is the counter which I'm looking for. Apart from this, if you want to go ahead and take a trade, persistent system looks good at this point in time, but not very aggressively one should be going. But yes, if you look at the chart structure, this counter has shown a decent recovery from the lower levels in last two sessions, and previously also if we see the overall chart structure, this counter looks quite good at this point. Then the risk reward ratio is quite favorable, so one can go long over here also.
Okay. All right, take that point. Snehal, thank you so much for joining in. So those are some technical stocks to bet on and chart checks as well. Slip into a short break. When we come back, we'll get you more on the markets and stock-specific action on the other side.
Welcome back to Midcap Radar. Well, the brief recovery that we see continues, especially within the pharma and the IT pack. But moving on to an important conversation, as the West Asia war intensifies, we are joined by Ajay Sahai, the Director General and CEO of the Federation of India Export Organizations, to discuss the impact on exporters due to the various conflicts that we are seeing, and also the closure as far as the Strait of Hormuz is concerned. Well, sir, first of all, thank you so much for joining us. Can you give us a sense of the quantum of goods by exporters that are stuck at various ports? What are the current difficulties being faced, and what is being done on ground to go ahead and ensure that there is some easing of the burden?
In fact, exporters are facing multiple problems. The orders have been put on hold, particularly from the Middle East. Those who are in the continuous production, they are finding it very difficult to manage the inventory because they have to now store all the goods at the factory level. Those consignments which have already moved, which have not stayed, they have to provide additional money for meeting the detention and damage and the ground rent charges. Those containers which have stayed, now shipping lines they are asking the surcharges, the emergency conflict surcharge, which in many cases much more, probably 200 to 250% much more than the cost of the freight. And since the goods are getting delayed, it is affecting the liquidity problems of the exporters also, because any buyer makes the payment only when he receives the good. So they are now reaching a situation where the bills are not getting realized on the due dates. And once the bills are not getting realized on the due date, banks are imposing penal rate of interest, which is generally 3 to 4% more than the normal rate of interest. The interest subvention, which is around 2.75% available to a lot of MSME, that also gets denied with that. So probably from all the front, they are facing challenges, and it's very difficult. And in fact, for last 3 to 4 years, we are seeing the headwinds in the global trade. And now this has come probably at the worst time.
Okay, take that point. Mr. Sahai, you mentioned what are the issues which are being faced, the kind of waiting periods that we are seeing as well. What is the quantum of increase in freight costs since the time this war has started?
In fact, the freight cost has increased substantially. If I'm comparing the freight cost, let us say from any port in the Western India to Dubai, the freight cost was around $400 to $500. Now the minimum surcharge is $1,500, and if I take them from the major shipping line, the minimum surcharge is $3,000 for a 20-foot container. So it is around 300% more than the cost of the freight. The air freight has also gone up. Earlier from Calcutta to any port in the Middle East, the freight was around 190 rupees per kg, which has already crossed 450 rupees per kg. I have been given to understand that the exporters of garments who are exporting to US, their costs have also gone up by around 100%. And this has happened when the oil prices have not moved. Now we are seeing escalation in the oil prices. They have already gone up by more than 20% and touched around $110 a barrel. We have to see how it will reflect on the freight in times to come.
Okay, Mr. Sahai, try and quantify the impact for us. You told us about escalating costs. Number one, due to non-delivery of goods. Number two, due to shipping lines charging a lot more and not even delivering the shipments. Number three, you spoke about higher penal charges at banks. Number four, higher freight costs. And also we understand that currently the rate of insurance is extremely high. Compared to a month ago or 2 months ago, what is the additional increase that exporters will now have to face?
In fact, additional increase, if you're looking into a percentage of freight, will vary from destination to destination. Okay. If I'm talking about the Middle East, the minimum increase is around 200% or more. And this charge has been imposed by some of the shipping lines, even when goods are transported to the ports in Africa. And where also this additional charge is imposed, we have to see what is the new rate which will be announced by the shipping lines once they are routing their cargo to the Cape of Good Hope, because additional voyage time around 10 to 20 days will be involved. These rates have yet to be announced. And this is impacting countries' exports also. In the last 10 days of the war, we have not seen much movement of India's exports, particularly to the Middle East. And the 10 days export translate to close to around close to $2 billion. And even to some of the destinations in the Africa as well as in the Europe and the east coast of US, we will see some hit. So I may not be able to give you the exact quantum, but probably this is coming at a worse time where my overall export for the current fiscal may also be impacted. We have to see how long the war is lasting, but if the war lasts for the full month of March, probably may take a hit of around $7 to $8 billion in exports.
Okay, all right, Mr. Sahar, thank you so much. A lot more questions, but completely out of time considering the minute-by-minute updates that we are getting. Thank you so much for your thoughts today. We'll slip into a short break. Up next, we'll focus on the impact of West Asia war on chemical sector. Stay tuned for that.
Welcome back to Mid-Cap Radar. Well, as the West Asia conflict continues, chemical companies feel the heat as most of the companies ship their products to the Strait of Hormuz and also have exposures to the US. Sonal is standing by the wall with all the important updates.
Thank you so much for that. Well, the West Asia crisis is not just impacting the oil sector, it could also ripple through India's chemical sector, which has heavy dependence on crude-based materials and will be impacted by the supply chain disruption as well. Here is how some key chemical companies could be affected. So let's start with SRF first up. On the raw material supply, SRF is relatively insulated in the refrigerant gas chain. But freight could be a factor because all three of its segments export heavily to the US and the UK. Another watch point is crude. Packaging films use crude derivatives as raw material, so there could be an impact. Next, Coromandel International. This one has clear West Asia exposure. Phosphoric acid and sulfur are key inputs. Iran is among the top global suppliers of sulfur. Most phosphoric acid and sulfur shipments pass through the Strait of Hormuz. Plus, some intermediates are crude-based, so there is another impact here. Now, Deepak Nitrite is a slightly different story. Its raw materials include propylene derivatives and ammonia, both of which could face supply disruptions. Exports are limited, so freight exposure is also minimal for this particular company. But propylene and benzene derivatives are directly linked to crude, where we could see an impact. Other Limited has a very wide raw material basket. Several of those inputs have exposure to West Asia. The company also exports across segments to Europe and the US. That means both supply chains and freight routes could matter. Crude sensitivity is spread across its portfolio, so the impact is not to be seen in a bigger amount. Aarti Industries sources benzene locally, which helps. But procuring aniline could become difficult if supply chains tighten. About 23% of its exports go to West Asia and about 4% to Europe. Benzene and other crude derivatives are key raw materials for Aarti Industries. GSFC faces a different kind of risk because it relies on natural gas supply through GAIL and Petronet LNG, where GAIL has already cut gas allocation. The company also imports sulfur from Iran, and caprolactam feedstock is linked to crude. This is where there could be an impact for GSFC as well. But you know, not every chemical stock is exposed. Companies like Navin Fluorine, Tata Chemicals, Archean Chemicals, Rallis and Anupam Rsayan currently have minimal or no direct impact from the West Asia disruption. So while oil grabs the headlines, the real story may unfold in supply chains, shipping routes and raw material dependencies across the chemical sector.
Well, thank you so much, Sonal, for joining in and giving in all of the details and all of the impact as far as the chemical space is concerned due to the ongoing conflict in West Asia. And with the news that the market continues to languish, especially the broad end of the markets, we take your leave on this edition of Mid-Cap Radar. Your stocks when we return.
Hello, good afternoon. You've tuned into Your Stocks, coming live from the CNBC TV 18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much, as always, for tuning in. In terms of the markets today, we are below the 24,000 levels. 23,880 around that mark is what the Nifty continues to trade at. Broader end of the market also is under pressure today. The Nifty mid and small cap down 2.5% in the trading session as well. I beg your pardon, sorry. With that, we have IT today is seeing a decline of 0.7% as well. But this is a show where we solve all your stock-related queries, and we are going to be doing just that with Ashish Gyal, CMT. And we're going to continue this conversation and solve all your stock-related queries with Ashish Gyal, CMT, author, Wave Strategy Advisors, as well as Gaurang Shah, Senior Vice President at Geopolitical Financial Services. Good afternoon, gentlemen. Thank you so much for joining us on the show. The first query for today is coming in from Srinivasan, who's writing to us from Hyderabad. He's holding 476 shares of TTK Prestige, price is 702 rupees per share, as well as 400 shares of IRCTC, price is 759. What should he be doing? Continue to hold, sell? Gaurang, good afternoon. What's your view?
Good afternoon to you, Vinny, and good afternoon to all the viewers of CNBC TV 18 and my good friend Ashish Gyal. Small disclosure, Vinny, that all recommendations that I'll be sharing with you this afternoon on your show are a part of our fundamental research team recommendations from a long-term point of view. Our company, Jujit, or myself, we do not have any kind of personal investments, no financial interest, no conflict of interest, but we share recommendations on similar lines with our clients. They might have their investment interest. So TTK Prestige, one of the niche and marquee names in the sector that it caters to and has got a decent market share. Unfortunately, because of input cost moving, volatility has impacted the margins in the past quarter gone by. But from a long-term point of view, we have a hold recommendation on TTK Prestige.
Okay, sure. Ashish, what's your view coming in for TTK as well as IRCTC?
See, if we look at TTK Prestige, we can see the stock has been under pressure after breaking below 520. It's now at 455. And there has been a systematic sell-off that we can see it on the charts. Having said that, I think one can maintain a stop loss of around 420 on the downside. That's a very important support. And on the upside, the stock needs to break back above that 480 mark. So it can consolidate for some time. The time horizon has to be more than a year from here on, and then we can expect some kind of a positive traction on TTK Prestige. IRCTC, again, if you look at the overall chart patterns, the stock has been under pressure, and it's not only these stocks. The selling is across the board that we can see, and IRCTC has also broken its support level of 545. Having said that, maintain a stop loss for the stock at around 510 levels, and let's see if the stock can manage to climb back above that 560 mark for a positive reversal.
Okay, thanks so much for that. We'll keep an eye out on those levels over there. Next query for today, we have Jay Kumar, who's writing to us from Chennai. He's holding 100 shares of Force Motors. Price is 21,000 rupees, 21,985. So right now they're making a loss on this one. The stock is trading at 20,750. Wants to know the long-term view for Force Motors. Continue to hold or sell. Gaurang, your view coming in for Force Motors?
So, Vinny, no specific coverage, but Force Motors, last 3 years, 5 years, if you actually go to see, this company has been a very prominent player in the auto sector and has got a very strong balance sheet. It has got some very niche and marquee names in terms of international names in the automobile manufacturing side, which are clients of this particular company, Force Motors. No specific comments because we don't have a coverage, but prominent and a strong balance sheet.
Okay. Don't have a coverage there, but an important prominent name there. But Ashish, your view on the technical front as well. When you look at it in the last 6 months, the stock has gone up 14%. Obviously, right now we're seeing a bit of a fall coming in the stocks in the last 5 trading sessions. But apart from that, what's your view on this one? What are the levels that they should keep an eye out on?
See, if you look at Force Motors, the price have corrected sharply from the higher levels, but it has still managed to protect the support levels of around 19,000. So I think there is still a positive hope from here on, and we can expect the stock to climb back about the levels of 23,200 on the upside. So the overall undertone can be range bound. One can possibly average out at the current level because it's a very important price action support, and we can expect the stock to eventually go to 23,000 followed by 26,000 levels.
Okay, let's move on then to the next query. We have Deepak, who's writing to us from Noida. He's holding 8 shares of DCM Shriram. This is at a price of 201 rupees per share. So making a good profit. Now he wants to say invested only for a short term for this stock now. What should he be doing? Should he continue to hold the stock, or should he get out of the stock? What's the view on this one, Gaurang?
Well, unfortunately, we don't have a coverage on DCM Shriram, but one thing is very clear, Vinny, that when you get invested in the stock market, and if you have now I'm a little bit confused. Is it the DCM Shriram Industries or DCM Shriram? Because they are two different entities, Vinny. I'm a little bit confused.
This is DCM Shriram Industries, because he said that he's making a loss on this one. So I believe he is holding DCM Shriram Industries, which is... Okay, it's DCM Shriram only. Okay, that's the correction there. So he's talking about only DCM Shriram.
Okay, no specific coverage, but if you're in the money, then I think in markets, as equally important is the art of investment. Equally important is to book profits, the art of booking profits on your investments and as and when you get it. Now, the level at which this gentleman got invested and the level where the stock is trading, I think I would leave it up to his wisdom and fine sense of judgment. I won't give any specific because we don't have a coverage.
Okay. Ashish, what's your view for DCM Shriram? If you could give levels for both DCM Shriram and Shriram Industries as well, in case the viewer is, they've not clarified it properly, but you could give a view on both of them, Shriram and DCM Shriram Industries.
Yes. So if you look at DCM Shriram, first, the stock has a very, very important support at around 900 because in March last year, it was at around these levels. And prior to that, again, in June of 2024, it was at the same level. So I think 900 is a very important price action support, and that should remain protected. And on the upside, we can expect the stock to bounce back towards the 1050 level. So the levels on the upside to look out for is 1050 from a short-term perspective, and 900 is an important support. As far as DCM Shriram Industries is concerned, I think the stock has a very, very important support lying near the zone of around 30 rupees. The stock is trading just at around 34, and the support is at around 30 rupees right now. So maintain a stop loss of 30 rupees on the upside. We can expect the stock to be facing hurdle around 38 levels.
Okay. Thanks for your view there on DCM as well as DCM Shriram Industries as well. Next query for today, this is coming from Venkatesh, who's writing to us from Telangana. He's holding 316 shares, transformers and rectifiers, and this is at a price of 300 rupees per share, making a loss on this one. Wants to know the long-term story. Gaurang, in the capital goods space, transformer rectifier side, would you say Transformer Rectifiers is a good company, a good bet, or would you be suggesting something else? A long-term story?
A long-term story, definitely positive on the entire, power generation, power transmission and distribution and power equipments. So this company happens to be a power equipment manufacturer, but unfortunately, Vinny, what I have known in the last maybe about 6 months to a year time, there has been some negative news flow, and because of which the stock has corrected quite sharply. I will leave it to my good friend Ashish to give the technical analysis, but my sense is that when you see this kind of deterioration and negative news flow, I think you need to be a little bit cautious and take remedial steps at the right time. We are positive on one company in the power distribution transmission side, which is a government-owned company called Power Grid. This company has almost about 70% plus transmission and distribution grid line network, and we remain extremely positive on this one.
Okay. Let's get a technical word on the stock as well. Ashish, your view for transformer rectifiers, what should the viewer do for a long-term story?
See, Vinny, in the month of November, we saw a very sharp decline on the stock, and it moved from around 440 levels and very sharply down. Since then, it is moving in a very consolidation phase in a range of 340 and 240. That's the range that the stock is moving, and currently it's just trading near the lower end of the range. So my suggestion would be hold on over here. Maintain 240 as a stop loss, and if the stock manages to cross that 340 mark, then there is a positive attempt towards filling the gap at 440. So in a nutshell, maintain 240 as a stop loss and see the price action at 340 levels. If it closes above it, hold on for 440 targets.
Okay, we'll keep an eye out on those levels over there for transformers and rectifiers. Thanks so much for that. But on that note, we're going to slip into a very short break. We'll come back with more of your stock-related queries. Stay tuned in.
ये हैं कोटक नियो के तेज ट्रेडर।
Nikkei index dips and snaps back.
ये ट्रिगर गिरावट का है कसम कैंडलस्टिक्स की।
बेचो और बचो.
ये करते हैं शोर को इग्नोर और ये हौसला जानकारी और तैयारी से मिलता है। Stay तेज with कोटक नियो। Investments in securities markets are subject to market risks. Read all related documents carefully before investing.
मेरा रुतबा है मेरा सिग्नेचर, मेरा जज्बा है मेरा सिग्नेचर, बेबाक है मेरा सिग्नेचर। सिग्नेचर फाइनेस्ट सिल्वर इलायची, a premium product from दिलबाग ग्रुप।
अरे टेंशन किस बात की? सेंचुरी प्रोबूट का प्रीमियम प्लस है ना, लो एमिशन है, हाई डेंसिटी है, वाटर रेजिस्टेंट भी, टर्माइट एंड बोरो रेजिस्टेंट भी है। यानी ये है जहां नो टेंशन वहां।
प्रीमियम प्लस बाय सेंचुरी प्रोबूट।
अगर हर जगह फुल फ्लेक्सिबिलिटी चाहिए तो इन्वेस्टमेंट्स में क्यों नहीं? अब अपने इन्वेस्टमेंट्स को दो फुल फ्लेक्सिबिलिटी का एडवांटेज विद फ्लेक्सी कैप फंड। म्यूचुअल फंड निवेश बाजार जोखिमों के अधीन है। योजना संबंधी सभी दस्तावेज सावधानी पूर्वक पढ़ें।
मेरा रुतबा है मेरा सिग्नेचर, दुनिया की सोच से ऊपर, बेबाक है मेरा सिग्नेचर। सिग्नेचर फाइनेस्ट सिल्वर इलायची, a premium product from दिलबाग ग्रुप।
This is Network 18 and you're watching CNBC TV 18.
Welcome back to your stocks in CNBC TV 18. We still have with us Ashish Kyal of his strategy advisors as well as Gaurang Shah of Geopolitical Financial Services to answer all your stock related queries. Keeping it going with the queries, then we have Rajesh Shekhar who's writing to us from New Delhi. He's holding he's holding shares of Realtel. Not mentioned how many shares. Shares of Realtel price is 350 rupees per share and currently you're making a loss on this one. Wants to know whether you should hold or sell this one. Realtel Corporation, Gaurang, your view for this railway stock. Are there other names you would look at or are you looking at the railway space at all?
So we used to cover Titagarh Rail Systems at one point of time. We used to have coverage on IRCTC. This is quite some time back. Currently, we don't have any stock under coverage in the railway sector as such. But speaking about Realtel Corporation, I think, look, Vinny, I'll give you a view on the entire railway sector. I think I can do that. So, a lot of changes are happening with respect to transformation and changes, whether it is to do with high-speed train, whether it is to do with bullet train between Mumbai, Ahmedabad, Mumbai, whether it is to do with modernization of railway station, railway tracks, railway coaches, as a matter of fact, and most importantly, Vinny, connecting the remote part of India with railway tracks and bringing down the dependency on road transport and bringing it on with the railway corridor, dedicated freight corridors, etc. So this company is closely associated, happens to be a PSU company, and is very closely associated with the Indian Railways. So as and when these transformation and changes happen, by definite, these companies are going to get benefited with respect to orders coming in.
Mm-hmm. And Ashish, your view on the technicals for Realtel? They bought it at 350 rupees and making a loss. A short-term target, maybe if you could give them?
See, the stock is trading at nearly 52 weeks low. There is an important support at around 272 level. So first, I would suggest to maintain that stop loss at 272. And if we get any kind of a pullback towards the level of 320, I would suggest to exit because the stock has been under pressure. There was a multi-month support of 320, which it broke. Retest is possible. So 320 can be the target over short term.
Okay, 320 can be the target for the short term. Next query then for today. We have Ramesh Jain, who's writing to us from Patna. He's holding JSW Energy, some shares of JSW Energy at a price of 548 rupees per share, and HPCL also. He's bought it at 500 rupees per share. Now wants to know the prospects of his investments. JSW Energy as well as HPCL. Gaurang, what should they be doing with both these names? HPCL, obviously we've seen the volatility right now coming around because of the crude prices, what's going on the Iran front. You know, what should they be doing here with both the names?
Unfortunate part is there is no definite date, Vinny, as to when this geopolitical situation will get over, and more importantly, where the crude prices will go and settle either on the higher side or lower side. Having said that, firstly, on JSW Energy, we have a positive coverage. You can continue to hold on to it in case you've gotten at higher levels. You can possibly use lower levels to add a little bit more in case if you're interested of adding some more. On HPCL, again, we have a fundamental coverage, but the sad part is the rising and boiling crude oil prices, Vinny. Don't know how government is going to compensate in case if the crude oil prices have to stay elevated at $100 plus, and in case if there is deterioration in the situation or there is higher aggression, and if more facilities get damaged and the supply becomes a little bit shorter than what it is usually is in the international market, then possibly there is short to medium term there could be pain for oil marketing companies like HPCL, but from long term we have a positive coverage.
Okay, long-term or positive coverage there. For the technicals of both these names, JSW Energy as well as HPCL. Ashish, what is the indication coming in here?
See, I would like to talk about first the crude oil. There is an event shock. We can already see that the crude oil prices were sharply up. WTI crude oil was nearly $120, showed some kind of profit booking, and it's now at around $104. Now that $120 is very, very crucial because if you look at the charts in the month of June 2022, post the Russia-Ukraine war happened in Feb 2022, the crude oil topped out at around $122. This is WTI crude that I'm talking about. And post that, there was a series of correction that we've seen until now. And the stock and the commodity has again come back to that same level. So 122 is a very important hurdle for crude oil. If that is closed and crude oil closes above it, then I think it's going to be anyone's guess where it's going to stop. So having said that, this is going to definitely impact the oil marketing companies, and we can already start seeing that with HPCL opening directly gap down and sustaining there. So we are at a very important junction right now. HPCL on the chart shows a very important support of around 365. I think that level is going to be breached if crude oil crosses that 120, 122 mark. So hold on with a stop loss of 365 and possibly expecting that there can be a reversal on the upside in HPCL from here on. And as far as JSW Energy is concerned, the stock has been in a range. It is failing to cross that 500 mark. That's a resistance. Let it cross that 500 mark, and then we can expect it to go towards 580. But this is relatively outperforming, and the support on the downside for JSW Energy is going to be at around 462 levels.
Okay. Thanks for that. Next query then we have is a couple of consumption names. Anandi is writing to us from Chennai. She's holding 100 shares of Jyoti Laboratories, and this is at a price of 490 rupees per share. So she's making a loss on this one. The other one is HUL. She's holding it at 2,800 rupees per share. Making a loss on this one as well, but not as bad as in terms of Jyoti Labs. Now wants to know the prospects of both these names on the consumption side of the story. Gaurang, your view?
Positive on both as a disclosure, Vinny, first of all. And for Jyoti Labs, from being a traditional South-based player, the company has managed to reach out pan-India and is doing well. Unfortunate part about this investment is that she got in at, I think, 400 plus level, and the stock is trading at about 240. 100 numbers is the shares that she's holding. My advice would be that if you have investable amount, you can maybe average about 50% or 100% at current level, bring down your acquisition cost and stay invested from a long-term point of view. On HUL, I think post the demerger of Quality Walls and of course the traction in terms of demand from semi-urban and rural India going up because the income levels have gone up, Vinny. Metros, tier 2, tier 3 cities, demand remains at an elevated level, but a big push is going to come in to the volumes front from semi-urban and rural India. And of course, whatever has happened in terms of new GST Avatar 2.0, good monsoon last year, and of course, a tax relief for those who are earning 12.75 lakhs. So all that will translate into positivities for top line and bottom line for quarters to come by. Hold will be the advice for HUL, and add and hold would be the advice for Jyoti Labs.
Okay. And on the technical front for both these names, HUL as well as Jyoti Labs, what are the levels that she should be keeping an eye out on?
See, both of these stocks are from the defensive space, and I think both of these sectors can outperform in current times of uncertainty. Jyoti Lab has a very important support at around 236, 235 levels, which it has managed to protect since the start of this year. And that can be a very important support or a stop loss. And on the upside, we can expect the stock to move towards the level of 280. So the outlook is positive on Jyoti Labs with 236 as a stop loss. As far as HUL is concerned, we can see some kind of disruption over the past few days where the stock has collapsed from the levels of around about 2,300 now at 2,181. But there is a very crucial support at 2,140, 2,150 levels for the same. So I would suggest that one can average out at these levels, and eventually the stock should start showing positive move back towards the level of 2,400 and possibly higher.
Okay. We'll keep an eye on those levels over there for both the names. Next query is coming in from Venu, who's writing to us from Karnataka. He's holding 3,090 shares of Tata Motors passenger vehicle. This is at a price of 590, and 3,090 shares of Tata Motors CV, and this is at a price of 239 rupees per share. Wants to know whether to hold or sell at the current levels. Gaurang, your view on both these names, right? Obviously, this is the demerge. I believe they got both of them on the demerge side. So PV as well as CV, should they continue to hold both of them, sell one of them? What's the strategy here?
So very candid disclosure, when the combined entity stood in terms of Tata Motors Limited, we had a coverage on the positive side. Post that, as we all know, the company got split into two, Tata Motors PV and Tata Motors CV. Very recently, we have initiated a coverage on Tata Motors CV, so you can continue to hold on to it. I am a little bit confused about the price that was flashed as far as the investment level in Tata Motors PV is concerned, because I don't think the stock has gone to elevated levels much more. But having said that, of course, we are not covering Tata Motors PV, so won't give any specific. But it remains to be a strong player on the domestic side. The only problem is to do with JLR, which is a high-end margin product, and that's not been doing quite well. And it had a cyber attack, etc. So that setback was there. But in terms of Tata Motors commercial vehicle, continue to hold on, and possibly if you get dips, you can add more in case if you have investable amount from a long-term point of view.
Okay, thanks so much for the view there coming in on both the names. But that was all the time we have on this edition of Your Talk. So Ashish as well as Gaurang, thank you so much for joining us as always and helping answer all those viewer-related, stock-related queries. And viewers, thank you so much for tuning in as always. Remember, you can always send us your queries on the email ID that is at the top of the screens for you all. There'll be a phone number as well. You can either send us your WhatsApp or a message on that phone number as well. So thank you so much for that. But up next, last hour of trade is still left. For that, you have closing bell to take you through that.
अरे टेंशन किस बात की? सेंचुरी प्रोबूट का प्रीमियम प्लस है ना, लो एमिशन है, हाई डेंसिटी है, वाटर रेजिस्टेंट भी, टर्माइट एंड बोरो रेजिस्टेंट भी है। यानी ये है जहां नो टेंशन वहां।
प्रीमियम प्लस बाय सेंचुरी प्रोबूट।
ये हैं कोटक नियो के तेज ट्रेडर।
Nikkei index dips and snaps back.
ये ट्रिगर गिरावट का है, कसम कैंडलस्टिक्स की।
बेचो और बचो।
ये करते हैं शोर को इग्नोर, और ये हौसला जानकारी और तैयारी से मिलता है। Stay तेज with कोटक नियो। Investments in securities markets are subject to market risks. Read all related documents carefully before investing. अगर शूज में फुल फ्लेक्सिबिलिटी चाहिए तो इन्वेस्टमेंट्स में क्यों नहीं? अब अपने इन्वेस्टमेंट्स को दो फुल फ्लेक्सिबिलिटी का एडवांटेज विद फ्लेक्सी कैप फंड्स। म्यूचुअल फंड निवेश बाजार जोखिमों के अधीन है। योजना संबंधी सभी दस्तावेज सावधानी पूर्वक पढ़ें।
अरे टेंशन किस बात की? सेंचुरी प्रोवुड का प्रीमियम प्लस है ना, लो एमिशन है, हाई डेंसिटी है, वाटर रेजिस्टेंट भी, टर्माइट एंड बोरो रेजिस्टेंट भी है। यानी ये है जहाँ नो टेंशन वहाँ।
Premium Plus by Century ProWood.
हाथ, ये जो हाथ है ना, सिर्फ लकड़ी ही नहीं, हमारा कल भी तराशते हैं। बंद हो या हो कोई स्ट्राइक, इनका शटर हमेशा खुल जाता है। इन हाथों का यही तो आपसे नाता है और इन्हें हम आसानी से लोन देकर अपना फर्ज निभाते हैं। कैप्री लोन्स फर्ज निभाते हैं।
मेरा रुतबा है मेरा सिग्नेचर, दुनिया की सोच से ऊपर बेबाक है मेरा सिग्नेचर। सिग्नेचर फाइनेस्ट सिल्वर इलायची, अ प्रीमियम प्रोडक्ट फ्रॉम दिलबाग ग्रुप।
This is Network 18, and you're watching CNBC TV 18. Go beyond market headlines to understand the reasons for the day's movers and shakers, and get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
The Hang Seng is down almost 3%. The Taiwanese index is down 6% as we speak.
Here in the Gulf, the major producers are also cutting output as we see storage continue to fill up here as well.
Not very often we see those kind of levels, 800 points lower.
All the oil shock of the prices have been passed in the past to the consumers.
Unconditional surrender from Iran. He says he has ruled out any deal with Iran.
Definitely, this prices, if and with this war to continue at this level, we might see the contraction in the margin profile for the consumer durable space.
You just have three names on the Nifty which are higher: ONGC, Coal India, and BEL.
India is relatively safe. Yes, we do get impacted about the crude related thing, and maybe this problem by 2032 should be addressed when we are moved towards the green energy in a big way.
So maybe there will be a short time where there will be a disruption, and the patients might have to bear the cost of a little bit more expensive ticket.
This 60 million standard cubic meters per day for the period when it is disrupted, I think India can manage very well by cutting the non-essential supplies.
There is a 150-point recovery from the lows of the day. The only question is whether that recovery sustains or not.
ONGC and Oil India, of course, if crude oil prices rise, it will be positive for them because they are oil producers as well.
It is indicating a 10% fall from the highs, which also signifies that the index has entered a technical correction.
Indian diplomacy has supported the endeavors of our energy enterprises in this volatile situation.
Continue to be below the 24,000 mark. There was some recovery, but some of it has been sold into.
Okay, well, we are down about 550 points. That was a day so far, which means we are where we were at 9:15 this morning when we opened, 550 points lower. There was a swoon, and the market went to the day's lowest point, which is about 200 points away from where we are right now. There's been a 200-point recovery, but still, I mean, the news, the story, the events, etc., are all the same, which is, of course, the Iran-led panic, especially in oil markets, and that causing and reverberating across equity markets, not just in India, but around the world as well. This is Closing Bell. Next 1 hour, last hour coming up as far as this Monday afternoon goes. We're coming to you from the CNBC TV 18 Motilal Oswal studios. I'm Prashant. Rima with me. Rima, hi.
Hi. What's changed is that Brent crude prices have eased. Now, if you pull up Brent, it stands at about 106, 107. So there has been a bit of a cool-off in Brent prices from the panic low that we had. G7 finance ministers are expected to hold a call at 8:30 a.m. Eastern Time to perhaps discuss the option of a coordinated release of crude from the strategic reserves. And that explains the pullback, the retreat that we've seen in crude prices. That said, it's still down 15%. And this follows the 35% decline that we had last week. Other than that, the shortage of gas is really going to show up perhaps in the next few days. So PG Electroplast has already informed the exchanges that they've received a communication that there will be some shortage of gas. And PG Electroplast is a stock which is down close to about 13%. And perhaps in the next few days, this could emerge as the collateral damage of what's happening.
I think there was a news story in the Tribune or something which said that that Punjab, the state government, is halting commercial supplies of LPG. And I think this morning we had the former chairman of MGL who said that the LPG situation especially is delicate. And I guess, the philosophy being that retail consumers should be protected, so industrial supply is cut, which at times like this. So that's where we find ourselves at. As Rima said, oil's pulled back, and the point is, 106 looks better on Brent after you've seen 120. But at 106, you're still some, $30, $35, $36 higher than you were the Friday before last. So that's the picture. And we'll await, how much oil is released and, what tranches and what it is able to do. US, of course, is sitting on the largest stockpile of reserves. But other countries we'll have to see how much is sort of supplied into the market in what phase, etc. So that, I think, is what has taken prices down a notch. Well, I think we'll talk about more directional view, sectors, etc. in just a bit. But Hormuz is here with just a snapshot view of how much the market's come off from the highs. I think on the Nifty, on Friday at close, we were down about 6.5% for the year. And of course, that's become larger now. Hormuz, take it away.
Well, you can call a bit of a correction from the lows, at least for now, if you want to call it that. But the bottom line being that at the lows of the day today, the Nifty had entered what you call a technical correction in the market parlance. So from the 5th January record highs, which was 26,373, we made an intraday low today, which was around 23,700, and that was a 10% fall from the record high levels. And that 10% fall for any index or stock means that index or stock has entered a technical correction. That is what has happened with the Nifty so far. Now, when you take a look at what has happened on the index since then, 13 stocks have delivered positive returns, and at least more than 75% of the index has delivered negative returns since then. And if you break it down even further, there are more than 20 stocks that have delivered negative returns of more than 10%. And out of those, there are 7 of them that have declined even 20% or more starting the 5th of January, which is over the last 2 months. Now, over these last 2 months, the overall market cap that the BSE listed companies have lost is over 43 lakh crore rupees. That's the kind of erosion that you have seen over the last 2 months. Now, which are the stocks that are leading this? So, well, no surprises that there are IT stocks that are part of this list. Wipro is the worst performer during this period, down 26%. But look at Asian Paints, a forgettable year last year and another forgettable start to the year as well. 23% down on Asian Paints as well. And Maruti, from record high levels, that stock has come off very sharply, 21% down over the last 2 months as well, along with names like Jio Financial and of course TCS, the largest among the Tata Group stocks. Of course, there are outperformers as well, and no prizes for guessing here too that ONGC is the top performer during this period, 16% higher on this stock during this time frame. Defense as a theme has done well. PSU banks were on a tear until the last few days, and if not for today's correction, SBI would have also been right on top of the list, trailing ONGC, but it still forms a part of the list. 7% higher for SBI, 7% for Apollo, and for Power Grid as well. So, well, it's been that kind of a market where there have been more downs than ups. The question only is when does this stop, and more importantly, when do we get back to those previous levels?
Thank you very much for that. A quick run through of the markets right now at 2:30 a.m. Well, sectorally, PSU banks, autos are down nearly 4.5%. Banks itself, the Nifty banking index still correcting 3.5% gone. It's 2,100 points lower on the Nifty banking index. Metals is selling off 3% down on that. There is no sector which is currently in the green, but the resilient ones, relatively, which have fallen lesser. One is pharma, that's down about 0.5%, and the rupee, which clocked in a new record low against the dollar, is limiting the losses on Nifty IT index to about 0.5%. Even defense, and defense, by the way, is the only sector which, on a month-to-date basis, since the start of the war, has got some gain going for itself. Even the defense index has corrected nearly 3%. To 23,900 on the Nifty. How should you position yourself? Mitesh Thakkar is now back with us. Mitesh, what trades have you taken today, and what is the call for the last hour?
So, good afternoon. I think, we've taken some profits off on put spreads positions, which we had on the back Nifty, but we've opened the put spreads on the lower strength. So the idea is that, we do believe that there'll be further more downsides happening. You'll get pullbacks and all. That's why it's not a clear naked short or a put long position, but it's a put spread. But broadly, I think, what is important is that now 24,200, which was, and to about 24,400, which was an important support zone, I think becomes a supply pivot. So pullbacks to those levels, which is only about 250, 300 points higher from here, I think would be selling opportunity. Similarly, on the Bank Nifty, the 55,500 target has been met, and we got a low of around 55,270 today. But anything close to about 56,700, 57,000, would be welcome time to possibly explore fresh short. So the structure is weak, but extremely oversold. So you may not want to go short right now, or the better way is to take it to some put spreads. And on the stock side, I have one buy and one sell. HDFC Life is a sell with a stop at about 662 and a target of around 630 can be looked at. While defense you were mentioning, and I do like Mazlan Rock, that's one stock. While it's down today, it's right at the support zones of 20-day averages, and the indicators are slightly positive. So I think with a tight stop at about levels of 23.29, longs can be taken for targets of around 24.20.
Thank you very much for that. The sell-off, by the way, has engulfed European markets this morning over there. Frontline European indices are down close to about 2.5%, and the Dow Futures is suggesting a downtick of about 800 points. But in the morning, when we were trading, the Dow Futures even went as low as an 1,100-point cut. But still, very, very bleak there. Dipan Mehta, Director, Elixir Equities, is now joining in on the last leg of the show. Dipan, thank you very much for joining in. PG Electroplast. Stock is tanking 13% because of the shortage of gas, lack of availability, gas constraints because of the Middle East crisis. Now, I guess this problem won't be limited only to PG Electroplast. There would be other companies who would be similarly and severely impacted. Your thoughts?
Yeah, Rima, good afternoon, and thank you for having me on your show. We are in the middle of a massive disruption of the energy supply chain, and somewhere some impact is going to have on the quarterly earnings. And all we can say is that we hope that this is transient and that the order book positions are secure, and whenever normalcy is restored, these companies will be able to convert the orders into actual revenues, and therefore the backlog will get cleared. But this is the thing, I have seen 2-3 such situations where there are wars like this, and it does cause a lot of pain. And we may see a very bad quarter also for a few companies. Maybe the June quarter may be very challenging, and that may result in stock prices also correcting. But it just as a long-term investor, you just patiently wait through these challenging times. And even good quality companies, I guess you should remain invested, because this is going to be transient. It cannot last forever.
Yeah. Let's just put up Chennai Petro and MRPL. These are standalone refiners. I don't usually talk about them because, they're like one specific kind of sort of segment, extremely volatile in terms of their share price moves. But I'm surprised. Stocks are down actually. If you look at diesel cracks, some $70. If you look at jet fuel, that is ATF cracks, north of $100. These are very large numbers. And the thing with, of course, refiners, standalone refiners, is that unlike OMCs, they don't have the retail side of the business where you'd lose money because, you can't increase prices. But I mean, on the refined products, you would for a while. We don't know for how long. It'll be windfall, especially because there is unlikely to be a shortage of oil itself. It was now that Russian oil is sort of coming. So there is crude oil supply, but refined product prices which have really gone through the roof. Deepan, good afternoon. I don't know if you have any thoughts here. MRPL, CPCL, or even, actually the others in the oil complex.
No, Prashant, I think that, these companies, although they've delivered decent returns, going forward, with the kind of disruption which is there, the kind of volatility in earnings, and it's not that these stocks are extremely attractive or that there's scope for the Ps to get re-rated. So at this point of time, I think all we are thinking is in terms of, which are the sectors which are defensive, which are the sectors which will continue to grow despite the war going on for a longer period of time. And the only sector which comes to mind and where we are focusing on just now is defense stocks. Because although they're expensive, come what may, I think across the globe in India as well, we are looking at these companies growing really fast. And with the way export orders can come into the sector, I think that could be a new growth engine also. So I think more and more we're looking at that sector closely. I know it's rallied and it's expensive, but still I think in a market like this, in the portfolios, one should be positioned with a large proportion of defense stocks. And all other companies, I think by and large, they should have their own challenges. But end of the day, I think the outperformer could be the defense sector.
In that, Mazgaon Docks is a stock you've liked in the past. That holds, or are you expanding your portfolio in defense?
Go for the largest company, Hindustan Aeronautics Limited. And that's one company which is sitting on massive multi-year order book position. Great opportunities, not only in defense, but also in civil aviation. And they are the preferred go-to company for the government whenever new technologies on the aviation side are being considered. So, and it's reasonably valued also, I feel. So I think that's one of the stocks that one could consider.
Even pharma, that's a domestic play. It's not even getting disrupted by AI. You've got gains in Emcure Pharma, 9.5%, Venus Remedies, Panacea Biotech, 4% up, Aurobindo Pharma, Thyrocare, Torrent Pharma, Acom's Drug, Jubilant Pharma. You go down the curve, even a Sun Pharma is up close to about 0.5%. Anything in the pharma, healthcare, we were talking about Apollo Hospitals, and they see emerging opportunity even more so in medical tourism. So they're saying people who went to the Middle East perhaps will now be redirected to countries like India. Any thoughts on pharma, healthcare? What catches your attention?
I think certainly pharma, healthcare are good defensive plays in a market like this. And within the pharma space, I think Sun Pharma and Dr. Reddy's, the larger companies, certainly will continue to do pretty well, especially Sun Pharma because of its specialty products. I think last quarter also numbers were very good. And look, Rima, in a market like this, when there's so much of uncertainty, we would always advise investors to increase their allocation to large cap stocks. Even if you're looking at pharma, the larger pharma companies with Sun, Lupin, Dr. Reddy's, I think should be preferred over some of the smaller ones. And once I think things settle down, we're very positive on CDMO, that's contract manufacturing companies as well. But across the board, all these companies are disappointed in the December quarter because of various issues like orders not coming through. But at least the RFPs are very good for these companies. So when things settle down, look for CDMO. But in the time being, if you want to put money to use, then large cap pharma is more attractive.
Yeah. Absolutely. I mean, given the state of the markets, in any case, pharma product consumption perhaps up a little bit, right? I don't know, but it is a tough situation. I mean, it's not as if it's like kicking something which is already down. Markets were already down, suffering, worst performing major market, and now you got this. So let's see. Hope is, of course, it gets resolved fast, and at least there are other things to worry about. We didn't need this, but. And I'm not even getting into all the humanitarian stuff and all the suffering, etc. I mean, purely from a market standpoint, there's been a lot here. to digest. Thanks very much, Deepan. Appreciate your time here. And thank you for joining us on CNBC TV 18. We're back with Nikhil Ranka. He's going to be with us from Novama. And we also have Sanjay Parekh of Soham Asset Managers. So they talk to us about what you should do. And we'll kind of sort of focus on that question. What should you do? What should you focus on with headlines flying thick and fast with what's happening in Iran? Stay tuned. Okay, welcome back. I just want to make a quick mention of the market, which is now recovering. I think what's happening, of course, in India is that the Nifty is back at about 24,000, 23,992, so almost at 24,000. And the Dow futures, US futures are also recovering. So Dow futures are now down less than 600 points. So basically, they've cut their losses in half. They were down about 1,200 compared earlier, now about 600 down now. By the way, we will hear from President Trump today in the evening. So he's expected to deliver remarks to the Republican members of Congress. Television cameras will be present. And I think he is perhaps, he's of course going to be expected to say something about Iran. We'll see what he really says. But I mean, it's all sort of in that sense come down to, what he says and just one person in that regard. To answer the question of when and how this is going to come to a close, at some point will he just declare victory and walk off from Iran, and will this situation cool down? So I think I'm not sure if there's anything new at this point to report except the fact that the markets are recovering. Is there a headline or two? Remember, the last headline which caused the markets, oil prices to come off was a Financial Times headline. And they quoted sources by saying that today at 6 p.m., later in the evening, you have G7 countries meeting to discuss oil release from sort of petroleum reserves. So that caused a sharp move, about a 10% move on oil. It cooled off 10%. And now you've got this move coming through. It's not as if oil has moved more, but US futures have indeed moved. Let's welcome in Nikhil Ranka of Nuvama Asset Management and Sanjay Parekh of Soham Asset Managers. Gentlemen, great to have both of you here. Thank you for joining us. Appreciate it. Let's do one thing. Let's talk about, we've been, of course, talking macro stuff and top-down stuff. So let's take the opposite route. And then towards the end, maybe I'll ask Nikhil, I know you have, some thoughts on what oil itself, perhaps where oil itself settles, but let's reverse the order. So Sanjay, let me start with you. What should, for viewers who are watching, I mean, historically, right, geopolitical induced oil shocks have been good times to buy. But of course, I mean, there are tail risks here we don't know how this will pan out. They're always there. So with that as a baseline, what would you do, and where are you finding serious dislocations? Because stocks were already down and they've been kicked down further.
And, you rightly said, so ours is, to start with, we are at 75-76% large cap. And after this reaction, pretty good opportunities in larger cap, across, you have a lot of choice. Another key point, we've seen crisis, Spain crisis, Greece crisis, Brexit, Ukraine war. And then, of course, last year when there was war again between Israel and Iran. And then we realized that all throughout, if we react when there is pain and sell out, it's absolutely, it doesn't help. You have to go through the pain, and the size of pain can be different. So this time, we all know that if it gets prolonged, you all have done a fantastic analysis of 5 million barrels a day into $40, 365 days is $70 billion. And we all know it's not going to last for a year. But even if it's 2 months or 3 months, it's painful. So all of us, we want to get this over maybe, or like a month or so. If that happens, then I think, markets will say, okay, March was bad, Q4 was bad, it's behind us, and back to basics. But it doesn't, doesn't happen that way. So I think at least what we're doing is changing a bit, pivoting a bit, not changing our strategy overall. And, like at least the largest market cap company, HDB Open, we added to that because we believe is far better placed. They will also have impact, but at least it's better placed. So there's a little bit of pivot, but no change in strategy that we have. Longer term, I think at least the government now should seriously have a policy which incentivizes E&P, which I've been tracking oil and gas for 30 years, and I've always been disappointed that we didn't have a policy which attracts investments in E&P, which I very, very strongly believe will happen, which is far more, attractive for potential investments in E&P.
Okay, so you're not changing the strategy too much, but shifting a little bit in what way, Sanjay? You said?
Yeah, so we added the largest conglomerate, the largest market cap company, because it's an integrated player.
Yeah.
It has an exposure to E&P.
Yeah.
If the cycle and this is assuming crude doesn't remain at 16, either it remains at 120. If it comes down midway, then the cycle petrochemical spreads for integrated player can get better. Definitely the demand impact we need to see, but at least we believe, they would be better placed because they also have an upstream presence. And then telecom is almost, not affected by that. Retail certainly from a sentiment perspective will be affected, but the solar and the renewables, most of the players, on a longer term as a strategy, certainly I think the government emphasis also will go up there, where there are very large investments. So we at least, we increased our weight in Reliance.
All right. Nikhil, at Nuvama Asset Management, are you all aggressively buying? If yes, what?
So yeah, we are now, we do feel that the markets don't have much downside from here. So Rima, if you typically look, whatever be major uncertainties, markets have typically bottomed in the first 7 to 10 days of those uncertainties. If you take the example of COVID, we bottomed out when we had the first 1 lakh cases of COVID. If you take Russia-Ukraine war, within the first 15 days, markets made a bottom. If you see even the Trump tariffs that happened last year, he announced the tariffs on 2nd of April, and we bottomed out around 9th or 10th of April in that sense. And this time around, if you see the starting point of valuations, we have been highlighting that 17 times 1 year forward is where markets typically bottom out. And even if you conservatively take 1400 rupees as the EPS for FY28, then today at 23,800, we are close to 17 times that number. And this time the earnings uncertainties, so to say, is not that clouded except for OMCs and to a lesser extent aviation. Rest of the sectors are not so much affected this time around. And my sense is this uncertainty should not last for more than a month in that sense, because it's not that any production facility has got disrupted. It's just that, logistics have got constrained. Once we have things moving from the Strait of Hormuz, then the recovery itself can be very swift in the markets.
Got that. Nikhil, so what have you at the margin done?
So we've not changed much. As I said last time, we were overweight on banking. We still continue with that overweight on banking. My sense is aviation is getting to a point where probably, larger names, one can look at it, because if margins stay at these levels, then obviously the other two players were loss making. That will put further pressure on them. So I think aviation is something that is starting to look incremental attractive, and at some point of time, I think 10-15% lower. Even OMCs will make a strong case in that sense, because this looks more a temporary disruption rather than structural long-term dislocation in that sense.
Never heard you talk about OMCs, Nikhil. That's a new one. 10-15% from here, lower from here.
At a price, everything is good, Prashant.
Yeah, no, absolutely. Absolutely. Sanjay, you mentioned one name, but I mean, anything else where you think there is too much dislocation which has happened, and maybe just by sheer numbers, it just is looking very attractive?
See, if we assume that it's not going to get prolonged,
yeah. Look, the markets are assuming this is going to last, this fight will last for about, the general consensus is 4 to 8 weeks, is what we're 10 days in, right? So
then I think a lot of options you have now, the entire financials, ICICI Bank, because we know some of it is led by selling, which is forced selling, by some redemptions, by some sovereign funds, so these fundamentals, they're not going to have issues on asset quality. And now with, inflation certainly will look up. So interest rates have bottomed up, and you're getting the same stocks at almost at 5-7-year low price to book, ex-COVID. So all the larger banks we own, and we slowly going to add exposure there. Then, of course, some of them which are not affected by them. Like telecom, I don't think telecom would have some element of, if diesel price spikes, then some of these towers needs diesel, where there will be some cost increase, but that's not significant. But otherwise, they're less affected. So there is one, we think at point the largest telecom player we have as value. So we are going to, navigate and look into, because there are a lot of opportunities in Nifty now. But we will discretionary side will avoid for a while. As I said, your impulse choice, you need to be selective. Where also the downside, if things go a little extended, is less, and when the bounce back happens, you are better off. Metals is one more, where they certainly look resilient. So these are the few names where at least we will put our incremental money.
So Sanjay, other than consumer, have you identified any other sector which you will avoid in the event of a prolonged war, say the logistics costs go up or oil spikes? Which are the sectors to avoid now?
At least we will not, I see, like Maruti, Mahindra, they've become very attractive. But for now, at least, we don't want to preempt, because the environment does get caution. Internally, we're discussing in our team that today, if somebody wants to buy a car, obviously they'll defer or delay for a while. So we'll see that happening. And we are conservative as a society. So I think that's where we will wait. Let it get more attractive, or let us see more evidence. And some part of the strategy is that we are not going to use all our money. We have limited cash that we will slowly deploy. And then when things get clear, you also can buy up. You don't have to, but we don't want to wait, as if the market is going to go down. We will slowly now nimble and use our cash gradually.
Nikhil, you want to name names? Anything? Spread the.
We can't take stock specific names.
Throw the net wide. 500.
We can't talk stock specific. We can only talk on sectors and market.
But have you run screens where, Nikhil, it's generally there is a fair bit of value emerging now? If in the broader market also, Sanjay, of course, is large. I mean, his portfolio also has a fair bit of mid caps, small caps, etc. But he's, I guess, Sanjay, you're skewed towards large caps in that sense, right? Yeah. Nikhil, broader markets?
I think across the board, value has started emerging. Mid caps, anyways, had seen a very sharp correction even before this event happened. It's just that typically, in March, you have that pressure on mid caps because a lot of fundings book closed down. So that has got accentuated a bit. But my sense is overall, both on the mid cap as well as the large cap side, we are getting to a point where if things don't get too bad from here, incrementally, the pullback in the markets can be very sharp, because what you have to also understand is now the leverage in the system has not got completely wiped out in that sense. There's very little leverage that is sitting in the system. So if you have buying coming in from lower levels, the impact cost will be very high, and therefore the initial 1,000 points on Nifty can come very fast.
Nikhil, you said we're trading at 17 times FY28 PE, and that's the valuation multiple typically at which we bottom out?
Correct. So if you leave COVID and global financial crisis, which were events where it's very difficult to predict what the earnings would be, then typically 17 times is the trough valuation where we bottom out. And this time around, I would say, the uncertainty is not as high. Even if you take last year, Rima, we bottomed at 21,800 when the Trump tariffs were there and there was a lot of uncertainty. In 1 year, earnings have gone up by 8 to 10%. So the 23,800 of today represents what we were at 21,800 1 year back in terms of the valuation multiples. So therefore, in terms of valuations, we are today at the same level where we bottomed 12 months back.
No, interesting conversation, and I hope that 1,000 points comes quickly, sooner rather than later. But Nikhil, you had a couple of thoughts on oil itself, right? You want to quickly run us through that? I mean, just your analysis.
But I just wanted to explain why, with the today's G7 meeting of emergency oil release, that's put a cap on oil prices in the near term, in my view. So if you look at it, Prashant, we had crude product of 15 million barrels flowing through the Strait of Hormuz. 3 million was refined products in that sense, out of which China was 5.5 and India was 2.5. Now we've got permission to take Russian oil, and the estimate of Russian oil floating on sea is close to 152 million barrels. So even if we get 50 to 60% of that, we have 1 month more of supply covered in. My sense is beyond 15, 20 days, China at least should get some relief on the Strait of Hormuz so that 5 million barrel incrementally should start flowing at least for China, guys. And then you have to understand in the case of Saudi, there is an east-west pipeline with a capacity of 7 million barrels, out of which only 3 million barrels were getting used. So if they are able to shift the incremental 4 million barrels through the east-west pipeline and evacuate it through Red Sea, then we are essentially talking about almost 11, 12 million barrels of dislocation which gets taken care of. And then if we have the SPR release from most of the sovereigns, then, that 2-3 million barrels also to a large extent will get covered. And therefore, my sense is it will be longer for higher because then you will have also inventory replenishment. But for the time being, I think 90 to 110 barrels is a range that crude should start to stick in. The upside tail to that sense is getting taken care of because of this SPR releases.
I think daily consumption, Nikhil, daily oil consumption, world consumption is about 100 million barrels, right?
Yeah, 104.5. And before this crisis started, Prashant, we were at almost 108 million barrels of production. So there was a global glut in oil because of which, if you see the consensus estimates everywhere, everyone was in that 60 to 65. Now, the only thing that is happening is the Russian floating stock will get used up, and what is there in the Strait of Hormuz becomes the new floating stock for the near term.
Okay, got that. Well, that's the math with regards to oil, but we'll talk more as we go through, what's going on in the Middle East, in Iran. Thank you very much for now. Sanjay, appreciate your time here as always. Nikhil, thank you very much for being a part of this conversation. I think we'll take a quick commercial break here. Markets actually came back. They are up, right? I mean, I think we're down about 387 points. So the thrust has been on the way up since about 220. 220, which I'm looking at the recent low, intraday low basically, not the absolute low, but over the last couple of hours, the low was made at about 23,870, and we've come up to about 24,060. So that's a very nice pullback that we've had in the 40-45 minutes or so. We'll take a break. We are back. As always, we get you the near-term trading ideas. We'll have Mitesh joining us for that. And after that, we'll have our next set of guests joining in. There's about 25 minutes to go for market closing.
ये हैं कोटक नियो के तेज ट्रेडर।
निकी इंडेक्स डिप्स एंड स्नैप्स बैक।
ये ट्रिगर गिरावट का है।
कसम कैंडलस्टिक्स की। बेचो और बचो।
ये करते हैं शोर को इग्नोर, और ये हौसला जानकारी और तैयारी से मिलता है। Stay तेज with कोटक नियो। Investments in securities markets are subject to market risks. Read all related documents carefully before investing.
ये हाथ केवल हल नहीं चलाते, मिट्टी से सोना उगाते हैं। ये हाथ केवल सिलाई नहीं करते, देश को नया रूप देते हैं। ये हाथ लोगों को उनकी मंजिल तक पहुंचाते हैं, और इन्हें हम आसानी से लोन देकर अपना फर्ज निभाते हैं। कैप्री लोन्स फर्ज निभाते हैं।
This is Network 18, and you're watching CNBC TV 18.
When the market moves, we don't just report, we decode. From the boardroom to the trading floor, we track what's driving business and impacting investor sentiment.
With insight that empowers and guidance that builds wealth.
Nuvama presents CNBC TV 18 Market Central,
for your daily source of market intelligence and wealth creation, with a commitment to doing it right.
Welcome back. The Nifty is above 24,300. Money is rotating back into IT and pharma, two defensive sectors. Wipro is now the top Nifty gainer, 198 on Wipro. You've got Infosys, Tech Mahindra, HCL Tech also in the green. On the pharmaceutical side, Apollo Hospitals is gaining, Sun Pharma, Cipla higher, and Reliance Industries is one of the big gainers today, 1.5% up on that. So in the morning, we had just about 2 or 3 Nifty stocks in the green. Now that list extends to about 8 or 9. The advanced decline ratio has also improved from 1:10. It stands at 1:6 in favor of the declining stocks. Mitesh Thakkar is now back with us for a few BTST calls. Mitesh?
Very clearly, I think there's some kind of bounce back, but as I said, I think that will happen. The markets are oversold on the intraday and the 2-hourly charts, but the structure is negative. So in that case, it becomes slightly tricky. But my belief is that we'll trade with the bigger direction of the trend which is still on the negative side. So we'll take one STBT and one BTST call. On the STBT side is IDFC First Bank. Keep a stop at about 68 or thereabouts, so 68.1. And a target of 65, 64.5 possibly can be looked at. And the defense back still looks good. In case there's a pullback, I think while the defense stocks should logically pull out, but they are the ones which are coming out above their 2-hourly charts, the 10-day, 20-period average on the hourly and 2-hourly chart. So HAL will take as a BTST with a stop at about 39.69 for targets of 40.30.
Okay, all right. Those are some trading ideas. Thanks very much, Mitesh, for that. 17 minutes to go for the market close. Let's just shift focus to the big story, which is oil itself. I caught up with Richard Ridolge of Matrix Global. He's someone who's seen oil markets for a long time, and this was an interesting conversation with regards to what Richard feels markets are pricing in. So I just want to play out a small slice of this conversation.
2022, after the Ukrainian war, the market went from around $55, $60, maybe $70, all the way up to $131. So that's the most recent high. So from a chart perspective, let's put that put a pin in that 131. The prior high before that was in 2008, which was $145, and that was a function of the huge amount of Chinese demand coming into the world. Oil production, ironically, at that time in the U.S., 5.5 million barrels a day. It's currently 13 million barrels. So that was an interesting move in 2008 because it said that we're running out of oil in the world. What are we going to do? And that's what made the move. Now, the most interesting thing about what we're seeing, when we talk about crude, we need to talk about the curve of crude. We need to talk about what the price of crude is. And what's interesting, and here's an interesting statistic. When the market in 2008 was at $145, the price between the first month and the 12-month was $13. That means that the forward contract was $13 under the spot price. In 2022, the price, when it got to $131, the price from spot to nearby was a $34 curve cheaper. This morning, when the market reached $120, really $115, $116, the curve price was $45 in contango. That meant that while the spot price was trading $114, the price 1 year out was trading $70. And there, if you look at that chart, so when you asked, do we have something to look at? That's what we're going to look at right there. But again, the key is not so much the price. It is how does the market determine what the price is forward? And what this tells me is the market believes at some point in the relatively near future, not necessarily tomorrow, but in the near future, that the market will solve this problem and prices will move back down as fast as they moved up.
Right, that's a very interesting, lots of statistics there, and I think fascinating stuff. And that graph, Richard, just what is GBX?
That is the symbol on the market for WTI. So I tend to look at WTI. I tend to look at WTI in my world. I know you guys look at Brent. It's probably more important for the Far East, but I look at WTI. So it's a WTI chart.
For our viewers, the 2008 spike is what Richard first referred to, which is 145. Then after 2022, the invasion, I mean, I think we got to 131, as you said, Richard. And now, of course, we are at 120 and has cooled off a little bit. But the more important point is that the forward, a year out, oil prices in 2008 were year out $13 cheaper, 2022, $34 cheaper a year out. And right now, a year out, prices are about $45 cheaper. You've spoken in the past, and before this, of course, current episode of conflict broke out, about the importance of the Kharg Island, right? Which is responsible for the bulk of oil which is shipped out of Iran. Iranian oil, which actually goes out from there. And there was some, I mean, social media, of course, it is what it is, with all kinds of people claiming all kinds of things. But do you think we could see action there? I think one of the mainstream outlets published something saying there's perhaps being discussed. What's your sense?
Excellent question. Spot on. I'm glad I had forgotten about that, and that's exactly, I think it's a very important point. I think, again, one of the reasons I think the market moves so sharply is that the IDF did take out a large oil depot. Now, they didn't take out Kharg Island. And just for your viewers, Kharg Island is where 90% of all oil exports leave Iran. And I've been making the point, and I've been right till this moment in time, that the powers to be do not want to take out Kharg Island, because if you take out Kharg Island, you really destroy the ability of a new regime to come in and utilize on day one the oil wealth that Iran has. Now, I've heard, I think, like you in social media and others, that it's possible that special forces go in there, that they try to take over Kharg Island, that something happens. And so the point you just raised I noticed on your screen was they have taken out a large oil depot in Iran. And I think that's important. It's not taking out export facilities. Export facilities are tremendously important. As I mentioned earlier, Qatar stopped exporting its LNG because of concerns of its export facility being attacked. And so I don't know what's going to happen at Kharg Island. I find it interesting. I think we should use it as a barometer for how we want to view the actions of the U.S. and how they view forward what's going to go on. Ultimately, I think if we give it major attacks on tankers in the Gulf, I can see Kharg Island being taken, having some damage done to it. It's sitting there, right? It is the easiest thing. It is the easiest target of all to hit.
There was so much military buildup, right? This armada that President Trump spoke about around Iran. And we actually, till the missile started flying, the markets were calm. There was nothing priced in. Right? It was all there. And it's very similar to what happened between Russia and Ukraine. There was a military buildup. Nothing happened. The markets did not. So, going in, they perhaps did not anticipate and price anything. But maybe, hopefully they're right a year down the line.
That's how I look at it. I really look at it that way, that the market, it doesn't react until it has to. What we know now is every short is out of the market. There are no more shorts. What we are starting to see is a lot of forward hedging.
Yeah.
Oil producers in the United States are using this move to hedge the curve because they know there's too much oil in the world. So, we've been on the phone. So the market says 106 right there. I have it moving back down again, to 103.
Well, that's Richard of Matrix Global. Remember, by the way, that conversation is only 3 hours old. 2.5 hours old, and even then prices have moved, right? Oil prices have recovered quite a bit. But the basic point he's making is, if you look at the Brent contract that we look at is April, right? Brent futures. So his point is, this is, as I said, 2.5 hours back, the prices would have changed a little bit, not much. His point is that oil prices are $110 at that point. But 1 year, April 2027 contract, Brent, that is $45 cheaper. That is at about under $70.
Yeah. Even December is 70.
Yeah. So his point is that it is, and he says markets are saying that this is not going to last that long, and they refuse to price. And I think Sandeep made that point. I asked him in the morning. He was talking about implied vol now, but the far dated contracts have not moved at all, and I think that is simply a function of the market refusing to assign high probability to the fact that this is going to last very long. I mean, they've been wrong before, but that's what the market believes at this point in time. Amrish Baliga is with us. Maybe we can go across to him for a quick word on things. Amrish, good to have you here. Thanks very much for joining us. Why don't we go from macro straight to micro? And I think you have a pick. Voltas is on your radar, Ambrish, and we're talking about Voltas on a day when PG Electroplast is down some 10-12%. Tell us. Ambrish, you're on mute.
Yeah, you can hear me now? Yeah.
Yes, go on.
In fact, Voltas also is down along with the markets, but then again talking of longer term, and just like the way you're talking of oil prices, I think in the next 12 months everything should normalize, and a stock like Voltas should perform. Being a leader in cooling and refrigeration products, a Tata Group company, leader in room ACs with about 18% market share, present in B2C as well as B2B. Voltas Beko, which is an international JV, is in the fast-moving home appliances market. That's also doing well. Should see a break-even by FY27. Their projects business is steadily growing. Orders worth about 6,100 crores in hand. So strong revenue visibility in the medium term. Pantnagar plant of theirs is running at 100% capacity. Chennai plant, the capacity is being increased by 50% and expected to run at an 80% utilization. And the latest weather forecast suggests that we'll have a higher summer temperature this time, and there should be heat wave, which again is positive for air conditioning and refrigeration companies like Voltas. So expecting an EPS of about 38 rupees for FY28 with a target price of 1862.
Okay, you can already feel the heat here out in Mumbai, Ambrish, and it's only the beginning of March. Any stocks that you've liked previously, which are now looking exceedingly attractive because they've corrected with the broader markets?
I think most of the stocks which I've recommended, which I've
Want to revisit? Tell us one, two.
I would surely go in for something like MTAR, which has been on a move because that's one company which is into mostly import substitute products, and because of their strategic client Bloom Energy, they should be making a major headway into data centers, and that's the big story going ahead. As well as if you look at the clean energy products, about 75% of the total revenue comes from clean energy. Defense, they are there. So I think MTAR should still move up decently well from here. In fact, I have a price target of 47.30 for this stock. The other one in a similar space like aerospace, railways and defense is DCX Systems, which again, was not doing well for the last close to 12 months. We have seen a major correction. But again, from a balance sheet perspective, zero debt company, order book position of about 2,600 crores. So I think over the next 2 or 3 months, we should really see a decent revival for this company. And here my longer term target is about 300 plus, but I think in short term, we should see levels of about 230 to 40.
MTAR is hardly corrected from the top, just about 8% lower from its recent high. But DCX System, 45% below the 52-week high. Ambrish, to stay on, need to slip into a very short break. We'll come back and we'll get the closing rates also. Welcome back. 2 minutes to go. Nifty is exactly at the 24,000 mark. Amrish, just a couple more questions. PG Electroplast, have you done the analysis here?
No, I've not really, tracked this company very closely, so a bit difficult to give a comment on this.
Sugar stocks are also holding up because of ethanol, proxy for crude oil prices, etc. Do you like any stock here?
Yeah, in fact, sugar stocks I like. Again, like ethanol right now is a short-term story because of which we have seen these stocks moving up. But my pick out here would be Balrampur, where I still see at least another upside of 15 to 18%.
All right. Thank you very much. We'll connect with you on the other side of the break. For now, we're closing with a cut of about 450 points, but the Nifty has recovered a good 300 points from the session lows, even as it ends the day deep in the red, 450 points down on the Nifty, Sensex down 1,400 points. In percentage terms, it's 1.8% lower on the benchmark indices. Mid-cap index also selling off more than 1,000 points, 2% gone at an index level. To the advanced decline ratio, 1:5 at close. But at the session lows, it was about 1:10. On the whole, there was a recovery. You can see that in the Dow Futures. Dow Futures was down 1,200 points. And when the Indian markets are closing, the Dow Future cut is restricted to less than 500 points. And even Brent, the low today on Brent was 119.5. And now Brent is at 107. On the way up, it's IT and Pharma, Wipro, Reliance, Apollo Hospitals, Infosys, HCL Tech managed to see some green by close. On the way down, broad-based selling, Tata Motors Passenger Vehicles, Ultratech Cement, Maruti Suzuki, Eicher, M&M, Bajaj Auto. Lots of losers in the auto pack, JSW Steel, SBI, Tata Steel, Adani Ports. That list goes on. 3.5% gone on some of these.
Absolutely. So bad day could have been worse. I think that's perhaps one way to look at it. 24,000 by close, 24,005. I think we'll get the adjusted rates in about 30 seconds and shouldn't be very different in that sense. I mean, even as compared to where we were when we started at 230, things did pick up quite a bit. It's actually, at about 230, we were at about 23,900. So around 100 odd point recovery from that level even. Of course, from the absolute lows, it's a pretty good bounce that we've had. Almost 300 points, 320 odd points from the day's lowest level. That's the Nifty for you. Nifty Bank down 3%, far larger in terms of damage. Mid-caps and small-cap indices will come up as well. And I think there is a pressure, which is very much there. Mid-cap index down 2% and the small-cap index down as well. Okay, I think it's a wrap on this edition, a closing bell. That's it from all of us here. Goodbye, but don't go anywhere. Markets forward will pick up on the action. A lot of headline watching, I guess, over the next many hours as we sort of bide time till markets open tomorrow morning.
Dalal Street sees an all-round fall, cracking weak global cues. The Nifty ends above 24,050. BSE listed companies erase market cap of nearly 9 lakh crore rupees.
Brent crude pulls back after breaching $115 a barrel, the highest level since the break out of the Russia-Ukraine war in 2022, as tensions in West Asia escalate and oil producers in the region curtail output. Prices see some relief on news reports that the G7 and IEA will discuss joint release of emergency oil reserves today.
And the Indian rupee sinks to a new record low of 92.3 against the US dollar amid a sharp rise in oil prices. However, RBI intervention manages to cap the losses.
Hello, thank you so much for tuning into Markets Forward on CNBC TV 18. This is a go-to show where we aim to get you all the key data points to gear up for the next trading day. I'm Vinny Motiwala. With me is my colleague Ritu Singh as well. Ritu, hi, and it's been again a day that we've seen red across the screen. There was no respite, so it's twinning with the color that you are wearing, and hope that changes sometime soon, but no de-escalation on West Asia. That continues to keep the markets under pressure as well.
That's right, Vinny. We want them to be in the pink of health, just like your outfit, but that is not to be. It's the second week in a row, now that, the war has not shown any signs of de-escalation, and that pressure is very much showing in the markets. You have the frontline index closing down more than 420 points. The mid-cap, the broader markets also seeing the pressure. The bank Nifty closing down almost 1,800 points. So there's pressure all around, sectorally as well, pretty much red everywhere except the IT pack. Marginally in the green, but apart from that, yes, very much under pressure. But we've got you covered over the next 20 minutes with all of this, the big news and the key developments on Dalal Street today. We've top corporate voices and events to track ahead. Let's kick off the day's market action, Vinny.
Absolutely. Let's kick off the day's market action. And with the first segment for today, we have Gaurav, who's joining us from the big wall to take us through the stock movers and shakers of the day. Gaurav, over to you.
Well, yes, today, if you look at the market did recover marginally at the end of the trade. But if you look at Nifty, it is still down 1.5%. But even in this weak market, we saw some companies actually gaining in trade, and not only in terms of numbers, but volumes were also strong. We've got companies like Jindal Poly Investment, Cupid. Remember, Cupid, it was an ex-date for the company to issue bonus share in the ratio of 4:1. But apart from that, we saw companies like R System, Chemplast, Emcure Pharma. All of these companies were not only up in trade, but we also saw some strong margins. On the losing side, we had a whole bunch of stocks. First, let's talk about PG Electropast. Now, there were concerns about the LPG supply, and that's the reason why we saw the stock took a hit of more than 14%. Other than that, we also saw Misho was down in trade because there was an assessment order from IT worth 1,499 crores. Rain Industries, Suntech, Realty were another casualties in the market. And lastly, let's also not forget about Tejas Network. If you look at the stock, although it was down, in a 1 month performance, it is still up more than 18%. On the flip side, if you look at OMCs and airline companies, now they did see pressure and they continued to see pressure for the last 1 month as well. Because even in today's trading session, we saw HPCL, BPCL, IOCL, all of these stocks losing in trade, even Interglobe Aviation, because crude oil prices are going up. And even if you look at the 1 month performance, all of these companies are down more than 10%. If you look at the bank Nifty, specifically the PSU stocks, though those stocks were down in trade, one of the reasons was that now Maharashtra state government is going to give farm loan waivers of loans up to 2 lakh crores. And after that, we saw pressure in the stocks like Bank of Maharashtra, Bank of India, Union Bank, even SBI saw some of a pressure in a day-to-day. So all in all, it was a weak day, but let's see what market has to offer for investors in tomorrow's trading session.
That's exactly what we're going to track. Gaurav, thanks very much for taking us through that. What should we expect tomorrow? Let's take this discussion forward with Ambrish Baliga, an independent market expert. And Ambrish, you saw the bloodbath in market today, a bit of recovery towards the end of the day. Crude prices have also recovered slightly from the dollars a barrel levels that we'd seen to now about 103 or so, thereabouts. What would you tell investors at this moment? I mean, the market's moving very fast on the back of all of these headlines that are coming in. Again, at 6 p.m. today, we'll probably hear from the G7 countries what they choose to do. But what would you suggest traders do at the moment?
No, see, I think the biggest question one should ask is how long this war will last. Because if it's going to be just 3 or 4 weeks, we are already in the second week, but if it just lasts 3 or 4 weeks, I think India can still manage. But if it's going to go beyond that, I think the first thing which will hit us is the crude oil prices, because governments won't have any option but to increase the retail prices. And that will have a cascading effect on inflation. So I think the bigger question is we need to understand how long President Trump can afford to continue with this war. So if we take a view that it should end sooner than later, yes, I think one should go long on the markets. But if you feel that it's going to last much longer, possibly it's time for you to stay out and just watch for a while.
Absolutely, Amrish point made there. Maybe just wait out and see where this is headed as well instead of rushing in. That would be the best right now to do, given we don't know how long it's going to continue. But as this war in West Asia, I beg your pardon, has continued, chemical stocks, they are feeling the heat as well. And as most of these companies ship their products through the Strait of Hormuz, and you also have exposure that comes in the US market for these companies. So now what is the overall impact? What are the important details here? Let's go across to Sonal for that update. Sonal, over to you.
Thank you so much for that. Well, the West Asia crisis is not just impacting the oil sector, it could also ripple through India's chemical sector, which has heavy dependence on crude-based materials and will be impacted by the supply chain disruption as well. Here is how some key chemical companies could be affected. So let's start with SRF first up. On the raw material supply, SRF is relatively insulated in the refrigerant gas chain. But freight could be a factor because all three of its segments export heavily to the US and the UK. Another watch point is crude. Packaging films use crude derivatives as raw material, so there could be an impact. Next, Coromandel International. This one has clear West Asia exposure. Phosphoric acid and sulfur are key inputs. Iran is among the top global suppliers of sulfur. Most phosphoric acid and sulfur shipments pass through the Strait of Hormuz. Plus, some intermediates are crude-based, so there is another impact here. Now, Deepak Nitrite is a slightly different story. Its raw materials include propylene derivatives and ammonia, both of which could face supply disruptions. Exports are limited, so freight exposure is also minimal for this particular company. But propylene and benzene derivatives are directly linked to crude, where we could see an impact. Atal Limited has a very wide raw material basket. Several of those inputs have exposure to West Asia. The company also exports across segments to Europe and the US. That means both supply chains and freight routes could matter. Crude sensitivity spread across its portfolio, so the impact is not to be seen in a bigger amount. Aarti Industries sources benzene locally, which helps. But procuring aniline could become difficult if supply chains tighten. About 23% of its exports go to West Asia and about 4% to Europe. Benzene and other crude derivatives are key raw materials for Aarti Industries. GSFC faces a different kind of risk because it relies on natural gas supply through GAIL and Petronet LNG, where GAIL has already cut gas allocation. The company also imports sulfur from Iran, and caprolactam feedstock is linked to crude. This is where there could be an impact for GSFC as well. But not every chemical stock is exposed. Companies like Navin Fluorine, Tata Chemicals, Archean Chemicals, Rallis, and Anupam Rasayan currently have minimal or no direct impact from the West Asia disruption. So while oil grabs the headlines, the real story may unfold in supply chains, shipping routes, and raw material dependencies across the chemical sector.
Thanks so much for that, Sonal. But we also have Jay Thakkar, who's joining us now from ICICI Securities. Jay, your thoughts first in terms of the markets. We managed to close about 24,000 today, but 23,800, that's an important level, and we did fall below that. So what are we keeping an eye out on in terms of levels for tomorrow? Tomorrow's expiry as well. What is the key here now?
Good afternoon to you, Vinny and Ritu. See, Vinny, I would say that Nifty, yes, it opened below 24,000, wherein for this entire March series, we had the highest put base. As in, we had the put open interest highest on 24,000 levels. It did open below those levels, but managed to close somewhere above those. But, one interesting thing is that the IVs have spiked quite a lot, and this, volatility spike ratio is generally what I track very closely in this kind of panic situations, Vinny, and that has reached to 1.5 today, 1.5 to 1.52. Generally, during these kind of panics, you see this volatility spike ratio to inch towards 1.6, and typically around 1.6 levels is where you see the index bottoming out, at least for the short term. So for this, in this week, and probably either today might have been a short-term bottom, or Vinny, I think that in this week, you should be having a probable bottom, at least for the short term, from where you could at least see 4 to 5% kind of a jump on Nifty. Why I'm saying this is that historically this is what has been proven. that around 1.6 volatility spike ratio is where you see the short-term bottom. Today, IVP and IVR, that is the IV percentile and IV rank, has also reached to 99 levels. I mean, those are indicating quite oversold regions as of now. So in the short term, meaning what I would like to say or sum it up is that I don't see Nifty falling below 23,200 on a closing basis until unless there is a meaningful bounce back. So, if at all you have to see a downside risk from the current levels, max I see is 800 points in the short term, not beyond that.
All right, Jay, take that point. Amrish, on the chemical space, any thoughts? I mean, like you said, we don't know how long the war will go on, so it's hard to, pinpoint a certain level. But do you see any opportunities to, buy in that sector?
Yeah, I mean, on a decent correction which you have seen, I think there is an opportunity to buy. But then I think one should look at the ones where at least there is some amount of backward integration which has happened. For example, someone like a Coromandel. I mean, they have about 50% of the raw material requirement. There is some backward integration. So that could be one of the picks. Deepak Nitrite, Atul, I think these are the ones to be looked at. RT, I think, is the other one where clearly I think, over the next at least 3 or 4 quarters, we should see possibly better earnings. It may not be this quarter because of this issue, but going ahead over the next 3 or 4 quarters, we should see better earnings.
Point taken there, Amrish. But let's move on and also, talk more about the Brent crude oil prices, which have been soaring. They hit those $115 above that mark, and its highest level that we've seen since that Russia-Ukraine war in 2022. However, the prices saw some bit of a relief on reports suggesting that the G7 as well as the IEA could discuss a joint release on emergency oil reserves. Let's go across to Manisha Gupta, who's here to explain us more on this front and give us more details. Manisha?
Well, crude is absolutely on a boil after 20% gains on Friday. We've seen Monday opening at around 25% on the higher side. Crude seems to be making some sort of records across here. Interestingly, from those kind of highs, there's a bit of a profit taking that you have seen in the markets. This is after statements coming in from various reports that G7 is looking to discuss the joint release of emergency oil reserves. Now, the markets do believe that this is going to take time, but at least the intent itself is something that has led to some premium going off to prices. Let me remind you that the prices are trading at the highest since 2022. That is when the Russia-Ukraine war took over. The other thing also is that even as the US-Israel conflict with Iran enters into day 10, it really is about not so much about the damages on the energy infrastructure, but the kind of statements that we've heard coming in from various Gulf countries suggesting that they're looking to cut output. You have similar statements from Middle East producers like Iraq saying that output from 3 southern oil fields is facing a 70% decline. UAE says that they are managing offshore production to address storage needs. Kuwait has said that it is cutting oil production and refining as well. Saudi also seems to be diverting some crude to Red Sea. And then you have a JP Morgan statement saying that if the Strait of Hormuz remains shut more longer, then we are looking at 4 million barrels per day of a loss to the global markets therein. We have seen the prices gain up quite strongly. But let me remind you, 1st of January was $60 a barrel. March 27 was $70 a barrel. And we've seen 117 barrels day to day. So it has been really a 70% of a jump up that crude prices have seen in this year till time.
Manisha, thanks very much for putting that in context. $60 a barrel is what we started 2026 with. Look at where we are now. Jay, just finally wanted to get your thoughts. I mean, ignore all this noise because the headlines, like I said, they're flowing in thick and fast. Where in the markets are we right now? I mean, are we closer to the bottom? Markets just taking a breather? Will we see a recovery? Or will you avoid fishing in these shallow waters? What are the charts telling you?
Well, Ritu, I would say that historically what we have seen in last 15 years, since when you actually compare these kind of events, what we have seen is from the peak, wherever these kind of events or negativity starts, or from wherever the volatility starts increasing, Ritu, from there generally you see Nifty falling by almost 10 to 11%. And if I see that from 25,600, then I think the bottom should be closer now. Hence I mentioned the levels of 23,000 to 23,200. I don't see Nifty falling below those levels because we haven't seen Nifty falling more than 11%. And so far, by if you include today's fall, then I think we have fallen by almost 8%. So not more than 3%. I think there should be a downside from current levels. Second point is that Ritu, it's not been more than 27 days, whenever we have seen these kind of events happening. So the consecutive or continuous fall or a downtrend has not been more than 27 days. That includes the holidays as well. And with today, I think we have already completed 19 or 20 days since the volatility has started rising. So I don't see more than a week for this short term to come into place. So 1 week's time, not below 23,000. That is what I would say. On the upside, yes. We have seen 25,000 levels now having the highest call base. So I think the range for the next 2 weeks should be 23,200 on downside to 25,000 on the upside. And the last thing which I would like to add is that the FI net shorts have now almost reached 1.8, 1.85 lakh contracts. And it has not gone to 2.1 lakh contracts. So it's also quite near to that. So maximum downside risk is 3% is what I see.
Okay, Jay, thank you so much for, highlighting those important levels for us as well in the next few weeks, hoping that this volatility ends as well. But Jay, as well as Amrish, thank you so much for joining us on the show as always. And viewers, on that note, we're going to actually step into a very short break. We'll get to the top corporate voices along with key market events to watch out for on the other side.
Welcome back to Markets Forward. Let's get you some top voices of the day. Soham asset manager Sanjay Parekh believes there are pretty good opportunities in large caps and that the metal sector looks resilient in the current environment. That's not all. We have Nuvama Asset Management's Nikhil Vanka, who asserts he doesn't think markets have much downside from here. Take a look.
To start with, we are at 75-76% large cap. And after this reaction, pretty good opportunities in larger cap across a lot of choice. Another key point, we've seen crisis, Spain crisis, Greece crisis, Brexit, Ukraine war. And then, of course, last year when there was war again between Israel and Iran. And then we realized that all throughout, if we react when there is pain and sell out, it's absolutely, it doesn't help. You have to go through the pain, and the size of pain can be different. At least what we're doing is changing a bit, pivoting a bit, but not changing our strategy overall. And, like at least the largest market cap company, we added to that, but we believe is far better placed. They will also have impact, but at least it's better placed. So there's a little bit of pivot, but no change in strategy that we have. Longer term, I think at least the government now should seriously have a policy which incentivizes E&P, which I've been tracking oil and gas for 30 years, and I've always been disappointed that we didn't have a policy which attracts investments in E&P, which I very, very strongly believe will happen. Which is far more, attractive for potential investments in E&P.
Okay, so you're not changing the strategy too much, but shifting a little bit in what way, Sanjay? You said.
Yeah, so we added the largest conglomerate, the largest market cap company, because it's integrated player.
Yeah.
It has an exposure to ELP.
Yeah.
If the cycle and this is assuming crude doesn't remain at 60, either it remains at 120. If it comes down midway, then the cycle petrochemical spreads for integrated player can get better. Definitely, the demand impact we need to see, but at least we believe they would be better placed because they also have an upstream presence, and then telecom is almost not affected by that. Retail certainly, from a sentiment perspective, will be affected.
Nikhil, at Nuvama Asset Management, are you all aggressively buying? If yes, what?
So yeah, we are now, we do feel that the markets don't have much downside from here. So Rima, if you typically look, whatever be major uncertainties, markets have typically bottomed in the first 7 to 10 days of those uncertainties. If you take the example of COVID, we bottomed out when we had the first 1 lakh cases of COVID. If you take Russia-Ukraine war, within the first 15 days, markets made a bottom. If you see even the Trump tariffs that happened last year, he announced the tariffs on 2nd of April, and we bottomed out around 9th or 10th of April in that sense. And this time around, if you see the starting point of valuations, we have been highlighting that 17 times 1 year forward is where markets typically bottom out. And even if you conservatively take 1400 rupees as the EPS for FY28, then today at 23,800, we are close to 17 times that number. And this time the earnings uncertainties, so to say, is not that clouded, except for OMCs and to a lesser extent aviation. Rest of the sectors are not so much affected this time around. And my sense is this uncertainty should not last for more than a month in that sense, because it's not that any production facility has got disrupted. It's just that, logistics have got constrained. Once we have things moving from the Strait of Hormuz, then the recovery itself can be very swift in the markets.
Got that. Nikhil, so what have you at the margin done?
So we've not changed much. As I said last time, we were overweight on banking. We still continue with that overweight on banking. My sense is aviation is getting to a point where probably, larger names, one can look at it, because if margins stay at these levels, then obviously the other two players were loss-making. That will put further pressure on them. So I think aviation is something that is starting to look incremental attractive. And at some point of time, I think 10-15% lower, even OMCs will make a strong case in that sense, because this looks more a temporary disruption rather than structural long-term dislocation in that sense.
Never heard you talk about OMCs, Nikhil. That's a new one. 10-15% from here, lower from here.
At a price, everything is good, Prashant.
Yeah, no, absolutely. Absolutely. Sanjay, you mentioned one name, but I mean, anything else where you think there is too much dislocation which has happened, and maybe just by sheer numbers, it just is looking very attractive?
See, if we assume that it's not going to get prolonged,
look, the markets are assuming this is going to last, this fight will last for about, the general consensus is 4 to 8 weeks, is what we're 10 days in, right? So
then I think lot of options you have now, the entire financials, ICICI Bank, because we know some of it is led by selling, which is forced selling, by some redemptions, by some sovereign funds, so these fundamentals, they're not going to have issues on asset quality. And now with, inflation certainly will look up. So interest rates have bottomed up, and you're getting the same stocks at almost at 5-7 year low price to book.
An interesting chat there coming in and updates coming in from top market voices. But with that, we're going to wind down this edition of Markets Forward on CNBC TV 18. Thank you so much for tuning in. We'll come back with more on news and updates on the other side. But it's a goodbye from Ritu, myself, as well as the team who put this show together.
Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. Crude oil prices attempt to recover after briefly touching $120 a barrel as the war in West Asia enters its second week. G7 nations to consider releasing emergency oil reserves. President Trump downplays the oil price spike, calling it a small price to pay to defeat Iran. Iran's political and military leaders pledge loyalty to Khamenei's son Mujtaba, who's been chosen as the new supreme leader. Fresh airstrikes reverberate across West Asia. Water desalination plants in Iran and Bahrain come under attack. Stock markets tumble across the world. The Sensex and the Nifty down nearly 2%. 8 lakh crore rupees in market cap is wiped out. All sectoral indices close in the red, barring the IT index. The rupee sinks to a new low against the dollar despite an RBI intervention, rising crude oil prices and continued selling by foreign investors. Royal sentiment. External Affairs Minister S. Jaishankar briefs Parliament on the West Asia war as the budget session resumes, confirms the death of 2 Indian mariners in strikes on merchant ships, says conflict has continued to intensify and security situation has deteriorated significantly. A U.S. Tomahawk missile is likely to have struck the school compound in Iran, killing 175 people, including children. Multiple reports point to the U.S. responsibility after new video shows U.S. missiles hitting the area near the school. A setback for Novo Nordisk. The Delhi High Court upholds a single-judge bench order that allows Dr. Reddy's to manufacture and export semaglutide to countries without patent protection. Semaglutide is the active pharma ingredient used in Ozempic, Novo Nordisk's weight loss medicine, and its patent protection in India expires later this month. Walmart-owned Flipkart completes a reverse flipping process, changing its domicile to India. The government approves the restructuring plan, clearing the decks for the online retailer to go public. The conflict between U.S., Israel and Iran continues to be the top focus. Now, fresh strikes and explosions being reported across the region as the war in West Asia has entered day 10. Missiles continue to rain down on Iran, with oil storage facilities facing the brunt of the attacks today and over the weekend. The Israeli attack appeared to be the first time a civil industrial facility was targeted in the conflict. Separately, desalination plants in Iran and Bahrain have also taken a hit. Iran's foreign minister alleged that the U.S. has set a dangerous precedent with this attack, which will lead to grave consequences. Amidst the turmoil, the Iranian regime has selected the second son of slain Ayatollah Ali Khamenei as the new supreme leader. The 56-year-old Mujtaba Khamenei is a hardline cleric who has never held elected office, but he is believed to have wielded his influence behind the scenes through his ties with the Revolutionary Guard. The Supreme Leader's office and top political military leaders have pledged loyalty to the new Supreme Leader. The island nation of Bahrain, which sits between borders of Qatar and Saudi Arabia, have seen an Iranian strike hit its biggest oil refinery, Bapco Energies. The company announced a force majeure on its group operations on account of the Iranian drone attack. Missile sirens continue to ring across Israel. A cluster bomb shrapnel resulted in injuries to civilians in central Israel from an alleged Iranian missile that was intercepted. Israel stepped up attacks in Lebanon with the first drone strike within the city limits of Beirut. Lebanon claims that nearly 400 people have been killed over the last week as Israel targeted hotels in the capital. The U.S. Embassy in Saudi Arabia has shared an urgent security alert overnight, urging American citizens to leave the country. President Trump has said Iran would be completely decimated if the U.S. sends ground troops, but when asked if the U.S. will deploy boots on the ground, Trump refused to answer the question.
What are the circumstances where you said it ground troops? How are you thinking about that? I don't even want to talk about it now. I mean, that's, I don't think it's an appropriate question. You know, I'm not going to answer it. Could there be? Possibly, for very good reason. Have to be very good reason. And I would say if we ever did that, they would be so decimated that they wouldn't be able to fight at the ground level.
People have been killed, places have been destroyed, and now they want to ask for a ceasefire again? Well, this doesn't work like this. So there should be a permanent end of the war. And unless we get to that, I think we need to, continue fighting for the sake of our people and our security.
We are going to get to the reports about some of the deaths in just a moment, but just to stay on this topic, would Iran ever agree to a ceasefire to get back to the negotiating table to end all of this military conflict?
Well, they have to explain why they started this aggression before we come to the point to even consider a ceasefire.
Well, no talks at this point in time. Crude oil prices soaring in trade, with Brent crude nearly touching $120 mark. Prices have subsequently cooled from those levels but remain elevated over the $100 mark. Just 4 months ago in October, Brent crude was hovering around the $60 mark. In fact, prices even dropped below $60 by the middle of December. By the last week of February, prices started inching up before the recent conflict began. Brent crude was at $72 just 10 days ago. 10 days of the war, prices have almost touched $120. Now, G7 nations are likely to consider releasing stock from their oil reserves. And as I mentioned before, Bahrain state-run oil firm has joined Qatar Energy to declare a force majeure. A report in Axios suggests the U.S. is not happy with the Israeli attacks on oil depots in Iran. President Trump has also downplayed the need for the U.S. to dip into its own oil reserves.
Our country has a tremendous amount, and there's a lot of oil out there. That'll get healed very quickly.
Would you consider using the SPR or tapping into the SPR at some point?
Strategic reserve?
Yeah.
Well, I'm the one that built them up. Biden used them so that he could get some extra votes in the election. It turned out it wasn't even him that ran, it was Kamala. And she obviously didn't get any extra votes because we won in an absolute landslide. He shouldn't have used it for that. He used it to I filled it up, and he brought it down to the lowest level it's ever been. We will start at the appropriate time, which is basically a gut instinct. We will start filling up these strategic reserves.
Well, it continues to be a very, very volatile crude oil prices. Friday was 20% of gains is what we closed the week with. And today the opening has been 25% on the higher side. Since then, it has been pretty volatile. The one statement that led to some profit taking was G7 saying that they will discuss the joint release of emergency oil reserves. That led to prices coming off that with the joint release expectation. Of course, it's going to take some time figuring out logistics and, of course, freight, etc. But the markets do believe that intent itself has led to some premium coming off. When we started this year, it was at $60 a barrel for the Brent prices. Today, we have hit $120 a barrel. It has been doubling in sense of crude oil prices in this year till time. Much of the gains, of course, have come in the last 7 or 8 sessions itself, especially with the news and reports of closures of oil facilities in Iraq, in Bahrain, in UAE, Qatar, for the example as well. And that has led prices higher. Strait of Hormuz closure, of course, is the biggest factor here. 20% of global oil flows from there, and that has led to a huge premium in prices. Even at $75 a barrel, most experts told us that $10 is just the geopolitical premium. Since then, we've seen prices gain up quite strongly. The markets do believe that the kind of speed that you've seen in crude prices going higher is exactly the speed that you will see the prices come down as well. And that's exactly perhaps what we are noticing. But there are 2 scenarios that the street also seems to be working with. One, if this conflict ends by the end of this week, then you could be looking at an average of an $80 a barrel of prices for the month of March. But if it gets prolonged to, let's say, 3 and 4 and 6 weeks, then $150 a barrel, which is an all-time high, perhaps could be breached as well. So at this point in time, crude continues to react to every tweet, every statement, every conversation and every decision that's continuing into the markets there with no clear sense on prices. But very few believe that crude prices will continue to sustain much higher. Most believe that we would be looking at much cheaper prices by the time we are in the month of June.
Well, that is the big oil shock. Manisha, many thanks for joining us. Now, what do higher oil prices mean for India Inc.? What impact will this have on operational costs for companies? Sonal is standing by now to give us the industry impact. Sonal, which are the sectors that are likely to be the most vulnerable to these high oil prices?
Well, to put things into perspective, India is heavily dependent on imported energy. And to give you some numbers, India receives around 2.5 to 2.7 million barrels per day, or around 50% of crude and 30% of its imported gas from the Strait of Hormuz. And with that, seeing some disruption, there is definitely an impact on imported energy as well. Let's first talk about the oil and gas space, because that's where you'll see a bigger impact on because of the conflict that has come by. But of course, ONGC and Oil India, it's a positive because higher crude oil prices would been high realizations for them. And the Oilfields Amendments Act did indicate that there could be no further windfall taxes on higher crude prices, so it's a definite positive. For oil marketing companies, though, it is a negative because the marketing margins will be squeezed. Around $75 to $82 per barrel, they will be in the positive territory, but beyond that, if they do not increase retail prices, they could see some margin compression. For Reliance Industries, largely positive on the refining front because remember, Singapore GRMs, they've moved higher to levels of $30 per barrel versus around $3.50 per barrel. So that will be very positive for their refining margins. But if we talk about some of these airline companies which have crude as their major raw material, some estimates suggest that every $5 per barrel increase in crude oil prices could impact Interglobe Aviation's EPS or earnings by 13%. The likes of paint companies, tire companies, all of them are also heavily dependent on oil as a raw material. Coming to gas now, we don't talk about it often, but fertilizer space, especially urea manufacturers, have around 50 to 60% of their inputs coming in from gas. And now remember, GAIL and Petronet LNG have declared force majeure, because of which there could be limited gas supplies to these sectors as well. City gas distribution companies are the other ones, especially Gujarat Gas, which gets around 60% of its input in the form of imported LNG. The other sector which could be impacted is plastics or polymers, because we had conversations with the industry. They indicated that raw material availability is very less for the plastic sector or for the PET bottle sector, and that is something which is impacting prices. And a lot of it is in the MSME space, so there could be issues of shutdowns as well. Tiles is the other space where we see gas being a major raw material. They are unable to get it, the prices are higher, and that is something which could be negative for this entire space.
Sonal, many thanks for joining us. So as both Manisha and Sonal are pointing out, it's not just the price of oil as well as gas, it's also the availability or the lack of that is a big challenge at this point in time. Now, the government, meanwhile, has hiked the price of domestic cooking gas by 60 rupees a cylinder on Saturday. The price of a non-subsidized cylinder will cost 913 rupees in the national capital and 912 in Mumbai. Energy experts say LPG supply will remain a key monitorable, given that 95% of India's imports come through the Gulf.
The more problem is in the case of crude oil and in the case of LPG, because unlike natural gas, the crude oil has to be then processed, and then the petrol or diesel or other products are to be produced. And in the case of LPG, the situation is little delicate, because India imports about 65% of its LPG requirement. And out of that 65%, out of the total imports, about 90% comes from Middle East only. And of all the LPG which is consumed in India, about 87% is domestic PNG, is only 13% is industrial or commercial.
Well, so gas might prove to be the bigger challenge at this point in time, both in terms of availability and, of course, we've already started to see a reprioritization, which essentially means rationing for industrial purposes, industrial use. Let's talk about the stock markets now. Tumbling across the world, the Lal Street followed global cues, ended sharply lower. All frontline indices fell over 1.5%. BSE listed companies erasing market cap of more than 8 lakh crore rupees. The Nifty breaching the 23,700 mark in today, but then ended above the 24,000 mark, down by about 400 points. The Sensex closing 1352 lower. At one point, it was down almost 1,800 points, coming off its intraday lows. The Nifty Bank down 1,700 points, 1,100 point cut there for the Nifty mid-cap, with 12 stocks declining over 3%. That is Prashant is standing by now to wrap up the market action for us. Prashant, markets weighed down by concerns of what's happening in the oil markets and just how long and protracted this war is likely to be.
Absolutely wild moves. I mean, the head was oil, the tail was, of course, equity markets and other asset classes. And, markets, of course, gyrating to oil moves, underlying oil moves. And, I mean, just think about it. We woke up with a 25% pop on oil prices, which, of course, mid-afternoon had cooled to about 15%. Rally, which further cooled as we sort of, went down into the last 30-40 minutes of trade. By 3:30, we were at about $103 odd. So the market trajectory kind of following something similar. We started about 550 points lower. At the low, we broke 23,700 by a few points. And by close, we had actually recovered about 250 odd points, maybe a little bit more, and we're down about 450 odd points. Nifty Bank was, of course, also under pressure. So the Bank Nifty had been steady till about last Thursday, and it had been by far the more stronger of the indices between the Nifty and the Nifty Bank. But Friday, the Nifty Bank came under pressure, and today, of course, was no different as well. 3% lower as far as the Nifty Bank is concerned. In terms of other sectors, the auto index was down 4%. That's a very large one. PSU banks, one of the best performers last year, one of the best performers this year as well, down about 4%. I mean, losses where indices were sitting on a fair bit of gains. I guess that's the way to look at it, because autos is the other space which has done very well. Bank Nifty, I kind of sort of already mentioned. Consumer index was down about 2.75% as well. You had the metals index, which was down about 2.5, 2.6%. I'll just come to the large cap stocks before I go any further. And the losers, Tata Motors passenger vehicle business down about 5, Ultratech was down 5, Maruti about 5, Eicher, Mahindra, Bajaj, Indigo were down about 4% each. Stocks, only two names with gains of over 1%. Wipro was one, and the other, of course, was Reliance Industries. Apollo Hospitals ended about 0.75% higher, but that's about it.
Prashant, many thanks for joining us. That was our market. Dow futures, meanwhile, in the US have come off their intraday losses ahead of Wall Street opening. You can, of course, catch the opening bell live on CNBC TV 18 at 7 p.m. We will bring you the coverage from the floor of the New York Stock Exchange. Tune to CNBC TV 18 for all the action. Remember, the US markets now open at 7 p.m. because of a daylight saving kicking in. Onto the commodities market, gold prices fell as dollars surged to a 3-month high, made bullion more expensive for holders of other currencies. Prices were impacted by the rise of the U.S. 10-year Treasury yields to a 1-month high. Dwindling optimism about the U.S. Fed cutting interest rates amidst inflation concerns also weighed on demand for the yellow metal. The rupee, meanwhile, falling to an all-time low today. This is oil importers' demand for the dollar rose amidst higher crude prices and foreign institutional investors continuing to sell Indian equities. Traders say RBI's intervention capped the currency's losses today, but 92.32 is the dollar rupee for you. External Affairs Minister S. Jaishankar briefing Parliament on the West Asia war as the budget session resumed today. The minister confirming the death of 2 Indian mariners in strikes on merchant ships, said security situation in the region has deteriorated significantly. Speaking on the rising oil prices, Jaishankar said the government is committed to ensuring energy security.
Government remains committed to ensuring that fully, taking into account availability, costs, and risks of the energy markets. For us, the interests of the Indian consumer has and will always be the overriding priority. Where required, Indian diplomacy has supported the endeavors of our energy enterprises in this volatile situation.
That's the External Affairs Minister. Up next, a big setback for Novo Nordisk. The Delhi High Court upholds a single-judge bench order that allows Dr. Reddy's to manufacture and export semaglutide to countries without patent protection. That and more when we return.
There was
In a setback for Novo Nordisk, the Delhi High Court has upheld a single-judge bench order that allows Dr. Reddy's to manufacture and export semaglutide to countries without patent protection. Ashmit joins us now with more details. Ashmit, take us through the High Court's order and what this means now as far as the weight loss drug market is concerned.
Well, semaglutide, of course, critical, is the active pharmaceutical ingredient behind the blockbuster drugs Ozempic and Wegovy. Ozempic for type 2 diabetes, Wegovy for weight loss and weight management by Novo Nordisk. Now, the essential battle that was playing out before the Delhi High Court is whether or not Dr. Reddy's can manufacture and then export it to other non-patented countries. That was the question up for consideration. This was an injunction that had been sought by Novo Nordisk. They were unsuccessful before a single-judge bench. The single-judge bench of the Delhi High Court had ruled against them. That was back in December of 2025. The matter then traveled to the division bench. And importantly, the division bench, in an order that came out just this afternoon, has held that it sees no reason whatsoever to interfere with the single-judge bench order, that it will continue with the relief that had been granted to Dr. Reddy's, that Dr. Reddy's is eligible to continue manufacturing this drug in question and then export it to non-patented countries. So no interference. And with that, the division bench of the Delhi High Court dismissing Novo Nordisk's application for an injunction. What makes this critical is that there are other companies that are also similarly placed, the likes of Sun Pharma, the likes of Natco, which are looking to make generic versions of the very same drug and then export it to non-patented countries. This is a verdict that will impact not just Dr. Reddy's. The other companies will also be watching very carefully. But one caveat, however, that needs to be borne in mind is that the patent protection itself for Novo Nordisk runs out in just a few days from now. That's March 20th of this month, just a few days away now. So the patent running out, but clearly no injunction being granted in favor of Novo Nordisk. Dr. Reddy's at liberty to manufacture and then export to non-patented countries.
Ashmit, many thanks for joining us. In fact, the head of Novo Nordisk in India, Vikrant Shrotriya, spoke to us about the Delhi High Court's ruling at the CNBC town hall on the market opportunity for weight loss drugs. Indian companies that have invested in manufacturing weight loss drugs also reacted to the verdict. Take a look.
There was this Delhi High Court judgment where they reserved the judgment, just took place today. And that means that Dr. Reddy's is allowed to manufacture, export semaglutide to countries without patent protection. Your thoughts on that? It is already a case which is, which has gone against you all.
See, there I cannot comment because I can only say that, we will have to go through this judgment. And I think we have a very, qualified legal team in terms of taking forward these kind of sub judice matters. And we will have to learn this verdict, which has possibly come by the time I am actually sitting here.
What I can say is that it is no different. This has been the previous judgments have been exactly like this, and we are not surprised. And we have been doing as per our customers' request. We have been manufacturing. Now it's just to wait for the approval to come in place.
Well, our guests, they're reacting to the verdict that's coming from the Delhi High Court. But remember, you can catch our special CNBC TV 18 town hall on the market opportunity for weight loss drugs, what it means for Indian pharma, what it means for companies in this sector, what it means for you as a retail investor. That's coming up for you here on CNBC TV 18 at 5:30 p.m. From all of us here for now, thanks very much for watching. Stay tuned. The news will continue.
increase in Brent translates to about 2 to 3% increase in food prices. What other rules of thumb do you have, and how long do you have to see those price hikes before they actually start to kick into some other inflationary places, whether that's airline prices, prices at the pump, food, and the rest of that?
Well, so there's the economic question and the political one. The economic question requires a little bit of a duration, and a transient spike over sort of long-term averages shouldn't really change inflationary pictures very much. Political story actually might be quite different because people remember those price spikes a lot longer than maybe politicians might like. On the other hand, the other rule of thumb I think you hear a lot is a 10% increase in oil prices is 0.4 of a percentage point increase in inflation. And it's because what we're looking at right now, particularly these barrels, these medium sour barrels from the Gulf, the middle distillates, the things that move our freight, that move our planes, that make our economy go. Those barrels are the ones that we're looking at missing. We're looking at products rising, becoming expensive, and staying that way until those inventories replenish. This is where that strategic action has some value, even if it can't close the flowing barrel gap. The idea to try to take the edge off prices further out the forward curve.
You're not obviously a military guy, Kevin, but would you, if a week from now you heard the Straits open for whatever reason, everything's been degraded, the ability to stop ships, whatever, would that be a surprise to you? Is that possible?
Well, I mean, we originally modeled a 1 week straight closure scenario when we were looking ahead at this for the last several years, and we're past that now. So, yeah, of course, it's possible. It was sort of our baseline expectation. We thought maybe mines would get laid down and then get cleaned up. We're not even looking at that right now, though. And the question is, what is stopping the ships? It's not just insurance. It's actual risk. It's assurance to the safety of the crews and physical cargoes. And it's not obvious, as long as the conflict persists, how that would change. Now, the conflict could end. There's a lot of mechanisms at work that could provide safety, more warships escorting tankers. But 1 week is starting to look a little optimistic right now.
All right, Kevin, thanks.
Thanks for having me.
Nobody knows. Obviously, we're asking you to do things none of us can do. Checking the futures this morning, 500 points now of downward pressure on the Dow. Let's get to Dom Chu with a look at this morning's pre-market movers. Hey, Dom.
All right, so good morning, guys. We're going to start off with a look at airlines on the back of what's happening with Iran, broadly lower as that conflict in the Middle East continues and oil spike raises jet fuel prices overall. Analysts at Morgan Stanley are attaching some estimates, noting that jet fuel has become an early pressure point as operations stall out in the Strait of Hormuz. Jet fuel prices have surged 58%, and more than 25,000 flights have already been canceled since the conflict began. So airline stocks overall down roughly 2.5% to 3.5% in the early pre-market trade. Moving over to the media and a look at Paramount, Skydance, and Netflix, both lower this morning after analysts at Wells Fargo resumed ratings for both of those companies. Analysts there rate Paramount, Skydance at underweight, saying that the Warner Brothers Discovery deal was a win, but that the debt that comes along with it is riskier when compared to other companies out there. Meanwhile, Netflix has resumed at equal weight. Those analysts expect the company to rebound from the Warner Brothers lost bidding and move back to Plan A, which they say is investing more in content. So Paramount down 2.5%, Netflix down 1.33%. And finally, shares of Adobe are lower this morning after getting price target cuts from Wells Fargo and Citigroup. Wells Fargo is cutting its target to $405. It was $420. That's an implied upside of 43% from Friday's close. Analysts there are worried that AI will continue to disrupt the software company, but hopes that Adobe's AI adoption aid will growth in 2026. Analysts at Citi cut their target price to $315 from $387. That's an implied upside of 11% from Friday's close. They also hope AI adoption will help the company, but remain neutral as they want to see if those results down the quarter show this week later on show signs of growth. So keep an eye on Adobe, down about 1%. For more on those and other analyst calls of the day, just head over to cnbc.com/pro, where subscribers get all the context and detail around those notable upgrades and downgrades each day. Joe, I'll send things back over to you guys.
Okay, Dom. Thanks. We'll see you later.
You got it.
Okay, coming up, shares of BlackRock tumbling 7% on Friday. This after the firm limited withdrawals from a flagship debt fund. We're going to dig into the problems in private credit and contagion risk. We'll do that right after this. and that allows them not to have to sell assets at fire sale prices. And this is a feature, not a bug of the product. The other side says this is a real problem, that people don't understand what they've actually bought, and that this is the canary in the coal mine. Which is it?
I think, honestly, Andrew, it's a bit of both. I think retail investors, who, as you know, have been brought into private credit funds relatively recently, they thought they were getting something different, something more liquid than what it is. But I agree, there are gates. If you read the terms and conditions carefully, you shouldn't expect to have full liquidity under all circumstances. So, to some extent, this is a reasonable repricing.
The broader question, I think, about private credit right now is how much of it represents, if it does at all, a genuine systemic risk to the system.
Right. Well, they said that's the problem, Andrew. We don't really know. The opacity of this sector has become a problem. And I think more disclosure, at least to the authorities and probably publicly, would be healthy for everyone. I don't think the industry necessarily has anything to hide. But the lack of, obviously, market pricing to real market valuations, that does give you some concern. And what exactly is the exposure of the banking system, Andrew? As you know more than anyone, it's always about the banks, the core banks. How exposed are they? How hedged are they with regard to the most problematic players in this space?
And how connected do you think they are?
My guess, Andrew, is they're quite connected, and probably more connected than we would be comfortable with, just because it's a hot sector, and private credit's been grabbing a lot of exposure to the AI and data centers and so on and so forth. So the banks often plow into this kind of exposure, but not all banks, I'm sure. And so more data, more transparency would be helpful to us.
If I was Mark Rowan, who runs Apollo, or Harvey Schwartz, who runs Carlyle, or John Gray, who runs Blackstone, and we were having this conversation, I think they would say a couple things. I think they'd say, first, it's a small piece of the total economy. Depending on your math, it could be $2 trillion, could be maybe $3 trillion. I don't know if you think it's $4 trillion. So in terms of just the total pie, how big is it? And how much does that unto itself portend a problem?
So it's probably 2 to 3 trillion, Andrew. So no more than 10% of total credit in the US. It's relatively small. It's grown very fast. And of course, financial issues often arise when you have this kind of fast growth. Could it be the tail that wags the dog? Yes, absolutely. But I hope not. And I think if we get some more transparency and if there's more disclosure from those distinguished people who run the industry, that would really help assuage the fears.
Talking about disclosure, who do you think should be providing that? Should this be a self-regulated scenario, or should there actually be genuine regulations that provide requirements for such disclosure?
Well, Andrew, as you know, we've had this discussion, 1,000 times in the last 100 years in the US. I think self-regulation is great when you can get it and if you can make it work. Some light regulation, I don't think we're talking about anything like bank regulation at all for this industry, but some light regulation requirements on the disclosure to the SEC, for example, that, as you know, has been discussed in the past. The industry doesn't like it. They don't want it. But I think this kind of pressure that we're seeing recently may bring them around.
When you look at the list of folks who are in the private credit space, and on our screen, which you probably can't see right now, we have Apollo on the list, we have BlackRock, we have Blackstone, and then we have Blue Owl Capital. Blue Owl Capital is down the most right now, down about 2.2% just this morning. How do you think about them, and do you think about them as an outlier, or again, are they sort of a proxy for other trouble to come?
Well, that's always the question at this stage of the credit cycle, Andrew, again, as you know very well. So you always get some outliers. You always have some people who've taken on a bit more risk, had a bit more exposure to the risky activities, whatever you think that is, data centers or software services, I guess, for the case of Blue Owl. And then the question is how much trouble are they in? How far are they as an outlier? You've got to calibrate everything relative to that. That's the key question of the week, well, apart from oil prices. But we don't know. And what's the data on which you would base that assessment? Hard to say. And therefore, it's understandable that certain kinds of investors who value liquidity highly would rather exit right now.
Do you look at it? I mean, I know you're not giving investment advice, but given how much some of these stocks have come down, this is not the funds, this is the companies themselves. But on the back of some of this, is there any party that says, maybe it's oversold?
Well, look, I think some of these are very well-run companies, Andrew, with deep pockets and some very wealthy people behind them, including wealthy people who've tapped into their own personal funds to handle their redemptions. So reputation matters a lot, Andrew, and I think reputations are made and broken at a time like this. It's unfortunate that the global pressures are also converging on us and on the U.S. economy and perhaps even on this sector at the same moment. But as Warren Buffett liked to say, this is when you find out who's been swimming with and without their clothes on.
Can I just throw one final question at you? We've been talking all morning about what's happening in Iran and these sort of global cross currents around us. Price of oil obviously spiking, stocks falling. Questions about what's going to happen to the Chinese economy and how they're looking at this. How do you see this all playing out?
Well, this is big trouble, Andrew. I mean, I think the U.S. can withstand it. We have, our Strategic Petroleum Reserve. We produce a lot of energy. We export a lot of energy. But the world is in trouble. I mean, a lot of important economies with whom we trade a great deal are massive oil importers, and a lot of them get their oil at this moment through the Strait of Hormuz, which is substantially closed. So there's a problem for Europe. It's a problem for manufacturing powerhouses in Asia. That's our export markets. So I think that the global economy has got a major problem here, Andrew.
Okay. Simon, thank you. Thank you for joining us this morning.
Still to come this morning, the impact of the Iran war, surging oil prices, and the ongoing partial government shutdown on the markets. You can see this morning the Dow futures are now off by about 600 points. S&P futures down by about 80. NASDAQ futures down by 308. It comes after a down week for the markets last week. Squawk Box will be right back. Public policy. And Libby, I think people are maybe a little surprised at this point. This looks like it's going to be a more prolonged action than most had been anticipating and maybe than we've gotten used to recently.
I think that's right. I mean, you even hear members of Congress saying the word war when they were, I think, choosing their words more carefully just as a week ago. I think that the real question for members of Congress is, will they have to now vote on a big supplemental, which is something, of course, that I think a lot of them would want to avoid. They voted on this war powers resolution. They voted that down, sort of green-lighting the president's ability to continue with the Iran strikes without congressional authorization. They'll have another bite at the apple, though, in terms of the supplemental, and that might be a harder vote for at least some members of Congress heading into the midterms.
And the way you start to think about this from what it will all mean for the markets, quick surgical strikes are very different than something that carries out, than something that causes elevated energy prices for starters. It's something that we see higher prices here at the pump, but nothing like what people are facing in Europe and Asia at this point.
No, I think that's right. I mean, obviously, war is a little bit easier to start than it is to finish, obviously, not to be glib about this, obviously. And so I think that just, politically speaking, this is something that I think everyone wants to avoid on Capitol Hill. From a market's perspective, obviously, higher prices of oil, more government spending, that could lead to higher deficits. You could also see the bond market react to that, which is obviously, our specialty at PIMCO. But generally, I think that the issue with war here is that it becomes, harder to control. The end game may not be something within, the administration's control.
What happens from the political perspective? You mentioned that this is, $2 billion a day that we're spending at this point. Congress is not going to want to reauthorize or re-up that. But you also have midterms that are coming this year.
Yeah, so I think if you go back to 2022 and you go back to spring of 2022, everyone was talking about sort of a Republican wave, and that's because there was a lot of enthusiasm among the Republican Party. Gas prices were very elevated. President Biden's approval ratings were sort of sub 40%. And so there was sort of this sort of optimism, both in the market, but also I think on Capitol Hill, that there'd be a Republican wave. That failed to actually manifest. So I think that our message to clients is there's a long way between here and there. So while the metrics look positive for Democrats in terms of taking back the House, and of course history is on their side, the party out of power on average picks up 26 seats in the House. The generic ballot, the enthusiasm gap, president's approval rating, all of those things are pointing to gains among Democrats. But I guess it's just too early to sort of say conclusively. So, while the betting markets all have Democrats winning the House, the Senate, so it seems like they say is a coin flip. I think we would put the chances lower. It's just too early to sort of say what the political read-through here is.
What do you tell more broadly at PIMCO people to do as they try and contemplate whether this is going to stretch out or not?
Well, for us as sort of active managers, it's a great opportunity for us to sort of take advantage of dislocations. I think there's some things that we can sort of fade, some of the things that sort of sell off that we think have good value, highly collateralized or what have you.
I keep hearing people saying, okay, it's a great opportunity. We haven't seen a sell-off yet. For the broad markets in particular. You've seen oil prices go up, but, really, the Dow futures down by 600 points, S&P futures down by 75. I don't even think that puts the S&P 500 down 5% from the all-time high.
No.
So are you advising people to wait? Do you think there will be a bigger pullback before you can be opportunistic, or you think this is it?
Well, in the fixed income market, credit, kind of came in sort of priced to perfection.
Sure.
So our view had been an underweight to sort of credit just generally, and we thought there was more value in securitized products, agency MBS, for instance, sort of similar spreads, but also the implicit guarantee of the U.S. government. So I think that we do believe that there's probably some more room to fall in terms of sort of the credit space.
Yeah, just
but again,
for the yields on the 10-year, let's say, we're only at the highest level since February 9th.
Yeah.
This is not a massive dislocation of anything that you've seen here.
No, you're starting to see the curve move a little bit more. Yeah. So again, we look at sort of the shape of the yield curve relative to where the 10-year is trading, and we think there's sort of opportunity in terms of that. But there's probably, again, in some of the sort of panic buying, we think there's a good opportunity for those who do have kept their powder dry. I mean, we went into this again pretty underweight to credit, and maybe there is more room to go at this point. but some good opportunities as well.
All right. Libby, thank you.
Coming up, entertainment ticket giant Live Nation reportedly reaching a deal with the DOJ to settle its antitrust case. We're going to bring you the details about that in just a moment. And then U.S. Attorney for the Southern District of New York, Jay Clayton. He's going to be with us this morning in just a little bit. Don't go anywhere. Squawk Box returns on what is turning out to be a volatile Monday morning.
Affected or
Hello and welcome to special broadcast on West Asia tensions. I'm Ashmit Kumar. Now, the West Asia war has entered the second week and Gulf nations find themselves engulfed in a conflict they did not start but have to cope now, somehow, from Bahrain's state-owned company declaring a force majeure after an attack on its oil refinery, to Kuwait, UAE and Iraq announcing output cuts. The global oil economy finds itself in the crossfire. And while crude prices briefly touched the $120 mark a barrel, analysts have warned that the sky is the limit. So what are the triggers? Well, number one, the war has deepened uncertainty around the Strait of Hormuz, where transit has come to a grinding halt. One of the world's most pivotal choke points, which account for 1/3 of global oil trade. Number two, the Iran-Israel offensive has led to oil refineries being struck across the region, further exacerbating oil's vulnerability. Take, for example, Iraq, the country which holds the world's third largest proven conventional oil reserves, has seen a 60% drop in its oil output. Overall, estimates are that several million barrels per day of supply are now disrupted, pushing crude prices higher and raising fears of a broader energy shock if the conflict escalates further. Analysts anticipate crude prices could even cross $150 per barrel mark if the war continues beyond 4 weeks. But crude is not the only pain point. Dry bulk movement has witnessed a grinding halt as well. From pellet supply to steel imports, flows have declined while grain markets remain broadly stable. Fertilizer trade is increasingly vulnerable as well. And we're joining us now to take this discussion ahead to help us understand what the dynamics of these recent moves are, especially when it comes to oil pricing. He's with us, Kepler's head of Middle East and OPEC, Amina Bakr. Ms. Bakr, thank you so much for joining us, being a part of this conversation. Let me help draw a few parallels back when there was a conflict between Ukraine and Russia. Back then, oil prices had nearly touched $140 per barrel. The oil at play back then wasn't nearly half as much as what we're talking about right now. So given that that's the benchmark that we set back in the Ukraine-Russia conflict, 140, is that the direction that we're heading in? Are we looking at $150 and beyond when it comes to Brent pricing right now?
As you correctly said, the gravity of the situation that we're seeing right now is a lot worse than the previous crisis with Ukraine and Russia. The Strait of Hormuz, as you pointed out, remains heavily disrupted. We're still not seeing traffic go through there, and that's stopping 20 million barrels of flows from passing and supplying the world. In addition to that, we are also noticing that the continued strikes against energy infrastructure in the region is causing a risk to supply. We've seen Bahrain declare force majeure, also the same in Qatar in Ras Laffan with their LNG facility. We also heard from Kuwait about them curtailing their production. And we also understand that Iraq has deeply cut its production, which is estimated to be around 1.7 million barrels a day. So this huge disruption in supply could only mean if this conflict is prolonged, we are going to see prices moving up.
Let me follow that up with, in fact, one aspect that you were alluding to, the force majeure conditions that were cited just last week. We had the Qatar energy minister warn that if this conflict grows, if it escalates further, the producers in the Middle East will have no option but to, in fact, declare force majeure conditions and stop production altogether. We're beginning to see first signs of that. Will this exacerbate the conditions even further when it comes to pricing of oil?
Yeah, he rightfully pointed out, I mean, the risk that was obvious that when you have storage that is completely full and a complete disruption of export outlets being Hormuz, then where do you put the oil? You have to start cutting production. And this is what we're seeing. I mean, the only two countries with outlets that could bypass the Strait of Hormuz are the UAE through Fujairah with a capacity of maybe 1.8 million barrels a day. And then you have Saudi Arabia with its east-west pipeline, and that pipeline has a capacity of 7 million barrels a day, and they export from the west. But other than that, you are facing a dire loss of supply here that I think is shocking many people. And last week, I don't think the market realized how serious the situation was. And that's why we weren't seeing a jump in oil prices. This week, it's a different story. I think finally the penny dropped and traders are the market's beginning to realize that maybe we are dealing with a serious supply shortage and a conflict that we don't know a clear timeline to.
Even as we're speaking, there are talks underway within the G7 nations to release a certain percentage of the stock as far as the reserves are concerned. We're talking about 300 to 400 million barrels. Is that something that will help calm the markets, or is that only going to be a token measure at this point?
I would say it's a token measure. It would quench a little bit of the anxiety that's out there, but it's a very short-term relief. In fact, I don't even believe, I mean, there is no spare capacity globally to make up for this huge outage in supply. So any measure that's taken now is going to be very temporary.
Speaking of measures, also, let me bring in some of the comments that were made by U.S. Treasury Secretary Scott Bessent. He said that they are open. The U.S. is open to unsanctioning sanctioned oil, referencing Russia, of course. Again, is that something that may quell the markets, the concerns in the market right now?
If we just look at the numbers, I don't think, again, Russia could make up for a loss of the massive supply that we're seeing from the Middle East and the flows that go through Hormuz. So, yes, it might satisfy some demand, especially, I mean, if we're talking about India replacing some of those Middle Eastern barrels. But just more long term, I think there needs to be a resolution to the conflict and a reopening of Hormuz for us to see things normalize.
Let's talk about India. There were reports last week of 3 tankers, very large crude carriers, docking at Indian ports. Are you getting reports that there are more such tankers due for Indian shores in the space of this week? And also, secondly, and perhaps equally importantly, is India now paying a premium of even Brent prices for the Russian crude at this stage?
Yeah, I mean, part of the idea is that I think the wider picture, Trump wants to remove some of the sanctioned barrels off of the market. Sanctioned barrels or discounted barrels have been benefiting some governments across Asia, talking maybe namely China, India, and so on. So removing some of these discounted barrels or the sanctioned barrels is going to cause India and China to pay a premium for crude oil prices. So that's a new kind of adjustment that needs to happen at the market.
Just for the benefit of our viewers, what is the kind of premium that we're talking about here for this Russian crude?
Well, discounts kind of ranged between $8 to $10, maybe a little bit narrower for Iranian crude. So paying, I mean, and again, with the surge, huge surge of prices that we're seeing now, I mean, today prices touching 120, that again is a huge pressure on not just India, but the global economy.
Just want to bring in a couple more questions. That's, of course, as far as Russia is one of the trusted sources as far as India for crude is concerned. Gas supply is, again, a critical choke point for countries like India. What does the matrix now look like for countries like India, where countries like Qatar were used to be the traditional suppliers of gas, which is no longer the case? How is India looking to fill that gap, plug that gap?
Yeah, that's a really good question. I mean, we haven't really seen any kind of official announcements come from the Indian government in terms of where they plan to source the alternative supplies. And it also impacts Europe, by the way. A lot of the Qatari LNG goes into Europe, and there were questions over whether or not they might again source from Russia. So these are kind of questions. I think everybody is waiting and hopeful that maybe there is going to be an easing of the conflict, but for now there are no real plans on where these supplies or clear outlines on where these supplies are going to come from.
Ms. Backer, that brings me to my final question. You mentioned that no realistic alternatives available when it comes to gas, limited alternatives available when it comes to oil. Going further, if the current conditions are likely to continue, does that automatically then translate into austerity measures that perhaps countries like India will have to engage in going further?
Yeah, for sure. I mean, we've seen a number of countries in Asia ban the exports of their products. I mean, we are at a risk as well of demand being destroyed here by the current prices, and everybody will have to kind of really cut back and look at what is necessary. So I think as long as the conflict prolongs, as long as there is no clear indication on when this would end, and as long as there are no kind of clear objectives or what they are from the US, that's when countries really need to react and put measures in place to limit the impact.
Given the dire conditions that we're looking at, Ms. Backer, do you anticipate that this could perhaps serve as an off-ramp for administrations like the US, like Israel, to perhaps back off from this engagement, to look at an off-ramp, to look at how to diffuse the situation? Is that something, a possible scenario that the markets are factoring in?
Well, I really hope so. On a personal level, I hope there is some kind of diplomatic off-ramp. But at the same time, I mean, just quoting Trump's recent tweet about this, and he said he's seeing short-term pain for long-term gain. So his idea is that oil prices are going to remain elevated, maybe in the short term, but as long as he manages to say that there's a resolution or a ceasefire or find a solution, declare victory, that's when oil prices are going to become lower and things are going to return to normality. So just based on that comment that he made, I think this is the strategy that he's following for now.
Right, Ms. Backer, we'd like to thank you for taking our time, for sharing your perspective, and we hope that you continue to be safe where you are. Ms. Backer, thank you once again. for joining us as a part of this conversation. With that, it's time now for slipping into a very short break, but we continue on the other side. We continue this discussion on West Asia war with Observer Research Foundation's Harsh Pant joining us on the other side. Stay tuned.
When the market moves, we don't just report, we decode. From the boardroom to the trading floor, we track what's driving business and impacting investor sentiment.
With insight that empowers and guidance that builds wealth.
Nuvama presents CNBC TV 18 Market Central,
for your daily source of market intelligence and wealth creation, with a commitment to doing it right.
This is Network 18, and you're watching CNBC TV 18.
Not all the oil shock of the prices have been passed in the past to the consumers. So to that extent, it gives a comfort to the economy, it gives a comfort to the consumers, and over a period, then it is recovered over a period of time. So as of today, the more worry should be related to supplies rather than the pricing. But of course, it has got impact on the current account deficit, the foreign exchange, etc. If the Strait of Hormuz is not affected or the oil infrastructure is not attacked, maybe it will maintain it around 85, and that is what it was holding for quite some time. But as soon as there was a threat to Strait of Hormuz, it was blocked. The insurance companies have withdrawn the cover, and there were news of attack on the oil infrastructure. It started escalating substantially. To project a worst-case scenario, but I assume that the world cannot absorb that type of shock. So there will be a point where something has to come up.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown.
How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits, and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC TV 18 and CNBCTV18.com.
If the Strait of Hormuz is not affected or the oil infrastructure is not attacked, maybe it will maintain it around 85, and that is what it was holding for quite some time. But as soon as there was a threat to Strait of Hormuz, it was blocked. The insurance companies have withdrawn the cover, and there were news of attack on the oil infrastructure. It started escalating substantially. To project a worst-case scenario, but I assume that the world cannot absorb that type of shock. So there will be a point where something has to come up. If the Strait of Hormuz is not affected or the oil infrastructure is not attacked, maybe it will maintain it around 85, and that is what it was holding for quite some time. But as soon as there was a threat to Strait of Hormuz, it was
Welcome back. Now, fresh strikes and explosions reported across the region as the war in West Asia enters day 10. Apart from missiles raining down on Iran's oil storage facilities, Israel was seen striking the desalination plants in Iran as well. Iranian foreign minister alleged that the U.S. has set a dangerous precedent with this attack, which will lead to grave consequences. Amidst the turmoil, the Iranian regime has selected the second son of the slain Ayatollah Ali Khamenei as the new supreme leader. The 56-year-old Mojtaba Khamenei is a hardline cleric who has never held or been elected to office, but he's believed to have wielded his influence behind the scenes through his ties with the Revolutionary Guards and the Supreme Leader's office. Top political and military leaders have pledged loyalty to the new supreme leader. The island nation of Bahrain, which sits between the borders of Qatar and Saudi Arabia, saw an Iranian strike hit its biggest oil refinery, Bapco Energies. The company announced a force majeure on its group operations due to the Iranian drone attack. Missile sirens continue to ring across Israel. A cluster bomb shrapnel resulted in injuries to civilians in central Israel from an alleged Iranian missile that was intercepted. Israel has stepped up attacks in Lebanon with the first drone strike within the city limits of Beirut. Lebanon claims that nearly 400 people have been killed over the last 1 week as Israel targeted hotels in the capital. The U.S. Embassy in Saudi Arabia shared an urgent security alert overnight, urging American citizens to leave the country. President Trump said that Iran would be completely decimated if U.S. sends ground troops. But when asked if the U.S. will deploy boots on the ground, President Trump refused to answer.
What are the circumstances where you said it ground troops? How are you thinking about that? I don't even want to talk about it now. I mean, that's, I don't think it's an appropriate question. You know, I'm not going to answer it. Could there be? Possibly, for very good reason. Have to be very good reason. And I would say if we ever did that, they would be so decimated that they wouldn't be able to fight at the ground level.
Well, to take this discussion ahead, I have with me now Professor Harsh Pant, Vice President of the Strategic Studies Program for the Observer Research Foundation. Mr. Pant, thank you so much for joining us again. Quick comment on the Trump statement there, refusing to either confirm or deny whether or not he's ready for deploying boots on the ground in Iran. What is your reading of this statement coming in from POTUS?
I think this is, this is emblematic of the challenge that Mr. Trump faces at the moment, because troops on the ground would be a big no-no for his base. His base, of course, he had risen in the American political establishment by talking against wars, never-ending wars, as he called them. And today, if he sends in boots on the ground, then he would be going against the very central theme that has propelled him to the center stage of American politics, as well as has resonated with his MAGA base. So I think it's very unlikely that he would go down that route very easily. Of course, this is something that he has to continue to tell the Iranians that everything is on the table, and America is looking at it insofar as his initial statement was about regime change. America intends to carry it forward. So that's a message that he has to send. But I think on the ground in America, it would be very, his support base would not easily acquiesce to this idea.
Let me bring into this the dynamic of the message coming in from the Gulf countries, beginning with the Qatari energy minister last week when he talked about force majeure conditions. They'll be left with no option but to stop production altogether. And we were just in the previous segment discussing the impact that will have, the dire consequences for the world economy, for the oil markets. Is that a cue to Donald Trump? And more importantly, will he take that cue?
See, he's a practical man. In some ways, he has often looked at the world and looked at America and American resources and constraints, and he has taken decisions going against just what he was saying the previous day. So it's not very unlikely that he may change his mind. But I think largely because so much is now riding on this war, insofar as his legacy is concerned, insofar as his reputation is concerned, I think it would be very difficult for him to make a U-turn. Clearly, Iranians are relying on this very fact that as the economic conditions worsen, there will be pressure on the U.S. president to do something about it. The Arab states, of course, are retaliating, and they are saying that they have. No one should be surprised if they retaliate against Iran. So I think it's a situation that is very fluid on the ground, but it would be very unlikely that Mr. Trump would cave in at this point, given the high expectations that he has unleashed, and given how central this war has become to his own political future now.
Well, speaking of the future, we now have Mujtaba Khamenei taking over the reins in Tehran. Political satirists are basically now questioning that it's been 10 days of havoc that's been wreaked as far as the Middle East, the West Asia is concerned. We've seen disruptions across the globe. And at the end of it, we have a Khamenei back in charge in Tehran. What message does that send to Donald Trump? And what message does he take that back stateside US when he faces the local population, the local opinion makers?
I think the message from the Iranians is very clear that they are coalescing around a key figure. It is, when nations are attacked, it's often there's a rally around the flag effect. Now, in this case, of course, it's the regime cohesion that is more important. So IRGC knows this. IRGC has, of course, Mujtaba Khamenei comes from that legacy. So it's not surprising that we are seeing a coalescing around him from the hardliners. There have been some indications initially that there are some divisions within the Iranian regime, but now it looks that everyone has decided to come together, at least in terms of showing in terms of showing to the world, and particularly to Washington, that despite what Mr. Trump would have liked initially, a quick regime change, it is unlikely to happen. Iranians are digging in for a long fight. At least that's what they want to show. Whether they have the capabilities or not, that's another matter. And that's, in some sense, would decide the battlefield outcomes. But I think for Mr. Trump, the message is very clear that Iran and the Iranian regime is not going anywhere. So it would also be very difficult for him to go to his base and say, look, this is what I have achieved. At the end of it, if there is no real achievement, then what was this war for would be a question that his base would ask. And that I think that would be the worry that he would carry with this with the opinion makers if he
that in fact, Mr. Pant was the very aspect I was trying to allude to, that as far as the optics of this entire process is concerned, Mujtaba Khamenei coming back to power in Tehran. When this entire conversation, when it began, it was about a regime change. That was the pitch that was made by United States. So when Khamenei comes back to power in Tehran after 10 days of havoc, does that then embarrass Donald Trump even more and then compel him to take an even more hardline approach going forward?
I think it does embarrass him. I think it does not look good from optics perspective. And we all know that he cares about optics more than substance. He certainly cannot go to his base and say, I went to this war where now American soldiers have also had to die just because the father had to go and son came back and took his legacy forward. So I think he would be under pressure to show results. But what does result mean when you end up in a war without a clear political endgame, without taking into account regional and global realities? This is what you encounter. War is in some ways too serious a business to be taken. In some ways, the way the decision-making went, the way this war has been conducted by Washington and by Trump himself, suggests a certain callousness about ground realities, and this is what is coming back to bite him. So again, I think the challenge for him would be, how do you balance this out? He can tomorrow decide that, look, I had met some basic goals, which is decimating Iran's offensive capabilities, missile capabilities, stockpiles, etc., and that he can take back and say, look, this is my victory. Now we will see what the new Khamenei decides to do, and then we will take action. But I think it would be embarrassing for him to go back to his base with what we see in Iran right now.
Right, Mr. Pant, we'd like to thank you for joining us and sharing that insight for the benefit of our viewers. Again, no clear direction visible as far as the way forward is concerned with respect to this conflict in West Asia. But that's all that we have time for. It's a wrap on this special broadcast. Thank you so much for watching. News and updates will continue right here on CNBC TV 18.
take What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest-running show on startups and entrepreneurship.
Young Turks at 22. Only on CNBC TV 18 and CNBCTV18.com. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits, and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC TV 18 and CNBCTV18.com.
Not all the oil shock of the prices have been passed in the past to the consumers. So to that extent, it gives a comfort to the economy, it gives a comfort to the consumers, and over a period, then it is recovered over a period of time. So as of today, the more worry should be related to supplies rather than the pricing. But of course, it has got impact on the current account deficit, the foreign exchange, etc. If the Strait of Hormuz is not affected or the oil infrastructure is not attacked, maybe it will maintain it around 85, and that is what it was holding for quite some time. But as soon as there was a threat to Strait of Hormuz, it was blocked. The insurance companies have withdrawn the cover, and there were.
How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits, and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC TV 18 and CNBCTV18.com. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about
Weight loss drugs are no longer just a health trend. They are one of the biggest disruptions in global pharma, and in India, we're at a critical inflection point.
India already has over 100 million people living with diabetes and over 250 million people with obesity, underscoring the rise of diabesity and its link to other diseases.
But globally, the GLP-1 market is estimated to exceed $100 billion annually this decade in India, and the shift is already visible. The weight loss GLP-1 market has more than doubled in a year, with drugs like Mounjaro, Wegovy and Ozempic driving that surge.
And now comes the big trigger. Semaglutide, or Wegovy, Ozempic, goes off patent in India later this month and across 80 emerging markets in this particular year itself. Indian pharmaceutical companies, they're lining up, whether for domestic launches, exports, manufacturing or distribution partnerships.
So what does this mean for investors? Will competition compress margins? Which companies are best positioned to gain scale? And how should markets price in all of these newer drugs?
That's exactly what we discuss over the next hour. We deep dive into the weight loss drug opportunity to assess whether India is ready for a structural shift in obesity and diabetes care, and what that means for stocks, investors and patients alike.
Welcome to this special show, Weight Loss Drugs, the Market Opportunity. Let's begin the show with an MNC perspective. We have with us Novo Nordisk's Vikrant Shrotriya. Mr. Shrotriya, thank you very much for joining in. If you could come, have a seat and take us through some key details about the company.
Thank you very much. Thanks a lot, Ekta and Mangalam. And fantastic to see that a healthcare subject comes into the market perspective that used to be completely rare, in India. Now we are talking about diabetes, obesity, not only for health, but also for the business. So that's a big change.
Yes, absolutely. And one of the key things that Mr. Shrotriya, I want to start with is that we're going to see that competition come in for semaglutide. Just in the next 2 weeks odd, we're going to see maybe even 50 companies launch generic versions of the drug that you all currently have patents on. Tell us how you're preparing for that competition.
Yeah, we welcome actually, and it's a party, but it's a serious party.
Right.
It's a serious party, why I say, because it's about a disease. It requires something which we call it's not about the patents, which is getting expired, but it actually talks about the purpose. And the purpose is not very short-lived. It has to be very, very long. The commitment, the passion, the kind of work which one has to do, that is very, very important. And I personally feel that expiry of a patent is like one injunction, which happens in the life cycle of a drug. For any drug, it will happen. But what is more important is who enters. And any company which enter with a serious intent, I think that is very, very critical. Alone, we can never do this job. I think, Mangalam, you talked about 250 million people with obesity, 100 million people with diabetes. Alone, a single company, 2 companies or 3 companies cannot do it. But of course, it is not also a thing where 50 or 100 companies can participate. We require serious players, and I personally believe that over a period of time, serious players will survive and they will do the justice to the market. And more important is to the patients. And that's a very important and critical point.
Do we have any historic parallel where, this drug is such an unprecedented drug? Do we have any historic parallel where a drug that took the world by storm like this and then went off patent, what was the impact of that on the market, the industry, and obviously overall patient health as well?
Yeah, we have seen that, drugs like sildenafil citrate, in terms of, Viagra, which was there, it went off patent. And then, of course, many of the players who came into the market. But remember, here we are talking about protein chemistry. We are talking about peptides. We are talking about injectables. We are talking about septic conditions. We are talking about precision device and an rDNA technology. We are talking about a serious manufacturing process. We are talking about serious supply chain. And we have at least seen in insulin market, which is also largely quite big, that despite being many of the players who are there, and they still serve a purpose, we still have got half the share. Every second patient actually is on Novo Nordisk insulin, whether it is in India or across the globe. And that's because our commitment is not today and tomorrow. It's not about an opportunity. It's about a serious concern for those patients. And patient is at the center of heart in terms of Novo Nordisk philosophy. And here also, we are talking about a long chain protein. It's called peptides. And in this, again, many of the serious players will survive and they will also do the justice in terms of the market.
So you're not expecting those 50 players to continue selling. You're expecting maybe some consolidation to take place in terms of market share, where maybe the top tier companies or certain companies hold the share because it's a complicated peptide drug that you're selling?
You always see that. You have recently seen a gold rush. Right. And by the time somebody buys and it comes down, right, it's also a rush of semaglutide, which is rushing in, right, with the patents going out, or, So you will find many of the players who see it as an opportunity, they will soon realize that while entering can be easy, to survive can be very difficult.
So that brings us the obvious question, right? What would it take for a company to survive in this market? And at the same time, what differentiates the winners in this versus the ones who will not make it?
I think players who have got a serious commitment, who have got a purpose to continue, players who have got an intention that when they enter, they will go in a long, long journey to be there with the patient, who work along with science, who work along with innovation, who don't only work along only on commercialization and market cap. This should be a byproduct. I think when it comes to the money, it should be a byproduct. But the first is a purpose and a commitment to go long, which is driven by deep science, is very, very important. Somebody who work and share education along in the journey and lead it, I think they will survive.
Okay. Well, Novo Nordisk has taken a steep price cut of almost around 37% in the month of November. Has that shored up sales at all for you all post the price cut? And do you think you'll need to cut prices further, because there's an expectation that prices could be as low as 50 to 60% once other companies launch?
Yeah, and there I would say, first my job was to bring the innovation here in the country, and then we are very concerned. In fact, I'm an Indian myself, right? Yeah. So I wanted that it should be actually adjusted to the Indian prices, and that's where 37% cut, you ask somebody to cut 37% of their salary, that's a kind of a cut which we actually took. Yeah. And I think that was required for access and access for care. That's very important. It's not only access for care. And with that kind of a cut, we have seen that accessibility of the medication across in India has increased. Many more people could able to afford it. And not only that, we also did the partnership with Emcure Pharma in terms of getting the wide reach across the country, because that's also, again, very important. We have to also see that it is available across India. So we partnered with Emcure. We have also partnered recently with Abbott India also in terms of making sure that it is available for the cause of diabetes, which is, again, 100 million population, which is there.
But just on that partnership that you have with Emcure, how is that partnership doing? Because the feedback is that, people don't recognize the Emcure brand as Novo Nordisk's manufacturing. They recognize it as a separate brand, and they'd rather still buy your brand. So is that, sort of cannibalizing?
Many of the Indian companies who are there 20 years back, they were not even there. But now they are the large companies. So as I said, this is the start. This is sowing the seed. You have to see these kind of start of the journey after 5 years and 10 years, and then see what kind of an impact they will make. I have been there in this journey with insulin, where we used to have only hundreds and thousands of patients only on insulin. Today, there are 6 million people who are actually taking insulin. So this journey is for a long haul. It's for chronic, and it is a chronic journey. It's a chronic disease. It doesn't require an acute mindset. It requires a chronic mindset to operate. And that has to be there in the mind.
There was this Delhi High Court judgment where they reserved the judgment, just took place today. And that means that Dr. Reddy's is allowed to manufacture, export semaglutide to countries without patent protection. Your thoughts on that? It is already a case which is, which has gone against you all.
See, there I cannot comment, because I can only say that, we will have to go through this judgment. And I think we have a very, qualified legal team in terms of taking forward these kind of sub judice matters. And we will have to learn this verdict, which has possibly come by the time I am actually sitting here.
All right, you take that point. You spoke about scratching the surface of the market right now, but the important part is we are also just scratching the surface of this conversation. So there's not just one, but the start of many that we have. In fact, we've heard from Novo Nordisk, the manufacturer of Ozempic and Wegovy. But as we head into this short break on the show, let's also listen in to what Eli Lilly's India head had to tell us when we spoke to him just a few weeks ago.
Semaglutide is going generic. There's not a generic for tirzepatide. And tirzepatide has a very different profile. We are a dual agonist, GIP and GLP. We know that that has proven as a mechanism to show superiority over semaglutide alone, both in weight reduction in SURMOUNT-5, but also in glucose control and weight reduction in SURPASS-2 as well. And so from that perspective, we feel like the value of tirzepatide differentiates it in the marketplace. We price our product based on the value that it brings.
not all the oil shock of the prices have been passed in the past to the consumers. So to that extent, it gives a comfort to the economy, it gives a comfort to the consumers, and over a period, then it is recovered over a period of time. So as of today, the more worry should be related to supplies rather than the pricing. But of course, it has got impact on the current account deficit, the foreign exchange, etc. If the Strait of Hormuz is not affected or the oil infrastructure is not attacked, maybe it will maintain it around 85, and that is what it was holding for quite some time. But as soon as there was a threat to Strait of Hormuz, it was blocked. The insurance companies have withdrawn the cover, and there were news of attack on the oil infrastructure. It started escalating substantially. To project a worst-case scenario, but I assume that the world cannot absorb that type of shock. So there will be a point where something has to come up.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest-running show on startups and entrepreneurship.
Young Turks at 22. Only on CNBC TV 18 and CNBCTV18.com. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian?
If the Strait of Hormuz is not affected or the oil infrastructure is not attacked, maybe it will maintain it around 85, and that is what it was holding for quite some time. But as soon as there was a threat to Strait of Hormuz, it was blocked. The insurance companies have withdrawn the cover, and there were news of attack on the oil infrastructure. It started escalating substantially. To project a worst-case scenario, but I assume that the world cannot absorb that type of shock. So there will be a point where something has to come up. If the Strait of Hormuz is not affected or the oil infrastructure is not attacked, maybe it will maintain it around 85, and that is what it was holding for quite some time. But as soon as there was a threat to Strait of Hormuz, it was blocked. The insurance companies have withdrawn the cover, and there were news of attack on the oil infrastructure. It started escalating substantially. To project a worst.
Welcome back to this special weight loss drugs town hall. Let's now get in a more granular perspective from various Indian companies and how they benefit from weight loss drugs.
We do have Neeraj Sharma, who's the MD and CEO, OneSource, Amit Bakshi, who's the CMD, Eris Life Sciences, and Amit Sanghvi, who is the MD, Shelly Engineering Plastics, joining us on this special coverage as well. Thanks a lot, gentlemen, for joining in. You know, a lot has been spoken about the opportunity. A lot has been spoken about what happens and all these things. The question is, how prepared is the ecosystem for it? Because on the one hand, yes, there is this opportunity, but on the other, you know, there are other things that are required along with all of this as well. So where are we in our preparedness for this, and how far are we to go from here on?
Yeah, thank you, Mangalam. Yes, we heard, you know, it's a really great opportunity. More than anything else, it's the opportunity to get the Indian patients treat obesity for the very first time. So in terms of preparedness, I can talk about you know, ourselves as OneSource CDMO. So from a point of view of having capacities in place, from the point of view of having all the required regulatory approvals in place, we are set. We have scaled capacities. We continue to scale capacities. We are set. We were awaiting approvals. Now, especially Indian companies have the approvals. So I would say now it's race to the line when patent actually expires and our customers will actually enter the market.
Yeah. So Mr. Sharma, I just wanted to bring that point up. You're prepared, but we saw what happened in the Q3 numbers. Everyone was anticipating that approval to come through for the Canadian market, but that didn't come through, and that impacted you all.
Absolutely.
You've said the next 2 quarters will possibly be soft because of this. How soft? And is it in line, better, worse than what you were anticipating?
So what I would say here is, we have said, what is in our hand is our preparedness. We have made sure we have got the required capacity in place. We have made sure that whether it is regulatory approval from any of the regulatory agencies where the patent is expiring, yes, we have that in place. Do we have all the purchase orders in place from our customers? Yes, we do. So we are all prepared. Now, obviously, we can only supply once the regulators approve, because that's the way the industry works, right?
So let me put it the other way. Dr. Reddy's has said that they are hopeful they'll get approval by May for the Canadian markets. Are you working with that timeline?
Absolutely.
Are you supplying them inventory right now, building up their inventory, building up companies' inventories across emerging markets?
I would say that, as soon as the approval comes, we are absolutely ready to supply our customers. We are doing whatever it takes, including some of the things which you mentioned, to ensure that when the approval comes, our customers, and there are many of them who will be in the market with the product.
You'd have some sense of how big this can be once it goes off patent, not from an analyst perspective, but because you obviously have purchase orders in hand, you've built capacities, and you've done your you've literally put your money where the mouth is, right? So to take science point forward on that itself, once it goes off patent, how big do you think that spurt in demand could be, according to you?
Significant. I heard Vikrant earlier say that, any analyst who has said anything about this has been wrong.
Which is why we go with the person who's put their money behind.
So the point here is that, and you're absolutely, we have really put our money there. Our idea of expanding capacity multifold is keeping in mind, obviously, visibility, which we have from our customers, which is very clear, which has been growing, and India is a small part of it, but many large markets which are opening up. But more importantly, also as a CDMO, we also take a leap of faith, because we can't build capacity once the demand comes. We build capacity in anticipation of demand. So it's a mix of the visibility which we have from our customers in terms of forecasts and purchase orders, but also some of it is basis what we have seen over the last few years, how the demand, and as the access increases and more patients come on it, because right now the demand actually has been constrained more by supplies than actual demands. And we see that changing and market expanding.
Okay. Well, Mr. Bakshi, you've partnered with NATCO. You have a huge market share in terms of the diabetes market in the Indian space. Tell us, how many companies are we expecting on the 21st of March when semaglutide goes generic? Is it actually going to be 50 companies? And if so, what is the price correction that you're going to see in the market? Are we going to get it as cheap as, say, paracetamol or ibuprofen in the market right now?
Yes, before coming to this, I just wanted to touch on the numbers point.
Right.
So guys, look, I will take from where, my friend left. Obesity in India is very different from what obesity we've seen from US. The numbers which US is throwing up are of a very different population, right? All of us know we are thin, fat Indians. Yeah. Look at the room around. Do you find anybody who wants to lose 20%, 30% body weight? So all that conversation which is happening about 20%, 30% body weight is largely not for our country. If we compare with the same BMIs, then our obesity is 4%. Our population is 4%. We have a problem of 2 to 5 kg extra visceral fat.
Yes.
Correct.
That's the reality. So what I see, responding to you, how many patients can come in. Look, guys, what happened to US in the late 90s? There was a huge turnaround in cardiovascular death. After the Second World War, they kept on going down, and 30% of all deaths were happening because of cardiovascular reason, cerebrovascular and cardiovascular. And then came statin.
Yeah.
And post-statin, early 2000, that was the first time everybody celebrated globally, because they have been able to push back the whole thing, reverse it actually, in only 10 years' time. What LDL meant to a Caucasian, population, not taking away the lipids, very important part. That is what that visceral fat means to us.
Yeah.
Got it.
Right?
Yeah.
So when we see the guidelines, say we put the ADA guidelines as a funnel and pass our population through them, 70% of all people with diabetes will greatly benefit out of semaglutide. Greatly benefit out of semaglutide. Right? Guys, before talking about reducing obesity, this is the only drug which can be taken, for example, semaglutide 0.25 milligram to 3 milligram, 12-time escalation in a dose without getting hypoglycemia.
Wow.
Yes.
So the new target of HbA1c for this country might not be 7. And 70% of people not controlled might not be true. So that is where the crux of the thing is. I'm happy to see the advertisement. They all look very good. But our problem is that visceral fat.
Yeah.
And I think that will turn the population if you simulate it on an AI, right? That if a large population gets into GLP, now whether they get in on pens, on some other fancy devices, or some vials, that's not my problem.
Yeah.
But if a large population can get through, we are going to see a huge change in the next 10 years.
Okay, that's interesting to know, because that'll be a completely different market. But if you could just go back and answer my first question, how many companies are we going to see launch semaglutide, and whatever it might be? What is the price correction that we might see in the market? And hence, your point about accessibility, which might increase exponentially once there is price reduction in the market.
Okay, so give us 1 year. This has been the first time, so the regulatory has taken a lot of work. Give us 1 year. As an Indian company, we should have a shot, a weekly shot available at $400-500.
Wow. $400-500.
Wow.
Now, whether it comes through a syringe, or it comes through a pen, or it comes through some different source.
Is that what you're saying?
I don't know. I don't know. But look, these are all, imagine 70% of diabetic needing it. So give us a year's time. We will make it accessible for 500 rupees a shot.
Wow.
That's what I think is going to happen.
Mr. Sanghvi, you're supplying the pen injectors.
Exactly. I was just coming for that. It's vials, pens.
Tell us, what are you supplying it at? You're increasing capacity. You have some capex coming up in Abu Dhabi as well. So just tell us about the demand.
How many people are asking you for those pens right now?
Well, everyone that we worked with, obviously. But I want to take a step back, right? He caught me off guard by saying he's going to reduce prices to $400 a shot a week, which is going to be very detrimental to our business.
But I also said 70% of the patients.
But having said that, in terms of readiness, most of us have been working at this since 2018-19. So it's been a good 7-8 years that we've been working at, Vikrant talked about precision devices. That's what we do. These guys do the manufacturing of the final product, APIs, and the full formulation, right? So I think companies are well prepared, right? There will be hiccups when you do any launch, but it should be shortly overcome, right? Now, in terms of capacities, we've seen numbers which there's a fairly significantly wide range. Of course, I'm going to talk about it at a global level. India might be a 2 million patient, 2 million pen market.
Okay.
Right? So when we look at it globally, we currently have a 30 million capacity. We just added 25, and we're adding another 25 by July. So we'll have about 80 million capacity in India. And then we're expanding in Abu Dhabi, where we're adding another 75 million by end of FY28.
All right, gentlemen, thank you very much for joining in and taking us through all of your thoughts with regards to the weight loss drug opportunity.
does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest-running show on startups and entrepreneurship.
Young Turks at 22. Only on CNBC TV 18 and CNBCTV18.com. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits, and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC TV 18 and CNBCTV18.com.
Not all the oil shock of the prices have been passed in the past to the consumers. So to that extent, it gives a comfort to the economy, it gives a comfort to the consumers, and over a period, then it is recovered over a period of time. So as of today, the more worry should be related to supplies rather than the pricing. But of course, it has got impact on the current account deficit, the foreign exchange, etc. If the Strait of Hormuz is not affected or the oil infrastructure is not attacked, maybe it will maintain it around 85, and that is what it was holding for quite some time. But as soon as there was a threat to Strait of Hormuz, it was blocked. The insurance companies have withdrawn the cover, and there were.
How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits, and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC TV 18 and CNBCTV18.com. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits, and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC TV 18 and CNBCTV18.com.
Not all the oil shock of the prices have been passed in the past to the consumers. So to that extent, it gives a comfort to the economy, it gives a comfort to the consumers, and over a period, then it is recovered over a period of time. So as of today, the more worry should be related to supplies rather than the pricing. But of course, it has got impact on the current account deficit, the foreign exchange, etc. If the Strait of Hormuz is not affected or the oil infrastructure is not attacked, maybe it will maintain it around 85, and that is what it was holding for quite some time. But as soon as there was a threat to Strait of Hormuz, it was blocked. The insurance companies have withdrawn the cover, and there were news of attack on the oil infrastructure. It started escalating substantially. To project a worst-case scenario, but I assume that the world cannot absorb that type of shock. So there will be a point where something has to come up.
How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits, and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC TV 18 and CNBCTV18.com. How about listening to global market maestros before crafting your investment strategy? How about...
As you can see, we have come back a little. We were down much more than that, and then down about 500, and now I think less than 500 points. Meanwhile, a story we told you about earlier, Novo Nordisk announcing it's reached an agreement with him and hers that will take effect later this month. Novo will sell its weight loss drug on the Hims platform as part of the agreement. Hims and hers will no longer advertise compounded GLP-1 offerings on its platform. You may remember Novo Nordisk scrapped a partnership last year after Hims refused to stop marketing and selling copycat drugs. Novo filed a lawsuit against Hims in February over a copycat version of its new Wegovy weight loss pill. As part of the deal, it will drop that lawsuit.
Take a look at futures, folks, because we do have some red on the screen this morning. The Dow looks like it would open down close to 500 points. NASDAQ off about 250 points. And the S&P 500 looking to open off about 61 points right now. Joining us is Mohammed Al-Arian at the table, the Rowan Curran, a professor of practice at the University of Pennsylvania's Wharton School of Business, also chief economic advisor at Allianz. Good morning to you. We're all trying to make sense of what's going on in Iran, the price of oil, what it ultimately means to the economy, what it ultimately means to the price of stocks. What do you think?
So start with what the market thinks. The market thinks that this will be a temporary and reversible shock because, after all, we threw everything at the U.S. economy last year and the economy proved incredibly resilient. So this will be the play once again.
Okay.
However, this time around, this is coming on top of a few things that are adding up. An uncertain labor market, affordability concerns, you have three distinct sources of financial fragility, and you have inflation that was already heading up, which limits policy flexibility. So I see the sort of central scenario that's an 80% probability in markets, about 50%. The bigger
Say
question,
that again, you see an 80% scenario in markets at 50%.
no,
What does that mean?
that's the baseline right now in markets of a temporary and reversible
You think it's at
shock
80%?
is at 80%.
But you're saying you think it's actually at 50%.
Correct. And there's a bigger question that we see, which is we got to understand that this global economy is subject to more violent and more frequent shocks. And there's a really good reason for that. We've lost the unifying themes. So we just have to be ready for a lot of volatility this year.
And so when you think about this 80%, you think the market's at 80% in terms of this being resolved in 2 or 3 weeks from now in a good place?
Correct.
And your 50% basis is based upon what?
It's based simply that while the market nets things out, the economy compounds them. So if you put one shock after another, you lose financial resilience, you lose human resilience, and your ability to bounce back is less. And we have thrown a lot at this economy in the last 12 months. And right now, between the labor market, between the inflation dynamics, and between what's happening in the financial markets, there's reasons to be less.
Do you think there's any chance that things get worse, meaningfully worse in the Middle East? Meaning, China looks at this and says, oh my goodness, we can't have this anymore. And somehow they tried to intervene or get involved in some way that we haven't even thought about yet.
So you had Jared on earlier today, and I was listening carefully to him because I have a lot of respect for how he thinks about these issues. I think the point he made about asymmetrical wars have an unpredictable element to them that you have to take seriously. And that is why the left tail is so big here. Because there is this element of unpredictability.
Okay, but let me throw in a different a domestic political issue, which is this president has been very cognizant, to his credit, of what's going on in our economy here. And so there's part of me that wonders whether he could look at what's happening and say, you know what, I wanted to do this for 2 or 3 weeks or 4 weeks. There's still stuff I want to do on the ground. But you know what, I can't have it this way. And politically, it's going to be bad for me. It's going to be bad for Republicans. We're going into the midterms. I can't have oil prices at these numbers. And then he steps away. What do you think the chances are that that happens?
That's certainly possible, but he also needs to convince two other parties to step away, Israel and Iran, and they have different agendas at this point. So that's point number one. Second, he's already aware of this because he said over the weekend, the higher oil price is a price that's worth paying. However, it compounds the affordability issues. So he's going to keep an eye on that. The one thing I would stress is we've got to stop thinking that oil supplies and supply chains are like an on-off switch. You can't turn it back on. If the UAE, Kuwait, and Qatar stop production, it will take weeks to resume production.
Although, part of the reason they're stopping production is they're filled to the brim. They have nowhere else to store this.
They've reduced production. They haven't stopped it yet.
Right, but it would be, look, if you can get the ships moving again, you can start kind of quickly unloading some of that stuff that's been building up in the meantime.
If you can get the ships moving again, if you can get new ships coming in, that
Your point is, what's the time frame for when this is like, oh boy, this is...
It is weeks and months. It's not days. I mean, there's this assumption in the market, it is days.
Yeah.
And we seem to have forgotten the lesson of COVID, is when you impose a sudden stop on supply chains, things are in the wrong place when you want to start them again.
The end for COVID, when we had these problems, was that economies cratered. Do you expect that to be the case this time around? Are you expecting an economic downturn to the point of recession based on what we've seen happen?
No, I'm expecting that GDP growth will be about 0.5% lower than would have been otherwise.
Okay.
I'm expecting inflation will be 1% higher. And I'm expecting those central banks in Europe that have a single mandate are going to be hiking rates. And that's what the market also expects right now.
What do you think the U.S. Federal Reserve is going to do as a result?
I think they will just stay unchanged and wait and see. No one wants to repeat the mistake of the 2021 transitory inflation call. No one wants to repeat that mistake.
A percentage point higher in inflation?
Than it would have been otherwise, yes.
That's over 3. That's like...
Yeah, 3 to 3.5%.
3.5%. For how long? Transitory?
I don't like that word because that word encourages all sorts of bad behaviors. I think that if you look at the average for the year, we will be about 3% for the year.
So you were thinking we might be at 2%. Then.
I thought we'd be between 2.5 and 3 before.
Well, that would be 3 to 3.5 if
Correct.
It's 1% higher then. Right?
Yes, that's
is way off the Fed's target. They shouldn't be cutting it all then. Or would they say, well, it's because of the war?
So first of all, we've entered the 6th year in which we are above the inflation target.
Right.
They will have 2 reasons to cut if they cut, and hopefully it won't happen. The labor market and financial instability. Those are the 2 things to keep an eye on. You have 3 distinct sources of financial instability. Neither is big enough to be systemic, but if they come together, they can be systemic.
What do you make of the whole Russia side of this situation and whether that can spiral into something that we should worry about?
I mean, if you really want to worry, and
I don't want to worry. I just want to know. I know you worry for a living.
If you really want to, you bring Russia and China into this. Okay, and their incentives right now are very different from our incentives, but they haven't so far.
Right.
Okay, China in particular has been incredibly quiet.
Well, this is good for Russia in its own way because they can charge more for their oil.
It's good. Yeah, I mean, obviously it's good for Russia. It's also good that a lot of the weapons are being depleted.
Right.
And not being depleted in Ukraine, but being depleted in the Middle East. But China is the interesting one because it lost Venezuela as a source of cheap oil. It's now losing Iran as a source of cheap oil. Already it has revised down its growth to the lowest since 1991. So China is hurting. Asia is hurting in this a lot because of energy issues.
Can I throw one last thing into the mix?
Of course.
We were talking to Simon Johnson earlier this morning about private credit and some of these semi-liquid instruments that the gates are going up on them. How much should we be concerned about that? Is that a canary in the coal mine, or is that just a blip along the way?
So that's one of the 3 areas I worry about. Small, isolated issues are becoming more of a liquidity issue because investors are getting spooked and pulling money out. We have valuation issues. We have underwriting issues. I want to stress it's not in all private credit in advanced countries, but it's in some private credit. But add to that the bond market. Look at what's happened to UK yields. Look at what's happened to Japanese yields. Remember, in the last few years, the bond vigilantes took on 3 of the G7 countries, Japan, the UK, and France. And then, of course, there's the issue of AI and the rational bubble of AI. So if these things come together, then financial instability becomes a concern.
Okay. Mohammed, it's great to see you. Thank you for coming in.
Thank you.
Are you looking forward to wars?
I am. I think you're going to see reforms to the Fed that are really needed. And I think you're going to see someone who understands that we need a theory of balance sheet management. We can't simply move the balance sheet from below 1 trillion to 9 trillion back to 6 trillion without having an understanding of what the neutral level of a balance sheet is. So yeah, I'm looking forward to him coming to the Fed.
Excellent.
Thank you.
Thank you.
Up next, former senior advisor to President Biden, Amos Hochstein, will join us to talk energy prices and Iran. Squawk Box will be right back.
CNBC TV 18 tracks the pulse of markets and business in real time, bringing you the stories that shape the economy.
From breaking news to sharp analysis, we deliver insights that help you navigate businesses, markets, and investment opportunities.
Nuvama presents CNBC TV 18 Market Central,
providing sharp market intelligence for wealth creation with a commitment to doing it right.
This is Network 18, and you're watching CNBC TV 18.
Not all the oil shock of the prices have been passed in the past to the consumers. So to that extent, it gives a comfort to the economy, it gives a comfort to the consumers, and over a period, then it is recovered over a period of time. So as of today, the more worry should be related to supplies rather than the pricing. But of course, it has got impact on the current account deficit, the foreign exchange, etc. If the Strait of Hormuz is not affected or the oil infrastructure is not attacked, maybe it will maintain it around 85, and that is what it was holding for quite some time. But as soon as there was a threat to Strait of Hormuz, it was blocked. The insurance companies have withdrawn the cover, and there were news of attack on the oil infrastructure. It started escalating substantially. To project a worst-case scenario, but I assume that the world cannot absorb that type of shock. So there will be a point where something has to come up.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of...
How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits, and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC TV 18 and CNBCTV18.com.
Caught a lot of people off guard. What do you think about where oil prices are and more importantly, where they may head from here?
Good morning, Becky. Look, I actually think no surprises have happened. Everything that we're seeing in the market was, I think, broadcast since last Monday. So the war started on Saturday with a shock and awe taking out the supreme leader and a lot of military leaders, with a lot of headlines that the command and control of Iran would be gone by Tuesday, Wednesday. That obviously didn't happen. When you shut down the Strait of Hormuz, whether by closure de facto or de jure, right, the baseline is that ships are not crossing except for very, very few. And you have a disruption somewhere in the 10 million barrel of oil plus jet fuel and diesel and other refined products, then oil prices are priced today, I think still even maybe a little bit complacently. This is the biggest shortage and energy crisis we've had in global history. So I think these prices now start compounding. In other words, we'll close at around, let's say today we'll be somewhere at around $100. But I think with the conditions on the ground, without a change, this gets worse and worse because of that compounding effect of loss of both transport of crude, the production of crude starts slowing, and the refined products.
Amos, let me ask you, we have not done something like this in decades and decades. We have allowed Iran to get more and more belligerent, known that they were working on this enriched uranium, known that their potential for a nuclear weapon was there. Is what you're watching right now the reason that we've never taken more action, that we've been worried about what it would do to global oil prices, what it would do to Asia, Europe, our allies around the world that rely on this oil even more than we do?
No, I think it's more complicated than that. I think for a long time it was about containment. Remember that if the nuclear issue is the most important, then there was a deal done during the Obama years to try to neutralize that threat. The problem with it was that it had sunsets and it was supposed to expire at some point. President Trump in his first term got out of that deal, and eventually the Iranians started enriching again. But in June, the strikes that the United States took, which as you recall, I was on your show and supported them, the president said we obliterated the nuclear program. That was 6 months ago. The Israelis said that we neutralized it. They used a little bit softer. In the run-up of this crisis, it was not about the nuclear weapons. Remember, it first started out based on the protests, right? Help is on the way. And the Israelis said that it was all about the missiles, the ballistic missiles, not the nuclear. They still believe today that the nuclear issue was not of vital concern because of the June strikes. But there's no doubt that when you consider war, you have to consider all the implications, and one of them is the energy markets. But I think nuclear threat was always something that we were going to address. But this war is not about nuclear. We are attacking a far greater part of Iran than just the nuclear sites or where the enriched uranium is. This is about much more about attacking the regime itself and taking away its capabilities to restore itself.
Let's start with where we are now. What's already taken place over the last week and a half, or 10 days? What do you see as being the way out of this? The way what objectives can and should be met? What is the off-ramp, if there is one? How do you see this playing out?
Look, I think right now, over the next few days, you're going to see intensifying strikes against Iran by both Israel and the United States. Although at the beginning of the war, the first several days, the U.S. was the lead as far as the number of strikes. Today, that has flipped, and Israel is doing far greater percentage of the strikes in the United States. Where do I think it goes? Look, Iran has been disrupted. Their missile manufacturing is disrupted. Their economy is degraded. Their nuclear weapons are further degraded from obliterated from 6 months ago. I think there's an ability to declare victory here, and for the president in a few days to say, look, I achieved all these things. They don't have an air force anymore. They don't have a navy. We've disrupted them. And because we have air superiority, we'll stay in the region, and if they go back to bad behavior, I'll attack them again and end that war. I know that Mohammed Al-Arian and your previous guest had said that you still have two other parties. The Israelis will do whatever Donald Trump says. If he says we're stopping the war, they will stop the war. And I think the Iranians will as well. So that is a scenario. However, the White House for that has to not want to see regime change, because the Iranians were able to select a new supreme leader. Just the fact that they were able to select one and announce one and go through the process means that the regime is still very much intact. So I think at some point, if you're talking about 3 to 4 more weeks, the cumulative economic damage is going to be globally, not just the United States, but mostly in Asia and Europe. Right. I think that we have to start looking at what that off-ramp, and I think this is a credible off-ramp. It's not a taco, quote unquote, that people are saying, because it actually is a victory for the president if he can make that declaration.
Yeah, the TACO acronym might be might be tough at this time. Listening to you, Amos, and I know you've got a lot of different concerns and reasons to either support or not support it. When I listen to people go over the four possible reasons why Trump would have done this, sometimes I think you just add them all together for one overriding reason. Could this end up, in your view, having been worth it, Amos?
Look, yes, I think there's a scenario where you do. There's no doubt in my mind Iran is a horrific regime with so much blood on its hands of Americans and others, but also by creating a network of proxies and terror groups in the region and around the world. So if you're able to degrade them and take away their missile capacity, take away their ability to support Hezbollah and the Houthis and the Shia militia groups in Iraq and so on, I think there's a lot of good that could have been done here. But if the longer it goes, the more mission creep, the more you start thinking, I need to get just a few more things. If I just use some ground troops, to me, that's where the danger signs, Joe, are. Yeah. And I think if you start paying this, I think the market is still very complacent about what it means to take 9 million barrels or 10 million barrels off the market on a day-by-day situation where it keeps, compounding. The cut to production is only going to increase where you shut these things in. The LNG plant in Qatar could take 2 months to break back. The oil fields that you shut in, the longer they're shut in, the longer it takes to bring them back, the longer it takes empty tankers to come and collect what's in storage, et cetera, et cetera. So I think at some point time starts running against you, not for you. But degrading Iran, that's not something I think is a bad thing for American national security.
As for rationales, people talk about a couple of levels of chess. I mean, you add Venezuela and this together with China. If they want to go after Taiwan anytime soon, they better have some. They have an SPR. I mean, what are they going to use? Their ability
First of all,
to.
Yeah, they do have an SPR, Joe. They have a very, very large one.
They're going to need it, right?
Look, my view has always been that China's not looking for a kinetic war with the United States to take Taiwan by force. I think they're trying to take Taiwan without firing a shot. I think they are taking over the business class. They are taking over interests inside Taiwan so that they can have a gradual takeover of the Taiwanese economy and eventually take over Taiwan with a lot less than is required. We only think about it in terms of war. I think they're thinking about it in other ways as well. But I'm not sure that I think China sees this war as an indication of strength vis-a-vis Asia. I think that what we're doing in Iran today is a lot harder to do in Asia, so far away from our bases and so far away from any other allies that may join or not. So I'm not sure that I would draw that analysis. I think we should first focus on completing this mission and the depletion of munitions that is also happening both to the United States and to Israel.
Wow. Amos, what pressure do you think President Trump is most susceptible to? Pressure from the idea of China getting upset and doing something, ideas of our allies getting upset and doing something, or just American voters getting frustrated with higher prices at the pump, higher prices that work their way into other inflationary measures?
Look, I've worked in multiple administrations. I don't think that President Trump is concerned about China or concerned about other allies around the world. I think what he's really concerned about is what's happening here in the United States, like all presidents. Look how much time he dedicated to gasoline prices and oil in the State of the Union. Today, we're barreling towards $3.50 on gasoline. We're probably going to go to $4 in the coming week. Diesel is even higher, and remember, our food prices have enormous amount of connectivity to diesel prices.
Does that mean that you think he potentially steps away from this more quickly as a result? We've seen scenarios where he's pushed it to a certain place and then decides, I'm going to pull it back because I think it's going too far.
Yes, I do think, Andrew, and I think that if you look at a number of examples over the last year, Greenland being one of them, when markets start to really react, I think there's a reassessment. I also think that while he's saying total surrender, he has his staff explaining that total surrender It doesn't mean total and doesn't mean surrender. It means when they're weak, too weak to respond anymore. Well, I think the scenario that I built for you earlier, where he can declare that he has degraded their military, their nuclear, their missile, and their economy, and maintain air superiority, I think he can say, look, I've achieved my goals. And I think these kind of market conditions, if they last for several days and get worse, I think that he's going to have to reconsider. And I think you can see in the rhetoric that he's already doing that.
We can survive at 350 a gallon. That's what we averaged during your Biden administration, almost, right? That's a pretty good price.
350. It doesn't stop at 350. We were at 280 a week ago, Joe. We're now at 350.
It was nice that it came down. It was nice that it came down. But we have been at 350 before. I just looked up the average for Biden for the 4
we
years.
sure have, because Joe, we went to $5 a gallon during that height. We had to take it down to 350.
I remember.
Thank you for being with us today. We appreciate it.
Of course.
Right now it's time for Squawk on the Street.
Really?
Coming up.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest-running show on startups and entrepreneurship.
Young Turks at 22. Only on CNBC TV 18 and CNBCTV18.com. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits, and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC TV 18 and CNBCTV18.com.
Not all the oil shock of the prices have been passed in the past to the consumers. So to that extent, it gives a comfort to the economy, it gives a comfort to the consumers, and over a period, then it is recovered over a period of time. So as of today, the more worry should be related to supplies rather than the pricing. But of course, it has got impact on the current account deficit, the foreign exchange, etc. If the Strait of Hormuz is not affected or the oil infrastructure is not attacked, maybe that it will maintain it around 85, and that is what it was holding for quite some time. But as soon as there was a threat to Strait of Hormuz, it was blocked. The insurance companies have withdrawn the cover, and there were.
How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits, and chart wizards? Only one show gives you a head start to your...
And welcome to Startup Street. I'm Ritu Singh, and here are the top headlines from the startup space. Walmart-owned e-commerce major Flipkart completes the process of shifting its holding company domicile from Singapore back to India. Flipkart says it has received Government of India approval for this internal restructuring. The CEO of Cars24's Himanshu Ratnu resigns from his post. His exit comes as the Gurugram-based firm, recently profitable, prepares for an IPO and targets 1,000 crores in EBITDA within 2 years. Fintech platform Crude raises $10 million in debt funding from a group of investors, including Northern Arc Capital, to support the growth of its lending arm. The fresh debt capital will be used to expand Crude Credit's lending operations and launch new loan products in the Indian market. SaaS firm CarTech raises $11 million in a Series B funding round led by Playbook Partners to strengthen its AI capabilities and increase deployment of its enterprise software solutions. CarTech is looking to expand its customer base across North America and Europe, as well as hiring senior talent. And Bengaluru-based B2B manufacturing startup Carkhana acquires electronics manufacturing services firm Micron EMS Tech Private Limited. The acquisition adds a 40,000-plus square feet manufacturing facility in Bengaluru, equipped with high-speed surface mount technology lines. So those are the headlines that we're tracking for you today. But in what's brewing, Crude Healthcare has raised $15 million in its pre-Series B round with participation from Al Nahyan and Al Ketbi families, along with existing investor Pulsar Capital. The UAE-based company is betting on a virtual-first healthcare model, combining telemedicine, home diagnostics, and hospital-at-home care across the GCC. This fresh capital is going to be used to scale its platform as demand for decentralized healthcare continues to grow in the region. And joining me now to discuss this further is Vish Narayan, the Executive Chairman at Crude. Vish, thank you very much for your time here on CNBC TV 18. Firstly, we hope you and your loved ones have been safe amid what's been happening in the region. You know, the GCC is currently dealing with a lot of geopolitical tensions, missile attacks and whatnot that we've been hearing in parts of the region. To begin with, does that really change the role of virtual-first healthcare in ensuring continuity of care when, physical mobility or hospital access is getting disrupted?
Thank you, Ritu, and thank you for having me on the show. I think it's a very topical question because our goal at Crude is to ensure that we provide the highest level of care, online first, at home second, and at provider last. And in keeping with that philosophy, especially now with the geopolitical uncertainty, with people cautious about going out to clinics, going to hospitals, we are able to provide 24/7 service, 24/7 care in the comfort of their own homes and in places where they don't have to step out. So I think, of course, it's from a short-term perspective, similar to what happened in COVID. At-home care and virtual care is the way forward. But particularly in this time of uncertainty, it's a very valuable service.
But, Vish, would you be able to share what's going on currently, how that has affected logistics, medical supplies, workforce mobility in any way?
So look, I think initially for the first week, there was a bit of uncertainty. Of course, a lot of flights were canceled. But the UAE government has really stayed on top of the situation. Our doctors, our healthcare professionals are back in the office serving patients. So I think things are returning back to normal. And we hope that, frankly, over the next week or 10 days, the situation resolves itself for the better.
Well, we hope it resolves much sooner than that. Fingers crossed. But, Vish, really to get back to your funding round, it includes participation from the Al Nahyan and Al Ketbi families. Should we read their backing as something beyond capital, strategic partners, perhaps, in scaling the healthcare infrastructure in the region?
Yes, absolutely. So the families that have backed us are some of the best-known families in the region. And not only do they provide capital, but they have deep relationships across the healthcare landscape, whether it's clinics, whether it's hospital, whether it's government relationships at the Ministry of Health, etc. So our funding partners are truly, as I said, partners and not just capital providers.
In that case, Vish, now that you've got this $15 million check, how exactly are you going to deploy this for growth?
So we are today present across 2 countries in the Middle East. We are the leaders and the largest company for digital health in the GCC. So today we are present in the UAE and Saudi. So we will be, of course, deepening our presence in these 2 countries, but also use this capital to expand to Oman, Qatar, Kuwait, and Bahrain, the rest of the GCC countries. But we want to deepen our presence across the services that we offer, which are telehealth, e-pharmacy, labs, home health, and what we call hospital at home, which is treating patients 24/7, discharging from the hospital, but then treating them almost at the same level of competence that you have in the hospital, but the same connected devices and the same level of care for patients at home.
Yeah. So, could you give us a sense, just to get a sense of your business, what the growth metrics look like today, patient volumes, enterprise clients, insurance partnerships, and how fast the platform really has scaled in the last 2 years?
Yeah, absolutely. So today we manage more than 2.5 million members across UAE and Saudi, about 2 million in the UAE and about 500,000 in Saudi. We've been growing almost 100% year on year since we acquired the company back in 2022. We are, doing more than 40,000 consultations just in the UAE per month, and then 5,000 to 10,000 in Saudi Arabia.
Yeah, I also wanted to understand, given that you're looking at the region and this is a interesting business, how big the opportunity is, would you say, for virtual first healthcare companies? And, what share of care do you actually believe can realistically move out of hospitals over the next decade or so, whether that is in the GCC region that you're focusing on, generally globally?
So that's a great question, Ritu. So we believe that today, through our hospital at home initiative, we are able to address anywhere between 20 to 30% of patients in the comfort of their home. So patients for acute care, for chronic care, we are treating pediatric cases, we are treating oncology cases. So increasingly, we are managing more and more complex cases. So today, we are able to address 20 to 30% of the patients from the hospital. But we are also about to start a new vertical, which is medical value care, which is essentially done outside of the region. So these are this case management, which is done offshore. So we are able to take patients which don't have to do urgent surgeries, but let's say a knee replacement, which can be done over the next, say, 4 to 6 weeks. We treat them in their home countries. So we have relationships with hospitals across India, Thailand, Egypt, Turkey, and patients are able to go back to their home countries and be treated there. And this would also expand another 20 to 30% of patients that could be taken out of the hospital.
All right, Wish we leave it at that. Thanks very much for your time here today, and we wish you and other people in the region stay safe. Thanks very much.
Thank you, Ritu.
All right, moving on. The Walmart-owned e-commerce giant Flipkart has completed the process of shifting its holding company domicile from Singapore back to India. It says it has received the government approval for this restructuring, making it the first internet private company, the new holding entity of the Flipkart group. Rashna Dhanrajani joins us with more details on the move.
Flipkart has completed a key structural step ahead of a potential public listing, shifting its domicile from Singapore back to India in what the startup ecosystem calls a reverse flip. Now, CNBC TV 18 was the first to report in December 2024 that Flipkart's board had approved the reverse flip, with sources confirming that the company had begun the process of moving its domicile back to India. More than a year later, that restructuring has now been completed. In a statement to CNBC TV 18, the company confirmed that the government has cleared Flipkart's internal restructuring, allowing Flipkart Internet Private Limited to become the holding entity for the entire group. That approval was the final regulatory hurdle, because sources tell CNBC TV 18 that NCLT had already signed off on the scheme, but a residual 10-cent stake meant the transaction triggered scrutiny under Press Note 3, rules governing investments from neighboring jurisdictions. But with that clearance now in place, Flipkart's re-domiciliation to India is legally complete. Now, the move places Flipkart alongside a growing list of Indian startups, bringing their headquarters back home ahead of listing plans, which we've seen last year and which we will be seeing going into 2026. But for Flipkart, the restructuring clears a key prerequisite before bankers can formally file the DRHP. Sources indicate that the company could now move to file its DRHP within weeks. Last valued at around $36 billion, Flipkart is positioning itself for what could become one of the largest IPOs in India's market history, with 2026 widely seen as a likely listing window. Operationally, the numbers show both growth and pressure for Flipkart. In 2025, the company reported a 17.3% rise in consolidated operating revenue to about 82,000 crore rupees. However, consolidated net losses also widened to roughly 5,000 crore rupees as the company stepped up spending across logistics, technology, and the quick commerce race. Now, Flipkart is also undergoing internal restructuring, with reports suggesting between 250 to 500 jobs that could get cut as the company streamlines operations ahead of the IPO. The focus now shifts to valuation, particularly as Flipkart continues to invest heavily in its quick commerce offering, Flipkart Minutes, and whether majority shareholder Walmart uses the IPO window to partially monetize its stake. We will keep an eye out for all these details.
Rachna, thanks very much for taking us through that. Now, India's women co-founded tech startups have raised $1 billion in funding in 2025, according to the annual funding report by Traction, which is titled Women Co-Founders in India Tech. Now, that's a 12% decline from $1.1 billion in 2024, reflecting the broader slowdown in venture capital activity. Deal activity even fell more sharply. The number of funding rounds dropped 29% from 574 deals in 2024 to 405 in 2025. However, the report says a structural shift towards larger check sizes, with a median deal size increasing from about $436,000 to nearly $594,000. Now, looking at the funding stages, seed stage investments declined to $261 million across 311 rounds as investors became more selective at the earlier stages. Now, in contrast, the early stage funding that actually increased to $533 million, even though deal volumes declined. Late-stage investments saw the steepest drop, falling to $213 million across just 15 rounds. On the exit front, India saw 2 IPOs by women co-founded startups in 2025, compared with 3 in the previous year. But acquisition activity did surge, with 33 acquisitions in 2025, up from just 12 in 2024. The largest deal was Resultic's $2 billion acquisition, followed by Ecom Express at $165 million and PeopleStrong at $130 million. Now, city-wise, Bengaluru remained the top funding hub, raising $384 million, about 38% of the total funding, followed by Mumbai with $112 million. Overall, the report highlights a more selective investment climate, fewer deals, but larger investments flowing into the stronger startups. And on that note, we're going to slip into a short break. And up next, Skyways Air Services is pressing ahead with its IPO plans. We'll get you more on that when we return.
Not all the oil shock of the prices have been passed in the past to the consumers. So to that extent, it gives a comfort to the economy, it gives a comfort to the consumers, and over a period, then it is recovered over a period of time. So as of today, the more worry should be related to supplies rather than the pricing. But of course, it has got impact on the current account deficit, the foreign exchange, etc. If the Strait of Hormuz is not affected or the oil infrastructure is not attacked, maybe it will maintain it around 85, and that is what it was holding for quite some time. But as soon as there was a threat to Strait of Hormuz, it was blocked. The insurance companies have withdrawn the cover, and there were news of attack on the oil infrastructure. It started escalating substantially. To project a worst-case scenario, but I assume that the world cannot absorb that type of shock. So there will be a point where something has to come up.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest-running show on startups and entrepreneurship.
Young Turks at 22. Only on CNBC TV 18 and CNBCTV18.com. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian?
If the Strait of Hormuz is not affected or the oil infrastructure is not attacked, maybe it will maintain it around 85, and that is what it was holding for quite some time. But as soon as there was a threat to Strait of Hormuz, it was blocked. The insurance companies have withdrawn the cover, and there were news of attack on the oil infrastructure. It started escalating substantially. To project a worst-case scenario, but I assume that the world cannot absorb that type of shock. So there will be a point where something has to come up. If the Strait of Hormuz is not affected or the oil infrastructure is not attacked, maybe it will maintain it around 85, and that is what it was holding for quite some time. But as soon as there was a threat to Strait of Hormuz, it was blocked. The insurance companies have withdrawn the cover, and there were news of attack on the oil infrastructure. It started escalating substantially. To project a worst-case scenario, but I assume that the world cannot absorb that.
Well, for the last few years, the government has consistently set aside money to develop horticulture. Some of these funds were to be used to support agri-tech platforms, which were working with farmers to get them ready for the global value chain. CNBC TV 18's Shraddha Tiwari reports that more and more agri-tech firms are now engaging with farmers on both technical and technological expertise, but there are still challenges to plow through. Take a look.
Coffee, sugarcane, cotton, tea. For decades, cash crops have been the dominant crops in India's agricultural sector. But fruits are now emerging as a viable export opportunity, especially for farmers looking beyond traditional commodities. But making the switch is not easy, nor is getting the quality or scale to compete effectively in the global market. That's where agri-tech platforms come in. And they have started by targeting the Indian consumer first, getting domestically grown fruits into Indian homes.
Not so surprisingly, but most of our palette in urban cities consists of imported fruits. India currently is importing over $2 billion of fresh fruits annually. At the same time, our production ecosystem is not really benefiting from the changing in consumer palettes. And that big divide is, we are here to kind of bridge the entire big divide for the same.
But this is not an overnight game. India's agri-tech story has long been recognized as being about apps, marketplaces, and quick commerce, and the odd weather tracking or soil and fertilization identification interface. But the next leap in this space will not come from 10-minute deliveries. It will come from 10-year commitments inside farms. Startups like Farm to Fam are betting that India can grow its own premium produce, reduce its import dependence, and create a new skill-based rural India, one that turns its farm workers and local clusters into high-level production hubs. Farm to Fam leases land from farmers on a multi-year basis. It oversees cultivation and inputs, providing more predictable income and building trust in regions vulnerable to climate and market volatility. Its approach has borne fruit, and it now plans to take this model to more farming clusters. As of 2025, it employed 150 women farm workers who make up nearly 90% of its workforce.
मैं इधर 2 साल से काम करती हूँ. इधर 2 फल रहता है, रास्पबेरी और ब्लूबेरी.
फर्स्ट टाइम तो मैं सब ऐसा वेडिंग का, ट्रेलिसिंग का, प्रोनिंग का, हार्वेस्टिंग का ये सब काम कर रही थी. अभी ये सब होने के बाद मैं अभी सब प्रॉपरली अभी प्रोडक्शन का, क्वालिटी का सब मैं देखती हूँ. पहले से तो 5-6 लोग काम कर रहे थे, अभी तो 100 लोग के आगे सब चल रहा है.
The journey has not been easy.
Definitely did raise a lot of eyebrows because there was never a model of what we were trying to do. Cut to today, we already not only have a land bank of 50 acres under us, but we also being constantly approached by farmers not only to give their land on lease, but to start working with us so that the next generation starts getting skilled in agriculture, which happens to be a big problem today, where you see the next generation of farmers are probably into a bank, they want to work at banks or BPOs, but none of them want to do agriculture. So they want to work with us purely now for skill development that they can have and obviously equal opportunities for growth.
The long-term bet is also being tested by climate stress. Maharashtra has seen repeated spells of unseasonal rains and rising temperatures which have damaged crops. Poor infrastructure and rising costs don't help either. Farm to Farm says it is adapting fruit varieties to India's changing climate through technical expertise, testing and global collaboration. But fragile supply chains and post-harvest losses remain a major challenge. If such initiatives succeed, India could move from being a buyer in the global fruit market to being a serious producer, pushing prices, supply chains and livelihoods. It's early, it's ambitious and it's tough, but it's exactly the kind of shift India's agricultural system needs. In Pune, Shraddha Tiwari.
All right, we'll move on. And Skyways Air Services is pressing ahead with its IPO plans despite the recent volatility in markets. Speaking to CNBC TV 18, the chairman and MD Yashpal Sharma said trade volumes have not seen any major decline so far, even as the conflict in West Asia briefly disrupted airspace and cargo routes. Listen in.
Skyways over the last 2 decades have constantly worked on this, that we want to have a very diversified customer base, which should not be one commodity specific or one lane specific. Today we have more than 7,900 clients who work with us across our group, and they also service across different commodities and across geographies. 22% of our business today is pharmaceuticals, which is a large part of our business. And as you do understand that pharmaceutical industry has been largely immune to what happens around the world. India is a very, very big contributor to the world's pharmaceutical production. And this is one of the reasons why over the last 5-6 years, Skyways has been investing hugely in this commodity, whether it is for internal domestic consumption or for international movement. Pharmaceutical goods will continue to rise. We're also investing a lot in the food and the vegetable industry, not just in the domestic segment again, but also in the international space. We will continue to invest in these 2 commodities in a very sizable way. The other couple of new age commodities like defense logistics, semiconductors, consumer electronics, some of these products also are looked at very, very aggressively by us. And each year we have been able to add customers in these products, keeping our size and rather growing our size even in other commodities, the traditional commodities of India like textiles, fashion, ready-made garments, home furnishing, pharma, handicrafts and more.
You have reported a EBITDA margin of nearly 4% for the first 9 months of FY25. So as you scale your business, do you see a chance of improving the margin going ahead?
So we've had a decent bit of operating EBITDA increase this year at about 4.3% in the H1 of FY26. And we feel that as we grow our scale, we have grown significantly this year on the back of some of these good advancements that we've done. We feel that over a period of next few years, we will definitely try our best to increase this margin consistently. But even if we are keeping the same margins in times ahead, I think we will be better than what the market does.
We have seen a decline in the equity market in the past few days, and also there's the sentiment in grey market is also weak. So what gives you the confidence, to go ahead with the IPO at this time?
Well, we want to remain with the market. Having said that, we feel that we have a great story. We have built this organization over 4 decades, and there is a huge amount of credibility which comes from our carrier partners, our customers who have been associated with us for a long period of time. We would like to continue building this piece. As of now, we are watching the space very closely as to what's happening in the Middle East and what impact it has on the stock markets. I'm sure our guiding merchant bankers will help us to probably time the IPO in the perfect way.
Also, given the ongoing geopolitical tensions, have you seen an impact on your trade volumes? Like, have they declined?
So not a big decline so far, but obviously there was a sudden disruption. We have seen most of the carriers have now started to find alternate routes. They started to reposition capacities. So things will come back. Obviously, when there is a sudden shock, it does create an impact. So there was a temporary impact that we saw, and some of the Middle East carriers definitely had a bigger impact because the movement completely stopped. But for us, since Skyways has a big portfolio of carrier partners, we have been able to pivot some of our customers, current customers, into other carriers to make sure that their businesses are not impacted in a very large way. We have been consistently investing time and energy and making sure we have created a small control tower, which is taking special care of new routes and new multimodal opportunities of how the customer's product can be moved. So we will make sure that the impact is least possible to our customers, and we really hope this comes to an end very quickly.
Okay, and on that note, we're going to wrap up this edition of Startup Straight, but stay with us. More news and updates will continue after this short break.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest-running show on startups and entrepreneurship.
Young Turks at 22. Only on CNBC TV 18 and CNBCTV18.com. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits, and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC TV 18 and CNBCTV18.com.
Not all the oil shock of the prices have been passed in the past to the consumers. So to that extent, it gives a comfort to the economy, it gives a comfort to the consumers, and over a period, then it is recovered over a period of time.
Redeem it. I think the ones I want to redeem are the ones that aren't doing well, because I think the real issues. There are good pieces of paper, some of these are bad pieces of paper.
Let's get the opening bell here in the CNBC Real-Time Exchange. And the big board, America 250, celebrating our country's upcoming 250th anniversary. At the NASDAQ, it's AvePoint, an AI data protection company, Jim. As we'll watch, as normal, breadth and levels. I gotta say, Tuesday and Thursday last week, opening low got bought, at least somewhat.
Look, I just think these are people who think that there's an off-ramp that we don't know about, that there is a back channel that we don't know about, and people who think that the straight isn't that important. of which we do know is. So it's great to see so much optimism, it's particularly because oil was so much higher last night. But I don't want to make it seem like that we forget that oil isn't totally in charge, because it is. We saw the futures down 2.5 when oil was spiking to 119. And I think that the idea that Europe might let loose some oil is not a reason to think that oil can't go much higher.
So you don't think 119 could have been a blow-off top?
No, I said this weekend in my memo to the CNBC Investing Club that 150 to 200 is within reason.
150 to 200?
Yeah, definitely. But yeah, because this would be the biggest reduction of oil that basically we've ever had. And versus the demand. And we have to respect that. We have to say that if we got another retaliation right now while we're talking that hits Saudi Arabia, then we would say, why did we buy? Because 150 to 200 presumes that the war is going to be wide. And it would be great if it isn't. It would be absolutely great if everybody said, war, what is it good for? Nothing. It's just that I don't see those people in charge. So I think that when the president says a little oil spike is nothing to worry about, is a little oil spike a spike to 150 and then it goes back down? Well, great. It's just that there's been no recorded instance of when it goes up that much, and we didn't have a 20% decline.
Right. Now, we have been in this range since November, the S&P.
Right.
I'm looking back at the November lows of 65-ish, 6,500. Do you think we break through that? Does that feel like support?
Yeah, I think we can break through it if the war is extended. Yes, and again, like I just think the odds. I'm not on a poly market thing, but the odds favor that it's not going to simmer down. It would be fabulous if we all knew, yes, but you see, the Saudis are talking. The United States has said to Israel, all right, guys, you went too far. And the next thing you know, you hear that there are rumors of peace. And then you got to say, wow, this was the opportunity of a lifetime. So I want to temper the idea that it could be down 20%. But I do think that you get that spike in oil like we've had before. It's just bad. I mean, you don't have spikes in oil over 100% and have the S&P do nothing. It goes down 20%, and that's what history says. Maybe this time, because our president is kind of
mercurial,
not really,
as you said.
Yeah, he's mercurial.
Yep.
If you get oil back down, then you're going to have what Josh Brown would say, a rip your face off rally.
Right. All sectors are red at the moment. Jim, financials are probably the worst.
Yeah.
Industrial, some consumer discretionary. We did get some specialty retail last week. And as far as earnings for the week go, we will get Oracle tomorrow.
Yeah, I mean, Oracle looks like you could say, hold on, wait a second, it's come down a lot. But I'm not a chartist, but if we could hold up the chart of Oracle, I think you'd see over a year, in 2 years even, it's the worst chart in the book. When I go through my charts, I get the chart book. Holy cow, is this one bad? I mean, it just, it's the head and shoulders of a lifetime.
Right.
And I think that this whole thing started when Oracle was at 110. That's when they started talking about it. You have to see them sell Cerner, which is their medical records business that they paid too much for. And I think that would be, they're reluctant to admit defeat. And you got to see them have another partner maybe in some of the stuff they're doing. I know that the story that was reported on Friday that one of the projects they're involved was kind of in trouble, that story was false.
There were additional headlines about headcount reduction.
Yeah, I got to hear more. I'm not going there yet. But you got GTC next week with Jensen. I think that if I were Ellison, I would say, look, we're fine. But you got to deal with what's happening with SoftBank. Right. You got to have access to capital. That's why I say, like to have a partner. Really like to have a partner.
Now, software was able to make some headway last week.
Look, I think that there are a lot of people. Gil Laurie this morning says that these stocks have come too far. Too far down.
Too far down.
Too far down. Well,
so last week's bounce notwithstanding.
Well, the one that's moving is the one that you've got to say maybe it doesn't belong there, which is Bill McDermott and ServiceNow. Because when you make a huge commitment to buy stock, you stop your sell program, you are buying back stock, you have a good AI program, it's very tough to say that ServiceNow is in trouble. They're not in trouble. They're doing well. What's in trouble, I think, are a lot of the private companies that we don't know about. And when you look at some of these geez, when you look at some of these private credit, like they bought the stuff that really I think is in the crosshairs. Ben Rice is with a good piece today about AI cutbacks to white collar. When I look at where the ones that are doing the worst, it's all these companies that these guys own. And by the way, there's a reason why this stuff's going down. It's not because it's panic. It's because maybe there should be a belief that I want to get out before something bad happens. That's why I want to distinguish BlackRock. I wanted to distinguish Blackstone because Blackstone put the workers put their own money in. I like that.
Yes.
And BlackRock because, geez, that seems like a good piece of paper. But I know that, you know, it's Katie bar the doors here and everything.
Yeah. 933 on BlackRock will take you. We took out the lows from November, and that'll bring you back to June or so, maybe May.
Wow.
But Jim, if financial conditions tighten because of oil, right?
Right.
And so there's a lot of jobs that have been financed through private credit, like a couple million, according to the Fed itself.
Yeah, and I mean, look, I saw when you look at the unemployment last week, one of the areas that was really bad was white collar information technology.
Right.
And I have to believe that those are the people you lay off. I mean, look, think about the market cap of Anthropic. Well, that's whatever they make, whatever they take from certain areas. They're not just, it's not going up. The revenues are not going up because everyone's looking in, going on Claude and looking things up. It's a business software company. That's why everybody likes it so much. And I just think that they're blowing up everybody because it's cheaper.
So when you think about possibilities, right, on the upside, we mentioned Dow and chemicals. Are there other spaces that seem like go-tos at the moment?
No. No.
It is tough. I mean, I'm looking at the leaders on the Dow: Procter, Amgen, J&J, Chevron.
Well, that would be, look, I own Procter, and Procter's the biggest cost. Yeah, they have a huge bunch of costs, but surfactant, plastic, those are things that are all going up in price. Amgen, I like the drug stocks. If you have something that is doing well, Amgen should be up, J&J should be up, but at a certain point they are S&P, they're part of the S&P.
Right.
But I think that if we have a March, if we have a mini bank crisis kind of market, then that's when the Magnificent Seven were formed. So, I mean, those are the ones, they have good balance sheets, so they're not as good as it was because they're borrowing a lot of money. They have historically done okay in this environment. The oil stocks do okay in this environment. I mean, I don't want to be facetious about it. I mean, commodities can do okay. I mean, every oil. I mean, look at Chevron 190. Chevron goes to 220. You can buy Chevron. So that's fine. Chevron does well. I want it to be temporary. And I certainly don't want people to say, listen, get out now. I don't think get out now because you can't get in now.
Yes. We'll watch Microsoft too, speaking of software, Jim, which I think was wrestling last week with its 200-week moving average, which it hasn't violated in, I think, over a decade.
I think it's time for Microsoft to unveil something that they have that I don't know about. It's time out there, guys.
Now's the time. Break some glass.
This is the time that if you're going to have that secret Copilot 2, I would unveil it right now.
Yes.
I think that Meta's doing a lot of stuff that we don't know about that is positive. This is a good chance, again, if you don't own any Alphabet, maybe a start here. Alphabet's doing so well. It's only down $2. See, I want things to be down more. Like
you want to flush, I think. Yeah,
I do. I want the crescendo sell. I mean, I look at J&J and how much, if that thing dropped at 230, that would be terrific. Medtronic offloaded Minimed the other day, and Medtronic's at 89. That's a good price, 15 times earnings. I like medical device. I really do. And medical device is down a lot, and they're obviously not economically sensitive. So, I mean, there's stuff to buy, but it's not down. I mean, do you want to go buy Merck? I mean, I think Merck's doing so much right. So let's buy Merck down 10%. No, it's down 94 cents. I don't want to tell someone to buy that. And every night we leave here, and every night oil goes up, and then you wait, at 3 in the morning, you wake up and the S&P's down 1.5%. I want to break that cycle. That's a cycle we've been under. And it makes it so that whatever you buy today looks foolish tomorrow.
Right.
So I just, don't want people to make a stand. I don't see a stand here. Something changed over the weekend. It got worse. So making a stand here this close, given the fact that the war escalated to a level that no one thought. I got to have a reason why these people are so bullish. Do they know something? I don't think they know something. I don't know anything.
There is at least one solid winner today, and that's Hims on this deal with Novo.
Oh, yeah, they got that, and that was, you know what's so funny is that Novo Nordisk, I mean, if you whatever you can think, and I happen to like the guy who runs it. He's a very nice guy. But, you know, when you, okay, everything they do is wrong. Okay? Stars continue. Why did he do this? So his stock's up 20 cents. Well, that was a good idea. Honestly, I mean, I met the guy. The guy is a great guy. He inherited a really bad situation. But name me something they've done right.
Right.
I don't know what they've done right. They got the pill out earlier. But he makes this huge deal to make it so that Hers and Hims is back. And his stock goes up 18 cents. The market is saying, do something. You know, they had this one. To take this to a loss is really incredible. I mean, it's one of those. You remember there was a game where against the Oilers where Frank Reich of Buffalo came back, greatest comeback ever, and you look at it and you say, well, the first thing he did when he came back to the second half was throw a pick. And then he said, all right, we got him where we want him. Man, maybe Novo has him where they want him. Maybe that's it. Maybe Novo has him where they want him. I'd be surprised.
Meantime, as we're talking, oil back below 100. For more on the war's effect on crude, let's get in touch with our Brian Sullivan today. Hey, Brian. We'll work on his audio.
Got to speak louder. Brian's got to speak louder.
Yes.
He's a loudspeaker, so that is a little.
Yeah, there's a lot to get
kidding.
to.
We got to hear from him because he had great comments in the previous Squawk Box. Look, if it doesn't stay here, or if something happens overnight that's bad, I think we go up a lot. If something doesn't happen overnight, I don't think we go down a lot.
Yeah. RBOB approaching 3 is important because that would get you to a $4 average in a few weeks.
Yeah.
Diesel, by the way, Jim, diesel in Texas is up $1 a gallon in a week.
I mean, people are saying the trucks are really going to be hurt. Yeah, I saw some truck upgrades. Well, they can pass it through. But let's talk about Disney as the stock. Disney's got cruise ships. Disney's got theme park. And they've got movies and Channel 7, TV, linear. They don't have the horses here.
Yeah.
They don't have the horses to withstand $4 oil. It's just the stock just doesn't. The stock is anticipating correctly.
Disney at 99 is the lowest since May. That's for sure. I'll try again with our Brian Sullivan. Talk some crude. Hey, Brian.
Hey, I think you guys can hear me now. No one's ever said they couldn't hear me, by the way, Carl, to your point. So there you go. Listen, I think Jim's point exactly is spot on. Look at crude oil. It's up 9.5%, but it's not at $125 a barrel. You got Exxon up 0.5%, Chevron up 0.25%. You guys were talking about it. The markets, yeah, they're down a bit, but they're not collapsing. This is a huge difference from what we had last night. Jim was talking about waking up at 3 o'clock in the morning and checking the SPYs. I woke up at 3 o'clock in the morning just in a cold sweat, wondering where oil was going to go. I think a lot of this, I'd love to hear your guys' take, is options positioning. A lot of people, myself included, kind of caught out, not in a trading way, don't take any positions, but thinking that this would be maybe over or less severe 1 week out than it turned out to be. The Wall Street Journal headline, Iran, by the way, appointing Khamenei's son, kind of taking that hard line tone, fight to the end tone. And I think that caught a lot of people on the oil positioning out short, literally, where they had to cover last night. That sent the biggest single day oil percentage gain in history. What we were up 35% at one time. We're still up 10% right now at exactly 100 a barrel. Not saying that's good, but relative to where we were last night, it's not bad. One thing I want to note, when you look at an Exxon, when you look at a Chevron, when you look at a Marathon, some of these other names, they're at or even above the average analyst price target, guys. You look at ExxonMobil, it's actually a couple of percent above where Wall Street, as a consensus, there you go, says it should be. A Halliburton is still a bit under, but I do wonder if these stocks aren't responding because the trading desk, Jim, are kind of like, well, Yeah, this is kind of where our analyst says the price should be and the stock is. So they might have to raise it up or not. We'll see if the analyst community makes a change. Just one thing. We've seen production cuts or shifts. Saudi Arabia, Bahrain, UAE, Kuwait. And I want to be very clear on these Saudi headlines. So a lot of Saudi headlines going around. I don't want to say they're wrong, but they're confusing. You'll hear the term Saudis cutting production. My sources will tell me they're shifting production to different fields. Number one, you had drone attacks, but number two, to a different pipeline. It's not a cut per se, as much of a shift. I know that's verbal semantics or verbal gymnastics, guys, but it does matter when you're counting the barrel.
First, Brian, you've been unbelievable in this, the best guy we have. Let me ask you, when you attack the desalination plants and when Israel attacked an oil facility, isn't that the kind of escalation that we really can't control right now?
Yeah, I think you're right, Jim. Listen, you made the point near the top of the show that you can't control the outcome. And I think that's where we are. I think, once you start a fight, you don't know how it's going to end. And I think there was, and I'm guilty of this, by the way, sort of an idea that Iran might take a little bit of a softer tone, that maybe disappointment of a new supreme leader by the Assembly of Experts might be somebody that wasn't pro-West. They don't have to say they like us, but would be less adversarial. With the installation of Khamenei's son, it looks like it's different. I'm not getting into Iranian politics, but my point, Jim, and I think to your point, is that the outcome here is uncertain. And when you've got Iranian drones and missiles and whatever it is hitting Bahraini refining plants and Qatari energy plants, things spiraled.
That's what I'm worried about. Exactly what I'm worried about.
Brian, thanks. We'll talk soon. Brian Sullivan watching Crude this morning for us. Let's watch bonds as well. We are going to get a lot of economic data. CPI Wednesday, PCE Friday. We'll get jolts in there as well. Michigan sentiment, revised GDP for Q4 is on our way later in the week. That 10-year holding 4.15 here. And, of course, the 2-year almost to 3.6. Don't go anywhere.
Good evening. Let's do it right with Nuvama presents The Wealth Brief, where today's market moves are decoded to guide your wealth journey. Indian market closes sharply lower on weak global cues, with benchmark indices falling over 1.5%. Sensex drops 1,353 points to 77,566, and Nifty declines 422 points to 24,028 after slipping below 23,700 intraday. Nifty Bank plunges 1,763 points to 50,020, while Midcap Index falls 1,128 points. Volatility jumps nearly 18% as broad-based selling hits the market, with 42 Nifty stocks ending in the red. Banking stocks lead the decline, while IT stocks such as Wipro, LTI, Mindtree and Infosys gain in a weak market. Oil marketing companies IOC, BPCL and HPCL fall up to 6% as crude rises above $100 per barrel. Rupee also hits a record low of 92.35 against the US dollar. Investments in securities market are subject to market risks. Read all the related documents carefully.
CNBC TV 18 tracks the pulse of markets and business in real time, bringing you the stories that shape the economy.
From breaking news to sharp analysis, we deliver insights that help you navigate businesses, markets, and investment opportunities.
Nuvama presents CNBC TV 18 Market Central,
providing sharp market intelligence for wealth creation with a commitment to doing it right.
This is Network 18, and you're watching CNBC TV 18.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's...
In the green, Procter, Johnson & Johnson, Amazon, and Chevron. Some of the laggards include 3M, Cisco, Boeing, Disney, as we mentioned, back below 100. Index itself is down 700 plus. We will get stopped trading with Jim in a moment.
Good evening. Let's do it right with Nuvama presents The Wealth Brief, where today's market moves are decoded to guide your wealth journey. Indian market closes sharply lower on weak global cues, with benchmark indices falling over 1.5%. Sensex drops 1,353 points to 77,566, and Nifty declines 422 points to 24,028 after slipping below 23,700 intraday. Nifty Bank plunges 1,763 points to 50,020, while mid-cap index falls 1,128 points. Volatility jumps nearly 18% as broad-based selling hits the market, with 42 Nifty stocks ending in the red. Banking stocks lead the decline, while IT stocks such as Wipro, LTI, Mindtree and Infosys gain in a weak market. Oil marketing companies IOC, BPCL and HPCL fall up to 6% as crude rises above $100 per barrel. Rupee also hits a record low of 92.35 against the US dollar. Investments in securities market are subject to market risks. Read all the related documents carefully.
How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits, and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC TV 18 and CNBCTV18.com.
Not all the oil shock of the prices have been passed in the past to the consumer. If the Strait of Hormuz is not affected or the oil infrastructure is not attacked, maybe it will maintain it around 85, and that is what it was holding for quite some time. But as soon as there was a threat to Strait of Hormuz, it was blocked. The insurance companies have withdrawn the cover, and there were news of
trading.
Tickets are expensive to live events, and Justice Department went after Live Nation, which owns Ticketmaster, saying that perhaps they have too much power when it comes to it. Well, the Justice Department's kind of no. It looks like the Ticketmaster stays. So they did a settlement. There's some payments that Live Nation has to make, but you can see Live Nation up 9 because there was really a fear that that they'd split this up, and that would be very bad for Live Nation. Live Nation is a very good company, and I've always felt that they do a good job with Ticketmaster. But the reason why tickets are up has nothing to do with Ticketmaster because they can get away with it. I mean, what happened in the country was that live music turned out to be better. People liked it, and Live Nation helps you go there.
Yes.
So Live Nation runs a lot of them. So I thought that it was really a mistake to think that it was Ticketmaster that was causing the problem. It's not like when you go to a Taylor Swift concert, say, boy, if it weren't for Ticketmaster, I would have to pay it. I mean, it's just not like that. Yeah. She can command what she wants to command, and a lot of these artists can command what they want to command, and the idea that, no, it's Ticketmaster that makes you pay, I always thought was
Fanciful?
Yes, fanciful. That's the word.
Now I know your favorite words.
Yeah, fanciful, ill-advised, and suboptimal.
Yes.
Because I learned raises eyebrows. Because when I decided to switch to being a statesman, I realized the way you can stay out of hot water is use those definitive terms.
You should write a book.
Fanciful's great.
Kramer's thesaurus.
Oh my God! I learned one of them, ill-advised, from a guy who is the Spanish. Is the Spanish announcer for the Miami Heat, which is owned, of course, by his boss. And he said, "Listen, when you have a shot and it's taken really badly, you say, oh, that was ill-advised,' instead of saying that was a horrible shot." So I. It was ill-advised for. I think it might have been ill-advised for Novo to make that deal with
Hims.
Yeah.
Yes. What is important to watch this week?
If we go back to that price of oil that we had over the weekend, the one that Brian described as a short squeeze,
right.
That's when you say, you and I'll come in and say, well, what's up? And I'll say, not even Chevron.
Right. Yeah. Positioning on WTI was, I think, net short, which was interesting coming into the week.
That was a mistake.
Yeah.
Well, no one thought the desalinization, and no one thought Israel going after the oil facilities, which is like, that's off limits.
Long week ahead, Jim. Look forward to
We're
tonight.
ready for it.
Mad Money, 6 p.m. Eastern Time, as we try to stabilize here at some levels around 66.50. Don't go anywhere.
Good evening. Let's do it right with Nuvama presents The Wealth Brief, where today's market moves are decoded to guide your wealth journey. Indian market closes sharply lower on weak global cues, with benchmark indices falling over 1.5%. Sensex drops 1,353 points to 77,566, and Nifty declines 422 points to 24,028 after slipping below 23,700 intraday. Nifty Bank plunges 1,763 points to 50,020, while Mid-Cap Index falls 1,128 points. Volatility jumps nearly 18% as broad-based selling hits the market, with 42 Nifty stocks ending in the red. Banking stocks lead the decline, while IT stocks such as Wipro, LTI, Mindtree and Infosys gain in a weak market. Oil marketing companies IOC, BPCL and HPCL fall up to 6% as crude rises above $100 per barrel. Rupee also hits a record low of 92.35 against the US dollar. Investments in securities market are subject to market risks. Read all the related documents carefully.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest-running show on startups and entrepreneurship.
Young Turks at 22. Only on CNBC TV 18 and CNBCTV18.com. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits, and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajaj.
Good Monday morning. Welcome to Squawk on the Street. I'm Sarah Eisen with Carl Quintanilla and Mike Santoli today. We're live at Post 9. David Faber has the day off. We are at the New York Stock Exchange, as always. Stocks are under pressure. Every sector is red right now except for energy, which is holding up the best because oil is surging. WTI crude up 9.5%, 99.49 a barrel. Brent, the international benchmark's above 101 a barrel. It's up 9.5% as well, and that's taking a bite out of the major averages. Consumer discretionary is the worst performing sector right now. Coming up this hour, we'll be all over this huge move in oil and what it means for every part of the market. Plus, Rockefeller's Ruchir Sharma will join us as global equities see big swings on the escalating war in the Middle East. And former Commerce Secretary Gina Raimondo is with us. Big warning about what she calls an AI-driven mass unemployment crisis and just what government is supposed to do about it. But guys, we have to start with the move in oil prices, which is sharp and it is high, pushing Brent above $100 a barrel, now more than $101 a barrel. We're off the highs of the session, but still, it is a big jump, and now a big jump of what we've seen since this war began. So one thing I decided to do is take a look at some of the countries that this hurts the most, the biggest importers of oil, right? U.S. imports a little, but we export a lot too, because we're, mostly self-sufficient on oil. But here's the countries that are not. China is the world's biggest importer of oil. Now, the good news for China is that they stockpile a lot, so they have a lot of reserves. But there are countries like India, South Korea, Japan that are nearly, 90-95% dependent on oil, meaning imports minus exports. They don't produce oil. Also Europe, a lot of European countries, like Germany, for instance, is nearly fully dependent on oil. It's no wonder we see sharp swings in markets like the Kospi, which, yes, was one of the darlings of the market and built up. It's an AI-driven market, not an energy-driven market. Right. So South Korea's economy certainly vulnerable. Places like India, they do price controls so that they don't have out-of-control inflation, but it's certainly a weight on their fiscal position when they have to pay up these higher prices for oil right now.
Yeah, and the market has been pretty careful in trying to hand out the punishment according to who is most hit and also according to the markets that were up the most. It's really interesting how the overnight hours have absorbed a lot of the shock, both on oil and equity prices. So the S&P 500 at the lows yesterday overnight were down more than 2%. Off of Friday's close.
Japan was down 5.5%. Yeah. South Korea was down.
And
6%.
WTI was up at 115 at the highs. So it shows you that you've had this moderating effect when the U.S. hours open. The rest of the world equity markets are down like 8.5% month to date. S&P down like 3.5%. S&P did this morning though get to a minus 5% off the highs pullback. Doesn't really mean a lot in the abstract, but it shows you that the downside has been kind of grudging. I think that every price is a position on the spectrum of probabilities, and the stock market in the U.S. has wanted to remain open to the idea that we get de-escalation, we get relief, we get a short duration crisis, and we can move on from there. Whether we get that or not, unclear, but the market doesn't want to price out the possibility.
For those other countries, the fear is now they're going to have to import oil. They need it at a much higher price. For the American economy, it's more about the U.S. consumer, and gas prices are rising. We know that. If you look at the price of gas across the country, it has risen about 20% since the war began. It's very different in places like California than, say, Kansas, which is the lowest gas price in the country, but we're still watching those prices go up. There it is, the national gas price average, and look, it's $3.48 a gallon right now, according to AAA, 17% increase from when the war began. The concern is around consumer companies, and so some of the research firms are starting to dig into who's most exposed. Wolf Research looked at coverage of some of the big retailers of who has the lowest income customer on average. I don't know exactly how they got this. They claim from the census and from their own research, but Dollar General, for instance, which reports earnings, $60, low income, $60,000 consumer there. So that's where going to be most vulnerable because they'll be affected by the high prices at the pump. They have put Walmart in there, Advanced Auto Parts, Dollar Tree. We'll wait to hear, because we're going to get retailers what the commentary is in some of these reports about sort of real-time behavior changes, if any, from the consumer at some of these retailers because of the higher prices at the pump.
Yeah. We'll get Petco this week and Ulta, Dollar General, I think Dick's as well.
Yes.
And then Lennar Friday too, a little housing data.
The retailers and the travel names have definitely borne the brunt. I think if there's a little bit of a silver lining, it's the levels we're starting from. So gasoline was cheap.
Yep.
Gasoline was cheap relative to its recent history, gasoline was cheap relative to incomes. If you look at the cost of a gallon of gas relative to average hourly earnings for non-supervisory and production workers, it was near a 30-year low before this spike. In other words, you could buy 11 gallons of gas for the average hourly wage going into this. Now,
so maybe it won't have as big of
what
an
it does
impact.
is
Also, we're
push
at the
against
highest
the
level since
idea.
2024. We've been here before recently, and we didn't have a recession
In absolute
then.
terms,
Yeah,
right,
sure.
but incomes have gone up. And so I do think that you're definitely pushing against the run-it-hot economy in the first part of the year, the tax refund bonanza, all that's getting washed out with these headwinds that are coming in. But I don't think that necessarily it means it completely knocks the economy off stride.
Well, Kalshi, I've been looking at the recession odds.
Yep.
You know, this is the prediction markets. We have a partnership with them. And they were 22% on February 28th. Now they've gone up into the 30% or so range. They've jumped, but it's not above 50%, at least if you believe, you know, the people that are betting on this sort of thing.
Yeah, I find this sort of funny because obviously there's market-based ways of saying that we've been betting forever. I mean, stock and bond markets are, you know, nature's original prediction markets, and there's ways to infer what the implied probability of recession is, and that's kind of a nobody knows and probably not likely is really the.
It's fun to throw this one into the mix as well.
False precision, that's what we want.
But it's not like the bond market is pricing in greater chance of recession because we've seen yields go up.
It totally agrees. It
Yeah.
totally agrees with what the other markets are saying, is my point.
Coincident indicator, maybe.
Yeah. Well, now to the broader market, as stocks do get hit hard to start the week. Let's bring in Lori Calvasina, RBC Capital Markets Head of U.S. Equity Strategy. Lori, good to see you.
Thanks for having me.
So I assume and know you've been stress testing your kind of fundamental view and general market take for $100 oil, how long it lasts. What do you get when you do that?
So we have 5 different models that go into our year-end forecast, you know, sort of process or 12-month forward process. And we took one of those models, our valuation and earnings test. This is the easiest one to kind of run through this scenario on. So for the earnings assumptions, I went back to 2022 and 2015-16. 15-16 was flat earnings. 2022 was 5% earnings growth. So we took those 2 numbers for earnings. Then we went to our PE assumption and we baked in 3.6% headline inflation, which our economists have done their own stress tests on $100 oil, and that was one of their outputs for 4Q. So we threw that in. I added in 4.5% on 10-year Treasury yields, honestly, just to put some stress in the model, and I left the Fed flat because I didn't feel like that was really in the zeitgeist at the moment. And what I came up with was basically 6,600 to 6,900 is fair value, which is kind of this range we've been stuck in. So the idea that we may be baking in some stagflationary impact, you can make a reasonable argument that it's there. Now, if you want to take the bear side on my model, that was my strongest model. It had been forecasting over 8,000 over the next 12 months. So you lop 1,000 points off of that. That doesn't feel so good, but it does give you some comfort when you can run through the numbers, at least that we have a decent starting point.
And then in terms of, I guess, more the tactical picture, it's kind of interesting. A lot of commentary this morning saying, well, look, the market doesn't quite look very washed out. You could look at, you know, people are paying up for downside protection. There's no doubt, but maybe not at extremes. You have seen, you know, sort of the market get oversold at an index level, but not the average stock because the market's been trying to escape through rotation. So where does that bring you in terms of whether we've done enough? Because, you know, the PE, forward PE has come down 2 points since October.
Yeah, when we just look at the bottom-up forward PE, we're down to 23 times, and I forget how high we were. I think it was maybe close to 30. It was 25 a few weeks ago. What we saw in 2022 was that version of PE went down to the long-term average, and that helped mark the low and the bottom of the market. That average right now is about 18.5 times, so there's still some wood to chop there. I like the Russell 2000 better as a broader barometer for these kinds of stress periods. If you look at 2022, 2023, and then 2025, the big drawdowns we had those years, small caps started baking in a recession. In 2025, around the tariffs, we got to 12.65 times, and 13 times is recession pricing. Small caps are down to 16.1. The average is 15.2. So again, a little bit more wood to chop. But you look at how quickly small caps are getting hit. That's probably going to be the better barometer to help us gauge a bottom here.
What is the history of oil spikes and shocks like this on corporate earnings? How long does it last? How big of an impact?
It's a great question. You know, I don't have that answer off the top of my head, but we did go back and look at the post-COVID environment, and we found a minus 40% inverse correlation between stocks and the oil price, and that was much more powerful than what I would have thought. I mean, you know, it's not 100% correlation, but it is pretty meaningful. And we did a sector study or an industry group study, and it's funny, the only industry that tends to rise in the post-COVID environment and outperform the market is energy. So you don't get a lot of help. What you're looking at in the rest rest of the market is sort of degrees of underperformance. And so you can find areas, like healthcare, both the pharma side and the healthcare equipment and services side, not really direct impacts to earnings. And you do see some resilience in those stock prices if you look at
But is it all
history.
just near term based on the oil price move, or does it matter how long this lasts?
I think it matters how long it lasts. I will tell you, Sarah, I went to my analysts last Tuesday and Wednesday, and I gave them a survey. And I know they were thrilled with me that I give them a survey in the middle of everything that's going on. But they did all fill it out, and they filled it out pretty fast. I went back to them at the end of the week to reconfirm their results. And we said, gauge the impact to earnings, gauge the impact to direct revenue exposure from the Middle East, and gauge the knock-on effect impacts, from this conflict. And we said specifically assume oil goes to $100 or more for an extended period of time, and this conflict lasts more than 4 weeks. And so those were the parameters we gave them. There were 4 sectors where we basically had most analysts say the impacts would be low on all 3 of those questions: healthcare, financials, utilities, and communication services. So there are some decent pockets of resiliency, even if we start to bake in worst-case scenarios.
Although
here.
financials are the worst sector of the year by a pretty wide margin.
Right.
Do you think the inflation, the tightening conditions, does it leave us vulnerable to a credit event?
Well, if you look at financials, and this is sort of the pickle on this one, they tend to need an inflecting economy, so they need ISM manufacturing to move up. They need consumer confidence to move up. They tend to outperform. We've got the private credit issues weighing on that sector, and, one of the things we've started to write, and I wrote it again in the weekly this week, is we just need, maybe some time to get through this, and not have things, come to a worst-case scenario. But there's just not a lot of transparency in this industry. And I know I'm going to get some hate emails on this, but I have lived my entire career in public markets, right? And so, it's really been a question of what is going to get investors past this. People going on TV and saying, trust me, it's not that bad. That's not going to work. The reality is we probably need time or greater transparency, sunlight, as I call it. But I think that's really been the bigger issue for financials, to be honest.
Yeah. Well, if your analysts are complaining about that task, it implies they're not just plugging it into ChatGPT. They're actually doing the work.
No,
so
and
that's good.
And I will say they didn't complain. I actually had a few people thanking me for doing it, because what it does, it allows us to compare them to one another. So, for example, there was a surprise in this survey, which was that consumer staples and materials were the 2 sectors where we, kicking energy out, we kicked the energy people out. But those were the 2 sectors where they saw the greatest impact. And I had 5 choices for them. They were not in the a lot category. They were in the some a decent amount category. But that's important, right? Because people have wanted to buy defensives. You think of staples as defensive. Maybe it's not as defensive as people might assume.
Yeah, and they didn't perform last week. Lori, great stuff. Thank you.
Thanks for having me.
Appreciate it.
Here's our roadmap for you for the rest of the hour. After the break, we'll talk to one energy expert who says there may be an even more important story in the space than the spike in crude oil prices.
Plus, global market expert Ruchir Sharma will break down the big war-driven swings in international equities.
And if all of that weren't enough, nightmare at the airports. We'll talk about this TSA shortage that's led to hours-long security lines over the weekend as Squawk on the Street continues.
Not all the oil shock of the prices have been passed in the past to the consumers. So to that extent, it gives a comfort to the economy, it gives a comfort to the consumers, and over a period, then it is recovered over a period of time. So as of today, the more worry should be related to supplies rather than the pricing. But of course, it has got impact on the current account deficit, the foreign exchange, etc. If the Strait of Hormuz is not affected or the oil infrastructure is not attacked, maybe it will maintain it around 85, and that is what it was holding for quite some time. But as soon as there was a threat to Strait of Hormuz, it was blocked. The insurance companies have withdrawn the cover, and there were news of attack on the oil infrastructure. It started escalating substantially. To project a worst-case scenario, but I assume that the world cannot absorb that type of shock. So there will be a point where something has to come up.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest-running show on startups and entrepreneurship.
Young Turks at 22. Only on CNBC TV 18 and CNBCTV18.com. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian?
If the Strait of Hormuz is not affected or the oil infrastructure is not attacked, maybe it will maintain it around 85, and that is what it was holding for quite some time. But as soon as there was a threat to Strait of Hormuz, it was blocked. The insurance companies have withdrawn the cover, and there were news of attack on the oil infrastructure. It started escalating substantially. To project a
half full view, at least when it comes to American energy security.
Yeah, well, I think when you look at what's happening right now, you're seeing who's most exposed, and you talked about it at the beginning. You need to have your own energy security, and in the U.S., we've seen natural gas prices not rise as much as they have internationally. Oil prices in the U.S. haven't risen as much as they have internationally, and so the fact that the U.S. actually produces so much oil, I think, is a benefit. I can't imagine where oil prices would be if the U.S. wasn't producing the level of oil that it's producing right now.
Yeah, I mean, it really sort of illustrates the pickle that some parts of Asia are in: Taiwan, South Korea, Japan. What do you think those countries do?
Well, I think obviously they hope that the ships start to move, and that'll eventually will happen. We can get some movement out of the Strait of Hormuz and get some of this oil back online. That'll help alleviate this price spike, and I don't know if normal is the right word, but get us back to a more affordable level of oil prices.
So you do see that happening. Why?
Longer term, I do think that the ships will continue. I mean, look, there's plenty of oil in the world right now. Obviously, the market is pricing in now a lot of supply being taken offline because of what's going on in the Strait of Hormuz. But further down in the year, we will see those oil volumes flow again, and that will get oil prices back into the $70 to $75 range. And which is much better for the global economy, obviously much better for the domestic economy.
Rob, in terms of domestic production, of course, it's a benefit that we're producing at the levels we are. But in terms of incentivizing incremental new production, you would think you'd have to see the forward oil prices and gas prices really hold much more of a bid, right? I mean, at this point, the futures markets are saying this is a pretty short-term, likely to be a short-term supply-driven price move.
Yeah, no, you're exactly right, Mike. You look, the U.S. oil producers probably still remain disciplined. If you look at the futures curve, as you highlight, you still see the futures curve with a 6 handle on it a little further out, maybe even a year from now. And so I think, you're going to have to see the futures curve move up a little bit more before you'll see significant amounts of capital spending reallocated to more oil drilling in the U.S.
So how should you be positioned? Own the American oil companies?
Well, yeah, Sarah. I think owning Exxon and Chevron, who are the largest oil producers in the world, we know here at Tortoise, we think that natural gas actually has got the bigger opportunity. What not a lot of people are paying attention to is the fact that international natural gas prices are up a lot, well more than oil, and what really shows the importance of natural gas going forward into the future. In the U.S., natural gas prices aren't up anywhere close to what the international prices are, and so I think that's an opportunity to be investing in some of the natural gas-related companies. Infrastructure stocks are a great place to be as well.
A lot of discussion about China and some of the purchases of oil that they made, and over really for a while now, sort of arming themselves for any kind of global disruption like the kind we're experiencing. But it doesn't sound like you think that's enough.
Well, China's obviously stockpiled a lot of oil, as you've highlighted, Carl, and so, but oil's still relevant. I guess that's what I need. That's a really important point. Oil is still relevant for economies to run. You need energy, and I think the world's figured that out. And you need oil, and you need natural gas, and so I think we really need, obviously, to get get oil moving out of the Strait of Hormuz so that the world economy can continue to grow, and energy is a really important component to that.
Right. Finally, I wonder if it is extended, Rob, this interruption, and if the straits really don't move for a while, does the conversation change around solar? Do we like revert back to incrementally toward an EV world? Did things like that happen so quickly?
Well, we tried that a few years ago, Carl, and it really wasn't that successful. So I think oil and gas are here to stay. You know, they've represented over 80% of the global energy supply for decades. Tortoise, we don't see that changing. We continue to see oil and natural gas in particular, representing a large portion of the global energy supply for the decades to come, especially with AI, because AI is going to be an important driver of the future economy, and natural gas is going to be an important future driver of the economy in an AI-driven economy.
Rob, appreciate it as always. Rob Thummel over at Tortoise. Thanks so much.
Thank you.
Much more on energy ahead. Goldman Sachs' co-head of global commodity joins us next hour. Plus, the broader market reaction to the war in the Middle East as stocks fall here and volatility spikes. Veteran investor Ruchir Sharma will weigh in. And then surging gas prices, not the only headwind hitting the airlines. More on the chaos across TSA lines across the country. Don't go anywhere.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest-running show on startups and entrepreneurship.
Young Turks at 22. Only on CNBC TV 18 and CNBCTV18.com. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits, and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC TV 18 and CNBCTV18.com.
Not all the oil shock of the prices have been passed in the past to the consumers. So to that extent, it gives a comfort to the economy, it gives a comfort to the consumers, and over a period, then it is recovered over a period of time. So as of today, the more worry should be related to supplies rather than the pricing. But of course, it has got impact on the current account deficit, the foreign exchange, etc. If the Strait of Hormuz is not affected or the oil infrastructure is not attacked, maybe it will maintain it around 85, and that is what it was holding for quite some time. But as soon as there was a threat to Strait of Hormuz, it was blocked. The insurance companies have withdrawn the cover, and there were.
How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits, and chart wizards? Only one show gives you
massive delays as the Department of Homeland Security shutdown impacts TSA staffing. Phil LeBeau is here with that story. Good morning, Phil.
Mike, have you seen the videos? Because if you have, you're looking at them this morning saying, what? People are waiting several hours to get through TSA security? That is the case in different places around the country. We saw this video from yesterday. This is New Orleans. That is a parking lot. That is people waiting to get through security stretched out into the parking lot. And we saw long lines at Houston, a few other airports around the country. Atlanta also had long lines. It's not across the board, but where it's happening, people are saying it is ridiculous. So here's where things stand in terms of lack of TSA staffing causing delays. It depends on the airport. Some airports are fine. Yesterday I flew out of O'Hare, no issues at all. Other people I know were flying out of Newark. They had long lines. Several hour waits are possible. And we're not exaggerating when we say several hours. Houston Hobby on social media was telling people get to the airport 1 to 2 hours ahead of when you're usually supposed to get there. And we are approaching peak spring break travel. Peak spring break travel. Basically, you're going to see busier airports. And as a result, it has a lot of people. This, along with what we're seeing with jet fuel prices, has a lot of people saying, what can we expect in the first quarter from the airlines? And that's why you see the airlines once again trading down anywhere between 5 and 7%. We probably will get some adjustments on Q1 earnings estimates when we start to hear from the CEOs within the next week, week and a half. To what extent remains to be seen. I think largely that's dependent on what happens with jet fuel prices. The Q1 guidance, as you take a look at the airline index, this says it all. This is what's driving how investors are looking at the airline stocks right now, down 16% this year, likely to fall a little bit further if we see an extended period with higher jet fuel prices. Guys, you don't want to miss the interview we have coming up next hour. We're out here in San Diego at the ISTAT conference. This is where all the aircraft leasing companies come together with leaders in the industry. That includes Robin Hayes. He is the CEO of Airbus North America, former CEO of JetBlue. He's been through a few of these jet fuel crises. We'll talk with him about the state of the industry, what he's expecting and what he's seeing and what he's hearing from those who he deals with, because they're selling these aircraft. They have record production. Things should be good for 2026. And now you've got a first quarter that a lot in the industry are questioning what we will be seeing from the airlines. Guys, back to you.
Over the weekend, Phil, I know Mealy has put some numbers on the group as a whole, bringing down net income by 10, looking at jet fuel. I guess, is hedging no longer an exercise as common as it used to be?
It's rare. You used to see hedging, I'd say 20 to 25 years ago, you would see a lot of hedging. Southwest, they were the kings of hedging. You would see it every quarter. They would talk about their hedging position. Rarely do you see that anymore. And largely that's a result of the fact that we've had an extended period of time where we haven't had the huge volatility when it comes to jet fuel prices. I'm not sure that this is going to be enough to get the airlines back into a hedging mode. But those days, I remember them clearly, Carl. Those are gone. You don't see that anymore within the industry.
Okay, thank you, Phil. See you next hour for the interview with Airbus. Time now for a CNBC News update. Pippa Stevens has it for us. Morning, Pippa.
The U.S. is reportedly considering an operation that could see special forces deployed to Iran to secure the country's supply of highly enriched uranium, pivotal in making nuclear bombs. That's according to Axios, which quotes 4 sources. Speaking on Air Force One over the weekend, President Trump said seizing Iran's uranium is, in his words, something we can do later on. President Trump says he won't sign any new laws until the Save America Act is passed. The proposed legislation would overhaul voting regulations and mandate proof of citizenship to register. Voting by non-citizens is illegal and very uncommon. Despite the president's threat, unless he vetoes, bills automatically become law 10 days after Congress passes them, even without the president's signature. And Amazon announced this morning it's expanding markets for its self-driving Zoox unit, planning tests in Dallas and Phoenix. Competitor Waymo is already in Dallas and Phoenix, while Tesla plans to launch in both markets this year. Carl, back to you.
All right, Pippa, thanks so much. After the break, Rockefeller's Ruchir Sharma's with us, breaking down how a prolonged conflict might change the power.
Not all the oil shock of the prices have been passed in the past to the consumers. So to that extent, it gives a comfort to the economy, it gives a comfort to the consumers, and over a period, then it is recovered over a period of time. So as of today, the more worry should be related to supplies rather than the pricing. But of course, it has got impact on the current account deficit, the foreign exchange, etc. if the Strait of Hormuz is not affected or the oil infrastructure is not attacked, maybe that it will maintain it around 85, and that is what it was holding.
Good evening. Thanks for joining us on India Business Hour. I'm Shireen Bhan. The headlines that we're tracking for you this evening. Crude oil prices attempt to recover after briefly touching $120 a barrel as the war in West Asia enters its second week. G7 nations consider releasing emergency oil reserves. EU says member countries have enough energy reserves to cover 3 months of consumption. President Trump downplays the oil price spike, calling it a small price to pay to defeat Iran. After Qatar Energy, Bahrain state-run oil firm declares force majeure after Iran strikes the oil refinery. Fears over gas supply spark a sell-off in shares of GAIL, Petronet LNG and Gujarat Gas. Kepler warns gas supply is the biggest concern for India, and the government is yet to announce any alternate supplies. No immediate plans to hike petrol and diesel prices, say government sources just 2 days after cooking gas prices were hiked. India is also unlikely to contribute from its strategic oil reserves to efforts made by G7 nations. Sources say Indian companies will source additional LPG from US and Canada. No plans to halt exports of petroleum products yet. Stock markets tumble across the world. The Sensex and the Nifty down nearly 2%, 8 lakh crore rupees in market cap. Wiped out. The Indian rupee sinks to a new low against the dollar despite RBI's intervention. Iran's political and military leaders pledge loyalty to Khamenei's son Mujtaba, who's been chosen as the new supreme leader. Fresh airstrikes reverberate across West Asia. Water desalination plants in Iran and Bahrain are under attack. A setback for Novo Nordisk. The Delhi High Court upholds a single-judge bench order that allows Dr. Reddy's to manufacture and export semaglutide to countries without patent protection. Semaglutide is the active pharma ingredient used in weight loss drugs, and its patent protection in India expires later this month. Walmart-owned Flipkart completes the reverse flipping process, changing its domicile from Singapore to India. Government approves the restructuring plan, clearing the decks for the online retailer to go public. Parliament reconvenes for the budget session. Reports suggest opposition parties are planning to move an impeachment motion against the Chief Election Commissioner, Gyanesh Kumar. The continuing big story, the conflict between US, Israel and Iran is the top focus. Fresh strikes and explosions reported across the region as the war in West Asia now into day 10. Missiles continue to rain down on Iran, with oil storage facilities facing the brunt of the attacks today and over the weekend. The Israeli attack appeared to be the first time a civil industrial facility was targeted in the conflict. Separately, and what is more worrying, desalination plants in Iran and Bahrain have also taken a hit. Amidst the turmoil, the Iranian regime has selected the second son of slain Ayatollah Ali Khamenei as the new supreme leader. The 56-year-old Mujtaba Khamenei is a hardline cleric who has never been elected to office, but he is believed to have wielded influence behind the scenes through his ties with the Revolutionary Guards and the supreme leader's office. Top political and military leaders have pledged loyalty to the new supreme leader. Meanwhile, missile sirens continue to ring across Israel. A cluster bomb shrapnel resulted in injuries to civilians in central Israel from an alleged Iranian missile that was intercepted. Israeli media reports that U.S. envoys Steve Witkoff and Jared Kushner have cancelled their scheduled trip to the country. Israel has stepped up attacks in Lebanon with the first drone strike within the city limits of Beirut. Lebanon claims that nearly 400 people have been killed over the last week as Israel targeted hotels in the capital. New York-headquartered NGO Human Rights Watch says it has found evidence that Israel used white phosphorus over residential areas in Lebanon earlier this month. An incendiary substance, white phosphorus, ignites on contact with oxygen and can cause intense fire and burn. The U.S. Embassy in Saudi Arabia has shared an urgent security alert overnight, urging American citizens to leave the country. It's also suspended its consulate services in Adana in southern Turkey and ordered non-essential staff and families to depart. Now, remember, Turkey is a NATO nation and shares a land border with Iran. President Trump has said Iran will be completely decimated if the U.S. sends ground troops. But when asked if the U.S. will deploy boots on the ground, President Trump refused to answer. Take a look.
What are the circumstances where you said it ground troops? How are you thinking about that? I don't even want to talk about it now. I mean, that's, I don't think it's an appropriate question. You know, I'm not going to answer it. Could there be? Possibly, for very good reason. Have to be very good reason. And I would say if we ever did that, they would be so decimated that they wouldn't be able to fight at the ground level.
People have been killed, places have been destroyed, and now they want to ask for a ceasefire again? Well, this doesn't work like this. So there should be a permanent end of the war. And unless we get to that, I think we need to, continue fighting for the sake of our people and our security.
We are going to get to the reports about some of the deaths in just a moment, but just to stay on this topic, would Iran ever agree to a ceasefire to get back to the negotiating table to end all of this military conflict?
Well, they have to explain why they started this aggression before we come to the point to even consider a ceasefire.
Well, that is the latest, and crude oil prices soaring in trade, with Brent crude nearly touching the $120 mark. Prices have cooled since, but remain elevated over the $100 mark. Now, just 4 months ago, in October, Brent crude was hovering around the $60 mark. In fact, prices had even dropped below $60 by middle of December. By the last week of February, prices started going up before the recent conflict began. Brent crude was at $72, and in just 10 days of the war, prices have almost touched $120. Now, here's why prices started to cool towards noon. G7 nations said that they are likely to consider releasing stock from their oil reserves. European Union said that its member countries have energy reserves to cover 3 months of consumption. No decision has been taken just yet on whether they will release from their reserves. Now, the island nation of Bahrain, which sits between borders of Qatar and Saudi Arabia, has seen an Iranian strike hit its biggest oil refinery, Bapco Energies. The company has now announced a force majeure on its group operations on account of the Iranian drone attack. A report in Axios, meanwhile, suggests that the U.S. is unhappy with Israeli attacks on oil depots in Iran. President Trump has also downplayed the need for the U.S. to dip into its own oil reserves. And India, meanwhile, government sources telling us, does not intend to dip into its reserves at this point in time. Take a look.
We've got a lot of oil. Our country has a tremendous amount, and there's a lot of oil out there. That'll get healed very quickly.
Would you consider using the SPR or tapping into the SPR at some point?
Strategic reserve?
Yeah.
Well, I'm the one that built them up. Biden used them so that he could get some extra votes in the election. It turned out it wasn't even him that ran, it was Kamala. And she obviously didn't get any extra votes because we won in an absolute landslide. He shouldn't have used it for that. He used it to I filled it up, and he brought it down to the lowest level it's ever been. We will start at the appropriate time, which is basically a gut instinct. We will start filling up these strategic reserves.
We haven't really seen any kind of official announcements come from the Indian government in terms of where they plan to source the alternative supplies. And it also impacts Europe, by the way. A lot of the Qatari LNG goes into Europe, and there were questions over whether or not they might, again, source from Russia.
And the bigger vulnerability, as is being pointed out, is on gas. And that's the big question at this point in time. Now, India is unlikely to contribute from its oil reserves to efforts by G7 nations. Government sources have ruled out any immediate plans to hike petrol or diesel prices. And this comes just 2 days after cooking gas prices were hiked by 60 rupees per cylinder. Now, India is also looking at US and Canada for additional LPG supplies. Sapna joins us now with more details. Sapna, what is now the government's plan of action, especially when it comes to gas, which is where the real vulnerability